Yes. Now let's begin the next chapter, that is income from capital gains, or simply you can call it as capital gains head of income, which is our fourth head of income. As you remember, we have totally 5 heads of incomes, and already we completed 3 heads of income. By the way, right now this particular capital gains head of income, whatever I'm discussing, I will upload the same chapter once again in the YouTube as full chapter demo, for just for demo purpose, or for somebody who want to watch. Okay, full chapter capital gains. Already those who are writing Jan 26 attempt or September 25 attempt, previous old students, okay, for them also I have uploaded capital gains. Even now whoever is going to write May 26, September 26 and Jan 27 capital gains chapter, right now this video is same for all these 3 attempts. There is no change at all. So now, like by the way, what is the previous year we are discussing right now? Previous year 25-26, am I right? And automatically what is the assessment year applicable for us? Assessment year 26-27. This is the attempt, I mean this is the previous year assessment applicable for May 26, September 26 and Jan 27 exams, right? And one more point I wanted to once again remind you, up to Jan 2027 exams, whatever May 26 syllabus is there, right? The same is applicable for Jan 27 also. What about May 27 attempt onwards? This video will not be useful at all. If any student is thinking of writing CA Inter, okay, in May 2027 exams, don't even watch this video, because entire income tax law itself changed. The new Income Tax Act 2025 is applicable from previous year 26-27 onwards, and the same is going to apply for May 27 examination onwards. The first thing I wanted to clarify. Okay, and now further I wanted to give one important disclaimer. Now this particular capital gains I am discussing completely based on Finance Act 2025 updated. Nothing but this particular capital gains right now that you are going to watch is applicable for May 26, September 26 and Jan 27 student, or if it is CMA, June 26 and December 26 students, it is applicable. Okay. Now what is my sincere request before you continue starting the concept is, you were earlier, because there are some repeaters who already gave attempt in Jan 26 or September 25 or May 25, where you learned capital gains based on Finance Act 2024 number 2. You learned based on Finance Act number 2024 number 2. And trust me, learning capital gains in this particular Finance Act is toughest ever. Toughest. If you remember what I'm trying to tell you, there is something called 23rd July concept. 23rd July 2024 concept. If at all you are transferring the capital asset in 24-25, 23rd July concept and all is applicable, right? Yes or no? So this entire 23rd July 2024 concept is applicable. Lucky, right now we are not discussing that year. For us, what is the previous year applicable? 25-26. The 23rd July concept is there, right? That will not be there for us. At 1 or 2 places only it will come, not at multiple places. So 23rd July 2024 date importance is there, right? That is lost now. When you are writing exam in May 26, September 26, Jan 27, the 23rd July concept is no need to touch. There is only one place, a tax computation place only that concept will come. Only a tax computation place. That too on immovable property, land, building by individual or HUF. Only there it is applicable. Otherwise, the 23rd July concept is irrelevant for us. By the way, if at all you are a first timer writing in May 26, this entire video is irrelevant for you. I mean, this particular introduction video I'm talking about, this intro video. Okay, then I start capital gains topic, right, where I give you section breakup, I discuss, entire in-depth, right? That is same for everybody. This introduction which I'm talking, some 4 or 5 minutes, that is irrelevant for May 26 students who are writing for the first time. So final conclusion is, whether you are a repeater or you are a first timer May 2026, watch this video as if you don't know anything about capital gains. My sincere request is erase everything. erase everything whatever capital gains you know earlier. I will structure the entire this chapter capital gains in your mind layer by layer, layer by layer. Whatever the phobia that you have earlier on capital gains, that it is very complex, that so many unresolved issues are there, I will like close all those issues in your mind. Don't worry at all. So simply speaking, start afresh. Clear? Whether you're a repeater or a fresher, I mean, it doesn't matter. Listen as if you don't know capital gains at all earlier. That's it. Okay, fine. This is just introduction I just wanted to give to this chapter. That's it. So now let's begin the actual discussion of capital gains chapter. The chapter name is capital gains, and if you recollect 45 to 55A, these are the sections that are dealing with capital gains topic. And you know what? Capital gains is one of the toughest topic in the entire income tax. If you ask me which is very tough, capital gains. Like many students, some students, they can get right answers in capital gains chapter even if they do not understand 100% of the provision. Sometimes that's the beauty of this chapter. Even if you understand at a very moderate level, not in depth, still you can you can solve most of the problems comfortably. But if at all the paper wanted to be really tough, this is one chapter where examiner can screw like anything. That too, this chapter, if it comes as a problem directly, a 6 marks or 8 marks problem, most of the students can handle it easily. But if at all MCQs were being asked on this chapter, that's it, very risky. Why? MCQs require in-depth knowledge of each and every provision. Am I right? In-depth knowledge. For example, in the May 25 attempt or Jan 25 attempt, sorry, September 25 attempt or May 25 attempt, in one of this attempt, 6 marks MCQs came from capital gains, directly MCQs. And in descriptive also some 2 or 3 marks adjustment is there. MCQs directly came, 6 marks MCQs. And those MCQs, only a student who have a deeper understanding of capital gains topic can write. So if at all the paper wanted to be tough, what he will do, capital gains, this chapter, this is one of the popular chapter for MCQs. In income tax, in your exams, if at all MCQs has to be asked, they will give first priority to capital gains chapter only for MCQ purpose. So this chapter is very, very important for MCQs. If at all you are thinking to leave this chapter's choice, sorry, it's not possible. Because most of the times this is tested as an MCQ. This chapter, the questions were tested as an MCQ. But trust me, we will be finishing this chapter somewhere less than 10 hours, maybe 8 hours or 7-8 hours only, the classes completely. But I will assure you, 6 to 8 marks, 100% you can solidly get it. 6 to 8 marks you can score. I'm not talking about how much you can attempt, you can score. So listen carefully. Okay, fine. Whether you are a repeater for May 26 attempt or September 26 attempt or Jan 27 attempt, or you are a CMA student June 26 or December 26, earlier you already gave an attempt, for example you are a repeater or you are a fresher, I don't bother about it. You also don't bother about it. Remove all your previous learnings, listen afresh now. Clear? So if the paper has to be really tough, if a tough question has to be asked in capital gains, then you are gone. If at all you don't pay attention to these points clearly, it's very tough for you to understand capital gains. Now let us understand what is the structure of the capital gains chapter. What is the structure? First I told, right, there is a section called 45 which is actually charging section. This section again has multiple subsections, 1A, 2, 5. We have multiple subsections. Whatever we have in the syllabus, I told. In fact, we have a syllabus we have actually section, original section. If you see, 2A is there, 5A is there, but we don't have them in syllabus. 3 is there, subsection 3, subsection 4 is there. We don't have them in our syllabus. What we have within 45 is only these items. Are you clear? 45. Then 46 and 46A. Then there is another section, 2 more sections called 46 and 46A. They talk about 46 talk about liquidation, 46A talk about buyback. If a company is buying back its shares, how to compute capital gains? Okay, first let me give the overview, then I will come back to what is capital gain, what is capital receipt, all that. Then there is one more section called 47, which talks about exemptions, from capital gains, which actually talks about exemptions from capital gains. You know, this section is also called as exceptions to transfer. This section is also called as exceptions to transfer, or what transactions not treated as transfer. That is also a point, that is also conveyed, that can also be conveyed. The following are not transfer, that's actually main theme, but I call them as exemptions. Fine, don't worry, you will understand. 48, which talks about computation mechanism. What is it? Which talks about computation mechanism for non-depreciable capital assets. 48 talks about what? Computation mechanism for non-depreciable capital assets. Then we have 49 and 55, okay, which both of these section collectively talks about cost of acquisition. Both of them collectively talks about cost of acquisition. Then we have a section called 50,50A. Guess what? This we already completed in PGBP chapter, but once again I will touch it here. Okay, depreciable assets capital gains computation. So 50,50A, which talks about depreciable assets capital gains computation. Then we have a section called 51. Right now it is non-operative. This section was removed with effect from 1st April 2014. This section is removed long back. 1st April 2014 it is removed. Then 52, 53 were omitted. We don't have in the syllabus also. 54. Then we have 54 series, which again talks about deductions from, what is it? Deductions from capital gains. Actually, this 54 series is called as exemptions, but I call them as deductions. Why I am calling it as deduction, I will come back to it and then explain. Even in ICA material, they call it as exemption only. Even in the sections, they call it as exemption only. But technically, this don't work like an exemption. This works like a deduction. Okay. Next up, then we have 55A, reference to valuation office. There is a provision called reference to valuation office. This is the structure of the syllabus. Apart from this, we are going to discuss some definitions. Section 2 related some definitions. By the way, there is one more section which is most important in between. 50B, which is actually talking about slump sale. Apart from this, there are a few more sections. 50C, 50CA, 50D, which talks about sale value, Actually, they talk about full value of consideration. The actual word is what? Full value of consideration, but let's call it as at the moment as what? Sale value. Are you clear, all of you? Now this is the section overview I gave. I know right now at this moment you get nothing. Just you understand that, okay, these are all the sections we have, these are all the names to it. Now let's understand one by one. Okay, tell me, just like in PGBP, house property salaries, we understood one point. What we understood? How to compute income. Just tell me how to compute profit or income. How to compute? Very simple. Revenue minus expense is equal to what? Income. Am I right? Is this how an income is computed? In house property, this revenue is called as annual value, this expense is called as deductions, then what you get is house property income. Am I right? In salary, this revenue is called as gross salary minus deduction, then you get income from salary. In PGBP, it's called as turnover minus deduction subject to 40 series disallowances, then you get what is called as profits or gains. Yes or no? Same way, in capital gains also, how capital gain means what? Capital profit. Capital gain is nothing but what? Capital profit. How to compute profit? See, forget it's a capital or is revenue, forget about it. It's a profit, it's a gain. How to compute a gain? Sale value minus cost, am I right, is equal to profit. Am I right or not? For example, I purchased 20 years ago a house. Okay, I purchased 20 years ago one house I purchased. You know, at what price I purchased? No, just 10 lakhs. Those days it is just 10 lakhs. But guess what? Today I am selling it for 4 crore rupee. Today I am selling it for 4 crore rupee. 4 crore minus 10 lakh, 3.9 crore. This is capital gains. Simple. This is what? Capital gains. Simple. Now, it is not as simple as I told here. Now, here, for example, what is the sale price? 4 crore. But guess what? There is something called stamp duty value. There is something called stamp duty value. I'm just telling you how the capital gain structure works. There is something called stamp duty. And guess what? What is the stamp duty value? You know, 5 crore. As per municipality records, stamp duty value is 5 crore. Then under capital gains, sale value is not 4. I will take stamp duty value 5 crore for computation purpose. What I will take? 5 crore I will take for computation purpose. Your profit may be 3.9 crore only really, but under income tax we assume that your profit is 4.9 crore. What is this, sir? What is this twist? That is what we are going to learn in capital gains. Are you clear? All of you? Now, tell me, when this capital gains head of income will apply? First question. When capital gains head of income will apply? Generally, when a particular head of income apply, which section will clarify that? Charging section will clarify. In each head of income, charging section is there. House property 22, PGBP 28, and salaries 1515. These charging sections clearly tell when a particular receipt, when a particular income is covered under this section. Am I right? Covered under that head of income. Charging section clarifies. In capital gains, charging section is very big. Section entire 45 is charging section. But within that, subsection 1 is even most important charging section. Subsection 1 is the main charging section, technically speaking. Actually, we have, so, you know, 1A, subsection 2, subsection 3, subsection 5, 4, 5A. There are so many. But we consider 45 subsection 1 as the main charging section. And what this section says, you know, any profits, what the section says, you know, any profits and gains arising on transfer of capital asset, on transfer of capital asset during the year is chargeable to tax, under capital gains head of income. Look at the charging section clearly. You are transferring, you see the word, they are not using the word selling, they are using the word transferring. Are you clear? You are transferring. What are you doing? Capital asset you are transferring, and you are getting profits, you are getting gains. You are getting either profit or gain on transfer of capital asset. When? During the year. Generally, tell me, for us, you know, what is the previous year applicable? 25, 26. Within this 365 days, on any day if I transfer, capital gains will apply in this year itself. Am I right? In this year itself, capital gains is taxable. Are you getting it? So, any profits arising on transfer of what? Capital asset. Now, what do you mean by transfer? We need to understand. What do you mean by capital asset? First, capital asset. Let's understand what is a capital asset. Remember, this head of income will apply only if the asset transferred is a capital asset. Only if the asset transferred is a capital asset. Now, what do you mean by capital asset? What do you mean by capital asset? One by one we'll understand. By the way, before I even proceed further, you remember basic concept chapter? In the basic concept chapter, we discussed some tax rates concept. Remember? Yes or no? Special incomes some point called special incomes we discussed. Like long-term capital gain under section 112 is taxable at 12.5%. Long-term capital gain under 112A is also taxable at 12.5% in excess of 1,25,000. Remember? Short-term capital gain 111A. Remember? So, which means capital gains are two types, long-term and short-term. It depends upon some concept called holding period or POH, period of holding. There is a concept called POH. We'll come back to that later. Are you clear? You know, what is a long-term capital gain? What is a long-term capital gain? Profit on long-term capital asset. What is a long-term capital gain? It's a profit on long-term capital asset transferred. What is short-term capital gain? It's a profit on short-term capital asset transfer. If the asset transferred is a long-term capital asset, the profit if I get is called as long-term capital gain. If the asset transferred is a short-term capital asset, the profit I get is called a short-term capital gain, which means first I should transfer some capital asset, then I should check whether it's a long-term or short-term, then accordingly long-term gain or short-term gain it is decided, then accordingly rate of tax will be decided. Am I right? Am I right? First of all, why are we learning this entire chapter? Why are we learning this entire chapter? To compute ultimately what we need to compute? To compute either long-term capital gain or to compute either short-term capital gain. Now this long-term capital gains are two types, only two types. Long-term capital gain under section 112, long-term capital gain under section 112A. Short-term capital gains is also two types. Short-term capital gain under section 111A, others. Now, long-term capital gains taxable at 12.5%. This is special income. This is special income. This is special income, whereas this is normal income. Short-term capital gain 111A alone is special income. Remaining is other is normal. Are you clear? Now, long-term capital gain under 112A. What is the tax rate? Same, 12.5% in excess of rupees 1,25,000 rupees. Yes or no? Whereas short-term capital gain tax rate is 20%, straight 20%. Some repeaters, sir, if it is before 23rd July, 15%. If it is on or after 23rd July 2024, it is 20. That breakup is not required right now, because for you the problems will be based on 25-26 financial year. For you transfer date will be 25-26. If the asset is transferred in 25-26, these are the only rates applicable to you. Don't worry at all. Don't worry at all. Are you clear? Next. Again, others, any other short-term capital gain, they are taxable at normal rates. If it is individual, slab rate. If it is company, flat 30%. If it is a partnership firm, flat 30%. If it is LLP, flat 30%. Are you clear? Now, ultimately, we should apply which rate of tax. To know which rate of tax we should apply, we should know it's a long-term capital gain or short-term capital gain. To know whether it's a long-term capital gain or short-term capital gain, we must know what is the asset nature. Is it a long-term capital asset or short-term capital asset? First of all, is it a capital asset or not? First we should know. Correct? Am I right? So, first thing that we need to understand is what? Capital asset means what? Capital asset means what? You know, there is a section called 2 clause 14. There is a section called 2. And most of the definitions are given under section 2 itself, in that clause number 14. So 2 clause 14 talks about capital asset definition. Capital asset is defined under 214. Now there the definition is like this: property of any kind. Capital asset means property of any kind, tangible or intangible, movable or immovable, whether or not related to business. Okay. However, it does not include stock in trade, does not include land not situated in specified area, does not include gold monetization scheme bonds, does not include gold bearer bonds, like that. So many. Does not include personal effects, like that. So much theoretical definition is there. But let's understand it from our day-to-day usage language. Now tell me, first of all, any person in this universe, everyone will have some assets. Everyone will have some assets. Am I right? Am I right? Anyone will have some assets. Especially, I want to talk from business owner point of view. I want to talk about a business owner point of view. Suppose you are doing business. Okay? From your point of view, I want to talk about. From a business owner point of view. If you understand this understanding will be something amazing. Suppose I myself is there. I'm running an academy called Sreshta. First of all, I have so many assets. What are the types of assets that I have? What are the types of assets that I have? First of all, if I see, I have my business assets, business related assets. Business related. There are some assets. Assets means what? Calculator is an asset. Yes or no? Mobile phone is an asset. This iPad is an asset. Everything is an asset. Even AC remote is an asset. Everything is an asset. Asset means what? Some physical item or intangible or tangible. Some item is an asset. So my assets I will divide broadly into business assets, and I will divide the other items into personal assets. Business related, non-business related. Are you clear? Now you remember there is a concept called depreciable asset, non-depreciable assets. Have you heard of it? The question of depreciation, the wordings of depreciation, depreciable, non-depreciable comes only for whom? You know, business people. Are you clear? Now look at business assets is again two types. Business assets are again two types. Okay, fixed assets and stock in trade. Fixed assets and stock in trade. Stock in trade is not a capital asset. Stock in trade is not a capital asset. Why? I purchase furniture. I'm a furniture dealer. I purchase furniture and I sell it. Profit if I get, where it should be taxable? PGBP. So a stock in trade is not a capital asset. That's why even if you see section 214, it clearly says, 2 clause 14, it clearly says capital asset does not include stock in trade. Why? If you are dealing in stock in trade and making profit, that's a business profit. That's not a capital gains. Are you clear? Now, fixed assets again. For a businessman, fixed assets again. These fixed assets are again multiple types. These fixed assets are again two types. Non-depreciable assets. What is it? Non-depreciable assets, depreciable assets. Are you clear? Now, these depreciable assets are called as block of asset. Am I right? Under PGBP, the same depreciable assets are called as block of asset. And we know very well, if an asset is sold from the block, how to compute capital gains we know. Do we understood? Section 50 deals with this. 58 deals with this. If at all you are a business person, business SSE, you are having a business asset, and within the business asset you are having depreciable asset, on that capital gains is computed on 50/50A mechanism. The business owner will also have sometimes non-depreciable assets. Only land is there. Only land is there. For example, okay, for him some land is there, business related land, factory purpose or some other purpose he would have purchased. Only land. That land is non-depreciable asset. That land is what? Non-depreciable asset. Are you clear? The business person, no, he will also invest in stock market out of surplus money. If you look at a company balance sheet, investments will be there. Investments are also capital assets for the company. See, you look at company balance sheet, except cash. Cash is not an asset. Do you agree? Cash is not an asset. Cash is cash, that's it. Bank balance, cash is cash, bank balance is bank balance. Yes or no? Property of any kind. Capital asset definition is what? Kind. It must be in kind. Are you clear? Cash is not a capital asset. Are you clear? Yes or no? Only kinds I am talking about. So the kinds are broadly two types. What kinds? Business kinds and personal kinds. So kinds of business, kinds related to personal. Business kind, stock in trade. Debtor is not a kind. Yes or no? Debtor is not a kind. Loan given is not a kind. Am I right or not? So fixed asset is a kind. Stock in trade is a kind. Yes or no? But stock in trade is not a capital asset because it's specifically mentioned. Now, depreciable assets is a kind, property of a kind, depreciable. Are you clear? Used for business purpose, 50-50 a computation mechanism apply. Non-depreciable assets, 48 computation mechanism will apply. What is the mechanism will apply? 48. There is a section called 48. We are going to discuss. That mechanism will apply. Do you understand? Do you understand? Now coming to personal assets. Now coming to personal assets. These personal assets, no, for normal, I am talking about non-business. I'm not talking about business assets. I am talking about personal assets. Personal assets are broadly classified into two types: movable assets, immovable assets. That's it. What are they? Movable assets, immovable assets. Personal, if at all assets are personal in nature. Personal means what? Not used for business. If at all you are using it for business, no, we don't discriminate between movable, immovable. We discriminate depreciable, non-depreciable. Are you clear? They both are capital assets only. Now here personal, movable, immovable. Immovable, they are capital assets always. Immovable, they are always capital assets. And what is the computation format applicable? 48. What is the computation format applicable? 48. You know what? How should I compute capital gains? For all depreciable assets, you should compute capital gains as per 50. You should compute capital gains as per 50A. For remaining assets which are not depreciable, for remaining assets, you should compute capital gains as per 48. That's the mechanism. Are you clear? That's why 48, which talks predominantly about non-depreciable assets. Now, for a personal property is not a depreciable. Under income tax law, depreciable means what? Under income tax law, depreciable means what? Something you are showing it as a part of fixed assets in the business and claiming depreciation on that. That is depreciable. Suppose I have my house, residential house I have, personal. Logically, house is a depreciating asset. Am I right? House is a depreciating asset, building, generally. But am I using it for my business purpose? Am I using my house for my business? Can I claim depreciation under income tax law? Will my house, my personal house, will it come under my Sreshta block of asset? No, it will not. Are you clear? Therefore, income tax law, what it says, you know, it's a non-depreciable asset. That's a non-depreciable building. So if my personal house I am selling, 48 will apply. Suppose I am having Sreshta, I am having staff quarters. That is a depreciable asset in my books of accounts as a part of block. There also I am selling building only. 50 mechanism will apply. Do you understand that? Do you understand that? Now, movable asset. Other type of personal asset is what? Movable asset. In this movable asset, again there are two types. There are some movable assets, movable assets, no? Some of them are not capital assets, some of them are capital assets. Some of them are not capital asset, some of them are capital asset. For example, jewelry I have, it's a capital asset. It's a capital asset, jewelry. I have archaeological collections, it's a capital asset. I'm having paintings, costly paintings. I have drawings. I have sculptures. I have any work of art. I have any work of art. Some art related, jewelry related, all this. This is called as what? Capital asset. Suppose, sir, I have personal, that too movable. I have in my home TV, sir. Fantastic. 5 lakhs TV that is. It's like advanced OLED TV, 85, 86 inch TV. Advanced OLED. 5 lakhs. Not a capital asset. I have in home, sir, cart is there. The cart is of Balarsha, teak cart. Okay, Balarsha. That's a very costly teak. Okay, that cart itself is costing 5 lakhs, sir. Not a capital asset. Carts, not a capital asset. Cart, I'm talking about cart. Okay, interior is there, sir, in my home. Okay, interiors are there. Woodwork is there. Costliest woodwork. Fine, costly, acrylic, advanced woodwork. Personal effect. You know, woodwork in your home, that's not a capital asset. Sir, I have a car, sir. Mercedes Benz. I have a car. Not a capital asset. That is not a capital asset. See, that is not even depreciable. That's my personal car, for example. I'm using it for personal purpose, not for business. If at all I'm using it for my business purpose, then automatically it will come under block of asset. Automatically section 50 computation format will apply. Correct? Yes or no? PGBP, we already discussed this point. But my personal car, sir, personal car comes under movable asset. That to personal asset, which is not a capital asset. So if I have any personal assets, only these 6 items will be treated as what? Capital assets. Only these 6 items are treated as capital assets. What are the 6 items which are movable and personal, treated as capital asset? Jewelry, drawings, painting, sculpture, archaeological collection, any work of art. Only these movable assets are treated as capital assets, even though I am using it for my personal purpose. In my home, dining table, car, mobile, everything which are used for my personal purpose, they are not capital. Sir, what about immovable property, land, building, which are used by me for personal purposes? They are always capital assets. They are always capital assets. Are you clear? Now you see, I explained you. Is there a logic behind it? Logically it is there also. Yes or no? Correct? Huh? Yes. Now let's look at the official definition of capital asset and then now sync with it. Are you clear? What is the meaning of capital asset? A capital asset mean, what is a capital asset? And if you see, under income tax law, the definitions, not only income tax, anywhere if you see, the definitions are 2 types of definitions. The definitions are 2 types. I have to tell this in the very first chapter, but I intentionally withhold it. Like I didn't tell it. Now I'm going to tell it. Okay. Definitions are 2 types. The definitions are broadly 2 types. One is inclusive definitions and another one exhaustive definitions. Exhaustive. Suppose if the definition term, it starts with the word means, it's exhaustive. If the definition starts with the word includes, for example, there is a section called 2 clause 24 which defines income under income tax law. What is an income? That's an includes. Income includes, they say, in the basic concept chapter you will find it. Income includes. Are you clear? Income is an inclusive definition. Includes means what? Inclusive definition. Means what? You can't list out everything. When you cannot list out everything, but you want to list out few things that you know, list out. Okay? Not only that, any other way also income only. So income is an inclusive definition. In capital gains, 2 clause 47, transfer is defined. That's an inclusive definition. Whereas capital asset means, the definition, the section is very clear. Capital asset, they defined exhaustively. Exhaustive means what? Exhaustive means what? Here whatever they say capital asset, only they are capital asset, not anything else. Whatever they below mentioned, no, whatever they defined as capital asset, only that is capital asset, nothing else. Are you clear? Yes or no? Now here they specifically did not cover personal car, personal movable properties. They did not cover. So since they were not covered in capital asset definition, I will not call them as capital assets. Now look at it. So capital asset means property of any kind. Cash is not a capital asset. Debtors is not a capital asset. Loans given by me is not a capital asset. Only kind. Kind means what? It may be immovable property, or it may be movable property. It may be tangible, it may be intangible, it may be business related, it may be non-business related. Yes or no? Even it may be stock in trade. Anything it can be. Kind. Property of any kind. Held by SSE. Whether or not related to business or profession, maybe it related to your business or maybe not related to business, every kind is a capital asset. Every kind is a capital asset. Are you clear? However, it does not include any stock in trade. What is it? Any stock in trade. Stock in trade is not a capital asset. Personal effects. What is it? Personal effects. Nothing but they are movable assets used for personal purpose. Are you clear? Suppose I'm having a phone, movable. I'm using it for my personal purpose. It's not a capital asset. Hello, it's not a capital asset. Dining table in my home, movable, personal purpose I'm using, not a capital asset. Are you clear? Remember, movable plus personal, that is only not covered under capital asset definition. Sir, that's a movable item, sir, but I am using it for business purpose, sir. Then this exception will not apply. Am I right? Sir, I'm using a mobile phone, sir. Same mobile phone, sir, but business asset, sir. It's for business purpose. This is a capital asset. So the same mobile I'm using for my personal purpose, sir. Not a capital asset. Easy or not? Yes or no? So movable personal assets are not capital assets. But movable and business assets, they're always capital asset because they come within the purview of block of asset, and if they come within the purview of block of asset, we know already how to compute capital gains or capital loss. Yes or no? Clear? Now again, personal effects definition is given. Personal effect means what? Those which are movable, and are also used for personal purpose. However, the following personal effects, the following are also personal only, but they are again treated as capital assets. What are they? Jewelry, archaeological collection, drawing. Yes or no? Yes or no? Jewelry, archaeological collection, drawing, painting, sculpture, any work of art. Any work of art. There are so many works of art. Thread paintings. Yes or no? With thread they do this entire image, thread image creation, nail art. So many were there. So many arts were there. Yes or no? So many arts. Work of art. Are you clear? All these whatever I highlighted, no exceptional 6 items. Suppose no, in my home jewelry is there. For example, my wife is wearing jewelry. It's a capital asset to me. Sir, it's personal movable, no? Yeah, specifically they covered exception under personal effect again. See, what are they saying here? Capital asset do not include personal effect. If personal effect do not include something, so see, if something is not a personal effect, automatically it's a capital asset. Personal effect is not a capital asset. Am I right? Remaining are capital assets. I am saying you gold ring is not a personal effect. I am saying you automatically gold ring becomes capital asset. Exactly. Are you clear? So now look at, so personal effect, jewelry, archaeological collection, drawing, painting, sculpture, work of art. They're all these 6 items. We again call them as what? Capital assets. These 6 items are again called as capital assets. Fine. Again, let's come back. Capital asset means property of any kind held by SSE, whether or not it is related to business. You may use it for business or profession, you may not use it for business or profession. Any kind is a capital asset. However, it does not include stock in trade used in business. Personal effect, which are movable and personal in nature, however, excluding these personal items, remaining all other personal items, they are not capital assets. Your TV, your dining table, your washing machine, your refrigerator, your entire kitchen equipment, your stove, gas stove, nothing in your home, whatever you are using for personal purpose, movable, they are not at all capital. However, high value items, jewelry, painting, sculpture, drawing, any work of art, archaeological collection, they are again personal effect. They are again capital assets. Are you clear? Next, rural agricultural land. What is it? Rural agricultural land. Actually, in the income tax law, they won't use the word rural land. I told you in basic concepts also, what they will say? Land not situated in specified area. What is it actually called as? A land not situated in specified. Specified means what? Urban area. If it is not situated in specified area, means it's a rural area. Are you clear? Specified area means what? Suppose if my land is there in a particular town or municipality where minimum population is 10,000, then it's a specified area land, it's a capital asset. Or if my land is away out of the town but within 2 kilometers and the town population is more than 10,000, then again it's a specified area land. Suppose my land is beyond 2 kilometers but up to 6 kilometers, but the town population is minimum 1 lakh, then again it's a capital asset. If my land is beyond 6 kilometers but up to 8 kilometers, when it will become capital asset? When it will become urban land? If the town population is at least 10 lakh. If the town population is 10 lakh, any land up to 8 kilometers is a capital asset. If the town population is 1 lakh, from the limits of the town, any land up to 6 kilometers is a capital asset. And if the town population is just 10,000, only up to 2 kilometers the land is treated as personal. If the town population is less than 10,000, the land even in the town is not a capital asset, is not an urban land. Are you clear? Easy or not? Yes or no? So next, so rural agricultural land is not a capital asset. Certificates, what is it? Certificates under gold monetization scheme, they are not capital assets. Certificates under gold monetization scheme is not a capital asset. Right now gold monetization scheme is not that popular, again because sometimes scheme will be active, sometimes scheme will be passive, it will not be. But if at all you are getting any certificates under gold monetization scheme, are you clear? That is not a capital asset. Now regarding gold, I have a in-depth discussion later, because we have something called regarding gold, physical gold I need to discuss, gold monetization scheme certificates, right now I told, right, that I need to discuss. SGB's taxation, sovereign gold fund I call it as, that we need to discuss. EGR taxation I need to discuss. Then I need to discuss about gold ETFs taxation. Remember in CA Inter all this is there in our syllabus. All this is there in our syllabus. Gold ETFs very recently included in our syllabus. They did not include directly ETFs, but indirectly through one provision they included. By the way, most importantly, I already told earlier, in your printed book, here highly volatile assets is there. You see, just open your printed book once, 103 page, here listed securities bracket other than securities is there, right? Please strike it. Don't strike it fully. Strike, simple strike. Why? You should read that and you should know that it is not there now. Earlier it is there, but with effect from 23rd July it is not there. Are you clear? So intentionally you keep it and then strike it, which means now it is not there. Are you clear? From 23rd July, even the students who are writing Jan 26 exams, right, for them also this is not there. Are you clear? Now that's it. So in the printed book the strike is missing, please put that strike. In the printed book hard copy, if its strike is already there, no problem. But for some books, one lot of the books, strike is missing. Please put the strike. Are you clear? Yes. Now next, certificates under gold monetization scheme. Do you understand? Okay, what are these certificates under gold monetization scheme? Slowly, one after one I'll talk. Now tell me, capital asset means what? Property of any kind, tangible, intangible, movable, immovable, whether or not related to business, any kind, related to business or not related to business, or doesn't matter. Every kind is a capital asset. However, stock in trade is not a capital asset. Rural agriculture land is not a capital asset. Gold monetization scheme certificates, not a capital asset. Personal effects, not a capital asset. Personal effect means what? Movable and held for personal use. They are not a capital assets. However, 6 personal assets are still treated as capital assets. Jewelry, archaeological collection, painting, drawing, sculpture, any work of art. Am I right? Yes or no? Yes. Now do you understand capital asset meaning? Now let's go little more in depth. Capital asset means, first one, property of any kind. Shares, securities, debentures, everything comes under kind only. Yes or no? Second one, securities held by FII. What is it? Securities held by FII. What are FIIs? Foreign institutional investors. So first of all, in a stock market, there are typically 2 types of investors. Typically, okay? Institutional investors, retail investors. What are they? Retail investors. Suppose you and me, we have a demat account and we are buying shares regularly. We are buying shares. We all come under retail investor. If a bank is having a demat account, bank is having demat and bank is buying securities for their own purpose. A mutual fund company buying securities, we call them as what? Institutional investor. What is it we call them as? Institutional investor. Now look at here, what is exception? Capital asset means securities held by foreign institutional investors and investment fund. Securities held by whom? FIIs or investment fund. Investment fund means alternate investment fund. There is something called AIF taxation under 115UB, which is inserted right now in Finance Act 2025 for you in CA into this 115BAC 115UB taxation is not there. Just the clarification here, it is there. Are you clear? 115UB taxation we do not have in CA into. What is it they are saying? Securities held by whom? Securities held by whom? FIIs is always a capital asset. Securities held by investment fund as referred under 115UB, it is always a capital asset. Sir, securities held by FII is a capital asset, huh? Yes, it is a capital asset. Now, stock in trade is not a capital asset, right? Stock in trade is not a capital asset, right? Look at the bracket. Other than securities held by FIIs and IF also add one, investment fund. IF means what? This point shortcut is what? IF means what? Investment fund. Now, any stock in trade. By the way, stock in trade is not a capital asset. Am I right? Stock in trade is not a capital asset other than securities held by FIIs and IFs. Are you clear? Now, let's take one example. Let's take, I am a trader in stock market. I am a trader in stock market and I have a demat account for trading. Specifically, I have a demat account for trading. Okay, and I have a separate demat account for investing. I have a separate, same person. Okay, and one demat account exclusively for trading, another demat account is exclusively for investing. In this demat account, any shares and securities, bonds, anything, whatever I purchase, I'm a retail investor, by the way. I'm a retail investor, by the way. Whatever shares, securities, bonds, if I'm purchasing, they are capital assets. Because here I am purchasing for investment purpose. I am not buying and selling as a stock in trade. Are you clear? Stock in trade. Suppose in my trading account I am purchasing shares. I am doing intraday. I am doing interday, like buy today, sell tomorrow. So many transactions I am doing. Okay. So I am buying securities with an intention to sell immediately. Are you clear? In the short run, make a profit like that. Now here, whatever shares and securities, whatever bonds I am having, whatever units I am purchasing, mutual fund units, anything, whatever I am purchasing, these are all, we call them as what? Stock in trade, which is not a capital asset. Am I right? Until now, the same example, let's look from a foreign institutional investor point of view. Now, a foreign institutional investor, they have a demat account. They have a demat account held for trading only. They're doing trading only. Primarily, they're doing what? Trading. It may be FII or it may be investment fund. It may be FII or it may be investment fund. They're doing trading only. So, they buy shares and securities, bonds, all items they will be buying and selling it. It's like a trading for them. But for them, it's always capital asset. It's always capital assets. Under section 2 subsection 14, 2 clause 14, for institutional investors and investment funds, that which institutional, foreign institutional investors or investment funds, if they are holding, if they are buying any securities, even though their intention is trading, maybe in their books of accounts they show it as stock in trade, in their books of accounts they are showing it as inventory, I am not bothered. Under income tax I call them as capital asset. That's why this exception is there. Look at, securities held by FII, security held by FII, securities held by FII is a capital asset. First they said that, very good, okay, fine, okay, maybe capital asset. Stock in trade is not a capital asset. Arey sir, a foreign institutional investor, no, he is buying shares, sir, for stock in trade purpose. Now tell me, other than securities held by FII, IF, remaining people, stock in trade is not a capital asset, which means for FIIs and IF, For FII and investment fund, even though securities are held as a stock in trade, it is still capital asset. That's why this point is specifically given separately, separate line item. Otherwise, no, why they should define like this? They could have added here, no? They could have added here. So, securities held by foreign institutional investors. Remember, it's foreign, not domestic. Suppose if securities are purchased by domestic institutional investors for trading purpose, for them it is a stock in trade. Stock in trade is a stock in trade, and on stock in trade, profit or loss is accessible under PGBP head of income only. Are you clear? All of you. Next. Then third capital asset. What is third item capital asset? Any ULIP. What is it? Any ULIP to which exemption does not apply. Tell me, I purchased insurance policy. I purchased insurance policy. First of all, insurance policy is not an asset. Am I right? Is it a property? Is insurance a property? Not at all. It's not a share. It's not a security. What is insurance? Insurance is an actionable claim. What is insurance? Insurance is an actionable claim. If tomorrow some uncertainty happened, then only I will get the amount, lump sum, maturity, yes or no? And if they don't give me, I can enforce it in the court of law. It's an actionable claim. And if you remember GST, goods definition does not include. Exactly. Goods definition does not include actionable. Actionable claims are not at all a kind. Actionable claims are, first of all, they don't come within the definition of kind. Are you clear? Now, capital asset means it must be kind. So, insurance policy is basically not a kind. However, ULIP. What is ULIP? It's a mutual fund plus insurance combination. Unit linked insurance policy. Capital asset defines. Income Tax Act law added that within the definition of capital asset explicitly. If at all this point is not added, ULIP will not become a capital asset at all. Because they specifically mentioned ULIP here, it became now capital asset. If at all ULIP is not mentioned here, it won't come within the kind definition. It won't come within the kind definition. So automatically ULIP will never become a capital asset. But right now, income tax law specifically added ULIP, to which exemption under 1010D does not apply. Nothing but taxable ULIPs. We call them as what? Taxable ULIPs. What is a taxable ULIP? You know, every year you are paying a premium of 2.5 lakh and above. You are paying more than 2.5 lakh premium. You are paying ULIP. That is capital asset. Fine. ULIP taxation, we don't have it in our syllabus. In CA Inter, we don't have ULIP taxation in syllabus. We have it in CA Final. Until now, clear. Until now, clear. So, capital asset means what? Property of any kind. You call tangible, intangible, movable, immovable, related to business, not related to business, doesn't matter. It's a capital asset. Securities held by foreign institutional investors. Securities held by investment funds. They're always capital assets. ULIPs, for which exemption under 10 clause 10D does not apply. By the way, we have 1010D section in income from other sources. We'll discuss there. Okay, 1010D does not apply. They are taxable ULIPs and they are capital assets. And following are not capital asset. Stock in trade is not a capital asset. However, securities held by FII and IF, even though they are stock in trade in their books of accounts, but for income tax purpose, they are always capital assets. 2. Personal effects are not capital assets. However, the following 6 items are always capital assets. 3. Rural agricultural land is not a capital asset. Last item, 7th item, you know, gold certificates under gold monetization scheme is not a capital asset. And apart from that, there are 3 more types of bonds which are also not capital asset. See, basically bonds and all comes under kind only. Yes or no? Everything comes under kind. Rural land is a kind. Certificate is a kind. Yes or no? But they specifically excluded. They specifically excluded to promote these bonds. To promote these bonds, we need to give tax exemption. Otherwise, people will not buy. So they exempted them so that people will buy. Are you clear? Specified gold bonds, special bearer bonds, gold deposit bonds, all this. Later, now it is certificates under gold monetization. But remember here, sovereign gold bond is not covered in exception. Sovereign gold bond is not covered in exception. These are all exceptions to capital asset, right? Means these are not capital assets, right? These are not capital asset. SGB, there is another bond, sovereign gold bond, sovereign gold bond, sovereign gold bond. Sovereign is different, sovereign is different. So sovereign gold bond. ETFs, gold ETFs, they are not covered in exception. Are you clear? Electronic gold receipt, they are not covered here. All digital gold, not covered here. You open Paytm app, you open PhonePe app, digital gold you can buy. Digital gold you can buy. Are you clear? They are not treated as, I mean, they are not covered under exception. They are all capital assets. Are you clear? Now again, property of any kind, I said, right? Property of any kind, whether you held it virtually or really, it doesn't matter. Tangible, intangible, movable, immovable, virtual, digital or physical, it doesn't matter. Any kind is a property. Are you clear? All of you. That's it. With this, capital asset definition is over. Okay. Now, I told right earlier, there is something called, long-term capital gain. What is it? Long-term capital gain, short-term capital gain. Like, what is it? If the asset sold by you is a long-term capital asset, then the gain is called as long-term capital asset. If the asset sold by you is a short-term capital asset, then the gain is called as short-term. Right now, we understood what is a capital asset. Now we need to understand what is a long-term capital asset, what is a short-term capital asset. Short-term capital asset is defined under short-term capital asset is defined under 2 clause 42A. Long-term capital is defined under 2 clause 29A. And you know what? What is a long-term capital asset? The section is so simple, which is not a short-term capital asset. What is a long-term capital asset? Which is not a short-term capital asset. If it is not a short-term asset, then it's a long-term asset. So which means long-term asset is a residuary. If it is not a short-term, then it's a long-term. Nowhere it is defined, this is long-term. They are saying, is it not a short-term? Yes, it is not a short-term. Then it's a long-term. That's it. Simple. Now, what is short-term capital asset? What is a short-term capital asset? Tell me, long-term, short-term means it defines about period. It defines about time period. Am I right? It defines about some time period. Correct? Yes. Whether a capital asset is a long-term or short-term depends on holding period. The concept is called as holding period, also called as POH, period of holding. What do you mean by that? Suppose there is one criteria. For example, there is one criteria below, exceeding 12 months is a long term. Okay, exceeding 12 months is a long term, less than or equal to 12 months is a short term capital asset. I'll tell you what is it. I'm just telling you example. 12 months. Suppose I bought this phone 12 months back. Okay, or else take this ring. Ring is a capital asset, right? Jewelry is a capital asset, right? Even though I'm using it for my personal purpose, yes or no? Jewelry is a capital asset, right? Yes or no? The ring, okay, if it is purchased by me, actually for ring, 24 months logic is applicable. Why? Again, you will, some students might say, sir, it is 24 months, no? Yeah. There are two logics, 12 months logic, 24 months logic. For some assets, 12 months logic will apply. For some assets, 24 months logic will apply. Are you clear? Suppose this ring is there. Okay, this ring is there. I purchased it 2 years before, for example. Okay, today, for example, let us assume the date is, 19th January 2026. The date is 19th January 2026. Whereas I purchased this ring in 2024. I purchased this ring in, let us assume 17th January 2024 I purchased it. Now, what is the gap here? 17th January 2024 to 16th January 2025, 12 months. 16th January 2026, 24 months. 19th January is after 24 months. Now my ring became long term. Now if I sell this ring, earlier I bought this for, let us assume 40,000. Now I am selling this for 60,000. 20,000 rupees is called as long term capital gain. That's it. Are you clear? So what is period of holding? Period of holding means date of sale, date of transfer. Suppose I am transferring this ring to somebody right now. I am transferring to somebody. So when you transfer, minus date of acquisition. What is it called as? Date of acquisition, date of transfer minus date of acquisition. If the period is more than 24 months or more than 12 months, as the case may be, it's a long-term capital. Sorry, it's a long-term capital asset. If the holding is less than or equal to 24 months or less than or equal to 12 months, up to 24 months, up to 12 months, it's a short-term capital asset. And if you transfer long-term capital asset and get a long-term capital gain, 112 section tax rate 12.5% will apply. If it's a short-term capital asset and applicable for short-term capital gain, then either normal rate of tax or 111 depending upon applicability, that rate will apply. Do you understand? So, which means now we understood what is a capital asset. Now we need to understand what is a long-term capital asset, what is a short-term capital asset. Clear? Look at very simple, straight. Okay. By the way, any asset is transferred on or after 23rd. Right now I told, right, 12 months to 24 months logic is there, right? Okay. This logic is applicable from 23rd July 2024 onwards. Right now this date is irrelevant for May 26 students all that month. Okay. I just kept it because in the CA Institute book also the wordings are given, but right now you don't have to worry, because for you the problems will be generally given on 25-26. For you 99% transfer date in the problem will be during 25-26 years. 99%. Sometimes transfer date will be old year. That time I will tell you, don't worry. That time how to decide I will tell you, nothing to worry. So right now transfer year is 25-26. Okay. So asset transferred on or after 23rd July means obviously for you problems will be tested based on 25-26 only. Are you clear? Now what is short-term capital asset? What is long-term capital asset? Remember, types of capital asset based on period of holding. Now short-term capital asset means, first of all, long-term means what? A capital asset which is not a short-term. What is short-term? It is held by SSE for not more than 24 months. Not more than means what? Up to 24 months, up to 12 months. Correct? If an asset is held by SSE means what? I am owning it. I am holding it. It's in my control. Up to 24 months or up to 12 months, as the case may be, preceding date of transfer. Date on which you transferred, ignore this date. From date on which you acquire, acquisition date count. Transfer date don't count. Before transfer date until this gap. If this gap is up to 24 months, if the gap is up to 12 months, then it's a short-term capital asset. Otherwise, it's a long-term capital asset. Now, sir, you said 24 months, 12 months. Like what exactly? For 4 types of assets. Look at. For 4 types of assets. I simply named them as highly volatile assets. Generally, I named them as highly volatile. This word highly volatile word will not be there, and I will also recommend, now not required. Earlier, I used this. Okay, just simply as a shortcut, I mentioned it. Let us not name it as highly volatile. Let's name it normally. Okay. For these 4 types of assets, what are they? By the way, these 4 assets. Now, what is the criteria? 12 months. 12 months is the criteria. Let's keep that pending. Any other asset. What is it? Any other capital asset. For example, I want to talk about my gold ring. What I want to talk about my gold ring. Is gold ring listed above? Is jewelry listed above? Jewelry. For example, I am selling jewelry. I am talking about jewelry. Jewelry is not a listed security. Jewelry is not a equity oriented fund. Jewelry is not a unit trust of India. Jewelry is not a zero coupon. So, if I am selling jewelry, is it long term or short term? What is the criteria applicable? 24 months criteria. If the holding period of the jewelry is up to 24 months, if the holding period of jewelry is up to 24 months, if it is 24 months, it's a short term capital asset. If it is more than 24 months, it's a long term capital asset. Are you clear? Now, I told you something called sovereign gold bonds. Sovereign gold bonds, SGB. It's not a zero coupon bond. It's not a unit trust of India. It's not an equity oriented fund. It's not a listed security also. It's not a listed security also. It's not a listed security. Sovereign gold bond. Now tell me, 12 months or 24 months, which criteria applicable? Which criteria applicable? 12 months criteria or 24? 24. If the bond I purchased on one date and I am selling it the bond again subsequently later, the gap is up to 24 months. It's a short term asset. Otherwise, it's a long term asset. Am I right? Suppose I have my house property. I have my house property. Look at carefully. I have my house property. My house property is not coming under these four assets. My house property is not coming under these four assets. Automatically, what is the criteria? 24 months. Are you clear? I have my personal car. I have my personal car. I purchased it. I have my personal car. Is it coming under any of these four? First of all, I don't check it. Personal car is not a capital asset. Yes, very good. What if my car is a business car? If it is my business car, if it is my business related car, I will apply this logic and this automatically 24 months. Based on 24 months logic, I will decide. But guess what? For depreciable assets which are forming part of block, no, I don't even have to check this. I don't even have to check this. Why? Remember PGBP? Remember PGBP? I didn't bring the discussion of long-term capital gain there. If at all part of a block is sold at a price higher than gross block value, remember, gross block value means what? Opening plus additions. Gross block. Part of a block you sold and the value opening plus addition 10 lakh you got, and the part of a block you sold for 15 lakh. Ayyo, block value will come to zero. That extra 5 lakhs I told you, it's always short-term capital gain. So directly there, gain itself is short-term capital gain or short-term capital loss. Remember I told you? So depreciable asset, even though the asset may be long-term, or short-term, I don't bother. The gain is always short-term. I will tell you. Don't worry. I will tell you how it is. Okay. Are you clear until now? Yes or no? Now, what are all? House property. Do you understand house property? Land. Am I right? Land. Painting, sculpture, work of art, archaeological collection. Yes or no? All these comes under bullion. Bullion means what? Gold, biscuits, all that. So all these items will come under 24 months criteria. Do you understand? Debentures, unlisted securities. What are they? Unlisted securities. Unlisted shares, unlisted preference shares, unlisted bonds, all comes under this 24 months logic. Do you agree? Now what will come under 12 months logic? What will come under 12 months logic? We'll take a small break and come back and discuss this. Okay, that's it. Are you confident until now? Yeah. Now let's understand the same period of holding concept. Okay. Now how to decide whether an asset is a long term or short term, whether a capital asset is a long term or short term. It depends upon period of holding by the transferor preceding the date of transfer. So before the transfer, as a seller or a transferor, how many months I am holding it? Generally 24 months is the criteria. If at all you are holding capital asset up to 24 months, no, I mean it's a short term. If at all you are holding it for more than 24 months, it's a long term. Now for few assets, for 4 types of assets, for 4 types of capital assets, the criteria is 12 months. What are they? Listed securities. Listed securities. What do you mean by security? Security is defined under Securities Contract Regulation Act. The same definition will apply. Security means what? Securities Contract Regulation Act. What are they? They may be shares, they may be bonds, they may be units. They may be units. You may call them as shares, you may call them as bonds, you may call them as units. Anything that comes within the definition of security, they all come under security purview. Are you clear? Again, the shares, equity shares, preference shares. Are you clear? Now, so all these items come within the definition of securities. Now tell me, right now we are discussing 12 months logic. 12 months logic means for which security is applicable? Listed securities. Only listed securities. And if you see in bracket, other than units word is there, that I striked off. Once upon a time within bracket other than units is there, but now other than units word not there. Are you clear? Which means right now listed units, nothing but listed units, listed shares, listed bonds, listed debentures, yes or no? Listed debentures, here you can add even the word debenture, listed debentures, listed units, everything is a 12 months criteria. If at all they are holding for more than 12 months, it's a long-term capital asset. If at all you are holding up to 12 months, it's a short-term capital asset. Listed units means what, sir? Listed mutual funds, nothing but. Listed mutual funds. You might have heard, no? Like SIP, mutual fund, ETF, all these, if at all they are listed, no? They are called as listed security. Automatically, if they are holding for more than 12 months, it's a long-term capital asset. Otherwise, it's a short-term capital asset. Are you clear? ETFs. Again, ETFs, no, multiple were there. Stock market based, stocks based, shares based ETFs were there. Bond based ETFs were there. Gold based ETFs were there. Silver based ETFs were there. There are so many types of ETFs. Gold based ETFs, Aditya Birla Gold, ICICI Gold, yes or no? Gold Bs, Silver Bs, there's so many. Now these ETFs, everything, ETFs, mutual funds, SIPs, if at all they are listed, no? If at all they are listed, no? It comes under 12 months criteria. Are you clear? Which is a very big relief. You know, if you want to save money in gold, suppose if you buy physical gold, no? Only after 24 months it comes under long term. Only after 24 months it becomes long term. Yes or no? Tell me, for an individual or anybody, for a taxpayer, if asset is a short term besta, long term asset is besta. Remember, short term capital asset, no, generally taxable at normal rates. Generally taxable at normal rates. Suppose if the SSC is already 30% slab rate, short term capital gain is taxable at what rate? 30% slab rate. Suppose if it is a long term, na, by default, by flat rate is 12.5. So if the asset is a long term, it's always advantageous, 12.5%. Now suppose, no, if somebody asks you, sir, should I buy physical gold or should I buy ETFs? I will recommend ETFs. Why? If at all you are having ETF, after 12 months it become long term, whereas gold physically up to 24 months you have to wait. Are you clear? After 24 months, if you make a profit, 12.5% only tax rate. Here, any profit you made after 12 months holding period, straight away the tax rate is 12.5%. Are you clear? All of you? Yes, sir. Now you said one more, no? Short-term capital gain triple 1 year. What about that? I'll come back to it later. Right now, my discussion objective is not tax rate discussion. Right now, my discussion is what is a long-term capital asset, what is a short-term capital asset. Now, so listed securities, listed shares, listed bonds, listed debentures, and listed units. All listed items are, 12 months is the criteria. What is the criteria? 12 months is the criteria. For them, 12 months. Indirectly, can I say unlisted? Again, no, by the way, in this, no, now again, listed units, no, I said, right, listed units, yes or no? These units are of mutual fund, these units are of ETFs, or maybe some other category units. Are you clear? Now mutual funds, in mutual funds again we have two types. What are the mutual funds? Equity oriented mutual funds, debt oriented mutual funds. In fact, you know, now it is called as DOF, MEOF. Equity oriented funds or debt oriented funds. Are you clear? Now remember, if it is listed equity or debt, 12 months only. If it is listed equity or debt, 12 months only. Now second point, you see, units of equity oriented funds are also 12 months criteria. Units of equity oriented funds. Now you see, equity oriented funds can be listed or even it can be unlisted. Are you clear? See, if at all it is a listed units, na, automatically first category will apply. Second category, once again they talk about units of equity oriented, means they are talking about mainly about unlisted. They are mainly talking about unlisted. Are you clear? They're mainly talking about unlisted units of equity oriented mutual funds. So even unlisted equity oriented funds, the criteria is 12 months. The criteria 12 months, which means, suppose, no, sir, I have units of debt-oriented funds, sir, not listed, sir. That is not covered here. That is not covered here. Automatically it come under other capital asset. For that, 24 months logic will apply. Easy or not? Then another unit is Unit Trust of India. Unit Trust of India is the first entity in India which launched mutual funds, first of all. Okay, so if at all you are having units of UTI, Unit Trust of India units, you have straight away 12 months. And finally, zero coupon bonds. Remember in PGBP I told zero coupon bonds. If a company, if an SSE issues zero coupon bond, the discount amount at which he issued, for him it's an expenditure. He can claim deduction under section 36. Now buyer, I am a buyer who is buying zero coupon bond. What is it for me? For me as a buyer, zero coupon bond is a capital asset. Are you clear? Unless it is a stock in trade. Unless I am trading in zero coupon bonds. If I am trading in zero coupon bonds, it's a stock in trade to me. Otherwise, for a buyer, zero coupon bond is what? Capital asset. Are you clear? For zero coupon bonds also, what is the holding period logic? 12 months. Easy. Now tell me, sovereign gold bond. Sovereign gold bond. Tell me, what is the criteria? 12 months or 24 months? 24 months. Gold receipts, EGR. There is something called electronic gold receipt. I'll discuss that later. 12 months, 24 months. 24 months. Am I right? Now tell me, unlisted debentures, unlisted equity shares, 24 months. Unlisted preference shares, listed equity shares, 12 months. Listed debentures, listed bonds, 12 months. Yes or no? Listed debt-oriented fund, 12 months. All these are listed. The moment you see the word listed, 12 months. The moment you see the word unlisted, be careful. Is it units of UTI? Is it unit of equity oriented? Check out. If not, straight away 24. Are you clear? Zero coupon bond unlisted, it doesn't matter. Zero coupon bond listed or unlisted, it doesn't matter. It is always 12 months. Land and building, 24 months. Machineries, 24 months. Mobile phones, business purpose, 24 months. Personal assets, not a capital asset. No need to check this point. Easy. That's it. I think now you are strong at period of holding right now. I mean, when an asset becomes a short term, when an asset becomes a long term. I hope now you are clear. Yes or no? Now, just now we understood. 12 months and 24 months is nothing but 12 months or 24 months is nothing but what is it actually? It is actually period of holding. What is period of holding? Date of acquisition to preceding date of transfer. Can I say that? Suppose I transferred on 28th January 2026, whereas I originally acquired, let us assume I'm talking about some jewelry. Again, I'm talking about some jewelry. Okay, I transfer on 28th January. I purchased it somewhere on 28th January 2024. Hello? Yes or no? Now tell me, is it a long-term capital asset or is it a short-term capital asset? Tell me. Now, up to 27th January 2025, 12 months over. Up to 27th January 2026, 24 months over. By the way, for jewelry, 24 months logic will apply. Now, you are not selling on 27th. You are selling on 28th, which means your holding period is more than, exactly, your holding period is more than 24 months. So, if it is more than 24 months, automatically, up to this, preceding the date of transfer is exactly 24. And next day you are selling it. Means you are holding more than 24 months. You can consider this more than 24 months and you can treat it as what? Long-term capital asset, and accordingly, long-term capital gain, if it all comes, section 112, what is the tax rate? 12.5%. Are you clear? Now, so period of holding computation is so simple, right? But there are some cases where period of holding is not as simple as I told right now. There are some cases where period of holding is not simple as I told right now. Okay, look at, there are some cases where period of holding will be discussed in a different manner. Tell me. Fine, or else it's okay, fine, it's okay, no problem, I can discuss it, I can discuss. Okay, for example, you purchased shares in a company. You purchased shares in a company directly. Directly when you purchase means it's called primary market, where you got allotment, where you were allotted securities, where you were allotted shares and securities. Yes or no? Now you made application money on 10th January. You made application money on 10th January 2026, but the shares were allotted on 20th January 2026. Now acquisition date is what? 10th January application data, allotment data. Allotment data for shares, no, purchase date is treated as application date or allotment date. Allotment. Why? Only when they were allotted shares came into existence. When you make an application, shares were not existing. Only on the date of allotment shares became into existence. So for shares and all, if at all you purchased in primary market, from which date you should calculate period of holding? Allotment date. Whether you purchased them or whether it is a bonus share, whether it is a right share, for all of them, from which date onwards you should count period of holding? Allotment date. Are you clear? Suppose I purchased shares in stock market, then purchase date is acquisition date. Are you clear? Subsequently you transferred, then till the transfer date. Are you clear? Easy or not? Yes. Suppose. So that is allotment. Yes or no? Asset became the property of an SSE by virtue of 49 subsection 1. Asset became property of the SSE by virtue of 49 subsection 1. What does it mean? There is a section called 49 where there are some ways through which I buy the asset. Actually I will not buy, I got the asset. I got the asset by some method. In those cases, holding period is not considered from my acquisition date. Holding period is considered from my previous owner acquisition date. What does it mean? For example, look at, my father, let us assume my father has purchased a house. My father has purchased a house. Okay, somewhere on 1st April 2005 he purchased it. Later in 2015, okay, 2015 10th August he expired and I inherited. Let us assume this is 2024. Let us assume it is 2024 10th August I inherited. Clear? I inherited 10th August I inherited. Now ultimately, I sold this house on 20th January. What is it? 20th January 2026 I sold this house. Now is it a long term or short term? Generally what we think, on this date I acquired it, no? Yes or no? When the SSE acquired it, when the current one acquired it, 10th August, right? Till 10th August to 20th January, less than 24 months. Therefore it's a short term capital asset. You will decide yes or no, but wrong. 2 clause 42A says, if at all you inherited. What is inheritance? It is covered under 49 subsection 1. Inheritance is covered under 49 subsection 1. Sir, what is 49, sir? How do you acquire this asset? Because not every time capital asset is purchased by you directly. Somebody else might have purchased it. You might have got it as a gift, inheritance or like that, yes or no? Then this 2 clause 42A says what? Holding period of holding shall be considered from date of acquisition by previous owner. Are you clear? Which means when I am computing capital gains, when I am determining it's a long term or short term, when my father purchased 2005, when I am selling it ultimately 20th January 26, this entire holding period is more than 24 months. Therefore, it's a long term capital asset. That's how you should determine. Like this, there are some cases listed in 49 subsection 1. There are some cases listed in 49 subsection 1. Assets received under gift, assets received under inheritance, assets received under will, assets received in partition of HUF, assets received on distribution of assets by the company on liquidation. Like that, so many situations are covered. I'm just telling you one or two situations to make it easily understandable for you. Are you clear? Next, you know amalgamation. So no, what happens in amalgamation? Suppose no, I will take a classic example of amalgamation. Okay, I will take a classic example of amalgamation. Which company amalgamation? Huh? Vodafone Idea, best example. Yeah, best example. Yeah, suppose I'm actually a Vodafone shareholder. I'm actually a Vodafone company shareholder. Okay, you know very well that recently, some 3 years or 4 years ago, 5 years it's been, more than 5 years it's been. Okay, Vodafone has merged into Idea. Yes or no? Now it automatically became Vodafone Idea, right? Vodafone Idea it became. Earlier, I'm a shareholder of the Vodafone. I'm a shareholder of Vodafone. Okay, I am having 1000 shares. I am having 1000 shares in this Vodafone company. But suddenly, merger is declared and Vodafone company is closed. Now it is merged into a company called Vodafone Idea VI. And guess what? They removed these 1000 shares, and in this new company they gave me 1000 shares. They gave me new company 1000 shares. And guess what? I am a shareholder of Vodafone, right? You know, when I purchased these shares, I purchased them on 1st October 2017. I purchased them on 1st October 2017, and that too they are listed. Listed shares. Okay, fine. I purchased that time. But when this merger happened, you know, I'm just modifying dates now for understanding purpose. Okay, you know, when the merger happened, you know, this merger happened on 10th August 2025. Very recently it happened. Let us assume example point of view. Okay, 10th August 2025 this merger happened. Because of this merger, what happened? My old shares in company were cancelled now. Now on the same 10th August, 2025, I got Vodafone Idea new shares. Now market value increased now because of the merger. No, company got a good synergy, market price increased like anything, very good, it increased. Now immediately on 10th January 2026, what I did, you know, I sold these shares. And I made a huge profit. Now my question, is it a long-term capital asset or short-term capital asset? Tell me, by the way, what I sold, did I sell Vodafone shares or did I sell Vodafone Idea shares? I sold Vodafone Idea shares. I sold. Now is it a long-term or short-term? Tell me, when I got Vodafone Idea shares, 10th October 2025. When I transferred them, 10th January 26. The period is less than 12 months. It's a listed company. Let us assume it's a listed company. Since it is less than 12 months, it's a short-term capital asset. Wrong. What is it? Here, you should not count from the date you got Vodafone Idea shares. Remember, you didn't buy Vodafone Idea shares. You bought Vodafone shares. Because you have these shares, you were allotted these shares. Yes or no? Technically, you purchased on 1st October 2017. So holding period will start from 1st October 2017. It's called previous asset. What is it called as? Previous asset holding period. Suppose if you are having any current right now, one asset, one share of some security, this shares you were allotted because of the shares you have previously in some other form. Then holding period will be considered. From the previous asset acquisition date. Are you clear? Similarly, before I give one more example, inheritance. There I don't call it as previous asset. There asset is same, but owners are different. Inheritance, there it is called as what? Previous owner holding period. Whereas now asset changed, owner is same. Am I right? Asset is only changed. Earlier I have Vodafone shares, now Vodafone Idea shares I have. Asset changed, new asset holding period. While counting new asset holding period, previous asset holding period also counted to determine, is it long term, is it a short term? Are you clear? Do you understand? Like that, there are some situations where how to count period of holding is defined. Generally, how to compute period of holding? From date on which this asset is acquired, when I ultimately transferred. Because now tell me, capital gains are taxable in the year of transfer. Look at the charging section. Look at the charging section at the first I gave once. Look at the charging section. Any profits and gains arising from transfer of capital asset, yes or no, affected in the previous year. Previous year means what? Relevant year. Whatever the year in which transfer happened, yes or no, shall be taxable in which year? Year of transfer. Whenever you transfer, in that year it is taxable. Year of transfer is decided based on date of transfer. Transfer means what? You are selling it. Popular mode of transfer is what? Sale. You are selling it. Your selling means you're transferring from you to somebody else, yes or no? So suppose if the date of transfer is 31st March 2026, this comes under which previous year? 25-26. So capital gains are taxable in which previous year? 25-26. Are you clear? Yes or no? Now look at just 1 minute. Yeah, are you clear? Okay, next example. So now let us discuss few more scenarios on how to calculate period of holding in some special situations. Generally, thumb rule, what is period of holding? Date on which I acquired that asset, date on which this asset got transferred. Are you getting the point? So this gap is called as period of holding. Are you clear? Now look at right shares and bonus shares. Bonus shares, right shares word you will use first of all only when you are getting them in primary market. Yes or no? If at all you are getting them in secondary market, they are not right shares and bonus shares. They are normal shares. Yes or no? Yeah. So consider period of holding from which date ma? Date of allotment. Don't take it from application date. Don't take it from option exercise date. No. Are you clear? Suppose you bought specified securities, equity shares, ESOPs and all. Again, consider from date of allotment or transfer as the case may be. It's actually, allotment date. We simply call them as what? Allotment date. Are you clear? Next up, shares held in amalgamated company acquired under amalgamation. Right now, Vodafone Idea company shares I'm having, which is amalgamated company. Am I right? Vodafone company is amalgamating company. Are you clear? It's a selling company. Vodafone Idea is a purchasing company. Am I right? Now you are having shares in purchasing company. Because of the shares you had earlier in selling company, then include period of holding, include period of shares held in amalgamating company. Are you clear? Similar logic is applicable for resulting demerger also. Suppose Hero Honda, it's a company. Hero Honda is a company. Originally Hero Honda is a company. Later Honda got separated, Hero got separated. Originally I'm having Hero Honda shares. Hero Honda shares I'm having. Are you clear? I'm having originally Hero Honda shares. Or you can take Tata Motors also. Recently Tata Motors also demerged. Somewhere in 21-22 year. Tata Motors is now demerged into one more separate company, Tata Motor Passenger Vehicle Limited, TMPVL. And previous old Tata Motors as usual continued. So one unit they demerged. Okay, the new company is called as resulting company. This is also a resulting company, whereas original this company is called as demerged, the company which demerged. Are you getting it? And that's called demerged company. Now I am a shareholder of Tata Motor. Because of demerger, I was given 1000 shares of Tata Motor Private Limited, Tata Motor Passenger Vehicle Limited shares. They were allotted to me. They allotted to me passenger vehicle shares. Are you clear? Now, when I'm counting these 1000 shares holding period, not only from allotment date of passenger vehicle shares, from the date I bought Tata Motors share holding period will be considered. Yes or no? So, how to calculate period of holding in the following circumstance? What is the circumstance? If at all you are having shares in resulting company which you acquired under demerger. How you got resulting company? You didn't buy the shares of resulting company directly. You acquired it in the process of demerger. Then first date of allotment of resulting company share to date of transfer, you will anyhow count, add, include, extra, include period of shares held in de-merged company. Period of shares held in de-merged company. Similarly, sometimes a company will convert bonds, a company will convert debentures, a company will convert debenture stock, deposit certificates, bonds, debentures into shares or debentures. Remember convertible debentures? Convertible debentures, for example, I originally bought a convertible debenture on 1st October 2022. I bought convertible debentures, yes or no? Later, very recently on 10th November 2025, it was converted into shares. Okay, and it is converted into shares, and that too the shares were listed right now. Are you clear? These shares were listed right now, and now these are immediately sold. These are immediately sold on 5th December, just immediately after conversion. Not even 1 month I waited, I sold them. Now the transfer, the gap is what? Less than, the gap is less than 12 months. No, not like that. You should count from this date. You should count from original debenture purchase date. Look at, so what is the holding period? Include period for which such assets were held prior to the date of conversion. See, after conversion, anyhow you will count. Conversion date to transfer date, anyhow you will count 2 months, 1 month, 2 months, 3 months. Plus, before conversion also you are holding that securities, no? Count that period also. Are you clear? Same logic. Conversion of preference shares into equity shares. Right now you are having equity shares, you are selling equity shares. Now equity shares allotment date, 2 months back they allotted equity shares. Now we are selling equity shares, but these equity shares were allotted to you because earlier you are having preference shares, which means what is the total holding period of equity share? Equity share holding period plus preference share holding period. So include period of holding of preference shares to determine equity shares holding period in order to determine whether it is more than 12 months or more than 24 months. Logic, yes or no? Easy, yes or no? Next, we have a similar concept in electronic gold receipt. Electronic gold receipt. What is this gold receipt? Electronic gold receipt taxation. Very simple. What is this EGR taxation? See, you have multiple options to invest in gold. Okay, so I'm just specifically telling you because there is a high possibility now, since it is booming, in the sense gold is booming, ETFs are booming. That's the reason I'm specifically emphasizing more, because a question can come in MCQ or a descriptive, a practical problematic question can come. Now with respect to gold, I can buy SGBs, sovereign gold bonds. For sovereign gold bonds, what is the holding period criteria? 24 months. Logic will apply. Okay, another way of investing in gold is what? Physical gold. What is it? Physical gold, like biscuits, ornaments. Again, for that also, what is the criteria applicable? 24 months. Okay, again there is another way, EGR. What is it? EGR. For EGR also, what is the logic applicable? 24 months. There is another way, digital gold. What is it? Digital gold. For that also the logic applicable is 24 months. However, gold ETF. What is it? Gold ETF. Gold ETF is actually that too listed. That too I'm talking about listed ETFs. Gold ETFs, since they are listed, they come within the definition of listed securities. They automatically, the holding period is 12 months. Logic is applicable. So if they are more than that period, it's a long term. If it is up to that period, it's a short term. Are you clear? So ETFs means directly you buy in the listed stock exchange. In a stock exchange, you will directly buy the ETF. Are you clear? Whereas these and all you can't buy in stock exchange. Are you getting it? These you will buy at some other sites. Able to understand? Digital gold, in PhonePe app you can buy, Paytm app you can buy. The moment you open Paytm homepage, digital gold option will be there, you see. So digital gold, there are many apps that are there where you can buy digital gold directly. Are you clear? So for all these cases, 24 months apply. Now I want to talk about few more cases. Okay, certificates. What is it? Certificates under gold monetization scheme. Certificates under gold monetization scheme. First of all, this is not a capital asset. What is it? This is not a capital asset. But SGB is a capital asset, physical gold is a capital asset, EGR is a capital asset, digital gold is a capital asset, gold ETF is a capital asset. Now, what is the difference between certificate under gold monetization scheme? What is SGB? What is EGR? Physical gold, gold ETF. I think this you might have really understood. Yes or no? Now we need to just have to understand the difference between SGB, EGR, gold ETF, and GMS. Gold monetization scheme certificates. Yes or no? Now first I will tell you certificates under gold monetization scheme 2019. Latest scheme is this only, or 2021 some scheme is there. Okay. What is this? Very simple. Go to a bank. Take your jewelry to the bank. Okay, give the jewelry to the bank. Appraiser will be there. He will melt it. What he will do? He will melt. Okay, he will melt the gold. Means now whatever the melted gold, valuation will be done. Now this gold value is there, right? Monetize with the bank. What is it? Monetize with the bank. Give it to the bank and get the money. Take the money. Are you getting the point? You will not take the money. You keep the money in the bank itself. You will keep the money in the bank itself. Now the bank will keep it, let us assume, for 10 years, 5 years or 10 years they'll keep the bank. Okay, bank itself will keep. But first what they did, your entire gold is converted into money right now. Now that money will be kept by the bank, and that is called gold monetization scheme. This is to promote liquidity in the economy. Are you getting the point? So instead of flying your gold in your locker at empty, instead if you give it to the banker, that biscuit gold, whatever the gold ornament biscuit is there, now they converted it into raw gold again. Now that will be circulated in the economy, which will help the economy development. Are you clear? Yes or no? Now for you, what benefit I will get, sir? No problem. When they converted into biscuit, no, let us assume it is 100 grams is there. Yes or no? After 10 years you can get back your 100 grams again. Right now you will be given certificate where 100 grams will be shown in the certificate, and on the day the value is 10 lakhs. Let us assume on this 10 lakhs every year 2.5% or 3% interest they will pay you. They will pay every year 2.5% or 3% or 4% some interest they will pay you, because you deposited your gold every month. Again after 10 years you come back and take back your 100 grams worth of gold. Maybe your gold will be given, or some other biscuit will be given, or gold worth amount will be given. Appreciation is there. Every year return is also there. In the economy, circulation improved or not? This is called gold monetization certificate. This is to bring idle lock lying in Indian homes. This scheme purpose. Are you clear? Then what is SGB? Sovereign gold bonds. This is an investment method. Every time, why dear mister, why you buy physical gold? Don't buy. Because if you're buying physical gold, we have to import from outside India so much. Foreign reserves are decreasing, rupee is depreciating, all this. Better you buy one bond, gold bond you buy. Okay, at what price? Suppose today you are buying 10 lakhs worth of bond. Okay, you get 100 grams worth of gold. Okay, in the bond it is clearly mentioned 100 grams worth of gold paid 10 lakhs. Now you got the bond, right? Now you paid 10 lakhs to RBI. SGBs are issued by RBI or nationalized banks. Okay, RBI is issuing. For example, you bought the bond, SGBs 1, SGB 2, SGB 3, version 3, version 4, like that, some bonds are there. You bought 10 lakhs, you paid. Every year you get interest, 2.5%. See, if at all this bond is not there, you would have bought physical gold. Unnecessarily, because of this import duty, all that will be there. But if you directly buy SGB, same market price, but on the government, import pressure will reduce. Yes or no? So here you are directly buying the gold in the form of a bond. Are you clear? 10 years is a bond tenure. Every year you will get interest, 2.5%, just like certificate. But remember, in the gold monetization, it is my gold. It is my gold, I am keeping there, and then I am converting it to money, I am getting interest. Where sale happened here? I didn't sell it to anybody. That's why it is not a capital asset. Whereas SGB, I bought gold. I bought gold in the form of bond. Yes or no? Tomorrow I am selling it. If I sell SGB, it's a capital asset. Transfer, it is taxable. Are you clear? Then EGR. What is EGR? It is converting gold into gold receipt. It is converting gold into gold receipt. Now this is not a monetization scheme. It is not a scheme. EGRs can be issued by registered vault operators. Gold vault will be there. Vault operators, they will be registered with SEBI. Anybody can register with SEBI. You must have minimum net worth of 50 crore rupees. Some norms are there. You register. Now you open a vault center. Now any customer can walk into your vault and they can give their physical gold. You will melt it, you will convert it into a gold receipt, you will give it to the customer, gold receipt. Again tomorrow after a few years he can come back and then submit back the gold receipt and then take back the gold. Same gold I will not give, maybe some other gold I will give, but it's like it's not a monetization scheme. Are you clear? Now gold monetization scheme certificate is the right. General this is not tradable, whereas gold receipt is tradable. You can sell to somebody else also receipt. So ultimately after 5-6 years, whoever have the receipt, no, if he come back and submit back the receipt, he will get the gold, physical gold, or he will get equivalent money worth. Are you clear? Now suppose no, I purchased one jewelry item. On, let us assume 10th August 2020 I purchased. Okay, now I converted this into gold receipt. On, let us assume 7th September 2025, and this gold receipt I sold to some other person. On 10th January 2026. Now what is the holding period for the gold receipt? Is it from 7th September to 10th Jana? No, it is counted from the gold holding period. Look at this. Okay, now conversion of gold into EGR. Include the period for which such gold was held prior to conversion into EGR. Suppose right now I am selling EGR. I'm just selling electronic gold receipt to somebody. Now is the electronic gold receipt long term or short term? Electronic gold receipt, your asset is not EGR originally your asset is gold. From gold purchase date, EGR sale date, entire period is considered for 24 months period purpose. Are you clear? Hello? Yes or no? Now again here X has a gold, he converted it into EGR, and that EGR is sold to Y, and this EGR is sold to Y on 10th January 2026. Are you clear? Now Y again sold the same to Z. Y sold the same EGR to Z on 20th February 2026. Now from Y point of view, holding period is only 1 month. Why? I mean, what is the reason? Because Y did not convert the gold into EGR. He directly bought EGR, sold EGR. Means EGR holding period only. Who will have gold counting period? I have gold originally, converted into EGR. Now I am selling. If I do conversion of the asset, then before conversion, after conversion, both will be considered. Here he didn't do conversion. This fellow, if at all tomorrow selling, he didn't do conversion. Suppose no, Z sold to Mr. A. Yes or no? Z sold to Mr. A. What he sold, Mr. A? 10th March he sold 2026. And what Mr. A did? He converted the EGR back into gold again. Guess what? Conversion of gold into EGR into gold is not taxable. Conversion is not taxable. Actually, transfer definition is there. As per transfer, conversions are also transfers. You know that? Conversions are also transfer. Transfer includes sale, exchange. What is it? Exchange. Exchange is also a transfer. As per definition of transfer, exchange. You are exchanging asset. You are liable for capital gains, man. Now gold you are exchanging for EGR. It's an exchange. It's basically taxable. But there is a section called 47. What that section says, conversion of gold into EGR or vice versa is not treated as transfer. So capital gains law itself gave an exemption. What exemption they gave? If you are converting, no, it is exempted. Are you clear? So that's why conversion is exempted. Here he converted gold to EGR, exempted. Whereas here he is converting EGR into gold. It is exempted. Not taxable. Now this fellow, no, he is selling the gold ultimately in 2029. He is selling the gold. He is selling the gold in 2029. Now gold holding period only from gold data, EGR purchase date, because this fellow converted. Mr. A originally bought EGR, then he converted into gold, and then ultimately selling gold. For calculating gold holding period, EGR holding period will be considered. Are you clear? Able to understand? Suppose I bought one asset, same asset I sold, same holding period. There is no concept of previous asset, all that. Suppose I got the asset from previous owner, now I am selling it, then previous owner holding period I will count. Suppose I bought from somebody and then selling it. I bought from somebody, I don't know who is he. I bought from him and then selling it. Previous owner holding period will not be considered. Previous owner holding period means previous owner holding period. See, for example, right now I am the current owner. Okay, earlier there is a previous owner. Previous owner means what? Earlier whoever is owner, he is a previous owner. Yes or no? Now holding period means current owner holding period only you should take always. Generally, from when you acquire, when are you selling, that holding period only you should consider. Yes or no? But there are some cases where previous owner holding period shall be considered. What are the cases? They listed under 49 subsection 1. In that section they listed some scenarios. Their previous owner holding period shall also be considered. What are the scenarios? We will come back and then discuss later. Are you clear? If at all you are acquiring capital asset through 49 subsection 1 modes, look at this. You got the capital asset. How you got the asset? Through 49 1 mode you got. Then previous owner holding period also you consider. Are you clear? Or you have right now one capital asset, but that's not what you bought. Originally you bought some other asset, now it got converted into this. Then again previous asset holding period also please consider. That's what the meaning of holding period logic is. Are you clear? So suppose if at all gold is released in respect of EGR, like conversion of EGR into gold, then for calculating gold holding period, EGR holding period shall also be included. Include the period for which EGR was held prior to its conversion into the gold. Are you clear? Yes or no? Easy or not? Yes or no? Next conversion of inventory into capital asset. Remember, I will come back to that point later, and let me not touch it right now. Okay, shares held in company in liquidation, that also I'll come back to it later. I will not touch it right now at the moment. Are you clear? Actually, if at all you are having shares in a company and that company is now going into liquidation, now when the company is going into liquidation, no, they will announce something called date of liquidation. Date of liquidation, one date they will put cutoff date. From that date business will be stopped. From that date realization, selling, negotiations, everything will start. The date of announcement of liquidation is there, right? That is called as date of liquidation. Suppose I'm having shares in a company which is going into liquidation. I'll tell you how exactly happens. Suppose I bought one shares of a company, that's a listed company, man. Listed company shares I bought. What I bought? I bought shares on exactly on 1st January 26 I bought. Yes or no? Now the company announced liquidation on 1st October 26. My unfortunate thing, immediately after I bought, they announced liquidation. Guess what? Ultimately 31st March 2027 the company took back the share. And they released me money. Of 10 lakh rupee. Are you clear? Now generally holding period means what? I acquired on 1st January and ultimately company took back the share on when? 31st March. Are you clear? So here you will immediately think it is more than 12 months since it's a listed company, and you generally think it's a long term, but wrong. What 2 clause 42 says, if at all you are having shares of a company which is going for liquidation, on which that liquidation started, announcement date 1st October they announced liquidation date, up to this only you will count. Now tell me, what is the period? Less than or equal to 12 months. Therefore it's a short term capital asset. Are you getting the point? Suppose this company did not go into liquidation at all. Okay, 1st January I bought, next year 31st March I sold it, then entire this 15 months I am holding it, then it is more than 12 months, it becomes long term. Are you clear? So in capital gains chapter, when you bought, when you sold, not only that is ultimately important, your previous asset, conversions, all these matters. Yes or no? Don't worry, we are discussing one by one, step by step, all that. Clear? I'll go to the question bank. Capital gains, I'll start. Where is it? Yes. Look at, capital assets. Look at capital gains. Are you clear? Look at capital gains. In the capital gains, I have not given any past exam questions because there is a substantial changes happened, and most importantly, in ICA book TYK illustrations were given, right? They themselves were super fantastic. Till now, that much advanced questions were not asked in past exams also. In ICA, capital gains is the only chapter where illustrations TYK questions are extreme tough. They're toughest. High number of twists. That many TVs were not there in the past exam MTPs also. Moreover, capital gains chapter earlier, the logics of the chapter are different. Now the logics of the chapter are different. Okay, that's why if you see, I gave a big disclaimer. I gave a big disclaimer in capital gains. If you see, now if you see, I gave a disclaimer. Yeah, here you can see, I clearly mentioned where is this 184, okay, I gave one big disclaimer to you here. 184.3, yeah, you see here what I mentioned in capital gains question bank, questions from MRP, MTP, RTP past exam. Important note to the students, why past exam questions are not included in capital gain chapter, because I didn't include it. Okay, why? You may notice that unlike other chapters, the capital gains chapter does not contain past exam MTP, RTP or revised answers from earlier years. In all other chapters I have included fully updated past exam questions, all that, right? But capital gains is the only chapter where I have chosen not to include, because I have a clear reasons for that. Reason, from 25-26 onwards, capital gains chapter undergone a complete shift. There is a lot of change. Indexation, that and all not there now. Earlier it is there. Indexation benefits were removed. Holding period logics were revised. Multiple rules, exemptions, computation steps were earlier have been modified. As a result, the pattern of solving, logic of old question, how do you solve previous exam questions, they were no longer relevant. Because of these sweeping changes, older questions were completely useless, no longer relevant for you. In fact, if you try to practice past exam questions in capital gains chapter, that will give you misconception or misunderstandings. I'm 100% telling you. Don't even tempt tomorrow if somebody says you capital gains past exam questions they are giving you revised answers. Don't even tempt. I'm blindly telling you. In the classroom, I will give thousands examples. I'll give you hundreds of examples which you can't even see anywhere. Are you getting it? So for this reason, I intentionally avoided. And please watch only ICI, mock test papers, SR model test papers, illustrations, TYK. Only this. For May 26 exam, no, model test papers, they will release 8 model test papers. ICI source will be there. That you follow. Okay. And MTPs will be released too. RTP will be released. This is enough. May 26 exam. If at all you are September 26, 2 more MTPs and RTP will come for September 26. If you are Jan 27, 2 more MTPs and RTP will come. That you practice more than enough. Are you clear? Next. Again, what's the page number in illustrations? Okay. Look at 165. Look at capital gains. How do you calculate period of holding in case of the following assets? Shares held in a company in liquidation. Shares held in a company in liquidation. Very simple. From the date of acquisition, I will calculate till the date on which company announced the liquidation. The period after the date on which company goes into liquidation will be excluded. Which means in our example, up to 1st October I'll count. After that I will ignore it. Yes or no? 1st October after I will ignore it. I will exclude it from holding period computation. Am I right? Therefore, the period of holding shall commence from date of acquisition and with the date on which company goes into liquidation. Bonus shares, allotment date. Period of holding will be counted from allotment date. Am I right? Period of holding shall be counted from the date of allotment of shares and will end with the date of transfer. Now, there is a flat in cooperative society. If you remember, in house property deemed owner concept, one point I told, sometimes if I want to buy a flat in one society, I cannot buy the flat directly, I buy the share. Then automatically flat will be allotted to me. Yes or no? Now I want to sell the flat to somebody. I will not sell the flat, I will sell the shares. Now here, what is the flat? Householding period. Shareholding period is householding period. Am I right? Look at. The period of holding shall be counted from the date of allotment of shares in the society and end with the date of transfer of shares. Are you clear? Yes or no? Now here below there is a note point given which I will come back and then discuss later, because this is there in our theory discussion. We will be covering at later point of time. Are you clear? Yes or no? Now there is one more question you see. There is one more question you see. Mr. A is a owner of a car. He is a owner of a car. Okay, on 1st April he started a business of purchase and sale of motor car, his personal karma. Okay, he treats the above car as a part of stock in trade of his new business. He sells the same on 31st March and gets a profit of malak. Discuss the tax implications. First of all, this is not a, first of all, this is your personal car, not a business related car. Therefore, it is not at all a capital asset. So what you did later with which is not a capital asset, this is not a capital asset, something you did later, you converted capital asset into stock in trade. See, you converted your personal asset into stock in trade, no tax treatment on that. Yes or no? Since car is a personal asset, conversion or treatment of the same as stock in trade will not be treated, will not be taxed. By the way, this provision I have not yet explained. I have to discuss it now. Then I will once again come back and then connect you to this point. Are you clear? Easy or not until now? Period of holding concept strong or not? Yes or no? Now you know. Now I need to discuss transfer definition. Transfer definition. Tell me when capital gains is applicable. When capital gains is applicable, first of all, when capital gains charging section will arise, when capital gains arise, you know, if you are transferring capital asset during the previous year, then in the year of transfer only it is taxable. What are you transferring? Capital asset. What is capital asset? I know. We discussed it right now already. Now what do you mean by transfer? What do you mean by transfer? Transfer means what? Generally what we think transfer means sale. But you see here, capital gains, transfer means what, you know? Sale. You can, even if you are exchanging means what? You are exchanging debentures, you are converting debentures into shares, no? Hello, you are converting debentures into shares, you are converting bonds into shares, you are converting preference shares into equity shares, you are converting gold into EGR, you are converting EGR into gold. Earlier you have Vodafone shares, now you are exchanging it with Vodafone Idea shares. All these comes under exchange. All these comes under exchange. Exchange is also a transfer, and exchange by default, exchange is a transfer, and that too capital asset you are transferring, therefore it is liable for tax. But don't worry, there is a section called 47. There is a section called 47. It exempted certain conversions, it exempted certain exchanges. In section 47, there are so many exchange variety transactions, exchange based transactions which are exempted. Are you clear? Sale, exchange, relinquishment of an asset. What is it? Relinquishment of an asset or extinguishment of any right therein. For example, relinquishment. The best example for relinquishment is redemption. You know redemption? Redemption of debenture. What happens in redemption of debenture? Once the debenture is redeemed, debenture will be lost. Debenture will be lost. See, suppose I sell this house to somebody, house will be still there. That's not relinquishment. Relinquishment means that is waived, gone. Are you clear? Suppose no property was destroyed. My entire, for example, my jewelry was destroyed in a fire accident. Relinquishment actually it is. It's a relinquishment. My property was gone, and still I am getting insurance company compensation to me, and I made a profit because of this. Taxable under capital gains. Relinquishment is also taxable. Extinguishment means what? You know, I have a right, but I am not using it. I'm transferring my right to somebody. That's called extinguishment. You know, I have a discussion called right renouncement concept. There is a concept called right renouncement related to right shares. There I will discuss extinguishment point. Are you clear? So that is a transfer. Conversion of capital asset into stock in trade is also transfer. Suppose no, you are converting capital asset into stock in trade, that is also transfer. Now I will discuss this point more in depth in 45 subsection 2. Right now at this moment let us not touch it. I will discuss in depth in 45 subsection 2. Are you clear? Next, zero coupon bonds are there, right? Maturity. What happens? You buy zero coupon bonds, it's a capital asset. You waited up to maturity, you gave it back and you got a profit. You bought at 500 rupees, maturity amount you got 1000. 500 rupees is a capital gain because redemption of zero coupon bond is a transfer. Redemption is transfer, maturity is transfer. Are you clear? Redemption is when zero coupon bonds are redeemed, generally on maturity they'll redeem. Sometimes they will redeem before maturity also, but at the end of the redemption is a redemption. Are you clear? Next, Next, part performance of a contract. I will come back to that point pending. Okay, I'll keep these points. Compulsory acquisition point, I'll keep it pending. Part performance point, I'll keep it pending. Any transaction which has a effect of transferring or enabling somebody enjoyment of the property, I'll come back to that point later. Are you clear until now? So transfer means not only sale, it includes exchange, it includes relinquishment, it includes extinguishment. Yes or no? Now let us see few more examples on relinquishment and extinguishment. Relinquishment versus extinguishment of capital asset. Yes or no? Examples. Look at relinquishment versus extinguishment. Both are treated. Relinquishment means giving up or surrendering one's right in a capital asset in favor of another person. Okay, actually, yeah, right renouncements comes under relinquishment. That also, okay. Rights are given upon in some other favor. Extinguishment is actually, I think I told Ulta. Just a small correction, okay. Extinguishment means termination or destruction of rights in capital asset. Rights are ended or destroyed. May happen by operation of law, or transfer to other person may or may not exist. Common example, compulsory acquisition is an extinguishment. Owner's rights are extinguished. Okay, destruction, factory building destroyed. I think I told reverse. No, relinquishment I told destroyed. Wrong. Okay, extinguishment means destruction. Are you clear? Suppose something destroyed. Okay, your rights. For example, employee will be given ESOPs. No, ESOPs on a particular date. If you don't exercise, your rights are gone. Yes or no? That's extinguishment. We call it as. Are you clear? Sometimes because of extinguishment also you will make a profit. Your property destroyed by fire accident, but it was insured and you got profit, you got compensation, and that compensation includes profit. Even though it is destroyed, even though you didn't sell it, but still you made a profit because of extinguishment. That extinguishment is treated as transfer, and that is liable for tax. Are you clear? Relinquishment means what? Relinquishment means what? Rights are given up in somebody else's favor, and asset is still existing. What is it? Asset is still existing. Are you clear? So for example, I sold my house to somebody else. I gifted my house to somebody. Gift comes under relinquishment. Best example. I gifted my house to somebody. Gift comes under relinquishment. Are you clear? Now whether you gifted, whether it is destroyed, whatever reason, I don't matter. Ultimately transfer happened. Ultimately owner changed. It is a transfer. The moment owner change itself, we will tax it. For example, I gifted a house to my son. I didn't get any money. He also did not get any money. Just a name changed in the bond. I gifted my house to my son. Will you tax it? No. Actually, primarily it is taxable. It comes under transfer. It comes under transfer of capital asset. But to identify, but there are so many cases in reality which should not be taxed immediately like this. We have identified that, and department gave exceptions to transfer. What is it? Exceptions to transfer. There is a section called 47. There is a section called 47, exceptions to transfer. Look at exceptions, transactions which are not regarded as transfer. What are they? For example, any transfer of capital asset by individual or HUF under gift, will or irrevocable trust. Remember, gifting by individual and HUF only covered. Gifting by company not covered. Be careful. Gifting by partnership firm not covered. So if an individual is gifting or will or irrevocable trust, even inheritance, all that also covered. Are you clear? Next up. Now there are some more cases here which I will come back to it later. Okay, now here one more point I want to highlight. Redemption of sovereign gold bonds is not a transfer. You know what? If it is not a transfer, what is the consequence? Capital gains will not apply. Now look at sovereign gold bonds. Look at SGBs. Actually I thought of discussing that, but right now I'm discussing SGB. I bought on 1st October 2024, for example. Now this bond period is 10 years. I bought at 10 lakh. Okay, Mr. A, original owner is what? Mr. A. Now what he did, he sold to Mr. B. In 2025, 31st March, he sold it. Now remember, this is a sale. This is not maturity. This is not redemption. Are you clear? He sold it for 15 lakh. Now, what is the profit he made? 5 lakh. It is taxable. Now, tell me, B purchased it at what price? 15 lakh. And guess what? He is not selling it to anybody. He waited until 2034 year. And he received and he redeemed the bond. What is it? He redeemed the bond. Guess what? The price at which he redeemed is 2 crore. 2 crores he redeemed the bond. At what price he purchased? 115 lakh. How much profit he made? 1.85 crore. No tax treatment. Why? Redemption of sovereign gold bond is covered under 47. Redemption or maturity, what is it? Redemption or maturity of sovereign gold bond. Redemption or maturity of sovereign gold bond. Redemption of sovereign gold. Maturity also not required. Redemption means RBI itself redeemed the bond. You don't want to sell it back. RBI itself redeemed, yeah. They themselves took back the money and then took back the bond and they gave you money back. That is not taxable. Are you clear? Suppose no, you didn't redeem. You are selling it to somebody else. It is again taxable. Are you clear? It is treated as transfer. Again, it is taxable. Until now, this 2 hours almost I spent. It looks bit theoretical. Okay, but don't worry. The very next session onwards, I'm focusing on problematic solving, where I'll be discussing formats of capital gains and I'll be solving. I'll be starting the problems. Okay, from then it will be more engaging. But remember, capital gains you can solve in a right manner only when you understand the provisions thoroughly. That's why I'm taking more and more dates, all that, and then explaining, confident or not. So SGB point you understood. Same way, there is one more thing. Conversion of gold into EGR. Here gold lost, EGR came into picture, which is exchange, or vice versa. EGR into gold, conversion of gold into EGR, EGR into gold. Conversion is not taxable. You sold EGR to somebody, and got money, taxable. You sold gold to somebody, got money, taxable. Are you clear? Yes or no? Conversions are not taxable. Are you clear? Same way, conversion of bonds, debentures into shares, debentures of that company. I converted bonds, debentures of this of our company into some other bonds or some other debentures or some other shares. You just converted, man. Owner is same. You didn't get any money here. Why I will tax the department? So under 47, at the time of conversion, it is exempted. But remember, subsequently after conversion, tomorrow you are selling this again. That time it is again taxable. That time, is it long term or short term? How will you count from conversion data? Before conversion, acquisition data. Exactly, acquisition date onwards. Yes or no? If you observe, all these cases, whatever we are discussing here, were also covered in holding period inclusion or exclusion or concept. Most of them are covered. Be careful. Are you clear? Same way, if at all you are transferring, by way of any transfer, how are you transferring? By conversion of preference shares into equity shares. If a company converted the preference shares into equity, conversion is not taxable. Conversion is not taxable. Subsequently, equity shares you sold. This equity shares, how long you held? Preference shares holding period also you should count, plus equity share holding period. Put together, if it is more than 12, more than 24, it's a long term. Are you clear? Yes or no? That's it. So main basic theme we understood right now. Okay, how to count holding period, all that. See, ultimately till now what we understood, we understood what is a capital asset. Now we understood what is a long term capital asset, what is a short term capital asset. It is decided based on period of holding. Then we understood how to count the period of holding. Then we also understood some exceptions to taxability. Correct? Some exceptions to taxability. Exceptions to taxability means what? Section 47 we covered. See, 2 clause 47 says transfer definition, whereas 47 section, exactly 47, there is a section called 47 which is different from 247. This talks about exceptions to transfer. 247 says conversions, exchanges, everything is a transfer. Charging section says transfer of capital asset taxable. But section 47 suddenly coming in between and saying, hey, they just converted, they didn't get any money. How will you tax it? So 47 protecting the SSEs. Yes or no? So just conversion is not taxable. Now in 47, most important point is what? Redemption of sovereign gold bonds is not taxable. But remember, if you are transferring sovereign gold bonds to somebody, selling it to somebody, it is taxable. Buying sovereign gold bond and selling to somebody, taxable. Selling back to RBI, Redemption of sovereign gold bond. Redemption is not taxable, even though there is a profit. Conversion of gold into EGR, not taxable. EGR you have and you are converting into gold, that is not tax because it is only with you. Again, owner didn't change. Suppose you sold EGR to some third party, owner changed it now. Profit, cash, conversion, consideration and all is there. It is taxable. Are you clear? That's it. Okay, so holding period concept we understood thoroughly. Right now few points also we understood thoroughly. Now hereafter I will be discussing more about computation of capital gains concept. Now onwards I'm just moving to computation of capital gains concept. Are you clear? In capital gains I will not follow any particular method. I will follow based on movement. Are you clear? So there is no way how I will discuss, in which order I will discuss. There is no specific way. Right now this video you compare with my last year I uploaded for Jan 26 exams capital gains full chapter video. There my order of discussion is different. Now my order of discussion is different. Are you clear? Once again if I take my order of discussion will be different again. Only for capital gains chapter this will be. Are you clear? Clear? Yes. In the previous two sessions we understood what is a capital asset, what is a long-term capital asset, what is a short-term capital asset, yes or no? And we also understood what is period of holding, and we understood what do you mean by transfer briefly, and we also understood which type of transfers are not taxable generally. Yes. Now let's begin into computational part. Let's begin computational parts. You know, in capital gains chapter we have typically three formats. Actually computation of capital gains is discussed in 3 sections, not even 3, I can say 4 sections, but one section is 50B. okay, one section is 50B slump sale. We call it as what, you know, slump sale, which is altogether different, generally. Holding period is decided based on which criteria? 12 months or 24 months. Only 2 criteria, right? But in slump sale, no, 36 months criteria is discussed. What is discussed in slump sale? 36 months criteria is being covered. Okay, fine. There is another section for capital gains. Okay, that is section 50 and 50A. You know what? These 2 sections talk about computation of capital gains for depreciable assets. They talk about what? Depreciable assets. And for remaining all other capital assets, what is the format applicable? Section 48. Whether it is your personal immovable property or your personal related but capital asset or business related but non-depreciable. For all other capital gains computation, section 48 computation format is applicable. Whereas for depreciable assets, which format of capital gains is applicable? 50 mainly and 50A. And if you remember, we already completed 50/50A in PGBP itself. Remember, what is 50/50A? I told you in PGBP, I told you section 50 will apply only when section 32 does not apply. Correct? Did I tell you this point? How I told this point? Section 32 will apply in respect of a block. Section 32 means what? Depreciation. Depreciation you will compute in respect of a block if 2 conditions are satisfied. On 31st March of the relevant previous year, block shall exist. Am I right? Block shall exist and there must be written down value. If block is existing on 31st March of the relevant previous year and there is a written down value, then automatically what you will do? You will calculate depreciation for that block. 50 section will not apply for that block. If any one condition failed, if any one criteria failed, see, as on 31st March both should be satisfied. If any one condition failed, either block completely gone or value became negative, automatically section 50 will apply. And this incident, how did I tell you in 32? You know, transfer of full block, transfer of part of a block. If you are transferring full block, either short-term capital gain or short-term capital loss, remember. And if you are transferring part of a block, either short-term capital gain or depreciation. Remember, like how do I know, how do I compute here? First compute, first identify how much amount received, on part of a block. Negative. For example, amount received on part of a block is 50 minus gross block value. What is gross block value? Opening value. Let us assume 20. Additions during the year. 10 lakh. Total 30. And if you see, gross block value 30 only, but amount received on part of a block is 50. Therefore, 20 lakhs is treated as short-term capital gain. Are you clear? Here if you apply depreciation format, opening value 10, additions, opening value 20, additions 10, gross block 30, minus part of a block 50, it is coming negative. That negative I presented in capital gains format like this. Are you clear? So look at the provision. Depreciable assets, am I right? Full block is transferred. If amount received is exceeding gross block value, short-term capital gain. Amount received minus gross block value. If amount received is less than gross block value, it's a short-term capital loss minus amount received minus gross block value. Am I right? Sir, part of a block is transferred, sir. When 50 will apply, sir. If part of a block is transferred for an amount where it is exceeding gross block value, part only sold, but amount received is more than gross block value, then directly it is a short-term capital gain. Am I right or not? Yes or no? So now let us complete this one. Computation of capital gains for depreciable. Transfer of depreciable assets which are forming part of block of assets. Now look at how to calculate. First identify amount received. Very simple. First calculate gross block value. Gross block value means what? Opening WDV of the block, add actual cost of asset acquired in the block, add expenses incurred in connection with transfer. These are all your investments. Yes or no? Suppose opening value 10 lakh, assets acquired 10 lakh, right now block sold for 1 lakh. Transfer related expenses 21 lakh. What is it? 21 lakh. Now what is the amount received on transfer of the block? Full block of part, look at 30 lakhs I transferred, then automatically 9 lakhs is the short-term capital gain. And if you observe here, this one point I specifically added. Are you getting it? This generally many students don't notice. Expenses in connection with the transfer of a block should also be reduced while computing capital gains. Are you clear? Yes or no? Next, thumb rule. What is the thumb rule? Now what is the thumb rule? If at all part of a block is transferred and amount received is less than gross block value, then WDV value is there. Then depreciation shall be calculated under 32 and capital gains will not attract. Suppose if part of a block is sold, that means if a part of a block is sold, the answers could be either short-term capital gain or depreciation. There is no question of short-term capital loss in case of part of a block sale. Yes or no? Suppose if a full block is sold, either gains will come or loss will come. No question of depreciation. Are you clear? Yes or no? That's it. Next 50A. This is also talking about depreciable assets, but it is dealing with power sector. That too, which power sector? Power sector following SLM, not block method. Yes or no? Now power sector following block SLM method. How to compute capital gains? Yes or no? If the sale proceeds are higher than original cost, then the excess amount is called as short-term capital gain. That's it. Under 50A, only gain is covered. Loss point is not there at all. Yes or no? Look at, if depreciable assets of power sector which is following SLM or transferred at a consideration more than actual cost, then profit above WDV up to original cost is taxed as balancing charge, whereas profit above original cost is STCG. In case of loss, it is finally treated as terminal depreciation under section 32 itself. Easy or not? With this, depreciable assets capital gain computation is over. Let us see, is there any problem in this book? Already we solved it, ma. Already we solved depreciable assets problem, ma. I'm just looking whether in this book also is there any depreciable assets. Yeah, it is there. It is there here. Depreciable assets related one problem is there. Question number, illustration number 9 ma. Okay. Now can I solve it? Singhania and Co., a sole proprietor, owns 6 missions ma. They were put in use for business in March 2024, means some to 1 year before. We are doing problem for 25-26. They have this block in 23-24 itself, correct? The depreciation on these missions is charged at 15%. The opening balance of these missions after providing depreciation of 24-25 was 8.5. Amma, thank God, right now they gave opening value. Yes or no? What is the opening WDV of the block? By the way, here 6 missions were there. Yes or no? How much it is? 8,50,000. Am I right? Next. 3 old missions were sold on 10th July for 11 lakh. Okay, sale is 11 lakh. 3 missions only sold, which means part of a block is only sold. At the same time, a second-hand plant was bought at 8.5 lakh on 30th November. 30th November means what? Less than 180 days. Am I right or not? Yes or no? Assets acquired and used for less than 180. How much it is? 8,50,000. Now tell me, what is the gross block value? How much it is? 17 lakh. I am now using depreciation computation format. Gross block value minus. Now 3 missions are sold, no? Yes or no? 3 old missions are sold. Now you see here 1 mission we bought. Total how many in the gross block value? We have 7 missions we have. Now amount received on part of a block 10 lakhs. Am I right? Yes or no? 10 lakhs. So what is the balance value? I call it as WDV of the block on 31st March 26. Now here 6 assets are no 4 assets were there, because out of 7 here you sold 3. So part of a block is existing on 31st March, value is existing on 31st March. I will happily calculate depreciation. Now tell me, what is the depreciation? Working note number 1, yes or no? 7 lakhs is the WDV value. I will split into less than 180 days and balancing figure. How much is less than? 8.5 lakh is there. Therefore here entire 7 lakhs I can allocate here. Yes or no? So balancing figure 0. 15%. Here it is 7.5%. Yes or no? 7 lakh into 7.5%. How much it is? 52,000. 7.5%. No. 52,500. So total normal depreciation minus depreciation how much ma? 52,500. Array is a manufacturer, yeah. Additional, this is second hand machinery which he bought. Therefore there is no additional depreciation. Yes. Therefore what is the closing WDV after depreciation? 6,48,500. Do you agree? Now look at the questions that they are asking. Look at the questions. What is the claim of depreciation? Very simple. 52,500. Compute capital gains liable. No, they are not liable because block exists, value exists. Are you clear? If Singhania and Co sold the same 3 missions for 21 lakhs, amma, if at all they are selling this for not 10 ma, 21, your block becomes negative. That time I will not follow this format. I will follow reverse format. If I have to compute capital gains, no, always in exam you should roughly think. Should I compute depreciation or capital gains? Depreciation of this format you put it on the paper. You have to compute capital gains. Now put 50 format. Section 50. Section 50 format is what? Amount received how much? 21 lakh minus gross block value opening 8.5 lakh, additions during year 8.5 lakh, gross block value 17. So therefore 4 lakh is called as short term capital gain. Am I right? Yes or no? Over. Look at, part of a block sold for 11 lakhs. What are you seeing? Part of a block here we took 10, it's 11. See the questions, that's why. So part of a block is 11 here. It's okay, fine. Alternative sum this is, that's it. Here it is 11 ma. I'm sorry, I computed wrongly. It is 11. Therefore it is 6. Therefore it is 6. 6 into 7.5. How much it is? 45,000. Yes or no? So depreciation would be 45,000, and here it will be 21 minus 17. This is right only. Are you clear? Original first answer is 45,000 ma. First answer is what ma? Look at 45,000. See and tell me here. If I'm doing some wrong number, correct me. Are you clear? Now, second part of the answer. How much is the capital gain? Look at this short-term capital gain. How much? 4 lakh. Yes or no? If 3 machines are sold for 21 lakh, the capital gain is 4 lakh. In between, second point, they are asking capital gains. Here there is no capital gains based on first point because WDV value is there. Yes or no? Section 50, computation of capital gains will be arising only in the following case. When part of a block is sold, for consideration more than the value of the block, then capital gains arise, or all the assets are transferred then more than value or less than value, that time also capital gains or capital loss will arise. Yes or no? Since in the first two cases sale consideration is more than short-term capital gain, whereas in third case return on value of the block exceeds sale is a capital loss. In the given case capital gains will not arise as block of asset continue to exist and assets are sold for a price less than the block value, nothing but written down value exist. Are you clear? So with this, question number 9 is also completed. With this, section 50A is completed. Now once again I'll go back. I told you right, we have computation format. What is the computation format? We have 50A. Right now we completed, correct? Now we are still having one more computation format, 50B slump sale. I will come back to it at last. Okay, now let us first finish 48. Computation of capital gains for other assets, non-depreciable assets, or personal assets which are jewelry, archaeological collection, all that. Yes or no? Or business assets which are non-depreciable, or personal assets which are also again like shares, securities, all that. For when you are selling shares, securities, everything which does not come under block of asset concept, that time capital gains computation format 48 is applicable. Are you clear? In the very next session 48 I will discuss. Are you clear? Yes, I'll stop this video. Yes. Let us discuss now section 48. Section 48, even in our book also if you see, section 48 is given. This entirely whatever pages right now I'm scrolling, this entirely related to 48. Look at 48. What is this? This is a format of depreciation, this is a format of capital gains computation, section 48. This format is applicable when you are selling any capital asset other than depreciable assets under section 50, that is related to blocks. Okay, section 50 is related to block. No, other than that if you are selling, capital gains, which computation format applicable? 48 is applicable. Are you getting the point? Now as per 48, how should we compute capital gains? Tell me a simple logic. You tell me how to compute capital gains profit. Can I say sale value minus cost, am I right, is equal to profit? Sale minus cost is equal to profit. Can I simply say that? Exactly, same is what they mentioned here. But guess what? They are not calling it as sale value. Instead of calling it as value, they call it as consideration. They call it as what? Consideration. Full value of consideration. What is the first point that they use? Full value of consideration. Sometimes you receive consideration at full value. Consideration value, nothing but value of consideration. Are you clear? They are simply using the word full value. Simple, just for more complete meaning sense, full value of consideration. Identify. Okay, for example 1 crore minus, generally when you are transferring any asset, some selling expenses you will incur, right? We call them as transfer expenses. Let us assume it is 1 lakh. Then what you get is net consideration. Am I right? Net consideration, am I right? Which is 99 lakh. Minus, this is consideration, man, that you got, but to get this consideration you bought this asset long back. Acquisition cost, yes or no? That's called as cost of acquisition. What is it called as? Cost of acquisition. For example, I bought that asset at 10 lakh rupee. For example, in this example, what I sold is land and building. My residential land and building is what I sold. I sold it for 1 crore. My residential land and building, I sold it for 1 crore. Minus transfer expenditure is how much? 1 lakh. Then what you will get is what? Net consideration. Then you know what? I originally purchased this building 20 years back. That time only ground floor is there. Guess what? 10 years before, I constructed 2 more floors on the building. I constructed 2 more floors on the building, and for that I spent 30 lakh money. For that I spent 30 lakh money. Today what I sold is 3-floor building. But tell me, originally what I bought? 10 lakhs worth of building only I bought. Originally I bought what? 10 lakhs worth of ground floor only with land. Now I have 2 more floors I constructed. What is it called as? Tell me, did I improve the asset or not? Original asset, did I made improvement or not? That improvement cost is called as cost of improvement. What is it called as? Cost of improvement. That's it. You get capital gains. Let us assume it is 30 lakhs. Okay. Therefore, capital gains is equal to 99 minus 40. How much it is? 59 lakh is the capital gains. Now the question is it a long term or is it a short term? It's a long term in case if the holding period is more than 24 months or less than or equal to 24 months, short term, or if it is 12 months criteria, then 12 months. Are you clear? Are you clear? Now look at the format which is given in the book. Look at the format. First, full value of consideration. What is it? Full value of consideration. What is it? How much? That much. Less transfer expenses. Transfer expenses are always calculated on actual consideration. Then what you get? Net consideration. Then from that, reduce cost of acquisition, cost of improvement. You know what? Here I mentioned indexed cost of acquisition and indexed cost of improvement, right? Biggest change is what you know? If at all transfer date is on or after 23rd July 2024. If the transfer date is on or after 23rd July 2024, this indexation point will never apply. Will never apply. Computation is always original cost only. Computation is always cost only. Always cost. Are you clear? Indexation point I will compute in one circumstance, that too not capital gain computation, tax liability computation. Indexation logic I will use only a tax liability computation. If at all you are not aware of it, leave it, no problem at all. But when you are computing capital gains, no, at the time of tax computation, these 2 points are there at index word is there, right? Yes or no? Here index word is there, right? Index word is there, right? This is applicable only at a tax computation stage. What is it? This is applicable only at a tax computation stage. That too as a rough note only you will do that. You will not do it in the main problem. The main problem is always cost of acquisition, cost of improvement. In the main problem, there is no indexation at all. Are you clear? Main problem means what? In exam, they'll give you sale value, cost of acquisition, cost of improvement. You blindly reduce sale minus cost minus improvement. No question of indexation. Are you clear? But now sometimes they'll ask you tax computation also. What is the tax on capital gain? That time, there is one scenario where in the rough notes, instead of cost, you should take indexed cost. So that too we will calculate only in working note, not in the main answer. Remember this for this moment, okay? I will come back to it later. Then you get what? Capital gain. Then from this, no, I told you, once you compute capital gain, you have again deductions, yes or no? Exemptions under 54. Then finally you get taxable capital gain. Now if you observe, everywhere I have given something called note number 1. Everywhere I have given something called note number 1. Now what do you mean by full value of consideration? Note number 1. What do you mean by transfer expense? Note number 2. What do you mean by cost of acquisition? Note number 3. What do you mean by cost of improvement? Note number 4. What do you mean by exemptions? Note number 5. Which means entire this table is explained below in depth. Are you clear? Clear all of you? Next. Now look at note number 1, 2, 3, 4, 5. Very simple. Okay. We have again, note number 1. We have entire dedicated discussion, FVC. Okay. Note number 2, cost of acquisition, right? Transfer expense, simple point here itself. Note number 3, cost of acquisition, no? We have 3 pages discussion. See, cost of acquisition means what? You see 3-4 pages discussion. This entirely 5 pages, I think it is. Yeah. It is almost 5 pages. Cost of improvement means what? Again discussed. Exemptions, note number 5, I told no there. Again, we have that dedicated before big 5-6 pages discussion. Are you clear? Typically in capital gains, what are we discussing? We are only discussing this format. Am I right? We are technically discussing this format. Now first, let us basically understand each and every term in a simplest way. Okay. What is full value of consideration? Actual consideration, I sell the asset for 1 crore, then 1 crore. Sometimes no, consideration is not actual amount, it is deemed consideration. What is it? Deemed considerations. Yes or no? For example, house property chapter, you remember, sometimes it is not rent received, it is expected rent, gross annual value, deemed let out property. Do you really get income? No, but still we are taxing it deemed value. Here also deemed consideration point is there. Are you clear? Then cost of acquisition. What is cost of acquisition? Actual cost. Or here also sometimes deemed cost of acquisition is there. Are you clear? Then improvement, actual cost or deemed cost of improvement will be there. Are you clear? Then transfer expenses. What is transfer? Very simple. Any expense I incurred wholly and exclusively for transfer, like brokerage, stamp duty, registration, legal fees, etc. We call it as what? Transfer expenses. Remember, most importantly, suppose if I am selling shares and securities in listed stock exchange, okay, and I'm paying security transaction tax. See, brokerage I can claim deduction, but if at all you are selling shares which are capital asset, STT you are paying no deduction under income tax for STT for capital assets. But look at PGBP chapter, if at all the shares and securities is a stock in trade to me, STT paid is deductible under section 36. For a stock in trade, for a trader, no problem for STT, that's an expenditure for him. But for an investor, if at all shares and securities are capital asset for you, STT paid, no deduction. Are you clear? No deduction for STT paid on listed security. First of all, security transaction tax is applicable only for listed securities. Okay, you won't get deduction. Are you clear? All of you? Yes or no? That's it. Now, one after one, in-depth discussion we will cover. Now, first we should learn how to compute FVC. Then we should learn how to compute cost. Then we should learn how to compute cost of improvement. Once we learn these elements, happily we can directly go to the problems and solve any problem. Clear? All of you? That's it. Okay, fine. I'll wind up this session. Right now, I just gave you a brief idea about computation of capital gain 48. In the next session onwards, one element after one element, we will decode and apply on the problems also. Confident? Yes or no? That's it. Yes, let's continue the discussion. In the previous session, we understood capital gain computation format for other than depreciable assets. Okay, and that format alone we understood. We need to discuss in-depth element of each and every item. Right? Let's once look at the GOAT notes. So full value of consideration, first you need to calculate, then you need to reduce transfer expenses. Generally, transfer expenses are given as a percentage of actual consideration. So transfer expenses is always taken as a percentage of actual. Okay, now like what exactly it is, I'll come back to it later. Next, what you get is next net consideration. Then what you should reduce? Cost of acquisition and cost of improvement. This indexation point rarely comes. I will tell you when it will come also. Okay. Next, then what you get is gross long-term capital gain, and each of it one by one I already briefly told. Now let us understand in depth about one after the other. Okay. Now what is a full value of consideration? First of all, sale consideration. Correct? Generally, capital gains is arising when I sell the asset, when I sell the capital asset generally, which is the popular mode of transport. See, we have transfer. Popular mode of transfer is what? Sale. Sale includes, transfer includes sale, exchange, relinquishment, extinguishment, so many were there. But the popular mode is what? Sale. Suppose if I am selling, I'm getting, for example, I am selling land and building. I am selling an immovable property. Okay, that too, which immovable property? That immovable property which is not part of block of asset. If it is block of asset, this format will not apply. Full value of consideration logic will not apply. Are you clear? If at all I am selling any building which is forming part of a block, then block of asset, part of a block, full block sale, that treatment will apply. Now again, if a business assessee, if a person who is engaged in business or profession and he is having land and building which is used for business or profession, now when he is selling land and building, land related capital gain computation will be done as per 48. Why? Land is not a depreciable asset and land cost is never added to the block. Am I right? Next, whereas building, since it's a business purpose building, block of asset method section 50 will apply. If at all examiner want to really test the students level of understanding, conceptual understanding, this kind of examples they will frame. But anyhow, so normally suppose I'm a non-business person, I am selling land and building. You know what, I sold land and building at 1 crore. I sold it 1 crore. Now can I take this entire 1 crore as full value of consideration? Can I take this is my consideration, can I take it? No. The income tax capital gains, there is one more section called 50C. There is a section called 50C. Whenever you are selling immovable property, whenever you are selling immovable property where capital gains are assessable, under section 48. If capital gains are computed under 48 in respect of this immovable property, then full value of consideration is determined as per section 50C. You know what 50C says? Full value of consideration is equal to, generally actual consideration. Actual consideration means whatever consideration that they give in the exam, whatever the sale price, that is actual. However, in exam, stamp duty value will also be given. If stamp duty value is more than 110% of actual consideration, if stamp duty value is more than 110% of actual consideration, then full value of consideration is equal to stamp duty value. Otherwise, full value of consideration is equal to actual only. What does it mean? For example, actual consideration at which I sold the property is 90 lakhs. And as per stamp duty value records, the value is 105 lakh. The value is how much? 105 lakh. Now, what is the full value of consideration I should take for computing capital gains? Capital gains, how will I compute? Sale minus cost. Now, first here I need to identify sale value how much. Sale value is how much? Actually 90. But that is not, you cannot take directly. That you can't take. You need to take full value of consideration. Now 50C section is applicable here. As per 50C, stamp duty value is how much? 105. Is it more than 110% of actual consideration? Yes. Now you see 110% of 90 lakh, you see what is 110% of 90? 110% of 90 is equal to 99 lakh, whereas the stamp duty value 105. Yeah, stamp duty value in the given example is more than 110% of the actual. Therefore, full value of consideration is taken as 105. Are you clear? Suppose the same example, stamp duty value is 98 only. What is the stamp duty value? 98. Now again, since stamp duty value is given, I will do comparison. Is stamp duty value more than 110% of actual? Now in the given case, stamp duty value 98. Is it more than 110% of 90 is equal to 99? Is it more than 98, more than 99? No. Therefore, this logic will not apply. Therefore, full value of consideration is actual only. Indirectly, what department is telling, indirectly, see, if your actual consideration, whatever you say that you are receiving only that much, I am not here to believe you. I will see municipal record stamp duty value data. If the stamp duty value is higher than your actual value, up to 10%, I don't have a problem. Up to 10%, okay, plus or minus market rate, I will agree. But if the stamp duty value is 110% and above, if the stamp duty value is higher than 110% of actual, then I will not believe you. I will take municipal records value, stamp duty value. Are you clear? Now here there is one more twist. Now generally, how an immovable property dealing happens, suppose I went and saw one land. I liked the land. Yeah, I'm okay with it. Vastu, everything is good. We negotiated the price. Entirely is done. Then finally, on 1st October 2025, we entered into agreement to sell. We entered into an agreement to sell. Agreement to sell means seller will agree with the buyer. Because I have acknowledged, I'm ready. I acknowledged him, I'm ready. And what, the moment first we entered into agreement. Okay, I told, buyer told to the seller, or seller told to the buyer, sir, for next 2 to 3 months I cannot sell it, sir. We'll wait for 2-3 months. Not for anything. No. Price confirmed. Agreed. the actual consideration is equal to let us assume 90 crore. That's a very big land, commercial, 90 crore. Let's agree, sir, no problem. Price and all, no change. But now I cannot register, sir, because I have to come from outside India. Over the phone, this entire conversation is happening. But his agent is there who signed this agreement. Now, ultimately, the registration is going to happen on 1st February 2026. This is the date of agreement. This is date of registration. Are you clear? Now, on this date, registration is going to happen. But at the time of agreement, no, sir, are you confirmed? You will buy? Buyer said, yes, sir, 100% I'll pay. Then pay me some advance, sir. Otherwise, how will I trust you? How will I wait for next 4 months? So seller asked. And buyer, what buyer did? 5 lakh rupee advance he paid. 5 lakh rupee advance he paid by account payee check. What is it? 5 lakh rupee advance he paid by other than cash. Nothing but other than cash he has to pay. He paid also. 5 lakh rupee cash he paid also. Now, finally on 1st February, registration is over. Sale is over. I paid 5 lakh already paid, no, remaining 89 crore 95 lakh rupee on the registration date I paid to the seller. Seller already registered the property in my name, happy. Now, seller is there, right? From the seller perspective, for him, he transferred a capital asset. For him, capital gains we need to compute. He went to his auditor. Now, the auditor is saying, sir, how much is the full value of consideration? Sir, I sold it for 90 crores, sir. Sir, we need to compare with stamp duty value. Okay, sir, compare it. Stamp duty value, on registration date, the stamp duty value is 100, 90. On registration date, the stamp duty value is how much, 98 crore. On registration date, stamp duty value, 98 crore. But guess what? Whereas on the agreement date, what is it? On agreement date, the stamp duty value is 110 crore. What is the stamp duty value? 110 crore. Oh my God, sir. On the date on which you entered into agreement, stamp duty value was 110 crore. Later, stamp duty value reduced. Seller is also happy. Yes, sir. Suddenly after that, the market fall is there. So price reduced. But lucky I sold the property. Sir, but there is a twist in income tax law. In income tax law, stamp duty value means what? Generally stamp duty value means value on registration date. Generally registration date, whatever value is there, that only we will take, sir. But in 50C, one condition is there, one situation is there. What situation, sir? He said, have you received advance from buyer, sir, by any mode, by account to pay check like that? Have you received any advance, sir? Have you received advance from buyer other than cash? So yes, sir, he received. He paid me token amount 5 lakh. When he paid, sir? 1st October itself he paid, sir. Oh, which means, sir, for you, stamp duty value is not registration value, sir. Stamp duty value is agreement date, whatever is there, that stamp duty value will apply to you, sir. Okay, if it's applicable, what problem? Sir, the date, as per municipal record, the stamp duty value is 110 crores, sir, which is more than 110% of actual consideration, 99 crore. Actual 90, 110%. Therefore, full value of consideration we should take 110 crore. Are you clear? Do you understand? Yes or no? Now, this is the twist. So, stamp duty value means what? In the problem, if advance point, nothing is given. Date of registration, whatever stamp duty value is it, that. But date of agreement, when stamp duty value provision will apply? If at all, seller received from buyer advance. Yes or no? And advance is received by other than cash. Are you getting the point? Agreement date is different, registration date is different. And seller received advance and advance is received by other than cash. Are you clear? Then stamp duty value on the date of agreement we should consider. And that stamp duty value should be compared with 110% of actual consideration. Accordingly, either STB will come or actual will come the answer. Are you clear? That's it. Provision 50C over. Provision 50C over. Look at what is full value of consideration. Full value of consideration in case of transfer of immovable property. How much is the full value of consideration? If stamp duty value exceeds 110% of actual, then FVC how much you should take? Stamp duty value. If does not exceed 110%, then actual. Then actual exceeds only ma. For example, stamp duty value is 99 lakh. Actual consideration 90 into 110% is equal to 99. It's just equal, not exceed. Therefore, actual only, actual 90 only I will take. It should be more than 110%, not equal to also. Are you clear? Only if the difference is beyond 10% only stamp duty value provision will apply. Now the question is, stamp duty value which date you should take? Because in immovable properties, no, agreement date will be there, registration date will be there. Which date stamp duty value we should take? We should take stamp duty value generally on the date of registration, nothing but transfer. Yes or no? When date of registration, for example, there is no advance at all, there is no advance involved, buyer directly paid full amount and bought, advance and all not there, agreement is there, sale registration, two dates are different, but advance amount is not there. Or advance is there, sir, seller, no, I'm a seller, I received advance, sir, but in cash mode I received, then also stamp duty value on date of registration only will apply. Suppose if the seller received advance from buyer on or before date of agreement, if at all advance is received when? On or before agreement date, not transfer date, by that to which mode? By other than cash, then stamp duty value on date of agreement will apply. Are you clear? Generally this is a protective provision for the seller only. It's actually good. Why? Mostly immovable properties prices will be rising, no? Agreement date generally stamp duty value will be lower, maybe at the time of registration value will be higher. So SSC what SSC might argue, sir, I entered into agreement long back, sir, that time value is lower, now again you are increasing higher. Yes or no? Are you getting it? So in a protective way drafted, but sometimes this provision might even hurt the SSC. Sometimes this provision work against the SSC also, but nothing can be done. Yes or no? Are you clear? Stamp duty value concept, are you clear? Yes or no? Now remember, in PGBP we kept one provision, we have one provision called 43CA. PGBP is applicable for whom? Real estate dealer. Suppose in PGBP also a 50C kind of similar provision is there, which is 43CA. What is it? 43CA. I am opening it. 43CA. You see, this I kept pending. You remember this I kept pending? Yeah, now look at what is in PGBP 43CA. Stamp duty value provisions in case of immovable property, 96th page. Okay, stamp duty provision in case of immovable property, 96th page. Look at, suppose if the business person is transferring land or building or both, which he is actually holding as stock in trade. Suppose I am selling a flat to some buyer, I sold it at 90 lakh, but in PGBP, how much income I must show? If stamp duty value is more than 110% of the actual, then stamp duty value shall be shown as income in the PGBP, turnover in the PGBP, if the stamp duty value is more than 110%. Otherwise, actual amount whatever at which you sold, that itself is shown as the selling price. Are you clear? So if stamp duty value exceeds 110% of actual, then stamp duty. Here you see that's why I didn't say full value of consideration. I mentioned clearly revenue under PGBP how much. Suppose if it does not exceed, then actual. That too, which stamp duty value determination? Same. Advance received from buyer on or before date of agreement by other than cash, then date of agreement. Otherwise, stamp duty value on the date of sale. Suppose if SSC thinks, means the seller, he thinks stamp duty value is very high than market value. For example, market value is just 95 crore and finally actual amount is 90 crore. Okay, but stamp duty value in that property is 150 crore, unusually high. So SSA by seller, sir, stamp duty value, sir, whatever your book records, that books and all keep aside, come and see the real market. No one is ready to buy at that values. How come you tax me 150 crore like that? SSC argued with the assessing officer. Then assessing officer understood the situation. What he can do, in that case, he can refer to valuation officer. He can refer in that scenario to valuation officer. That discussion is already there in the capital gains topic. I will directly go there. Are you clear? Once again, I'll come back to capital gains topic. So now, if SSC request, what is it? If SSC request AO on the ground that stamp duty value is much higher than market value, fair market value, then AO may refer the stamp duty value to valuation officer, and in such a case, full value of consideration shall be value determined by valuation officer. That too when only if it is beneficial to SSC. For example, no, I will tell you. Okay, so what happened here is I sold one of my immovable property. Maybe I'm a real estate dealer, or maybe I'm a capital asset for that building to be, leave it aside. Okay, because whether I'm a real estate dealer, whether it is a 50 CR, whether it's a 43 CR, both the cases provision is same. Yes or no? Now look at, what happened is actual consideration I sold for 90 crore, but fair market value is what, 95 crore, because very recently somebody bought a similar land at 95 crore in the locality. But real estate prices are not constant. No, it is not a product to have MRP. Correct? Fine. Now, stamp duty value as per registrar is 150 crore. Now what department is saying, my dear, full value of consideration is equal to stamp duty value. Why? It is more than 110% of actual. He said 150 crore is taxable as revenue. He said, sir, that is unfair, sir. I told him, please, no, you, if you want, you send a surveyor, you send a market valuationer. He will come and tell you what real value is there. Then assessing officer appointed one valuation officer. This officer came, did valuation, and went back and reported, sir, it is not 90, 150, not, it is 200 crore, he said. It is completely even unfavorable. So if valuation officer give value which is even more than stamp duty value, then stamp duty value, then SSC what he will say, sir, that value, happy I'll go with stamp duty value only. Yes or no? Suppose if the valuation officer come back and say, yes sir, the value is only 120 crore, then I will take value given by valuation officer. Are you clear? Yes or no? So look at, if fair market value is more than stamp duty value as per valuation officer value, then stamp duty value. If it is less than fair market value is less than stamp duty, then fair market value. Yes or no? That's it. Then SDV is revised in appeal, revised SDV. This point you can ignore. Why? Because appeals concept we don't have in our syllabus. Are you confident? Next, one example. Suppose actual consideration 100 lakhs ma. Stamp duty value on agreement date is 109 ma. Stamp duty value on the date of transfer is 112 lakh ma. And let us assume here advance is paid in other than cash on agreement date itself. In such a case, stamp duty value on agreement date will apply. Now, is 109 more than 110% of 100? No. Therefore, if at all here advance paid is, so therefore deemed full value of consideration is actual. Suppose no, if there is no advance paid, that time stamp duty value on a registration will apply. Is 112 more than 110% of 100? Yes. Therefore, 112 will be treated as stamp duty value. That's it. So generally, what is full value of consideration? Suppose I'm selling shares ma, I'm selling listed company shares. Array, you are selling in stock exchange directly. How much you received? 500 rupees is selling price, 100 shares I sold. 50,000 rupees is only full value. No problem at all. But if it is immovable property, this is how you need to check. The moment you are doing problem for immovable property, immediately you should check for stamp duty value application. Are you clear? Yes or no? Then full value of consideration in some other scenario. Full value of consideration in some other scenario. Look at this unquoted. Unquoted means unlisted shares. Unquoted shares are also called as what? Unlisted shares. Now, what is full value of consideration? Suppose no, I am selling unlisted shares. Tell me, by the way, unlisted shares holding period concept is 24 months, correct? Yes, I am selling unlisted shares and I am selling this unlisted shares at 1000 rupees per share. 1000 rupees per share, and the fair market value is 2000 rupees actually. If consideration received is less than fair market value, then income tax department will take fair market value as full value of consideration. What is full value of consideration? Fair market value. Next, 50D. Sometimes if the consideration received or accruing cannot be ascertained for other assets generally. Suppose you got some consideration, but what is its value? You exchanged a property and you got consideration. We are unable to identify what is its value. Then asset given is there, right? Asset you transferred and received some other asset, right? Asset transferred, that has a market value, right? That much is only treated as consideration. Whatever you sold, that market value itself is treated as sale value. Are you clear? Now we understood FVC point. Are you clear? FVC point, everyone understood or not? FVC point understood. That's it. Now second one is what? Transfer expenses. Second one that we need to reduce is what? Transfer expenses. How much is the transfer expenses? Transfer expenses means what? Selling expenses. Selling expenses in the problem, no, they will tell you 1% brokerage. Brokerage, we pay to broker, is it based on percentage of sale or is it based on percentage of stamp value? Brokerage is always paid as a percentage of sale. Generally, transfer expenses are applied as a percentage of sale. Maybe when you're doing a problem, no, you know, full value of consideration you might have taken STV, but when you're reducing transfer expenses, never apply here percentage. Actual amount you see on that apply percentage, 1% like that you should reduce. Are you clear? Yes or no? That's it. Now we understood full value of consideration, we understood transfer expenses, then you get net consideration. Now what we need to understand? Cost of acquisition, cost of improvement. If these 2 points we understand, finally we can easily compute capital gains. Are you clear? Now let's understand what is cost of acquisition. What is cost of acquisition? Now I will tell you what are the provisions that are dealing with cost of acquisition. There are 2 sections that are dealing with cost of acquisition. One is 49, another one is 55. You know, 55 actually explains what is cost of acquisition. What is cost of acquisition? 55 section explains that. Then what is 49, sir? 49 explains source of cost of acquisition. 49 explains source of cost of acquisition. Are you clear? 49 section explains source, nothing but what is 49 exactly dealing with. Tell me what is cost of acquisition generally? Sir, right now I sold a land, sir. Right now I sold a land. Right now I sold some land, sir. Okay, how to arrive full value? Right now we understood already. But this land, no, I purchased 10 years ago. I purchased 10 years ago. How much at what price? 5 lakhs I paid. Then 5 lakhs is only cost of acquisition. No doubt at all. Undoubtedly 5 lakhs only. When you purchase for 5 lakhs, it is cost of acquisition is 5 lakhs. Sir, the point is I didn't buy it. I got this land through 49 subsection 1 modes. What is it? I got this land through circumstances referred under 49. Let us assume 49. What is the circumstance referred under 49? Well, like, what does it mean? What do you mean by circumstance referred under 49? Sir, you don't. I will show you. Circumstances referred on 49 means what? I will show you. What are the circumstances referred? Okay. What is the cost of acquisition? If the capital asset became the property of the current assessee through under gift, will, yes or no, gift or will, yes or no, by an individual or HUF. I have received it as a gift or will from an individual or HUF. I received it as a gift from my father, or inheritance, succession, inheritance, or devolution. Are you clear? I got it through succession, inheritance, or devolution. Are you getting it? Or I transfer, not this, that's it. These are the 2 main points. Remaining I'll come back to it later. If at all I got through gift or inheritance, then what is the cost of acquisition? You know what is the cost of acquisition if I got it through gift? Cost of acquisition to PO. PO means what? Previous owner. Cost of acquisition to PO, previous owner. PO, previous owner point I already told that somewhere. 2 clause 42A, holding period computation. Yes or no? If my father purchased the land and I am selling the land subsequently, holding period will be computed from my father acquisition date. Yes or no? So here also cost of acquisition is cost to previous owner. Are you clear? Yes or no? So cost of acquisition is cost to previous owner. Now cost means what? What do you mean by cost? Cost means what? Section 55 explains. See, 49 says what? 49 says if at all you got, if at all you received capital asset, you got this capital asset originally by gift, inheritance, all that. I will tell you. Then only you open. Okay. Otherwise you will miss the flow unnecessarily. Okay. You just focus when I open the book, that time you see. Okay. Now gift, will, inheritance. Suppose I got a property under a gift, or I got a property under inheritance, or I got a property under succession. Are you clear? Now what is the cost? Actually I didn't pay anything. I didn't pay anything for this. I paid 0. Yes or no? But this land, no, I am selling tomorrow at 100 crore. Now what is my cost? 0. Do you say 0? But my father paid so much of amount. No, what about that? Are you getting the point? See, it's my father property. It's my father property, and now I am selling it. But my father paid some money, that cost also I should claim, right? See, if my father property, if I am selling, if I am getting money, you are taxing it. But then what about my father spending? He paid this asset. He paid for this asset. That cost I can take. So 49 subsection 1, what it says, what is cost in case of this? Cost to previous owner. Whatever previous owner cost incurred, same cost you take. Now cost means what? 55 section clarifies that. 55 section explains meaning of the cost. Meaning of the cost means what? Actual cost. What is the meaning of the cost? Actual cost. Suppose, here there is a twist. Suppose if the capital asset, if the capital asset is acquired on or before, if the capital asset is acquired on or before 1st April 2001, if the capital asset is acquired on or before 1st April 2001, what is the cost? Actual cost, how much checkout, or fair market value on 1st April 2001, whichever is higher. Are you clear? This point where it is mentioned, 55 section says that. What 55 section says? Previous owner at what price he purchased, that price only take it as cost, purchase price only. Sir, my previous owner, my father purchased this house before 2001, sir. 1st April 2001, before he purchased it, sir. Okay, then cost is what? Actual cost. Sir, my father paid in 1988. Okay, approximately 2 lakhs for that land. Today 100 crore is the value, but that time it is 2 lakhs only. And fair market value on 1st April 2001 is 2 crore. Whichever is higher, so that value you have to take it as cost of acquisition. Therefore cost of acquisition is cost to previous owner. My previous owner purchased before 1st April 2001. Therefore FMB is how much? FMB is how much? On the day 2 crore. Actual cost is 2 lakhs. Whichever is higher is equal to 2 crore. That is what section 55 says. Actually it's a beneficial provision for the SSC. What is it? Beneficial provision for the SSC. So if the SSC, you only acquired before. See, if the SSC or previous owner, whoever acquired, that fellow. If either SSC or previous owner, if any of them, or if any of them, see, if it is previous owner, then previous owner. Sir, land is mine only, myself owned. I didn't get anything as a gift and all from parents, inheritance, nothing is there. I only bought. When you bought? Before 2001 I bought, sir. Or you got it as an inheritance, when he bought it before 2001, sir. Then on or before 1st April 2001, if at all capital asset is bought, on or before 1st April 2001, if a capital asset is acquired by the SSC or by the previous owner, yes or no, then actual cost or fair market value, whichever is higher. Are you clear? By the way, tell me here, I told you, right, 49 subsection 1, cost to previous owner. This is what taken as cost of acquisition. When should I take this logic? If I am getting the capital asset, right now I am the current owner, I am getting this capital asset through gift, will, inheritance, succession, like that. If at all I am getting only this logic applicable. Sir, I bought from some third party, sir. I want to buy in 2005-6, no, in 2005-6 year, no, I have some savings, sir. That time I consulted one broker, sir, and through broker we found one buyer, sir. One seller is there, sir. I paid him 10 lakh rupee. I paid him 10 lakh rupee and bought a land in my name, sir. Now he might have purchased a 3 lakh rupee, 2 lakh rupee, 10,000 rupee. Yes or no? Now this 10 lakh rupee worth of land, today I am selling it for 2 crore, sir. What is full value of consideration? Let us assume stamp duty value also 2 crore, 2 crore. What is cost of acquisition here? What is cost of acquisition? 10 lakh. Sir, cost to previous owner 3 lakh, no? No. Cost to previous owner logic is when applicable? Cost to the previous one is applicable if at all you got this asset. Right now you are selling it at 2 crore, right? This asset you got under the modes, under the circumstances mentioned under 49(1). Through that circumstance you received. That time cost to the previous owner, because you will incur no cost actually. Are you clear? Yes or no? That's it. Now one more point. Suppose if either the SSE or the previous owner, if they acquired the capital asset before 1st April 2001, on or before 1st April 2001, then cost of acquisition is actual cost or fair market value, whichever is higher. Are you clear? Now you know what? There is a land. By the way, before I go further, what do you mean by previous owner? What do you mean by previous owner? For example, I'll give you one example, okay? Actually, my great grandfather, he purchased a land in 1970 at just 250 rupees. He purchased at how much price? 250 rupees. 3 acres he purchased. 3 acres he purchased of land. Okay. So 1970 he purchased. Let us assume. Fine. In 1980, my grandfather inherited that. Tell me, inheritance gift is not a transfer as per section 47. When property changed from great grandfather to my grandfather, nothing is taxable. Fine. Now, at the time when my grandfather got this property, that time fair market value is what? 1500 rupees. That time fair market value is 1500 rupees of the same land. Again, from my grandfather, my father inherited in 1995. That time the land is 2 lakh already. By then the land is 2 lakh. My father acquired it. From my father, I inherited in 2015. I inherited when? 2015. 2015 year I inherited. This time the market value is 1 crore. And guess what? In 2025-26 year, 2025 and 26 year, this is myself. Okay, are you clear? Now in this year I sold this land for 5 crore. I sold this land for 5 crore. Now minus what is cost of acquisition? You say simply, because how I got this property through gift, inheritance, succession. Yes or no? What is the cost of acquisition? Cost to previous owner. Now previous owner means what here? Previous owner means what? Actually to me, my father, for him also cost is 0. For him, he got it through his previous owner. For him also cost 0. For him also he got it through his previous owner. Actually, this is not bought by my father. If my father purchased it, then that cost I will take. He didn't buy this. He inherited. Oh, he also did not incur. Then how he got it? He got through inheritance. Oh, for him cost to previous owner. For him cost to previous owner. For him cost to previous owner. Are you clear? So cost to the previous owner means what? Previously who originally purchased? My great grandfather purchased. So cost to the previous owner means 250 rupees. The one in the entire previous one. Are you getting it? Who originally purchased. My father did not purchase. My grandfather did not purchase. But my great grandfather, he originally purchased. And I got it through succession like this. One after one, I got this. Are you clear? So cost to the previous owner means what actually cost is that to my original previous owner. That is what previous owner example here. So 250 rupees you should take. Or since my great grandfather purchased in 1970, which is before 1/4/2001, 1st April 2001 fair market value on 1st April 2001, no fair market value on 1st April 2001, no, it is already on 1st April 2001, it is already 10 lakh. On 1st April 2001, it is already how much? 10 lakh. So 250 or 10 lakh, whichever is higher. So what is cost of acquisition? 10 lakh. But guess what? On the same date, 1st April, stamp duty value data is also available. Stamp duty value data is also available. And what is the stamp duty value? 7 lakh. Then what? Section 55 says, first, my dear, calculate as usual. Cost of acquisition is what? Actual cost 250 rupees or fair market value on the day, which is 10 lakhs, whichever is higher. But since it is immovable property, this value cost cannot exceed, should not exceed stamp duty value on 1st April 2001. Sir, stamp duty value on 1st April 7 lakhs. Then take cost of acquisition as 7 lakh rupees only. Are you clear? Are you clear? This is how you need to calculate cost of acquisition. Cost of acquisition concept understood mainly. That's it. For immovable property, cost of acquisition point is clear. Then let's understand some other scenarios how to calculate cost of acquisition. Some other scenarios how to calculate cost of acquisition. For example, no, right now today I am actually selling listed equity shares. Right now I am selling what, listed equity shares. I am selling them at 2000 rupees per share. I actually have 1000 shares. So what is the consideration? 20 lakh. Are you clear? Now how I got these shares? I didn't buy these shares. I didn't buy these shares. Then how did you sell it without buying? Earlier I bought preference shares. Earlier I bought preference shares that were converted into shares. Earlier I bought 1000 preference shares, or I might have bought 500 preference shares. Are you getting it? Now this 500 shares were given 1:2 conversion ratio. For every one preference share I got 2 equity shares. These 500 preference shares, no, earlier I bought at, each share I bought at, let us assume 500, which is equal to 500 into 500. How much it is? 225. So 2,50,000 rupees is the cost of acquisition. Yes or no? Because you invested earlier 2,50,000, then you got these equity shares, and today you are able to sell them at 20 lakh. For getting this 20 lakh, earlier how much you invested? 2,50,000. Then here cost of acquisition is cost of previous asset. Reduce it. Balance amount 17.5 lakh is capital gain. Sir, here is there any such 1/4/2001 logic? Here everything happened after 1/4/2001. Suppose no, if I buy this preference share before 1st April 2001, no, then actual cost how much, or market value on 1st April 2001, whichever is higher. Should I compare with stamp duty value? Stamp duty value will be compared for which property? Immovable property. When computation of capital gain is not through block of asset format, 48 format you are doing, that time only all this logic is applicable. Are you clear? Yes or no? Next. Are you clear? Now sir, what if a building is there, which is forming part of block, but this building, no sir, company purchased it before 2001, sir. Now for the building which is forming part of block right now, it is sold, sir. Okay, it is sold. To this also fair market value is STV on 1st April 2001 logic applicable? No. Fair market value on 1/4/2001, STV on 1/4/2001 applicable only when you are computing capital gains under 48. And first of all, there's a building forming part of block, and if you are selling building which is forming part of block, section 50 computation format applicable, not 48. Therefore accordingly, when you are selling depreciable assets, the logic of 1/4/2001 will never apply. Are you clear? Easy or not? That's it. So now by the way, shares point you understood? Conversion shares, fine. Suppose in 2004-5 I bought Reliance company shares of 500 shares at 100 rupees per share, which is exactly 50,000 rupees I invested. You know what? In 2007, 2008, company gave 1:1 bonus. So accordingly I got shares, 500 shares, I paid 0. Are you clear? Again in 2012-13, again company gave 1:1 bonus. By then how many shares I have? 1000. So again I got 1000 shares. At 0. Finally in 2025 and 2026, by this time I have 2000 shares now. Yes or no? All the 2000 shares were sold by me. Now how to compute capital gains? Always compute separately. Original shares how many? Original I bought 500, sir. Then first time bonus how many you got? 500, sir. Second time you got bonus how many? 1000, sir. That's it. What is original shares cost of acquisition? You paid 100 rupees, sir. So 100 rupees is the cost of acquisition, sir. Are you clear? 100. Yes or no? So therefore what is the cost of acquisition? 50,000. By the way, are the original shares bought before 1/4/2001? No. Therefore that logic will not apply. 2004 logic will apply. Are you clear? Then what about bonus share? 0. Cost of acquisition 0. What about this? Cost of acquisition 0. If bonus shares are allotted, cost of acquisition is taken as 0. Are you clear? Yes or no? Another example, right shares? Right shares, yeah. For example, in Reliance Industries Limited, I am having 1000 shares, okay, which I purchased at 500 rupees per share, where I invested 5 lakh rupee in 2015-16 year. Somewhere in 2018-19, company declared 2:5. What is it? Sorry. 5:2 right shares they declared. For every 5 shares held, you are eligible for 2 shares. 1000 by 5 means what? 200. 200 into 2 means what? 400. Suppose if I have 5 shares, I'm eligible for 2. If I have 1000 shares, I'm eligible for how many rights? 400 right shares I'm eligible. Guess what? Market value is what, that day? 2000 rupees per share. But since I am already existing shareholder, company is charging me issue price 1200 rupees only. They are charging me how much? 1200 rupees. Generally, if at all you're a clever man, what he will do? He will happily buy 400 shares into 1200. Yes or no? How much it is? By paying 4,80,000, he'll happily buy the share. Immediately, the same 400 shares he will go back and sell in the open market at 8 lakh rupee and make 3.2 lakh rupee profit. Correct? Because company gave me this wonderful option. But guess what? I'm a shareholder, right? Yeah, since I'm a shareholder, I have this benefit. But guess what? I don't have this money, first of all, in my bank. I don't have money. Okay, shares you have, no. Put them in loan and get the loan. I already took the loan and used it for personal purpose. I don't have any money. Nobody is ready to give me. Okay, which means 2000 rupees worth of share you can immediately buy right now at 1200 rupees, where 800 rupees per share you can easily make a profit, right? Now here I can relinquish my right. What is it? I can relinquish. This is the right for me. How many rights I have? 400 rights I have. Here, because I'm an existing shareholder having 1000 shares, I'm having 400 right shares option. I have a right to purchase 400 shares at 1200 rupees, where market value 2000. Indirectly, the rights I have, no, that market value is 3.2 lakh, no? The right value itself, the right value is how much? 3.2 lakh. But I don't have that much money. Are you clear? I want to buy at 1200 into 400, 4.8 lakh rupee I require. I don't have money. So I am able to, because of this, I'm going to lose 3.2 lakh worth of benefit I'm going to lose. But nothing to worry. Company gave right renouncement option. What company did, right renouncement option they gave. Company gave right renouncement option. Sir, what is right renouncement? Very simple. You don't want to buy the right share, huh? I don't want to buy, sir. Do one thing. You have 400 rights. No, give it to your friend. He will buy at least. Oh, that option is there. Happily you can give. Tell me, what is the market value? 2000. At what price company is giving you? 1200. So how much profit if you buy you can make? 800. Do one thing to your friend, no, you sell this right only for 600 rupee. You sell right only for 600 rupee. Oh, okay, I will sell right at 600. What he will do with that? He will buy from the company at 1200 rupee. And he will go and tell, so no, I am the friend, I'm telling, I saw my friend facing this tough situation. I told him, why are you facing that tough issue, Ram? You sell me at 600, I'll pay you 600. Give me 400 rates. I will pay you right away 2,40,000 to your bank. Enjoy. What he will do, he asked me, hey, 400 rights I bought, no, at 400 rights I bought at 600, no, I will go to the company and I will pay 1200 and got allot 4.8 lakh worth of share. Okay, what you will do with that? So 4 plus 2, 7,20,000 I pay totally. To you, how much I paid? 2,40,000. To the company, how much I'm paying? 4,80,000. Immediately, I will sell in the open market at 2,000 rupees into 400, 8 lakh. So I'm selling at 8 lakh. Again, I'm making a profit of 80,000. Are you getting it? Now, my friend renounced me the right, no? So what is right renouncement consideration he received? 600 rupees per share he received from me. Are you getting it? Now he renounced 600 rupees, no? What is its cost of acquisition? 0. What is the cost of acquisition? 0. He didn't pay anything to get that right. He's just a shareholder. He got the right. That right has a value. That value he encashed it by transferring that value to me. He has a power to buy the shares. That power he transferred me. That's it. How he got the power? How much he paid for getting the power? Nothing. He didn't pay anything. Sir, immediately you may say, sir, he paid original shares he bought. No, that is no, that is shares cost of acquisition. The price cost is nothing. This is a generated right, intangible right. Are you getting it? This cost is 0. Therefore, now compute capital gains. Very simple. In the hands of seller of right, I am selling at 600, cost is 0, 600 is capital gain. Are you clear? Yes or no? Buyer of right, he paid 600 to me, to the seller of right, and again he paid to the company 1200. Total 1800 rupees is the cost of acquisition of the share to him. Are you clear? Easy or not? Yes or no? Let's do one question in the question bank if it is there. Is there any question in the question bank? Right shares concept. Just I'm trying to search ma. Okay, TYK probably. Just a minute. There are no right shares related problems as of now, but anyhow, I gave you numbers, no? That is more than sufficient. Are you clear? Yes or no? Now tell me. Do you understand until now? So tell me, what is cost of acquisition of original shares? Amount paid at the time of allotment, correct? Whatever you paid at the time of allotment, that's the original cost. If at all you bought in primary secondary market, then amount paid itself. Now for right renouncement, what is the cost of acquisition? 0. Suppose no, you bought right shares itself. How much you paid to the company for right shares? 1200. If at all the original shareholder himself bought the right share, for him cost is 1200. Suppose my friend bought the right share from the company, for him the cost is 600 rupees. For renouncement he paid me 1200 rupees. The amount he paid to the company, total cost is 1800. Now look at that point also. So look at that point. You know what is cost of acquisition? For financial assets? Original shares you got, cost of acquisition shall be amount paid to the company. Right shares itself you bought, cost of acquisition shall be amount paid to the company. Sir, I didn't buy, sir, I renounced it, sir. Renouncement, you are computing capital gain. For right renouncement, no, you got some profit, some income you got. What is cost of that? 0. The cost of acquisition shall be 0. Sir, my friend is the right buyer. For him the cost is what? Cost of acquisition is amount paid to renouncer plus amount paid to company. Am I logical? Now what is the cost of acquisition of bonus shares? Sir, cost of acquisition is nil. Are you clear? What if bonus shares are allotted before 1/4/2001? Tell me, what if bonus shares are allotted before 2001? Actual cost 0, or fair market value on 1st April 2001, whichever is higher. Suppose no, if at all I purchased original shares or bonus shares or both before 1/4/2001, whatever asset I acquired before 1/4/2001, at what price I acquired, 0 some amount doesn't matter. Actual consideration or fair market value on 1st April 2001, whichever is higher, you can happily take that. Am I right? So if bonus shares are allotted before 1st April 2001, what is the cost of acquisition? What is the cost of acquisition? Directly 0 or FMV, whichever is higher, directly you can take FMV. That's what. So if bonus shares are allotted before 1/4/2001, 0 or FMB means FMB, obviously. Cost of acquisition is FMB on 1st April 2001. Are you clear? Yes or no? Now here is the twist. From here there is a big twist. Now until now clear? So until now clear? Next. Special rule for immovable. This also will cover and then go back to financial asset logic. Suppose no, I purchased generally land and building. What is the cost of acquisition? Cost will be actual cost of purchase. Suppose land or building or both I acquired before 1st April 2001. Then the cost of acquisition shall be fair market value on 1st April 2001, but subject to maximum of stamp duty value on 1st April 2001. Correct? Any other capital asset, jewelry, archaeological collection, something. What is the cost of acquisition? Purchase price only. But if the same is purchased before 1st April 2001, then cost of acquisition shall be higher of actual cost or fair market value on 1st April 2001. Can I go with this logic? Yes. Suppose no, when cost of property in the hands of previous owner, see, there is a logic. 49 we have seen some points. Gift to inheritance will. What is the cost? Cost to previous owner. Suppose if cost to previous owner we are unable to decide. If cost to previous owner is unable to decide, then market value on the date when the capital asset became property of the previous owner is taken. Nothing but previous owner when he purchased. But original cost details nobody knows. My great grandfather did not maintain 250 rupees. We don't know anything. At what price he bought? When he bought, right? Sale date is there, na? Yes or no? In that probably value we don't know exactly. Then that day market value how much identify? That is fair. That itself is treated as cost. If cost of previous owner is unable to determine, we don't have information, then market value on the day can be taken as cost. Are you clear? Simple until now what we understood. Cost of acquisition is equal to purchase price. Sir, previous owner purchases, sir, then at what price previous owner purchased, that only you take it. Sir, he purchased before 1st April 2001, sir, then take fair market value on 1st April or actual cost, whichever is higher. Sir, it's immovable property, sir, then restrict the value to stamp duty value on 1st April 2001. Over. Easy or not? Until now. That's it. That's it. Now there is one more provision. Which is little tougher provision. We'll do one thing. We'll take a break and get back and then continue discussion of the tough provision. Okay. There 1st February 2018, 31st January 2018, some logics and all were there. Okay. For example, I'll show you this. You see here. Okay. So here what is it? Some listed shares acquired before 1st February 2018. Array sir, already just now we saw 1st April 2001 we saw. Now again you are bringing 1st February 2018 logic. What is this? After the break I will discuss. Clear? Now let's look at listed securities, how to determine cost of acquisition. See, generally cost of acquisition. Now we'll discuss one more provision of cost of acquisition and will immediately start solving the problems. Okay. Now generally whether it is a listed share, unlisted share, bond, debenture, all that doesn't matter. What is the cost of acquisition? Zero. Sorry. What is the cost of acquisition? Purchase price. Correct? Suppose if I acquire the same asset from previous owner as per 49 subsection 1 through gift, will, inheritance, succession, like that, then cost of acquisition is cost to previous owner. If at all these assets were originally purchased by me or my previous owner on or before 1st April 2001, then what is the cost of acquisition? Actual cost or fair market value on 1st April 2001, whichever is higher. Suppose if it is immovable property, the similar clause restricted to stamp duty value on 1/4/2001. I think we understood until now. Correct? Now, once upon a time, listed equity shares. What is it? Listed equity shares. Equity oriented mutual funds, that too listed equity shares. Listed equity oriented mutual funds, units of business trust, BT means what? Business trust. Once upon a time, if they are long-term capital asset, and if they are sold for profit, entire that profit is exempt under 10 clause 38. Once upon a time, I'm talking about this provision is there till 2017 2018 onwards. 18 up to 18 means up to 31st March 2018 this provision is same. Like what is it? If at all listed equity shares, equity oriented mutual funds, units of business trust, if they were long-term capital asset and they are sold for profit, and guess what? STT is paid, because listed means obviously at the time of sale STT will be paid. At the time of sale STT. See, actually for shares at the time of purchase STT should be paid, at the time of sale also STT should be paid. That logic is that we'll discuss that later. First look at the provision intention, then I will discuss about the remaining issues. Okay. So if STT paid, the entire capital gain is exempt from tax. Suppose if the same is a short-term capital asset, like which assets, by the way, which assets I'm talking about? Listed equity share, equity oriented mutual fund listed, units of business trust. and if they were short-term capital assets, and STT is paid, and if they were short-term capital assets, then it is taxable under 111A. Right now, tell me, what is the 111A rate right now? Right now the 111A is taxable at 20. Once upon a time, if it is a long-term capital asset up to 31st March 2018, what is the tax rate? Under 10 clause, what is the tax treatment? Exempted. However, from 1st April 2018, because of Finance Act 2018, which is presented in budget on 1st February 2018, because of the Finance Act 2018, which is presented in budget on 1st February 2018, they brought one amendment. What you know? From 1st April 2018 onwards, this long-term capital gain exemption is there, right? They withdrawn. What they did? They withdrawn. Because of this, suddenly what happened? Suddenly, entire stock market got affected. Because there are so many foreign institutional investors, Indian institutional investors, retail investors who bought listed shares and holding it for more than 12 months, so that if the profit is fully exempted, they're thinking. Suddenly they removed this exemption and they brought a section called 112A. Right now, what is 112A? We have seen in the introduction chapter. What is the 112A tax rate? 12.5% in excess of 1.25 lakh. When the section was introduced, what is the tax rate? 10% tax rate in excess of 1 lakh. When the section was introduced, what is the tax rate? 10% tax rate beyond 1 lakh profit. Now tell me, suddenly, on 1st February 2018, the finance minister presented budget. So long ago, some 15-20 years, decade, almost 1.5-2 decades, this provision is there, this exemption. I think 2004 onwards, I guess it is there. Almost like 15 years this provision is there. You suddenly withdraw an exemption. What about existing shareholders who bought shares before this budget date? Okay, before 1st February 2018 is also expressed as on or before 31st January 2018. Am I right? Before 1st February 2018 is also expressed as on or before 31st January 2018. What about these people who bought somewhere in 2016, somewhere in 2015, somewhere in 2017? One day they want to sell somewhere in 2019, 2020, after when their children grow up, that time they want to sell and make a profit, thinking that their profit will be exempted. What about them? It's like cheating, no? So what income tax department did that time? Okay, don't worry. What is the budget date? 1st February 2018. Okay, before budget date, what is the date? Before budget date is what? Before budget date is what? 31st January 2018. So 31st January 2018, I will take it as a cutoff. Date. On this day, fair market value is there, right? On this day, fair market value is there, right? I will treat it as cost of acquisition. What I will treat it as? Cost of acquisition. Look at, I will tell you how the computation happens. I will tell you that formula, no, there actually what it is, there it is what, lower of, okay, lower of, look at this. The actual provision, you see, I will show you, lower of, what is it here? First, lower of FMV or actual consideration on sale, or compare it with cost FMV on 1/4/2001, whichever is higher. So higher of 1 and 2. What higher? Actual cost or FMV, whichever is higher. Okay, lower of these two. Am I right? So arrive this. Then between these two, between 1 and 2, higher of 1 or 2. Generally, many students know they try to mug up this formula. I'll tell you a simple example. I'll tell you. I bought somewhere in 2015-16 at 100 rupees per share, listed company share. I paid STT also that time. Okay. Now I wanted to, if at all I sold this in 2018 January 1st itself, I sold it for 1000 rupees. Whatever the profit 900 is there, fully exempted. That time it is fully exempt. Even on 31st January to, what is the market value? 1500 per share. Even on that day, if I sell also, exempt. Even up to 31st March 2018 also this exemption is applicable. If I sell within that time, any profit I got is also exempted. Are you clear? But suddenly finance minister brought an amendment saying, if at all you are selling that share on or after 1st April 2018, you bought a listed company share and then again selling it for a profit from 1st April 2018, cost of acquisition, capital gains you need to compute and pay tax on that. Yes or no? Now suddenly those people who bought long back, they will definitely feel bad about this amendment or not. So for them, what finance minister said, my dear, for example, I am selling that in 22-23 year. Sale value is, let us assume 2000 rupees, and what is the cost of acquisition? 100 rupees. What is the profit ma? 1900. Originally this 1900 is exempted, right? Yes or no? Now somewhere in 2018 you brought the amendment. Yes or no? What people will tell suddenly, hello finance minister, you suddenly brought and suddenly taxing it. If at all you give me an option, I would have sold it and made profit. People will tell the same. Yes or no? So what people told, this argument they told. So what department come back with a reply? Don't worry. Your cost is 100, right? Do one thing. I will give you this facility. Cost is higher of. Actual cost is how much? 100. Or lower of. Fair market value how much? Fair market value on 31st January 2018. How much it is? Let us assume market value on 31st January 2018 is 1200. Let us assume. Okay, 1200 rupees. Or right now you sold at what price? 2000 rupees I sold. Whichever is lower, 1200. Okay, and actual cost or fair market value, this whichever is higher, 1200. Now you can happily show this as cost. Okay, I am showing this as cost. So what is my capital gain? 800. Now you pay tax on this. People will be happy. Why they gave this benefit? See, generally here shares are purchased on or after 1st April 2001, which means cost means actual cost. Yes or no? Computation of capital gains, this is how you should compute generally, 2000 minus 2019. No, but here you purchased shares when? Before 1st February 2018, when that amendment came. That's why what department did, on 31st January market value is there, right? That much you can take it as cost. That much you can take it as cost. But sometimes what happens is fair market value on 31st January 2018 or actual cost, whichever is higher. This is what the provision. Okay, now fair market value 1200 or actual cost 100, whichever is higher, 1200 you take it as cost. Happy? Yes or no? But guess what? Suppose you are selling today, at 500 rupees only. Today you are selling it 500 rupees only. Now if you take 500 rupees sale value minus cost of acquisition 1200, you are getting loss. Which means what generally when this loss is there, what you do? You set off with other. Here department is losing again. If I give this benefit, department is losing. So what the department said, fair market value you take on 31st January 2018, provided it is less than or equal to sale value of today but at which you are selling. Indirectly, how this is expressed? Fair market value or sale consideration given in the problem when you are selling actually, whichever is lower. Okay, now you get some value. Compare with actual cost, whichever is higher, that much value happily you can take. If your real cost itself is higher than market value, then take cost itself. If your cost is lower than market, then take market value. So indirectly, as on that date, if you sell the share, whatever exemption you would have got, I am giving you even now also the benefit. Logically. Yes or no? Otherwise, 2000 rupees I am selling, 100 only my cost, 900 is capital gain. Because exemption is taken away, SSC is getting cheated now. Because of that provision, what happens now? 100 rupees my cost, market value on the day 1200, whichever is higher, 1200. So department indirectly told SSC, look, on 31st January when I brought the amendment, 1200 market price. That day you sell, whatever profit is there, you might have got complete exemption. Of that much exemption I'm indirectly giving you. Your cost is 100 only, but I'm treating your cost as 1200 indirectly as on the amendment date. Yes or no? Whatever profit you would have made, if at all you sell and you would have got exemption, that indirectly I'm giving now. I'm only taxing 800 rupees any profit that you made after the amendment only. Right? So the amendment is prospective only, not retrospective. Are you clear? So this is the provision behind. Are you clear? Therefore, if at all you are dealing with 112A assets. What are 112A assets? What are 112A assets? Listed equity shares, listed equity oriented mutual funds, units of business trust, and STT is paid at the time of sale, and these assets were purchased by you before 1st February 2018, whereas you are selling now in 25-26 years, because our problems are based on 25-26, then cost of acquisition is equal to actual cost, what you paid, check out, or fair market value on 31st Jan 2018, whichever is higher. But if at all this fair market value is less than the sale consideration, suppose, sorry, if it is more than sale consideration, then sale consideration you take. Are you getting it? That's why what they say, fair market value or sale consideration, whichever is lower, this value compare with actual consideration, whichever is higher. That's it. Easy or not? Now actual cost. This is actual cost. Now actual cost means what? How much ever I paid. Suppose I bought this, forget about 1st February 2018 before. I bought them before 1st April 2001 also. Then actual cost means what? Generally original cost or fair market value on 1/4/2001, whichever is higher. That is step number 1. Step number 2, lower of fair market value on 31st January 2018 or sale consideration today. Yes or no? Whichever is lower. This is step number 2. Now step number 1, step number 2, whichever is higher. Do you understand? Next. Okay, now look at, so suppose listed shares only, listed shares only I got before 1st February, but guess what, those listed shares were bonus shares. That time cost will be nil, or fair market value as on 1/4, whichever is higher, which between these two, whichever is higher. Yes or no? Then now between these two, whichever is higher, compare that with lower of FMV or actual, whichever is lower. Now between 1 and 2, ultimately go with higher. Same way, listed equity shares, equity oriented funds, units of business trust, which are acquired before 1st February, 112 assets, the cost is higher of 1 and 2. First one, cost of acquisition, actual cost, or market value and 1/4/2001, as the case may be, whichever is applicable. Compare with lower of FMV on 31st January, actual consideration, whichever is lower. Then between 1 and 2, once you arrive the value, higher value you take as cost of acquisition. Sale value, today whenever you are selling, the price, that itself is the sale value. Are you clear? Yes or no? Now here you see, here STT must be paid at the time of transfer. My dear, STT should be paid at the time of transfer. Are you clear? Now sir, what do you mean by fair market value? What do you mean by fair market value? Suppose if the capital asset is listed on stock exchange on 31st January, then highest price quoted on that date, if trading is happened. So trading does not happen, then preceding date, highest price how much, that itself is the fair market value. Are you clear? Suppose sir, it's a unit, sir, it's a unit of mutual fund, sir, but not listed in stock exchange before 31st January. Later it was listed and STT paid by me. Then NAV of the unit on that date. On that date means what? 31st January 2018 NAV. For mutual funds we look at NAV. Are you clear? Then this case I will come back to it at last and then discuss. Are you clear? Remember, right now we are supposed to discuss 112A also. Okay, but without even discussing 112A, 111A, we can actually proceed with the discussion. Okay, now let us compute one problem. Illustration 1, I guess. Illustration 1, no, TYK 1. There is a TYK question. First we'll solve that question. Okay, shall we? Look at this. If the same question comes in exam, they will ask it for 6 marks or 8 marks. Now look at, Mr. Midun purchased 100 equity shares of Messrs. Good Money Company Limited on 1st April 2007 at the rate of 1000 per share in public issue of the company by paying STT. So he purchased shares by paying STT before, that is 1st April 2007 means immediately you should remember before 1st February 2018, that is on or before 31st January 2018. Remember that. Okay. Company allotted bonus shares in the ratio of 1:1 on 1st December 2024. Remember, bonus shares were allotted in 2024, which means after 2018. Bonus shares generally cost of acquisition is 0. But if the bonus shares were allotted before 1st February 2018, actual cost 0, below fair market value on 31st January 2018, whichever is higher I can take, no? Yes. And he also received dividend of 10 rupee per share on 1st May 2025. That's a dividend which is taxable under other sources. Okay. Then he had sold all the shares on 1st October 2025. Year of transfer is 25-26. Are you clear? At the rate of 4,000 per share through recognized stock exchange and paid brokerage 1%. Brokerage means what? Transfer expenditure. STT paid how much? 0.02. Tell me, STT paid, can I show it as transfer expenditure? No, I told in capital gains, STT paid is not considered as expenditure. Now they're asking compute. What is it? Compute his total income and the tax liability for assessment at 26 if at all Midun is opting out of default tax, means his optional tax regime. Assuming that he is having some other income 8 lakhs. Wow. Fair market value of each share on 31st January is 2,000 rupees. Now look at the question. First of all, Midun is having how many? Original shares. Midun is also having bonus shares. Are you clear? Midun is having bonus shares as well as original shares. By the way, these shares were listed, no? Listed shares, what is the holding period logic? 12 months. If they are held for more than 12 months, it's a long term. Otherwise, it's a short term. Okay, let's compute. Okay, one by one carefully. Original shares, how many he purchased? 100. How many were the original shares? 100 shares. Are you clear? Then, when the company issued bonus shares, 1st December 2024. What is it? 1st December means last financial year he got bonus shares. Okay, how many? 100 bonus shares only, that too allotted on 1st December 2024. Am I right? But if you look at original shares were purchased by him in 2007. Bonus shares were allotted on 1st December 2024. And if you observe, ultimately all these shares were sold when he sold all the shares on 1st October 2025. When he sold date is what? 1st October 2025. Here also 1st October 2025. First to know, I should decide 2007 he bought, 2025. More than 12 months. It is a long-term capital asset. Original shares are long-term capital assets. Bonus shares, allotment on 1st February. Tell me, for shares, no, bonus shares and all, from when period of holding will be counted? From allotment date only. Am I right? From allotment date. Allotment is on 1st December 2024 to 1st October, less than 12 months. Therefore, it is a short-term capital asset. And guess what? Listed equity share, listed equity oriented mutual funds, units of Unit Trust of India. If they were long term, 112A section apply. If they were short term, 111A section will apply. Correct? Just section is important for identifying tax rate, but computation is very easy. Now tell me. Okay, now first I will compute capital gains for original shares. Okay, what is the full value of consideration? What is the full value of consideration? Remember, both are 100 shares. Correct? Original shares are 100. Bonus shares are 100. But remember, original shares are long-term capital asset, bonus shares are short-term capital asset. This point until now everybody understood? Yes. Now look at full value of consideration. What is the selling price of each share? He sold all the shares at 4,000 per share. So selling price is 4,000 into 100. How much is the sale value? 4 lakh. Very good. Same format, I will follow the same format. Minus transfer expenses, then I get net consideration minus cost of acquisition. Shares, no, improvement won't be there. Improvement will be there generally for immovable properties, like that only. So finally, once you reduce all this, you get capital gains. Correct? Minus, is there brokerage? Yeah, 1% brokerage paid on sale value. 4,000 he paid brokerage. Here also 4,000 he paid brokerage. What is the net consideration? 3,96,000 net consideration. Here 3,96,000 net consideration. Am I right? Now, what is the cost of acquisition? Now, if you remember, original shares were purchased on 2017. Before 1st February 2018, original shares were purchased. That time STT also paid. Okay, I'll come back to that point, STT point at the time of purchase logic. I'll come back to it later. Generally, at the time of sale, paid or not? That's it. Now, at the time of purchase, he paid. Now, if the original shares were purchased before 1st February 2018, then cost of acquisition is higher of 1 or 2. 2 is what? Lower of A or B. Can I say that? B, sale value is what? 4,000 rupees. A, 31st January 2018 fair market value. How much is the fair market value on 31st January? Wow, 2,000 rupees. Yes or no? 2,000 rupees, correct? Now, first one is what? Actual cost or fair market value on 1st April 2001. Here 2001 logic will not apply. Why? Because original shares were purchased in 2007. Therefore, FMV on 1/4/2001 logic will not apply. Actual cost of original shares, how much? He purchased original shares, you see 2001 at the rate of 1000. Very good. So 1000. Now here whichever is lower, answer is 2000. Now step 1 is 1000, step 2 is 1000. Whichever is higher means actual cost is what? Exactly 2000. Now cost of acquisition 2000 into 100, how much? 2 lakh. Are you clear? Now coming to what is the cost of acquisition of bonus shares? Generally cost of acquisition of bonus shares is 0. However, if bonus shares are allotted before 1st April 2001, cost of acquisition is market value on 2001. In the given case, bonus shares are allotted on 1st December 2024. Again, we have one more provision. If bonus shares are allotted before 1st February 2018, then again cost will be 0. This logic is same. Again cost will come to 2000. But here bonus shares are not allotted before 2018. They were allotted in 2024. Therefore, generally for bonus shares, what is the cost of acquisition? 0. Am I right? So the capital gain is 1,96,000. Here 3,96,000. And if you observe, this capital gain is taxable at 20%, 111A. Whereas this capital gain is taxable under 112A in excess of 1.25 lakh. Balance is taxable at what rate? 12.5%. Look, I cannot compute just like this, okay, because now other income is there as well as, by the way, income we computed. Now let's understand what is his total income. Let's compute what is his total income. Now long-term capital gain, how much it is? 1,96,000. 112A. Am I right? Short-term capital gain 111A, 3,96,000, which is on bonus shares. Am I right? Yes or no? Then he got dividend, he got dividend. How much is the dividend he got in the problem? After bonus shares on 1st May 2025, 1st May 2000 means current year 25-26, he received 10 rupees per share dividend. 200 shares he is having, no? How much is the dividend? 10 rupees, no, 10 rupees into 200 shares, 2000 rupees dividend. Yes or no? And what is his other income? They themselves mentioned other income is 8 lakhs. Yes or no? 8 lakh. So right now, what is the gross total income? What is the gross total income? So 8 lakh plus 2000 plus 3,96,000 plus 1,96,000. Until now understood? Yeah, 13,94,000. Now information nothing is given. This itself is total income. Yes or no? 13,94. Now how to compute tax on this? So total income 13,94,000. Now look at it. By the way, are we following optional tax or default tax here? Optional tax. They clearly said very clearly, opts out of default tax regime. Correct? Therefore, it is optional tax regime. Now, optional tax regime. First, special incomes. What are the special incomes? Long-term capital gain 1,96,000 and short-term capital gain 111A. How much it is? 3,96,000. Am I right? 112A. In the same way we did in first chapter problems, balancing figure 8,02,000. This is taxable at slab rate. This is taxable at 12.5% in excess of 1.25 lakh. This is flat taxable at 20. By the way, slab rate means what is middle age? Nothing is given. If nothing is given, I assume that he is a normal citizen. Yes or no? Now 8 lakh 2. Yes or no? 3,02,000 into 20%. Am I right? Up to 5 lakh it is 12,500. Am I right? 72,900 basic tax. Do you agree? Yes or no? Then capital gains 1,96,000 minus 1,25,000 remove into 12.5% is equal to 8,875. 3,96,000 into 20% is equal to 79,200. Am I right? You know what is the total basic tax? Okay, total basic tax 72,900 plus 8,875 plus 79,200 is equal to 1,60,975. This is basic tax. Am I right? Plus add surcharge 0. Okay, now then again subtotal 1,60,975 minus rebate. Is it applicable? Look, total income is more than 5 lakh. Therefore optional tax regime, since more than 5 lakh there is no rebate, therefore straight away plus 4%, how much it is? 1,67,414. nearest 10 rupee 1,61,410. you can round up the tax to nearest 10 rupee 167,410. look at the answer. I hope our answer should be right. Happa, 1,67,410. do you understand? Yes or no? Capital gains, you see, when I discuss so complicated, no, but when we are solving the problem, this is how easy capital gains problems are. Basically they're very easy. Look at computation of total income and tax liability of Mr. Midun. Long-term capital gain on sale of original shares. Okay, sale consideration is 4 lakh, correct? Transfer expense 4,000. Net consideration this much. Cost of acquisition 2,000. Refer note number 1. What note number 1? They are saying cost of acquisition is higher of A or B. Okay, A actual cost. Here market value on 2001 does not apply because here SSC purchased after 2001. 2007 he purchased. Okay, second step, lower of FMB 2000 actual consideration, full value of consideration 4,000, whichever is lower. So here automatically it will come 2,000, correct? Now compare with 1000 with 2000, whichever is higher, 2,000. STT paid is not allowed as deduction, correct? So 2,000 into 100, what is the cost? 2 lakh. Therefore what is the long term capital gain? 1,96,000. now coming to bonus shares, sale value 4 lakh as usual. Brokerage net, now bonus shares were allotted in 2024 1st December, therefore cost is 0. therefore short term capital gain 3,96,000. yes or no? Then 8 lakh 8 lakh to other sources income, total 13,94,000. the answer is over. Easy or not? Easy or not, everybody? Next, that's cost of acquisition discussion. Major point is over. Major discussion is over. Major discussion is over. Okay, next. Are you clear until now? Yes. I'll see, is there any other problem that we can solve? We can solve one more. No, this is question number 3 is bit difficult question. No, that provision, one provision is that we need to discuss. Question number 4 also one more provision is that we need to discuss. Oh, fine. Until now clear? Now there is one more question, one more topic I wanted to discuss. Okay, so now, so until now what we understood, full value of consideration means sale value or stamp duty value in case of immovable property. That too, if stamp duty value is more than 110% of actual cost, then stamp duty value, 50C provision, all that we understood. Cost of acquisition is also means what? We understood decently, correct? Now let us understand forfeiture of advance. Let us understand forfeiture of advance point. Let us understand forfeiture of advance. Remember, right now we started discussion with section 48 format. In that, FVC completed minus transfer expense, we completed discussion. Then we got net consideration. Then we started cost of acquisition discussion. That only right now going on. Once we complete this, then I will discuss about cost of improvement logic. Clear? Yeah, clear? Now forfeiture of advance is also one of the important point in cost of acquisition. What is this forfeiture of advance? What is this forfeiture of advance? You know, once upon a time, I mean even now also, I told, right, whenever an immovable property dealing is happening, first they will have an agreement, then later they will have a registration, correct? A date of registration, date of agreement will be generally different. On the agreement date, when seller and buyer will enter into agreement, you know, only when the buyer pays some token amount, advance amount. For example, buyer paid 5 lakh rupee advance to seller, and made a promise that I will buy the property after 3 months. Seller also agreed. They made an agreement. Seller received 5 lakh rupee advance also. Happy, very everything. But after 3 months, buyer is not at all picking up the phone. Then seller understood that something went wrong with the buyer. Actually, the buyer don't want to buy the property. He decided not to buy. Okay. Now buyer finally called back. Sir, I don't want to buy, sir. Can you please give back my advance? Hey, what? How will I give you? Because you said you will buy. I waited for 3 months. In between, I got so many buyers and I lost contacts. Now, suddenly, if you don't buy, again I have to sit and look for another buyer. Problem. So, do you think seller will refund this back? No. What seller will do? He will forfeit. Forfeit means what? He will keep it with himself. Is it a profit or not? Is it a profit or not? What is the treatment for forfeiture? This is the question. Now, you know, before 1st April 2014, what is it? Before 1st April 2014, forfeiture point is discussed under section 51. On or after 1st April 2014, forfeiture is discussed under other sources clause number 9. Other sources 56 subsection 2 clause number 9. Forfeiture is discussed under this section. Whereas before 1st April 2014, forfeiture is covered under 51. What they say, you know, if at all any advance is forfeited by the assessee, if any advance is forfeited by assessee, forfeiture means a profit to him, the advance forfeited shall be reduced from cost of acquisition while computing capital gains on the same capital asset subsequently transferred. See, you forfeited now, but later on you will sell this house again no to somebody. The land you will sell no. That time you will compute capital gains no. That time capital gains, how will I compute? Full value minus cost gain, correct? When you are reducing cost no, don't reduce full cost. Cost inner column. In that forfeiture is there, right? Reduce from the cost. Balance cost you claim. Indirectly forfeiture is taxed. Like, sir, can you explain with the numerics? Yes. Okay, very simple. In 2012-13, I forfeited 5 lakh at once. Actually, you know, I purchased a house or land, something. Okay, 1 crore I purchased. Somewhere in 2007-8, I purchased it for 1 crore. You know, in 2012-13 itself, I decided to sell. That time I took 5 lakh advance. Bad luck, it didn't happen. Are you clear? Are you clear? Again, 2018-19 also, I took, you know, I wanted to sell the house. That time I took 20 lakh advance, and that time also the same thing happened. Buyer could not turn up. 20 lakhs I forfeited. What I did? 20 lakhs I forfeited in 18-19. Finally, 25-26 in the current previous year, I sold this house for 5 crore rupee. I sold it for how much? 5 crore rupee. By the way, when I bought this house, 2007-8 year is the purchase year. I bought it for how much? 1 crore. Now tell me how to compute capital gain. Full value of consideration, how much right now? 5 crore. Let us assume stamp duty value is also similar. Okay, so I'm not going more complicated. Minus transfer expenses also, let us assume there is no net consideration is how much? 5 crore. Minus how I calculate cost of acquisition? 1 crore. No. What is the cost of acquisition? 1 crore. No. So capital gain is 4 crore. This is how, right? No, you should not do. You forfeited. What you forfeited? You forfeited 5 lakhs in 2012-13. Oh, I forfeited. What to do? What is cost? 1 crore. Minus 5 lakh you reduce. 95 lakh only you claim cost. How much cost you should claim? Not the cost you incur. After forfeiture amount you reduce, balance cost only you claim. So 4 crore. Automatically capital gain is 4 crore 5 lakh. Are you clear? Yes or no? See, actually this can be taxed in a different way also. Actually department can do this way also, but they didn't follow. Okay, minus 0, 5 crore minus 1 crore. Yes or no? What is the capital gain? 4 crore plus add forfeiture amount 4.05 crore. Over. This way also they can tax it. No, forfeited is a profit, you can tax it like this. No, but they didn't do that. What the section says? Section 51 says if the forfeiture is before 1st April 2014, the forfeited amount, keep it. Tomorrow, here you forfeited in 12/30. That time nothing happened. No taxing, nothing. Department waited. What they did? In 25-26 you sold ultimately, right? That time you are computing capital gains, no? That time you will claim cost of acquisition reduction from consideration, no? That time this forfeiture amount set off with cost, balance cost only you claim. So department will remember you forfeiture long back. Now you adjust it with cost. Indirectly this forfeiture is taxed or not? Indirectly taxed or not? This treatment only you should follow. Are you clear? Now, sir, in the same problem, there is one more forfeiture. No, why you didn't consider that? Here in the same problem, forfeiture one more 20 lakhs is there. No, why you didn't adjust it here? Here 25 lakh. No, 5 lakh only I'll adjust. Why? Here the forfeiture is in 18-19. I told you, if the forfeiture is on or after 1st April 2014, department understood one point. What Array forfeiture, no? Indirectly tell me where forfeiture is taxed here? Forfeiture is indirectly taxed in capital gains only. But capital gains, which amount you should tax? Any asset transferred, amount received only should be taxed, right? Forfeiture, did you transfer? Without transfer, you got amount. So this is not something taxable under capital gains. So from 1st April 2014, they realized their mistake. What they wrote, from 1st April 2014, if any forfeiture is there, that is straight away taxable as income from other sources in the year of forfeiture. So from 1st April 2014, if you forfeit any amount, no. Whenever you forfeit, that year it is a benefit. That year only it is taxable. Where? In which head of income it is taxable? Income from other sources. Accordingly, in the given case, in 2018-19, 20 lakh forfeited, no, it is taxable in other sources in 18-19 itself. We don't have to indirectly tax it in 25-26 like forfeited amount which happened before 1st April 2014. Are you clear? In problem, to confuse you, they'll give you both forfeited amounts. Are you clear? Before 2014 forfeited amount, after 2014. After 2000 forfeited amount, no, in that year, whenever it is forfeited, that year it would have been already taxed. Before 2014 forfeited, now you are computing capital gains in 25-26, no, that time you adjust it. Able to understand? Indirectly, forfeited amount is taxed in which year? Indirectly, if a forfeiture is before 1st April 2014, indirectly it is taxed in which year? Whenever ultimately the concerned property is ultimately transferred. In that year it is taxable. Yes or no? Are you clear or not? That's it. That's about forfeiture logic. Clear? That's it. Confident until now? Now, is there any problem on this? Let me see once, okay? Let me see whether is there any big, tough, nice problem is there or not. I'll see. Fifth question we can solve to some extent. By the way, one more point I'll tell you. Suppose, my father purchased a house in 2007. 2007-8 he purchased it at 10 lakh. Okay? He wanted to sell the house in 2014-15. Okay, he wanted to sell and he received an advance of 2 lakh rupee, and ultimately it is forfeited by him. Later in 2015-16, luckily I gifted, my father gifted to me or I inherited. Okay, understood? In 2017-18, I entered into agreement to sell, and what I forfeited. This is in my hands now on. Earlier it is in the hands of my father, and this amount forfeited by father. Are you clear? Now 13-14, let us assume forfeiture is 13-14 year. Forfeitures my father is by in 13-14, and in 17-18 I also forfeited some 10 lakh rupee. Finally I sold in 25-26 for 5 crore this property. Now let us compute capital gains. What is full value of consideration? 5 crore minus what is cost of acquisition? Tell me, what is the cost of acquisition? Cost to previous owner. Am I right? Cost to previous owner is what? 10 lakh. By the way, previous owner purchased in 780 only. Amma, thank God. 1/4/2001 logic will not apply. Okay, 10 lakh minus how much my previous owner forfeited? How much my previous owner forfeited? 2 lakh. That too when he forfeited before 1st April 2014. How much he forfeited? 2 lakhs. Don't reduce. Forfeited by SSE only should be reduced. If forfeiture is by previous owner, no tax treatment. If at all advance is forfeited by previous owner, no tax treatment. Nothing to worry. In the book it is given already. In the book it is given. Somewhere it is given. Yeah, you see here. Look at it. Page number 114. Look at it. Forfeiture of advance money. What is it? Forfeiture of advance money. What they are saying here? Advance forfeited before 1st April 2014. Advance forfeited shall be reduced from cost of acquisition before applying indexation if applicable. If indexation concept is applicable, before applying indexation. Sir, what is indexation? At this moment I didn't tell you. I will discuss it. If advance was forfeited by previous owner, no tax treatment. If advance is forfeited on or after 1st April 2014, the advance forfeited is taxable under IFOS in the year of forfeiture. Directly whenever it is forfeited, that year it is taxable. Clear? Now let us look at one question in the question bank. Okay, now question number 5. In this it's actually a comprehensive problem. Okay, remember I told format. First you compute FVC, then you reduce transfer, then you get net consideration, then you get cost of acquisition, cost of improvement, then you get capital gain, then again 54 series point is there. Okay, that point is also there. By the way, before I solve, one more important point is there. That also I'll cover. Now, do you understand cost of acquisition point until now? Let's now understand what do you mean by cost of improvement. What do you mean by cost of improvement? If you remember the format of capital gains, until now we understood. You see, we understood what are all we understood now. Predominantly we understood what is FVC. Are you clear? Are you confident? FVC. Do you understand transfer expense? Do you understand cost of acquisition? Now let us understand cost of improvement. What is cost of improvement? Original asset I bought, right? To that, before I am selling it, some improvements I did. Improvements means repairs. Repairs maintenance. No, repairs is not improvement. Yeah. What is improvement? Anything that enhances value of the asset is called improvement. Repair is not an improvement. Whitewash I did. Suppose painting I did. That's not improvement. I constructed additional floor. Improvement. I constructed additional floor. Improvement. I replaced old marbles with new Italian marbles. Improvement. Any capital expenditure nature you spent on the original asset, that capital expenditure is called as what? Improvement. Are you clear? Now, improvement, if at all any improvement is there, when you are computing capital gains, no, cost of acquisition you reduce from consideration, improvement also you reduce. That's it. Suppose if the property is acquired by you on before 1st April 2001, if the property acquired by you before 1st April 2001, cost of acquisition means what? Actual cost or fair market value, whichever is higher. But since it's a movable property, stamp duty value on 1st April 2001 is the maximum. And guess what? Before 1st April 2001, I even incurred improvement cost. 0. Any improvement cost incurred before 1st April 2001, take it as 0. Don't even consider this improvement cost. Before 1st April 2001, if any improvement amount is spent, 0. But if at all any improvement is spent on or after 1st April 2001, if I spend any improvement, take that. Whatever is their actual cost, take that. For example, sir, in 1980, my father, by the way, if improvement is incurred by previous owner, then whatever previous owner improvement he spent on, that you can take cost to previous owner. How cost of acquisition to previous owner you take, same way cost of improvement by previous owner also you can take. Clear? 1980, my father purchased a house for 5 lakh rupee. Are you clear? My father purchased a house for 5 lakh rupee. Okay. Then 1990 he did cost of improvement. He incurred some 6 lakh rupee improvement he spent. And he constructed. Actually, when he purchased, actually what he purchased is only land. Okay. Whereas in 1990 he constructed a building on that for house, residential house. Are you clear? He constructed building. On the land, building construction is improvement. On the land, building construction is improvement. Are you clear? Now, again in 2002, 2003, he again constructed second floor where with 20 lakh rupee. Okay. In 2006-7, he wanted to sell this house and received 10 lakh rupee advance money from somebody. And what he did, forfeited. Finally, later on, I inherited in 2009-2010. I inherited. Are you clear? By the way, when I inherited the property in 910, no, from my father it is transferred to me, right? Is it taxable for my father as a transfer and capital gains? No. Any asset transfer under gift will, inheritance, all that, no, gift will, that is not a transfer, not taxable under 47. Yes or no? So it's just a change of ownership from my father to me. Nothing is taxable for my father. Now I got it as a gift from my father. For me also nothing is taxable. He is my father. Are you clear? Then again what I did, in 2012, what is it? In 2012-13, I took an advance of 10 lakh rupee and I forfeited. I took an advance of 10 lakh rupee and I forfeited. What is it? I forfeited. Are you clear? Until now I forfeited. Okay. Finally, in 2025-26, I sold this house for 5 crore rupee. Are you clear? I sold it. By the way, before this, again in 2019-20 also, I forfeited another 10 lakh rupee. Finally, in 25-26, I found a right buyer. He paid on prompt 5 crore rupee and then registered the property in his name. Now, in 25-26, I should compute capital gains. Yes or no? Because ultimately, transfer happened when 25-26. Now, here, one more point is missing. What point? Since it's purchased before 1st April 2001, market value data is required. What is the fair market value on 1st April 2001? 30 lakh. What is the fair market value? 30 lakh on 1st April 2001. Now let me compute capital gains. What is the full value of consideration? 5 crore. And guess what? Stamp duty value is given. On registration date they gave 6 crore. What is it? 6 crore. Here, no, with the buyer there is no agreement and all. Directly we spoke, went for registration, he paid 5 crore. So stamp duty on agreement concept right now is not applicable. Okay. Now is 6 crore more than 110% of actual? Yes, actual 110%, 5.5, 6 crore. Therefore full value of consideration is what? What is full value of consideration? 6 crore. Are you clear? And guess what? Brokerage we paid in between. Brokerage is 1%. Brokerage is applied on stamp duty value. Consideration. Consideration is how much? 5 crore. So brokerage is 5 lakh. Are you clear? So generally brokerage is calculated on actual amount. Broker will ask amount, sir, at what price you are selling? 5 crore. 1% of sale price. Brokerage is always calculated on sale price. How much is the net consideration? How much is the net consideration? 5 crore 95 lakh. Do you agree until now? Net consideration 5 crore 95 minus what is cost of acquisition? I didn't buy. Who bought it? My father bought it. What is cost for him? He bought it in 1980 at 5 lakh rupee. Since he bought in 1980, fair market value on 1/4/2001 30 lakh or 1980 cost, whichever is higher, fair market value how much it is? Exactly 30 lakh. Are you clear? And if you observe, my father forfeited amount. I told you any amount forfeited by parents to be ignored. Sorry. 6-7 my father forfeited. previous owner forfeited shall be ignored. Are you clear? Yes. Sir, my father spent improvement also, no? You know, in 1990 he spent some improvement. Generally, if improvement is there, cost to improvement. See, cost be considered. Now improvement, I'm thinking improvement also to be ignored. Yes or no? Cost of acquisition right now clear? 30 lakh clear? Yes or no? Now 30 lakh. Now previous owner forfeited amount, ignore it. Did you forfeit any amount? Yes. In 12-13 year, I forfeited. Hey, if you forfeit, no, that will be considered. When you forfeited? 12-13. Oh, before 1st April 2000, before 1st April 2015, forfeited under section 51. How much you forfeited? 10 lakh. What is the balance cost? What is the balance cost? 20 lakh. What is the balance cost of acquisition? 20. Wait, there is one more forfeiture. You forfeited in 2019-20 again. Since it is forfeited in 1920, after 2014, it is already taxed. I think you might have already paid tax on that in your 1920 IT return. So no problem. That I will not touch it. Are you clear? Minus. So acquisition cost we claimed. Now cost of improvement. Did previous owner spend improvement? Yes. 2 times my father spent. One time 1990 he spent 6 lakh. 2002-3 he spent 20. But any improvement expenditure before 2001 we will ignore. Why? You know, we are already taking market value of the property on 2001. Therefore improvement is indirectly considered here. So any improvement here and all is considered indirectly in market value consideration. So generally that is the logic why we ignore improvement cost before 2001. So the asset market value on 1st April 2001 we look at, right? So improvement is ignored. Are you clear? Now again, my father spent improvement in 2002-3. Can I take that? Absolutely, yeah, you can take after 1st April 2001. So improvement by previous owner, how much it is? How much it is? Yes, 20 lakh. How much it is? 20 lakh. Yes or no? Okay. Did you spend any improvement? Did you spend any improvement? Did the SSC spend? Nothing. He inherited and then blindly sold. Okay. So total improvement is how much? 20 lakh. Therefore, what is the capital gain? 5 crore 95 lakh minus 40. 5 crore 55 lakh. Am I right? Now, which capital gain? Is it long term or short term? How do you decide long term, short term? Sir, I got the asset in 2009-10, sir. 9-10 to 2025-26. Very good. Not 9-10. You should count from 1980. Previous owner holding period also you should consider. Accordingly, it is more than 24 months. Therefore, this capital gain is called as long term capital gain. Do you understand how to solve it? That's it. Now let us solve one problem here. Can I go with this? Now look at Mr. Sardak entered into an agreement with Jayakumar to sell his residential house located at Kanpur on 16th August 2025 for 1 crore 50 lakh. Means year of sale is what? 25-26 for 1 crore 50 lakh. He agreed. He just agreed right now. The sale proceeds were to be paid in the following manner. How? 20% through account to pay bank draft on advance is there on agreement date. Yes or no? That too advance is other than cash. Am I right? Then balance amount is paid at the time of possession. Balance after completion of registration, some amount that is given. Okay. Then Jayakumar was handed over possession of the property on 15th December 2025 and the registration process was completed on 14th January. Remember, registration was completed on 14th January. Possession was given on 15th December. Probably generally when do we give possession? You know, sometimes agreement date itself. So this is agreement date. What is it? Agreement date. What is it? Agreement date. No. Agreement date they gave specifically. They gave agreement date. I entered into agreement on 16th August. Date of agreement is 16th August. Whereas date of registration is 14th January 2026. Whereas 25. Correct? Now. He paid sale proceeds as per the sale. Fine. Finally, sale proceed paid. Registration also over. Now you see the value determined by stamp valuation. Agreement date 1 crore 70. Possession date they gave stamp duty value. Is possession date stamp duty value relevant for us? No. registration date, stamp duty value they gave, which is again relevant for us. We should see that. We should see that. Yes or no? Then here they have given one more transaction information. One more transaction information they gave. This I will keep it pending. Are you clear? This I will keep it, because related provision I didn't discuss right now. Our agenda is what? Our agenda is only to compute capital gain right now. Okay, this is regarding exemption. This is regarding exemption, so this I am not I'm not discussing right now at the moment. Okay, fine. Now compute income under the head capital gain. I will not compute final income, but I will compute main capital gain income. Can I do that? Now as usual, first one, our format, full value of consideration, yes or no, minus transfer expenses, then what you get? Net consideration minus cost of acquisition minus cost of improvement, then you get what? Capital gain. Am I right? Yes or no? Am I right? That's it. Now full value of consideration, how much? Look at, he sold it for what price, 1 crore 50 lakh. Actual consideration is equal to 1 crore 50 lakh. Am I right? It's an immovable. Look at this. What is this? Is actually house they are selling, immovable property. Since it is immovable property, 50C section will apply. As per 50C, I should see stamp duty value. Yes or no? Here, which stamp duty? Agreement date is there, registration, both were there. And if agreement is there, yes. Is advance received? Yes. Is it received by other than cash? Yes. Then stamp duty value on agreement date 1 crore 70 will be applicable. Stamp duty value is how much? 1 crore 70 will be applicable. Now is the stamp duty value 170 more than 110% of 150? 110% of 150 is 165. 170 is more than 160. Therefore full value of consideration is 1 crore 70 lakh. Do you agree? Do you agree? Minus transfer expense. In the given case, nowhere transfer expense details are given. Therefore transfer expense 0. Net consideration 1 crore 70 lakh minus what is the cost of acquisition? Look at, did this fellow buy the property or his previous owner bought it? What is the cost of acquisition? 1 minute, just a minute. Sorry, here I kept one point pending. No, this is actually that only. Sorry, I'm sorry. That green point, you see, green color, what I mentioned here. Yeah. These two lines have to keep it pending. By mistake I highlighted this one. This one is pending. Okay, now you see here, Mr. Sarthak had acquired the residential house at Kanpur. Kanpur means what? This one only, Kanpur. Yes or no? This one. Okay, on 1st April 2001. Oh my god, he purchased the house on 1st April 2001 for 30 lakh. Okay, since he purchased on 1st April 2001, market value also on 2001, but the data is not given anywhere. Did they give anywhere? They have not given. So I assume that market value is also same 30 lakh. Now by the way, since it is on 2001, I need to look at stamp duty value on 2001. That is also not given. Therefore this itself is cost of acquisition. Can I take it? How much is the cost of acquisition? 30 lakh. Are you clear? Minus what is the cost of improvement? Nothing is given in the question. Therefore capital gain is 1 crore 40 lakh. Do you agree? Let's look at the answer. What is the capital gain? Exactly. Long term capital gain, how much it is? 1 crore 40 lakh. Yes or no? Yes or no? So cost of acquisition 30 lakh. And here 170 we took. Agreement date to value exceeds. Yes or no? That's it. Confident? No. Later when you are free, read this entire answer once. Okay? Then there is one more question. Let us solve that question also. Not fifth one. Sixth one you go. Sixth one we'll see. Wow, this is even more. Okay, it's okay. Shall we do it? Yes, but remember, in this also we only compute up to capital gain stage. Balance part we'll do later. Okay, now this alone we will do it and then take a break. Mrs. Yuvika bought a vacant land of 80 lakhs in May 2005. Okay, Registration and other expenses were 10% of the cost of the land. Generally, registration buyer only will bear, which means 80 lakh land cost plus 10% registration, which is 8 lakh. Total cost is how much? 88 lakh. Yes or no? Cost of acquisition includes purchase price plus this one also. Even additional registration charges also is a cost only. Then what she did, she constructed residential building on the said land for 100 lakh in 2000. Oh, 1 crore is cost of improvement. Can I say that? Can I say that? Yes. Next, she entered into an agreement for sale of the above said house with Johar. Okay, not a relative. Let's leave it. Okay, when April 2015, the sale consideration was fixed at 700 lakh on 23rd April 2015, and she received 20 lakh at advance in cash by executing an agreement. However, due to failure on the part of the buyer, the said negotiation could not materialize, hence the amount is forfeited. Oh, which means how much advance? 20 lakh. When it is forfeited? 2015-16 April. Therefore, it is taxable in income from other sources in that year itself. Am I right? That's it. Next. Again, what happened? They're giving you. Again, what happened? Again, Miss Yuvika again entered into agreement on 1st May 2025 for sale of this house at 810 lakh. Okay. Consideration is 810 lakh. She received 80 lakh as advance by RTGS. Oh, date of agreement 1st May 2025. Advance received by other than cash. The stamp duty value on the date of agreement was 890. 890 is applicable, correct? 890 because agreement is there. Advance received by other than cash. Stamp duty value on agreement date will apply. 890 will apply. But sale deed was executed and registered on 14th July. Agreement 1st May, 14th July. Both are in 25-26 only. Yes or no? For agreed consideration. However, stamp value authority has revised the values and value of the stamp duty, 900 lakhs now at the time of registration. But I'm not worried about it because my stamp duty value is agreement date 890 only, correct? Therefore, what is my actually stamp duty value is what? 890. Am I right? What is actual consideration? 810 ma. Yes or no? 810, you see here they gave it clearly 810 lakhs. Yes or no? Now, is it more than into 110%? You just apply and check. 891. Oh, 890 is not more than 891. Therefore, actual consideration is 810. That itself is taken as full value of consideration. First, I will start the problem. Yes or no? Full value of consideration is equal to 810 lakh. Am I right? Then still question not over. Let us read. Okay. Miss Yuvika paid 1% brokerage. What is it? 1% as brokerage on sale consideration received subsequent to the sale. Okay, she paid 1% brokerage on sale consideration received subsequent to sale to the broker she paid. Okay. Then Yuvika made following investments. This is regarding investments. This we didn't discuss yet. Okay. Now this entire answer, this entire information I am right now keeping it pending. Which information? Now you see. Okay, this information I am keeping it pending. Okay, that's it. So I'm not touching it right now. Until now you understand. By the way, she paid 1% brokerage. Brokerage is calculated on stamp duty value actual. Very good, actual. So minus stamp duty value. Minus transfer expenses. How much it is? 1% of 810. How much it is? 8.1. What is net consideration? 801.9. Am I right? Minus cost of acquisition, then cost of improvement. These two if I reduce, I will get the answer. Now, what is cost of acquisition? Yuvika bought this house when 88 lakhs in 2005. Am I right? 2005 she bought. What is the cost of acquisition? 88. Is there any furniture before first? Is there any furniture before 1st April 2014? Nothing. Therefore, again cost is 88. Cost of improvement, again she improved 1 crore. She spent 100 lakhs. She spent. Yes or no? In 2007-8. Yes or no? How much it is? 100. Is there any other information? No. Therefore, what is the long-term capital gain? By the way, it's long-term only, no? 2005 she bought. Now 25-26, more than 24 months. 801. 801.9 minus 88 minus 100 is equal to 6 lakh 13, I mean 6 crore 13 lakh 90 lakh, 613.9. Am I right? So if at all in this, that part of the answer, if it is right, that's it. Yes, long term capital gain 613.9. That's it. Are we right or not? Easy or not? That's it. Next. Wow, one more problem is there. Fine, we'll do one thing. We'll take a break and get back and then solve this problem also. Like this, we'll solve whatever possible. Okay. Then remaining part of the answer, after discussing remaining provisions, we'll come back and then solve it. Are you clear until now? That's it. These questions, if this question is there, this question in exam, they will ask for minimum 8 marks. Now until now we computed one step, no, that itself will be 4 marks weightage. Remaining steps and all put together, it will be even more higher weightage. Are you clear? That's it. Now let's continue. 7th question. One more question is there, right? Let's continue. Same here also. We will compute up to only one level, capital gains computation. Okay. Wow, this is so much. Mr. Siva purchased a house property on February 1979 for what is the cost? 3,24,000. In addition, he has also paid stamp duty at 10% on the stamp duty value of 3,50,000, which means 3,74,000. 3,24,000 plus 35,000 stamp duty value. Yes or no? Total cost is 3,59,000 is the actual cost. Do you agree? Yes. Next, how did we got 359? By the way, how did we got? Some students might have this doubt also. 324 plus on this 10%, 35,000. That's how you got 3,59,000. Okay. Next. In April 2008, Mr. Shiva entered into an agreement with Mohan for sale of such property for 14,35,000 and received an amount of 1,11,000 as advance. However, the sale consideration did not materialize and Shiva forfeited the advance. So Mr. Shiva forfeited before 1st April 2014. How much it is? So section 51, 1,11,000. Am I right? Next. Again, in May 2015, he again entered into an agreement for sale of the said house for 20 lakh approx to Deepshika and received 1,51,000 as advance. This is in 2015-16 year. Yes or no? However, she did not pay the balance amount, so Shiva forfeited again. Wow. So in 15-16, how much is forfeited amount? 1,51,000. This could have been taxed under IFOS in that year itself. Am I right? Yes. Next. In August 2015, Shiva constructed first floor by incurring 3,90,000. Can I call this as cost of improvement? Yes. Okay. Then finally, on November 15, 2025, Shiva entered into an agreement with Manish for sale of such house for 30,50,000 and received an amount of 1,50,000 as advance through account payee check. Oh, agreement is there, account payee check is there. Yes or no? November 15 is the agreement date. 30,50,000 consideration actual, but agreement advance received. Manish paid balance entire sum and Shiva transferred on February 20. November 15 agreement date, February 20 registration date. Mr. Shiva paid brokerage 1% of the sale consideration. See, brokerage is given 1% of sale consideration. Sale consideration 30,50,000. So 30,50,000. So brokerage will be 30,500. Am I right? Yes or no? Next. Now they gave additional information. What additional? On 1st April, fair market value of the property was 11,85,000 and on the same date, stamp duty value was 10,70,000. So we should restrict to stamp duty value on 1st April 2001. Yes. Further, stamp duty value on 15th November was 39 lakh and 20th February was 41. In our example, agreement is there and advance is received. Yes or no? That too by other than cash. Therefore, agreement date amount only will apply. Do you agree? Yes or no? Therefore, full value of consideration is equal to agreement date 39 lakhs. Yes or no? More than 110% of 30,50,000, which is equal to 33 lakh something approximate. 30,50,000 into 110% is equal to 33 lakh 55. Oh, stamp duty value is more than 110. Therefore, 39 lakh. Am I right? Yes or no? Minus transfer expenses. Transfer expenses we just computed already. Look at it. 30,500. 30,500. Am I right? Therefore, net consideration how much? 39 lakh minus 30,500 is equal to 38 lakh 69,500. Are you clear? Minus straight away cost of acquisition. But remember here SSE purchased in 1979. Cost of acquisition 3,59,000. Yes or no? Since it is before 1st April 2009, market value 11,85,000 or 3,59,000, whichever is higher, 11,85,000. But if it is more than stamp duty value, then stamp duty value 10,70,000. Am I right? So cost of acquisition is 10,70,000 minus forfeited amount 51. How much is forfeited amount? I told you 1,11,000. This fellow only forfeited. What is the balance cost of acquisition? 10,70,000 minus 111. Yes or no? 9,59,000. So indirectly we are now taxing the forfeited. Again, he forfeited in 15/16, but that is taxable in IFOS, right? So cost of acquisition, do we understood? Minus again cost of improvement. Again, if you remember, he spent improvement cost. Look at in 2015 August, he constructed first floor by incurring 3,90,000. So that is actually called as what? Cost of improvement, 3,90,000. That's it. Answer over. Capital gain, how much it is? 38,69,500 minus 9,59,000 minus 3,90,000 is equal to how much? 25,20,500. What is this? Long-term capital gain. What is the answer? What is the answer? Wow. Here they are also asking tax liability. This problem we can compute, but before that I have to discuss one provision. Then I will compute. I will again come back to the same problem and then do. By the way, capital gain is what? 25 lakh 20,500. Same answer we got. 25,20,500 exactly. Now tax liability is pending. By the way, we know it, right? We know it, right? Long-term capital gain. This is, you know what? Long-term capital gain two types. By the way, 112A capital gain. 112A section when it applicable: listed equity share, equity oriented mutual funds, units of business trust. Remaining all long-term capital gains, 112 section will apply. What is 112 section tax rate? 12.5%. How much is the tax rate? 25,20,500 into 12.5%. How much it is? 3,15,063 plus 4% cess. Plus 4% cess. Okay, 25 lakh. No. Wait. Is there any other income for him? Is there any other income for him? By the way, it is taxable at what rate, ma? 12.5. Now, by the way, let's look at the question once. Let's look at the question once. Compute capital gains. We just now computed. Also compute tax liability, assuming that basic exemption limit is fully exhausted. Other income is there. Basic exemption is fully exhausted. There is no unutilized basic exemption. So we can directly apply 12.5. 25,20,500 into 12.5%. How much it is? How much is the tax? 3,15,063 plus 4%. 3,27,665. 3,27,665. Are you clear? But here we should compute tax in one more option. There is another option through which we need to compute tax. Like, what is it? You know, like now capital gain computation is so simple, right? But this was not the case before 23rd July 2024. If at all transfer of capital asset happened before 23rd July 2024, you know how the computation would have been? That too, if the asset is a long term, how the computation would have been? How you know? Full value of consideration as usual minus transfer expense as usual, then net consideration as usual minus, if it is long term, you know what? Indexed cost of acquisition minus indexed cost of improvement. Indexed. Somewhere we saw indexation already in our previous chapters. Where we saw? Exactly. We saw in salaries chapter rent-free accommodation indexation concept. Remember? A similar indexation is applicable for acquisition cost and improvement cost. Okay, we used to calculate indexed cost and indexed improvement. Then that's how we used to calculate capital gains. Tell me, for example, cost is 10 lakh. Indexed cost would have been definitely little more higher. Indexed means what? Inflation adjusted cost. What is it? Inflation adjusted cost. So earlier we used to compute this like this. But what happened, you know, in Finance Act 2024 number 2, okay, immediately budget after election, what they did, you know, they removed landmark amendment in capital gains. They removed indexation concept, which really hurted entire real estate sector. It's really hurt. But what they did, you know, indexation is removed, which means now there is no concept of indexation right now. Okay, if at all you are selling any asset, if at all you are transferring any asset on or after 23rd July, if at all you are transferring any asset on or after 23rd July, no more indexation. Simple. Net consideration minus cost minus improvement, answer over. But earlier, if the transfer is before 23rd July, they used to get indexation benefit. First of all, what is indexation? What is indexed cost of acquisition? What is indexed cost of acquisition? Very simple. Cost of acquisition multiplied by denominator. Cost inflation index CII number of year. CII number of year. Remember the formula. Year in which asset is first held by SSC. Denominator. Numerator. CII. What is it? CII of year of transfer. Are you clear? For example, I purchased the house in 2000, let us assume 2012-13, I purchased the house for 10 lakh. Okay, I purchased a house for 10 lakh in 2012-13. And 2025-2026, I sold it for 1 crore. Okay, tell me, how do we compute capital gains generally? Full value of consideration 1 crore minus what is the cost of acquisition? 10 lakh. Therefore, the capital gain is 9 lakh, which is absolutely right because you are selling in 25-26. But you know, if at all, like earlier way, if at all we have to compute capital gains, how do we compute? You know, as usual, full value of consideration 1 crore minus indexed cost of, this is old method I'm telling you. In olden method, now how do we compute on indexed cost? Indexed cost means what? 10 lakhs is the original cost multiplied by year in which you transferred 25-26. First is what? You know, for example, here itself 10 lakhs is the cost multiplied by CII of year of transfer. Look at index number we have given here. We have given index numbers, you see here. Cost inflation index numbers. Don't worry, in exam they'll give you. Comfortably you can do that. Don't worry at all. In exam they'll give you numbers. Okay. What is index number for 25-26? 376. In our example, year of transfer is what? 25-26. So what is the index number? 376. Denominator. What is the word used? CII number of year in which asset is first held. Asset first held means what? When the SSC got the asset. He got the asset in 1213. 1213 number you see. 1213 number you see. Oh, 200. What is it? 200. Denominator is what? 200. Okay, now which means 10 lakhs cost I am adjusting in growth of inflation. Okay, how much is the cost? 10 lakh multiplied by yes or no? 10 into 376 divided by 200 is equal to 18.8 lakh. Am I right? Yes or no? So 1 crore means 100 lakh. Yes or no? Indexed cost is 18.8 lakh. So what is the capital gain balance? 100 minus 18.8 is equal to 81.2. This is how we compute in olden days. We just index it and then compute. Whereas now how are we computing? Sale consideration minus actual cost is equal to capital gain. Simplest way we are computing. But earlier no, we used to calculate indexed cost of acquisition, indexed cost of improvement, all that. Now, what is the formula for indexed cost of acquisition? Cost of acquisition multiplied by denominator, inflation, index number of year in which asset is first held by SSE. First time in which year you are having this asset, that year number. Numerator, transfer you ultimately sold, right? That year number. Are you clear? So that's how you calculate indexation. Okay, first year in which you held, and numerator year of transfer. Same way improvement also, same way cost of indexed cost of improvement is equal to cost of improvement multiplied by same numerator, CII of year of transfer divided by CII of year of improvement. What is it? CII of year of improvement, in which year you improved, that year number will be the numerator, transfer year, that year. So accordingly you get indexed cost of improvement, this year reduce. Now tell me, earlier even though my original cost is 10 lakh, my indexed cost is 20 lakh, 30 lakh, 40 lakh, like that some amount will be there, bigger amount will be there. So if because of indexation, what happened earlier? Capital gain amount will reduce. Am I right? Look at here in this case, without indexation 90 lakh, but with indexation capital gain is 81 only. Gain reduced, yes or no? Yes or no? Now because indexation is removed, what is happening? Gain amount is increasing. What is happening? Gain amount is increasing. That too, one more point, earlier long-term capital gain tax rate, what rate, 20%. Until Jan 26 exams also this is there. From May 26 only this rate is removed. In our book it is removed. ICA book also removed this rate. But one point they will be testing this. Okay. Earlier, no, before 23rd July 2024, if at all you are selling before 23rd July, that too it is a long term. If it is a long term capital gain after indexed cost, indexed improvement, capital gain 20% they used to tax. Now what finance minister told, hello, we reduce tax to 12.5% only. We reduce tax to 12.5% only. So now since we are reducing tax, indexation I will remove it. So one benefit they gave, another benefit they took back. But this many SSEs did not like. Are you clear? For example, I will tell you, I purchased a house in 2001-2. I purchased a house in 2001-2. Look at how carefully the problem is. Okay. I purchased the house in 2001-2 at what price? 10 lakh. 2001-2, 10 lakh. In 2025, 2026, I ultimately sold for 1 crore. First option. Okay. There is no improvement, nothing. Just a blind example. Okay. Full value of consideration is how much? 1 crore minus cost of acquisition 10 lakhs. What is the capital gain? 90 lakh multiplied by, right now you are saying tax rate is reduced. No. 90 lakh into 12.5%. How much, ma? 11.25. What is the tax rate, ma? 11.25. Are you clear? Let us assume the sale value is 50 lakh only, ma. Okay. For better convenience sake. Okay. For better convenience sake, I am taking so that a correct analysis you will get. 40 lakh into 12.5% is equal to how much, ma? 5 lakhs. 5 lakhs is the tax. Suppose if I compute the same answer with old method, shall I see what is the answer? Full value of consideration how much? 50 minus indexed cost of acquisition. Cost of acquisition 10 lakh. Numerator 376. What is the numerator? 376 by, because in this year only I am selling 25-26. So numerator 25-26 index number 376. Denominator, when I purchased the house, when I held the house for the first time, 1-2 index number is what? Wow, 100. Okay, 100. So what is the cost of acquisition? 37.6 lakh. Do you agree? What is the long term capital gain? 50 lakh minus 37.6 is equal to 12.4. Okay, as per old income tax, what is the tax rate? 20. As per old provision, I am calculating capital gain as per old provision. Okay, what is the tax rate? 12.4 into 20%. How much it is? 2.48 lakh. Now finance minister is saying, hello mister, tax rate I reduced, man. That's why I am removing indexation. Okay, fine. Shall I tell you your amendment is worst amendment? Shall I tell you? Shall I prove it? Now I did. Suppose I purchased a house for 10 lakhs in 1-2 year and I sold it for 50 lakhs in the current year. How much it is sold for? 50 lakh. That time, without indexation as per your amendment, you are saying lower tax rate, and that's why you took indexation benefit, you told no. So I calculated tax 5%. With indexation, even though tax rate is higher, still my tax is lower. Many SSCs argued this. Finally, finance minister came down. Okay. So what she did, oh, fine, I understood. This is a genuine concern. Fine, I understood. What she did, if at all, look at the analysis very carefully. If at all you bought the house property before 23rd July 2024, you bought the house property before 23rd July 2024, you bought the house before this, like in our example 2001 to before that, 2015-16 before that, whenever you bought, and you are selling the house property, it may be land, building, or both. Immovable property, for immovable property only this logic is, yes or no? If at all you are selling that land, building, or both, okay, on or after 23rd July 2024, okay, when you are computing tax, tax computation only, compute tax as per both options. Wherever the tax liability is lower, that option you choose and pay tax. This is what the finance minister told, and that is what in the book amendment is adjusted like that. Now by the way, look my dear, when you are computing capital gain income, no indexation. 1 crore minus 50 lakh minus 10 lakh, 40 lakh only your capital gain income. Total income is 40 lakh only. There no problem. But when you are computing tax, in the tax computation steps, that time, compute capital gain with indexation and tax at 20%, compute capital gain without indexation and apply tax at 12.5%. Wherever the tax is low, that much is your basic tax. At a tax computation, see, you are worried about the gain computation or tax computation. People are worried about this gain computation or tax. They are worried about tax burden. So at the tax computation stage, whichever option is beneficial to you, that option you choose. When this option is given, when this option is applicable, if the property is purchased, if the land or building or both immovable property is purchased long back 23rd July with an assumption that tomorrow I will get indexation benefit, I will have to pay 20% after indexation capital gain, where my tax is generally lower, but suddenly you came and shocked me saying indexation removed. Now if I calculate my capital gain, huge tax I will get. Are you clear? So that's why, so if at all you are an SSE who is an individual, or you are an SSE who is a HUF, if at all any of you purchased any immovable property before 23rd July, that is before we bring this amendment, and you are selling the house on or after 23rd July, whenever 2030 or 2040 or 2060, doesn't matter. This house you bought when? Before 23rd July. Either you might have bought or your previous owner might have bought. Who bought? I am not asking. It was there with you before 23rd July. You are selling it after 23rd July and it's a long-term asset. You compute, see, capital gain computation latest only. Sale value minus actual cost is equal to cost of capital gain. But in tax computation stage, once again compute capital gain with indexation, then compute tax at 20%. Already you computed capital gain without indexation, on the 12.5% apply. Wherever tax is low, that tax you show to the department and pay that. I will not ask any question. Are you clear? Now look at this question. Did you understand indexation concept now? Now look at this question. Here what happened? Look at the same question. Shiva, 7th question. When he is selling to November 15, 2015, he agreed. Okay. He is selling on February 20, 2026. Transfer date is February 20, 2026. That's the date of transfer. Sale deed, agreement, I mean, whenever registration happened, that is the transfer date. But when he purchased to 1979, he purchased when? which means he purchased this immovable property before 23rd July 2024. What is the capital gain computation method? The capital gain computation method is no change at all. Already I computed, no change at all. 25,20,500, no change. And on the 12.5% tax will apply as usual. But should I pay this tax blindly? No, no, no. Compare. Another option you have. What option you have? What option you have? Here I'm erasing, okay? Here I'm erasing, okay? Okay, or else I'll just add a page. Okay, now I will compute tax as per option 2. Sorry, I will compute tax as per option 2. Can I? Option 2. I will compute tax as per option 2. Okay, same details I will take. What details? Full value of consideration how much? Full value of consideration how much? 39 lakh. Am I right? Minus transfer expense how much? Transfer expense how much? By the way, where am I computing this? Am I computing it income computation time or am I doing this at tax computation time? When I'm doing this and when I'm computing tax, that time I'm computing capital gains. This is not for IT return purpose. This is just for tax computation purpose. Do you understand? Yes. Transfer expense how much? 30,500. Am I right? 30,500. Net consideration is how much? Okay. 39 lakh minus 30,500 is equal to 38 lakh 69,500 minus cost of acquisition, indexed cost of acquisition. This is a long-term capital asset. This is a long-term. Long-term means it is eligible for indexation. Short-term asset is not eligible for indexation. Now, indexed cost is equal to, what is the original cost, by the way? Oh, 10 lakh 70. What is the original cost? 10 lakh 70,000. By the way, minus forfeited 51. 1 lakh 11,000 reduce it. What is the balance cost? 10 lakh 70,111 is equal to 9 lakh 59,000. This you should index. If forfeiture is there, indexation should be done after reducing forfeited amount before 1st April 2014. That amount you should reduce and then index it. Index divided by. Okay. Now indexation divided by numerator. CII of the first year in which asset is held. In this problem, asset is held by him in 1979, 78, 79 year. But you know what? Indexation you will get only from 1-2. This is called base year. Indexation is available only from 1-2 year where 100. So if at all you bought before 2001-2, indexation will be only from 1-2. Why? To that extent we took market value as on 1/4/2001 only. Here also. So don't worry. So below denominator how much is the index value? 100. New denominator. Numerator 25-26. You are selling this house when 25-26 year? Yes or no? You are selling this house in 25-26, no? What is the index number for 25-26? You see, in exam they'll give you problem like this. So 1-2 they gave, 25-26 they gave. You see, to confuse you, they gave remaining also. This is irrelevant for you. Year of transfer, numerator, that index number. Transfer year index number is only relevant for you. Denominator, first time when you held this house. In this case, 1-2 year is what? In that year only, the house is in my hand. Yes or no? 376. So 376. What is the indexed cost? 9,59,000 into 376 divided by 100 is equal to 36 lakh 5,840. Wow, what's the capital gain? 38 lakh 69,500 minus 36 lakh 5,840 is equal to how much it is? 2 lakh 63,660 only into 20% tax rate. Correct? As per old rate only I'll pay. If I pay tax as per old rate, 52,000 I'm getting, whereas as per new law 3,27,000. How much I will show? What happened? That's okay. Basic tax. Okay. Basic tax earlier I got 3,15,000. Right now basic tax I got 52. Which option is better for me? Indexation route is better for me. See, in my income computation, I will show as per this only. My income is, what is my capital gain is 25 lakh only my capital gain. But my capital gain tax is not that method. My capital gain computation is this method. Okay. Tax amount is 52. So 52,732 plus 4% is equal to how much I will pay tax? 54,841 I will pay tax, and finally I will pay challan. I will file my IT return. In IT return, if they ask me what is my capital gain income, I will show this only. My income is this only, but my tax liability is This tax amount is computed based on options, whichever is lower. Compute capital gain without indexation, which is what you originally did, on the 12.5% plus 4% cess. Then second option, compute capital gains with indexation facility, and then on that apply 20% tax at old law provision. Okay, wherever the tax is low, that option. Now let's look at the answer once. So how much is the answer? Look at it. First option, 3,15,000 basic tax. Am I right? Second option. What is the second option? Oh, hurry, we forgot. Yeah, improvement we didn't reduce in this question. Array, we forgot improvement. Only indexed cost of acquisition we reduce. Array, improvement is also there, no? Yo, we missed it. If some of you remember it, very good. Okay, minus indexed cost of improvement. Cost of improvement is how much? We already reduced here. Here we forgot. What is it? 3,90,000 multiplied by numerator 376, denominator 100. Improvement which year? Improvement is in which year? Improvement is in first floor, August 2015, means 15-16 year. In the below information, the 15-16, 254. How much is that? 3,90,000 into 376 divided by 254. 5,77,322. 323. Oh, if I total it, I am getting loss actually. I am not getting gain at all. So there is no tax at all. I will go with the old method where I will not have to pay any tax. Happily I'll go with the old method. Okay, if I go with the new method, no, this much. By the way, this entire computation I will do when I am computing my tax liability. That time only I will have to check this option. Otherwise I will not even look at this option. By the way, when I am eligible to check this option, first of all, I am an individual or HUF. 2, the asset I transferred must be land or building or both. 3, the land and building which I sold right now, right, that I must have purchased before 23rd July and it must be long term. Then only I am eligible to check this option and compute tax. Are you clear? If it is a short term, I don't have any, I write like this. If the land and building which I sold is a short term capital asset in my hands, this option not available. If at all I am an individual and HUF, I am selling jewelry, I don't have this option. I am selling some archaeological collection, painting, drawing, sculpture, work of art, gold deposits, sovereign gold bonds, gold receipts each years. No such option. Only for removable property you were given this benefit. Are you clear? For remaining capital asset, how do you compute? Sale full value of consideration minus transfer expense minus actual cost of acquisition minus cost of improvement is equal to answer. That's it. Do you understand? Now look at in the GOAT notes. This point I'll tell you. Now look at what is cost of acquisition. By the way, tell me, what is cost of acquisition? Cost of acquisition refers to cost at which asset is acquired by SSE or previous owner. When the previous owner logic is applicable, star mark I gave. If the asset is received by SSE under circumstances, modes means nothing but circumstances specified under 49, discussed in detail under later topic, I clearly mentioned. Now if at all you are transferring long term capital asset on or after 23rd July, how to compute capital gains? Transfer of any long term capital asset on or after 23rd July, they are not eligible for indexation. Exception. What is exception? Exception, resident individual or resident HUF, if they are transferring long term capital asset, that to land or building which is acquired by them before 23rd July, they can pay tax at his option. Tax only. Pay 12.5% tax on capital gains computed without indexation, or pay tax at 20% on capital gains with indexation. The SSE chooses the option where the tax amount is lower. But remember, when you are computing total income, tax capital gains on the transfer shall be computed without giving benefit of indexation. Computing total income point of view, indexation and all ignore. But when you are computing tax below basic tax, that time indexation option will be checked. Are you clear? Why? I will tell you. Here how examination one time, sometimes how. Your income from salary, okay, some 30 lakh. Your income from capital gain, long term capital gain, okay, this income from capital gain is 40 lakh. This 40 lakh is how 1 crore minus cost of acquisition 60, 40, okay, like this. Now your total income is what? 70. Fine. On this you computed basic tax, original basic tax. When you are computing basic tax, you have when you're computing basic tax, you can compute on salaries, this is taxable at slab rate. Okay, 30 lakhs is normal citizen optional tax regime, I'm assuming. Normal citizen optional tax regime, I'm assuming. So 20 lakh into 30%, 1,12,500. Am I right? So basic tax comes on salary related income, how much? 7,12,500. Am I right? Now capital gains. Okay, option number 1. Option number 1 is what? 40 lakh into 12.5%. Assuming this capital gain I got for the asset purchased by me, land and building, before 23rd July. So capital gain, one option 12.5% directly 5 lakh. Option 2. Option 2. In option 2, my capital gain is actually not gain, it's a loss. Okay. Therefore, my tax at 20% is also 0. So my option 2 is 0. Therefore, I will pay tax as per option 2 and this. Now tell me what is the basic tax. Now tell me what is the basic tax. Tell me what is the basic tax. 7,12,500. Do you agree? Plus surcharge. Since my total income is 70 lakh, surcharge is applicable at 10%. Now immediately if you see, here income I computed based on option 1. But tax I'm computing based on option 2. When I'm deciding surcharge, my income I should check based on my option 1 only, not option 2. As per option 2, my income is what? 30 lakh, capital gains nothing, negative. My total income as per option 2, 30 lakh. But income I should not compute like this. Income I should compute always based on option 1. Option 1 means without indexation. When you are computing basic tax, option 1, option 2, both options you check and compute basic tax. Wherever lower basic tax is, take that basic tax. Over. That's it. Now you need to add surcharge. Forget about options. Original option 1 total income 70. Therefore 10% surcharge applicable. Understood? That's it. That's why only at basic tax computation only option scheme checking is applicable. When you are computing total income for problem purpose, no option. As usual, original provision will go. Easy. That's it. That's it. Now look at. So do you understand? So therefore, for income computation purpose, the capital gains will be computed without indexation. But for tax computation purpose, indexation option will be checked to pay the tax in beneficial manner. Question number 7. TYK question number 7. Yes or no? Yes or no? Make it as exceptional. Okay, in the book also write it exceptional at the beginning. Question bank. It's question bank. TYK question number 7. Question number 7 only, no? Now look at what is indexed cost of acquisition. Indexed cost of acquisition is cost of acquisition into year of transfer number divided by number for the year first held by the SSE or 2001 to whichever is, whenever you first held that year, or 1 to number whichever is later. If at all you are holding in 1780, 1881, then 1 to number you should put. If at all you are having in 56, then 56 number you should put. Are you clear? Yes or no? Indexed cost of improvement. What is it? Cost of improvement multiplied by index of year of transfer divided by index of year of improvement. Are you clear? Are you clear? Yes or no? No. No. Should I cover this point or not? I will not cover this point. I am asking you to strike up this point. Okay. Wait, let me decide. Actually, this is not relevant. This is an old provision basically. Okay. But it is given in the ICA book also. It is given in the book also. Tell me. No, once again. One more concept I wanted to tell and I wanted to conclude here. Okay. One more concept I wanted to tell. Okay. Now. When not required. It's not required because it's outdated provision. Now, like here, there is a case law called Manjula Jesha case. Okay. Manjula Jesha case. You just remove this concept. Okay. My request is remove this concept. Okay. Now, even indexation applies only to the assets transferred before. That also remove this. Not required. Now not required. Okay. This was relevant for Jan 26 students. Okay. Now it is not required for May 26 students or September 26 and all. It is not required. Okay. Fine. Now tell me, if at all you are acquiring a asset under 49 circumstances, what is cost of acquisition? Cost to previous owner. Same improvement also cost to previous owner. Improvement to previous on or after 1/4/2001. Yes or no? Holding period. When you are getting assets through 49(1), holding period will be counted from which date? From the date in which you got from previous owner data. From previous owner date. Are you clear? You consider that you are holding asset from previous owner purchase date onwards. That date onwards you will count. Are you clear? That's it. But remember, indexation, if at all we have to compute in option, no. You should compute indexation only from which year onwards? You should compute indexation only from when you got the asset in your hand. From that year only you should. For example, I will tell you, my father purchased the house. Look at, actually, you striked off, right now you striked off this one. You striked off, fine. Though you strike off, nothing wrong. I'm going to tell what exactly this. Briefly I'll tell you, but not required. Don't even touch it, okay? Now, my father purchased a house in 1981, okay? 10 lakhs. No improvement, nothing. 1st April 2001, the market value is 30 lakh. But I inherited the house in 2009, 2010, okay? Finally, I sold it in 2025, 2026. By the way, this is a house because I had this house before 23rd July, which means I can compute indexation at the time of tax computation. Indexed cost I will compute, yes or no? How will I compute? Cost of acquisition into first held by me when? First held by me when? 910 index number denominator, and numerator I am selling the asset in 2025-26. Are you clear? That's it. Now there is a case law, Manjula J. Shah, Bombay High Court case law. What they say, By the way, tell me, is this long term or short term? From which date you will count? 910 I inherited. No, from the date you will count. From my father acquisition date you will count. Previous owner holding period. Previous owner holding period 80-81 onwards I will count, and this is more than 24 months. Therefore, it is a long term. Yes or no? From this year you will count, right? Holding period. What Bombay High Court said, for period of holding purpose, you are treating holding period from 80-81 when previous owner purchased. Why indexation from 910? Holding period you are saying 80-81 onwards you are holding, deemed to be holding. Then indexation also you can claim from 80-81. Nothing but 1 to base year, if whichever is later. So Manjula Jesha case says you can happily claim indexation from the year previous owner is having, because previous owner holding period is counted to decide whether the asset is a long term or short term. Previous owner holding period is considered. Since holding period is considered, first held means holding period. That logic they interpreted, and they said 2001-2 onwards you can compute indexation in this example. But in the ICI, all the problems were given based on first held by SSE. Even though period of holding is counted from 80-81, first held by me when? Tell me. 910 only. I held the asset 910, and before that my father is holding, not me. I am holding for the first time in 910 only. So 910 onwards only I will give indexation. Are you clear? However, cost of improvement, denominator year of improvement. Am I right? If year of improvement, for example, my father did improvement in 4-5, okay, year of improvement point of view, happily I can give 4-5, because previous owner improvement I can take whenever he incurred improvement, that year index number I can give denominator, and 25-26 numerator I can give. Only for acquisition first held option is applicable. For improvement, when I'm taking indexation, denominator, whenever improvement happened, that year improvement you can take. Are you clear? Yes or no? That's it. Now, but by the way, what I will tell this entire Manjula Jesha case right now, whatever I said, strike off, not required. Not required for you, because in the institute book, this Manjula Jesha case is not considered in problem solving. Are you clear? First held by the SSE, acquisition, indexation. Whereas improvement, whenever improvement is incurred, if previous owner incurred, that year. If current owner incurred, that year improvement number. Are you clear? Are you clear, everybody? That's it. So actually there is so much depth we used to discuss once upon a time, but now it is not required because indexation concept is removed. So which is something which is very, very best thing happened. Okay, are you clear until now, all of you? So which means we effectively discussed acquisition concept, improvement concept fully. Are you clear? Improvement concept, you see, year of improvement, CI of the improvement, CI of the year of improvement. You just add one more word, year of improvement. Look at page number 113 formula. So cost of improvement is equal to indexed cost of improvement. Cost of improvement into year of transfer numerator divided by index number of year of improvement. Are you clear? Now let me once summarize before I go for the next topic. So capital gains, when it will arise? From the beginning I'm revising. If at all there is a transfer of capital asset during the relevant previous year, then in the same year it is taxable. To attract capital gains, there are two conditions. There must be transfer and it must be capital asset. And the transfer is taxable in which year? Year of transfer. Taxable in year of transfer. Now, capital asset means what? Any property. Tangible, intangible, related to business, not related to business, everything is a capital asset. Security held by foreign institutional investor, capital asset. Securities held by investment fund, capital asset. We referred under 115 UB, capital asset. Yes or no? ULIP, capital asset. Other than stock in trade, other than securities held by FII and investment fund. Okay, for them it's always a capital asset. Okay, then second one. Personal effect, which are movable and personal purpose, they are not capital asset. However, jewelry, archaeological, painting, drawing, sculpture, work of art, capital asset. Then land not situated in specified area. What does it mean? Rural agriculture land is not a capital asset. Then special bearer bonds, gold deposit bonds, gold monetization certificates, they are not capital assets. Are you clear? Then we understood capital assets are again two types: long term, short term. Short term is, long term is something which is not a short term. Short term means what? Up to 24 months, it's a short term capital asset. For some assets up to 12 months. What are some assets? Listed securities. Listed securities. Be careful. Now again, I'm telling you. Okay. Short term capital asset means what? 12 months criteria purpose. Okay. Listed securities. Are you clear? Listed securities. Then units of equity oriented mutual fund, then units of unit trust of India, then zero coupon bonds. Whereas 112A section and 111A section, you remember 112A 111A section, their special assets are taxable at 12.5% excess of 1.25 lakh and 20% short term capital gain, special rates, special incomes. Yes or no? There what are all covered? Listed equity shares, listed equity oriented mutual fund or equity oriented fund. Okay, then units of business trust. What is it? Units of business trust. Here the list purpose is different, here the list purpose is different. Here the list is given for 12 months criteria, whereas 112A 111A the list is different. There it is regarding tax rate purpose. Are you clear? Yes. So now for these 12 months, up to 12 months they are short term. Beyond 12 months it is long term. Any other asset, land, building, jewelry, archaeological collection, painting, drawing, sculpture, sovereign gold bond, gold receipts, all these, yes or no? Debentures, unlisted shares, unlisted bonds, for all this, yes or no? 24 months is the criteria. Are you clear? Now how to compute this holding period 12 months, 24 months? From when I held the asset, generally from the date on which the asset is in my hand, control, till the date I sell it, that is the holding period. But there are some cases, if at all I got the asset as referred under section 49 from previous owner, or I got this asset because of my previous asset, then for holding period computation, previous owner holding period, previous asset holding period, both has to be considered respectively. Yes or no? Yes, that's it. This is period of holding concept. Are you clear? Now we understood until here whether it's a long term or short term, how to decide, we understood. Then we understood section 50/50A. Capital gains is computed in 48 format and 50/50A format. 50/50A depreciable. If it is other than depreciable, 48 is applicable. As per 48, full value of consideration minus transfer expense, net consideration, then minus cost of acquisition, cost of improvement, then you get capital gain, full value. If at all I am selling land, building or both, then 50C will apply. As per 50C, if stamp duty value is more than 110% of actual, then stamp duty will be the full value of consideration, otherwise actual. Stamp duty value, which date? Transfer data, agreement data. Agreement date I will take when if there is an advance and advance is received by other than cash, then agreement date stamp duty value I will take. Otherwise, transfer date stamp duty value. Once you decide stamp duty value, compare that with actual. If it is more than 110%, stamp duty. Otherwise, actual. Suppose if stamp duty value is unreasonably high, SSE felt that, he can request assessing officer to refer the case to valuation officer. If valuation officer comes back and tell you one value, if it is good for SSE, take it. If it is bad for SSE, then take SDV directly. Are you clear? Next, what is now FVC? We understood. Now 50D, there is one more section. 50CA, one more section. 50CA, what is that? Unquoted share, unlisted shares. If at all you are selling, what is full value of consideration? Actual or FMV, whichever is higher. Simple logic. Then, if at all consideration is not determinable, then asset you gave, right? It's market value. Are you clear? That's it. Now, full value over minus transfer expense. Generally, we calculate as a percentage of real price. Then you get net minus cost of acquisition. What is cost of acquisition? Cost of acquisition is actual cost I paid. That's it. The purchase price I paid. Yes or no? Suppose if I purchase the capital asset before 1/4/2001, then actual cost or 1/4/2001 market value, whichever is higher. Suppose I got this capital asset not by myself, I didn't buy, I got from previous owner, then cost of acquisition, cost to previous one. Suppose if previous owner bought before 1/4/2001, then cost of acquisition is cost to previous owner or 1/4/2001 market value, whichever is higher. Suppose if it is immovable property, restricted to 1/4/2001 stamp duty value. Are you clear? Further, what is cost of acquisition of shares allotted? You know, whatever amount I paid, that much. What is the cost of acquisition of right shares? How much amount I paid? That much. What is cost of acquisition for right renounced? Zero. Renounced, no, you only renounced. For that you didn't incur anything. Zero. So entire renouncement is a profit. Okay. Then what is cost of acquisition for the right buyer? How much he paid to renouncer plus how much he paid to company, both put together is called as cost of acquisition. How much is cost of acquisition for bonus shares? Zero. Yes or no? Now, suppose if at all there is a 1128 asset, if at all you are having these assets, are you clear? Which are acquired by you before 1st February 2018, and now in 25-26 year you are ultimately selling. Now what is these assets cost of acquisition? Whether they are bonus or others, leave it. Okay, what is these asset cost of acquisition? First step 1, actual cost. If at all they were acquired before 1st April 2001, then market value, that is step number 1. Step number 2, lower of market value on 31st January 2018, or actually you are selling now, right? Sale whichever is lower. This is step number 2. Step number 1, step number 2, whichever is higher. That is the cost of acquisition. Are you clear? That's it. Finally, capital gains, how do we compute? Full value minus cost of acquisition minus cost of improvement. Improvement means what? Any expenditure I improved. Capital expenditure I spent on original asset is improvement cost. Previous owner if we spend, you can take that. But any improvement before 1/4/2001, ignore it. So how to compute capital gain? Finally, FVC minus transfer minus cost of acquisition minus cost of improvement is equal to capital gain. Now you need to compute tax on that. What is the tax rate on that? If it is 112 asset, 12.5 straight. If it is 112 asset, beyond 1.25 lakh, 12.5. If it is triple 1 asset, 20%. Suppose it's a land, building or both, which is purchased by you before 23rd July. Now you are selling it. Tax compute normally, just now I said, right? 12.5 on the capital gain computed without indexation as usual. However, option 2, at the time of tax computation, with indexation compute capital gain and compute 20% rate tax. Whichever is beneficial, take that. By the way, forfeiture of advance. 51. What is forfeiture of advance? If I forfeit any advance before 1st April 2014, that forfeited amount shall be reduced from cost of acquisition while computing capital gain ultimately on the same asset which is transferred. Suppose if any advance is forfeited on or after 1st April 2014, that entire amount is taxable in the year in which it is forfeited. That's it. Entirely hardly 10 minutes. Whatever till now 4 or 5 hours discussion we did, 10 minutes I summarized it. Are you clear? I covered every point. So in the next session I will talk about, tell me right now, until now what we discussed, capital gains are taxable in which year? Year of transfer. Am I right? Now there are some circumstances where capital gains is not taxable in year of transfer but some other year. What are those circumstances? 45 subsection 2, 45 subsection 1a, 45 subsection 5. These 3 sections in our next session I will discuss. Once this is discussed, major topic is over. Technically major topic. Apart from this, we have 46, 46a, buyback liquidation, which is easy concept. I'll come back to it at last. Okay. Then once it is over, 54 series discussion is there. Once that is over, capital gains chapter is closed. Are you clear? Now, let's continue another topic. So remember, in all the previous sessions, the problems that we solved, they were always based on taxability in the year of transfer, right? So in the previous session, what we discussed is generally capital gains are taxed in the year in which it is transferred. But now there are 3 cases where capital gains are not taxable in the year of transfer, but they are taxable in some other year. Means transfer is happening in 1 year, but the transfer is happening in 1 year, and the computation of capital gain will be in some other year. Are you clear? Now look at, maybe in this problems, no, in these kinds of problems, no, there is a possibility of indexation concept. Remember, indexation concept I told, there is no indexation now. Any problem that you do today, when you are computing capital gains income, no indexation at all. But when you are computing basic tax liability, and in the problem, if at all, it's a land and building which is purchased by you before 23rd July 2024, which is transferred in 25-26. Yes or no? Now when you are computing basic tax, you have 2 options. Option number 1, original capital gain you computed without indexation, on the 12.5% tax you apply and then compute the original basic tax. Option number 2, compute basic tax on capital gains, revised capital gains, which is computed with indexation facility. This option is available only for resident individual and HUF who transfer land and building on or after 23rd July, which they purchased before 23rd July. Am I right? Yes or no? This is the option which they have. Except that there is no indexation concept at all in computation time. Correct? When I'm computing income table, no indexation. Only at the tax working note, indexation option, that too only for land and building, individual HUF, resident transfer before the purchase before 23rd July, transferred on or after 23rd July. That scenario is there. Am I right? Yes. Look at now 45 subsection 2 first. No, not for subsection 2. First I will cover 1A, which will be very easy to understand. First 1A. What is this? You know, here capital asset is relinquished. Actually the section is capital asset is destroyed, demolished. So capital asset got, what happened to it? Destruction or demolition happened. Asset destroyed. Asset destroyed, how come it's a capital asset? Problem is, the point is, the SSC received insurance compensation. SSC received what? Insurance compensation. Now you know what asset got destroyed? You know, for example, building got destroyed. What destroyed? Building. Okay. No, let us not take building because that's a depreciable asset concept comes. Fine. Let me take, maybe SSC personal property got destroyed. Personal jewelry. For example, SSC took jewelry insurance. Best example. SSC took a jewelry. He has taken jewelry insurance also. You know, insurance is there for jewelry also. Bulgari. So no, Bulgari means theft insurance. Okay, Bulgari insurance. Some type of insurance he has taken. Now it was destroyed or demolished in a fire accident. Some fire accident happened in the home and the entire jewelry got smashed. Okay, completely, you know, like it was destroyed. It was melted completely and we can't even trace it. And it was proven by scientific surveyors also. Luckily, I have an insurance compensation. Insurance policy is there. Whatever market value of the jewelry that got destroyed, that entire market value is compensated to me. That entire market value is compensated to me. Okay. You know what? How much compensation I received? 1 crore. But what is my jewelry cost? You know, the cost is only 20 lakh. The cost is only 20 lakh. And I have received compensation of 1 crore. Even though it's a bad incident which happened, you still made a profit or not? So 45 subsection 1A treats this as transfer, and it comes under relinquishment. Destruction, demolition, everything comes under what? Relinquishment. So capital, the 45 subsection 1A treats this as transfer. You know what is the year of transfer? You know, when the fire accident happened, you know, the fire accident happened, let us assume the fire accident happened in 23-24 previous year. In that year it happened. Okay, in 23-24 previous year the fire accident happened, and 1 crore is the compensation decided, but they didn't pay me. They just decided, and department know, and actually they are going to pay me in which year? 25-26 only. They are going to pay me 1 crore plus interest also they are paying me. That interest amount is taxable under other sources. Interest on compensation is taxable under other sources. Okay, that keep it aside. 1 crore they decided in 23-24. They decided 23-24 1 crore, and 45 subsection 1A says this is what year of transfer, because in this year only destruction happened, right? This is year of transfer, and 1 crore compensation decided. Income tax department got to know this information. Oh, SSE, even though lost by fire accident, he has got 1 crore compensation. He has got 1 crore compensation. Let us go and tax him. Department decided. Let us go and tax him. Department decided. So dear SSE, 1 crore compensation decided, no? So in 23-24 they went to his house. Pay tax on it. And the SSE responded, sir, 1 crore decided, I agree. I didn't receive it yet. Insurance company told me they'll pay after 1 year or 1.5 years. I have not yet received. There are some formalities which they need to go. They need to go for higher head offices, all that, and then finally approve it and then pay me. So how can I pay you? I don't have cash. See, if at all I sell, no, at least I'll be receiving cash. But I'm not selling it. It's destroyed. Now I will receive compensation. I myself don't know when I will receive. And now you are suddenly coming and asking me because I made a profit. How fair it is? So department brought 45 subsection 1A. Why? You know, I'll tell you why 1A is required. Because original charging section is subsection 1. In that subsection 1, capital gains is taxable in the year of transfer. And if you observe in the subsection 1, any profits and gains arising on transfer of capital asset during the previous year is taxable in the year of transfer. Am I right? In this entire charging section, when are you getting consideration? When are you receiving the money? Sale money, when are you receiving? They didn't focus on. They don't care. Suppose, no, I sold a land on credit to my brother. He told he'll pay after 6 months. But still, I have to compute capital gains in the year of transfer. I have to pay tax on that in the same year. Are you getting the point? So I have to compute. Indirectly, capital gains is taxable on what method, of what basis? Accrual. Basically, capital gains is liable on accrual. In which year you got gains? In that year only it is taxable. Yes or no? Whereas here you see, you got gain in 23-24 technically, because compensation you know very well. That 1 crore you will receive, you know very well. And it is decided in 23-24. But we don't tax it in the year of transfer as per charging section, which is unfair in this scenario. Am I right? Which is completely unfair. So what department says, you know, I will tax it the moment you collect the compensation. The moment you receive the compensation, I will tax you. This is what department told. Now tell me, year of transfer in this case is what? 23-24 in our example. Whereas year of taxability is 25-26. And guess what? If the transfer is before 23rd July 2024, you remember that date, one date I told? 23rd July 2024 onwards indexation is removed, I told, right? But here transfer is when? Before 23rd July 2024. If the transfer is before 23rd July 2024, you know what? Indexation facility is available, because indexation facility, whether it is available or not, it is decided by date of transfer. If the date of transfer is on or before, if the date of transfer is on or before 23rd July, if the date of transfer is before, I think so, it's okay. Okay, if the date of transfer is before 23rd July, indexation is available. If indexation is after 23rd July, yes or no? No indexation available. Now here, transfer date is what? 23, 24. Automatically, see, I will be computing in 25, 26 year only. So full value of consideration 1 crore minus indexed cost of acquisition I should reduce. Remember, I am talking right now not the tax liability. I am talking about capital gain computation. Computation of capital gains for the previous year 25, 26. Are you clear? Now, what is the gold cost I purchased? 20 lakh multiplied by, indexation means what? Obviously, numerator CII of year of transfer. In this problem, 23, 24 number I should put. I should not put 25, 26 number. 23, 24 number divided by CII of first held by the SSE. For example, SSE purchased this asset in 2005-6. For example, the jewelry 5-6 number you put and 23-24 number you put, automatically indexed cost you will get, capital gain you computed. Are you clear? Hello? Yes or no? Easy or not? So remember, here when destruction, demolition happened and you're receiving insurance compensation you're receiving, the compensation received by you is liable for capital gains tax in the year in which you receive compensation. However, destruction happened in 23-24. Capital asset is there only up to 23-24. Then after capital asset is not there. Yes or no? So if at all indexation is applicable, then indexation will be given up to 23-24 or 24-25 year of transfer only. Yes or no? You will not get indexation up to computation year. But generally tell me, as per 45 subsection 1, year of transfer, year of taxability, both are same. Here I don't have an issue. But 45 1A, year of transfer is different, year of taxability is different. Are you clear? Suppose the machinery, the asset that got destroyed, what machinery. The asset that destroyed is a machinery forming part of block. If at all a machinery which is part of the block of asset got destroyed and I am receiving insurance compensation, what is the treatment? I should apply section 50 logic. And if you remember section 50 logic, opening plus additions, then you get gross block value, then amount received on transfer, demolition, destruction. You remember depreciation format? I told you whatever amount you received on sale, that amount you reduce. Or destruction, demolition, whatever you receive, reduce it. That too, if it is a part of a block, reduce it. Then balance, if at all value is there, calculate depreciation. Suppose if this amount received is more than gross block value, then extra amount is taxable as short-term capital gain. Yes or no? Are you clear? That's it. We'll do one problem on this. Okay. So I think illustrations we have, I guess. So illustrations are T by K. We'll see once. Question number 4 you see here. Question number 4. Okay. Can I? Next, look at. Mr. A is an individual carrying on business. Okay. His stock and machinery were damaged and destroyed in a fire accident which occurred in December 2025. Oh, fire accident occurred which year? December 25, which means 25-26 itself is the year of transfer. Yes or no? Am I right or not? Next, the value of stock lost was 6,50,000. By the way, stock is what? It's SIT, stock in trade, inventory. Inventory is not a capital asset. Now you got stock value also destroyed, and related to stock also you might receive insurance compensation, but that amount is taxable under which head of income? PGBP. Yes or no? PGBP head of income, it is taxable. Next, certain portion of machinery could be salvaged. The opening balance of the block is 1st April 2020-25. Opening block, that is last year closing minus depreciation, is 10,80,000. So opening block value they gave. Yes or no? Fine. And if you remember, if you observe, certain portion of machinery could be salvaged, means some recovery is there in the machinery. Are you clear? Then next, during the process of safeguarding machinery and in firefighting operations, Mr. A, who is the owner, lost his gold chain and diamond ring, which he had purchased in April 2005 for 1,20,000, and the market value of these items on the date of fire accident 1,80,000. Market value, how much doesn't matter to me. How much insurance company paid me, that you show me. Yes or no? And finally, you see here, you see, Mr. A received the following amounts from insurance company towards the stock 4,80,000. Ayyo, 6,50,000 worth of stock, you received only 4,80,000. So which means almost it will be 1,70,000 business loss. Am I right? It's a PGBP loss. Am I right? You claim it under PGBP. Then towards machinery, towards how much? Machinery, you just received 6 lakhs. You just received 6 lakhs. What is the machinery block value? 10,80,000. You see, only salvage left. Means block is not there. Salvage means what? Some scrap only left. Machinery block is over. Yes or no? That's why they told only machinery could be salvaged, which means block itself is not there. Are you clear? 10,80,000 is a gross block value, but I received how much amount? 6 lakh. Am I right? 4,80,000 is short term. Entire block itself is not there, right? So it's a short term capital loss. Now gold chain and diamond ring. How much I received? Gold chain and diamond ring. Full value of considerations. Remember, gold chain and diamond ring, section 48 format is applicable because it's other than depreciable asset. How much amount I received? 1,80,000 minus, since December 2025 is the date on which destruction happened, so which is after 23rd July, there is no question of indexation facility, minus cost of acquisition straight away 1,20,000, therefore 60,000, since the jewelry is purchased by him in 2005, now 2025 December only he lost the jewelry, the gap is more than 24 months, which is a long term capital gain. Am I right? Yes or no? Here in this question, year of transfer, year of taxability, both are same. Am I right or not? Why both are same? Because he received from the insurance company the following amounts, and when he received exactly they didn't mention. I assume that he received in the same year. Are you clear? You are requested to briefly comment on the tax treatment. Just is asking tax treatment. Yes or no? Now here you see, any compensations, loss of stock, compensation received, is constructed as trading receipt. Hence 4,80,000 received will be assessed under PGBP. The SEC can claim value of stock destroyed as a revenue loss, eligible for deduction. So stock destroyed, debit to deduction, you claim 6,50,000. Amount received, tax it as 28. Are you clear? Next, compensation towards machinery. Are you clear? Now look at, therefore 4,80,000 being excess of written down value over insurance will be assessed as short term capital loss. Am I right? Suppose by 31st March he received compensation, very good, but before 31st March he bought one more machinery, block is there. If at all by mistake he buy one more machinery before 31st March, block is there, value is there, depreciation is applicable. Yes or no? Further, if new machinery is purchased next year, it will be constitute new block machinery. Next year if you purchase, in that year new block you will open, but in the same year if you purchase, the existing block will continue. Yes or no? Yeah. Next, compensation for gold chain, all that directly, they are not personal effects, correct? If any profits and gains arise in the previous year because of insurance claim, the same is chargeable to tax. The capital gains has to be computed by reducing cost of acquisition of the jewelry from compensation. 1,80,000 minus 1,20,000 is equal to 60,000. Therefore, long term capital gain is equal to 60,000. Am I right? That's it. Easy. Yeah. I think there is one more problem similar to this in illustrations. It is there in the illustrations, I guess. Okay. I will go to the illustrations. I will go to the illustrations. Okay, just will go to the illustrations once. 13. I think illustration 4, 5, 6 something is there. Six, 5. No, I think it is not there. Only one problem is there, and I already told one problem for you. Okay, I already told one problem. Now easy, understood. 45 subsection 1A. Yes or no? But even I told advanced problem. In fact, suppose if at all destruction happened in 23-24, it means it happened before 23rd July. Yes or no? Before 23rd July, if at all any transfer happened, that time we have indexation facility in computation time itself. Yes or no? And one more point, you know what? Guess what? Here you compute gain, no. Here you compute the gain, right? Most important point I'm telling you, 45 1A, if year of transfer date of transfer. If it is before 23rd July 2024, and if you are computing capital gains in current year, even though you are computing capital gains in current year, indexation is eligible. Indexed cost and all you reduce based on year of transfer, and the capital gain is taxable at what rate? 20%. Capital gain is taxable at what rate? 20%, not 12.5%. Are you clear? Capital gain is taxable at 20. Now tell me, sir, like why is it 20? Very simple. What is the long-term capital gain tax rate under 112? It depends upon date of transfer. If the date of transfer is before 23rd July, 20%. Otherwise, 12.5% is the tax rate. Are you clear? Clear. That's it. That's why since capital gain tax rate is reduced and indexation is removed, many have fought like anything. That's why what department gave, okay, if at all you are selling the asset which is a land or building or both by individual HUF residence, on or after 23rd July you are selling it, you are transferring it, and which you purchased it before 23rd July, before this amendment came, then do one thing, compute capital gains without indexation. In the tax computation step, no, compute 2 times capital gains again without indexation, which you already computed. With indexation, once again a fresh compute tax at 12.5 in option 1, compute tax at 20% in option 2. Wherever the tax is lower, that option you choose, yes or no. But is this entire option scheme and all applicable if the transfer is before 23rd July? Directly, first, directly we compute capital gains itself with indexation, and tax rate will be applicable is 20%. Be careful. Are you clear? Confident? Next. So this is 45 subsection 1A. Okay, now let's go to 45 1A once, and then let's conclude this topic. Let's conclude this topic in 45 1A. Yeah, so come back to 108 page. What is the scope and year of chargeability? First of all, as per original charging section, profits and gains arising on transfer of capital asset during the year are taxable under this section. When it is taxable? Year of transfer, that is based on date of sale, not based on agreement date. I am just reminding you, because agreement date is not sale date. Sale date is different, agreement date is different. Yes or no? And remember, sometimes what happens, agreement happened in March 2025, but sale happened in May 2025. Agreement, stamp duty value purpose, we might take March value, but taxability will be in 25-26 only. Am I right? Because taxability will be always in the year of transfer. Yes. And cost of acquisition can be indexed only up to year of transfer. That too, when indexation concept, when it is applicable, option scheme. Yes or no? Option scheme at tax computation time. Am I right or not? 45 subsection 1, generally if you are computing capital gains in the year of transfer, in our book, right now for our exams, 25-26 problems they'll give. So 25-26 problems means year of transfer, no indexation. But then why I spoke about indexation here? I spoke because you may be computing tax in, you may be applying indexation concept at the time of tax computation step. That time up to transfer you will get. Are you clear? Next, look at destruction of capital asset and compensation from insurance company. What is the section? 45 subsection 1A. What is it? Applicability. When this is applicable? You received money or you received asset from the insurance company. Sir, if money is received, I'm okay, I understand consideration. If asset is received, how to do? Market value of the asset you received, that itself is consideration. That itself is, you can take it as full value of consideration. Are you clear? So money or other asset received under insurance due to damage, destruction of a capital asset for various reasons, okay, it is treated as transfer of capital asset. Reasons can be earthquake, natural disaster, man-made disaster, riot, war, whatever reason it could be. Your asset got destroyed, that's it, and you got compensation, that's it. Okay, now when it is taxable? Year of receiving the consideration from insurance company. Now what is full value of consideration? Amount received is full value, or if assets are received, on the date of receipt, what is its fair market value? That value. Are you clear? Suppose if it is liable, eligible for indexation, because here destruction happened before 23rd July. But when happened? Before 23rd July it happened. Then indexation is available. Indexation is available up to Year of destruction, because year of destruction itself is treated as year of transfer. Am I right? Easy or not? Next, with this 45 subsection 1a is completely done. Are you clear? Now, something similar to compensation, there is one more logic. Compensation related something, there is one more provision where once again compensation point is only coming. 45 subsection 5. What is it? 45 subsection 5. What is this 45 subsection 5? Computation of capital gains. What is it? Computation of capital gains on compulsory acquisition. Compulsory acquisition of capital asset. Compulsory acquisition. Have you heard of compulsory acquisition? Yes or no? For example, if a government wants to construct a bridge at one locality, or they want to lay one big national express highway, if at all any farmland is there in the map, they will acquire it on a compulsory acquisition basis. They will acquire it on a compulsory acquisition basis. People will not give. So in every state government, compulsory acquisition act will be there. As per that act, if it is for public welfare as a whole, if it is for the total state welfare, you have to support, the people have to support. So by using compulsory acquisition act, even though you are not willing to sell, I can buy your property. Generally, I cannot buy your property with coercion. Without your free consent, I cannot buy. But under compulsory acquisition act, even if your free consent is missing, I can take it. But provided I have to satisfy you rightly with the compensation. This I cannot mess with your compensation. The government has to give you compensation in the right way. Are you clear? So if the government is acquiring your capital asset under compulsory acquisition act, if the government is acquiring your capital asset under compulsory acquisition act, are you clear? Now tell me, government generally when they acquire, for example, my land is there. I have a land, agricultural land, that too urban agricultural land, not a rural land. Okay, what is that land? Urban agriculture. No, let me not take urban agricultural land compulsory acquisition. Why? Because if urban agricultural land is compulsorily acquired, 10 clause 37, it is exempted. Urban agricultural land, if it is government is compulsorily acquiring it under compulsory acquisition act, and they paid me compensation which is more than the cost of land, I had a profit, but that is exempted. That is exempted under 10 clause 37. Okay, I'll come back to that later. Mine is a normal commercial land. Okay, I have some commercial land. Okay, my house or land or something, I have commercial land. You know what happened? This national highway project has been sanctioned there, express highway project has been sanctioned, or greenfield highway was sanctioned there. Okay, what happened is, in 23-24 year, the government compulsorily acquired my immovable property. And if you observe in the transfer definition, one of the point is what? Compulsory acquisition. In transfer, the definition includes what? Compulsory acquisition. By the way, even if transfer definition does not cover, nothing gonna happen. Why? Transfer definition is inclusive definition. Okay, so since transfer definition is inclusive, this and all doesn't matter. Compulsory acquisition means your asset got transferred to somebody. Are you clear? When it was transferred, when it was compulsorily acquired, 23-24. When it was compulsorily acquired, 23-24. And guess what? You purchased this land in 2005-2006 at 10 lakh rupee. Government compulsorily acquired in 23-24 when the fair market value is 10 crore. When the market value is 10 crore, they compulsorily acquired it. Okay, fine, they acquired it, fine. When did they pay me consideration? When did they pay me compensation? They didn't pay me in that year. They didn't pay me compensation in that year. 0 rupee. Tell me, will I be taxable? Can department come and tax me on this? Hello, Mr. 10 crore minus 10 lakh, 9.9 crore you made profit. Come pay me tax, 20%. Hurry. They took my land away without my interest, without my consent, and they didn't even pay single rupee. Again from the same government, another person is coming, income tax people coming and asking me, pay tax on this. Take our blood. So the SSC started automatically. Tell me what happens in this case. Is department right here? Taxing in the same year, are they right? Can they collect tax from the SSC where he has not received money itself? Look, I didn't sell to somebody. They compulsorily acquired it and they didn't pay me money yet. Clear? So I can't pay tax like 45 subsection 1. I can't be with 45 subsection 1. So what government said, what income tax, they brought a new section 45 subsection 5, and what they are saying, compulsory acquisition compensation you will receive, right? Compensation you will receive, right? That is taxable. Compensation received is taxable when in the year of receiving of such compensation. For example, in previous year 25-26, out of 10 crore, 1 crore is paid to you. 1 crore is paid to you. Enough. Department can tax you fully. Enough. You received 1 crore, it doesn't matter. You received it, no? You received it, no? Partly only you received it. It doesn't matter for me. In the same year, full value of consideration 10 crore they will take. In the same year, full value of consideration 10 crore they will take. Until now what you said, since you didn't receive even 1 rupee, don't tax me. Now you received 1 crore. Sir, I didn't receive my full amount. It doesn't matter. Even if you receive part of the compensation in the 25-26, full compensation received, we will tax it. So what is the full value of consideration? 10 crore minus indexed cost of acquisition. Why? Because compulsory acquisition happened in 23-24, because transfer happened before 23rd July 24. Therefore I will give indexation. I purchased this land at what price? 10 lakh. 23-24 index number you put, denominator 2005-2006 index number you put, because in this case the SSI purchased the land when 2005-2006. Then you get indexed cost of acquisition. Suppose if cost of improvement is also there, indexation improvement is there, then again in cost of improvement, for example some 20 lakh is there, same 23-24 year of transfer divided by index improvement is in 19, that number, then you get it. Then balance amount is taxable as capital gains. Are you clear? Now here one important lesson. First point, if at all there is a compulsory acquisition of capital asset happened, the capital gains is taxable in the year in which compensation is received. Now compensation received means full amount you should receive. Is there any compulsion like that? No. Even if you get part of the amount, are you clear? Even if you get part of the amount, full amount is taxable. Are you clear in this case? Therefore in this case full value 10 crore minus cost capital gain is computed. Guess what? In 26-27 balance 9 crore they paid you. Will you once again compute? Will you once again, array last year 1 crore only I received, you taxed me 10, balance 9 only I received. No, why will you tax me again? This is nothing, because I paid in 25-26. Yes or no? Are you clear? Now the same incident I will tell you further. SSC in 26-27 he collected 9 crore also, fine, very good, but he got to know one big information. What? That land market value is 50 crore, not 10 crore. He got to know that the market value of the land is what? 50 crore, not 10 crore. Then he went and filed a case in the High Court. Okay, sir, 50 crore worth of land compulsorily government acquired. There are readily buyers available for 50 crore. Okay, I will sell them first, then let government take from them, not me. High Court understood the situation and they ordered. What they did? They ordered, okay sir, let's not go 50, let's not even go 10 sir, let's fix total compensation 30 crores sir. Okay, let's fix total compensation 30 crores sir. 50 and all too much sir, that rate is not there in the locality. High Court agreed. They sent a valuation officer, all that. Finally High Court agreed 30 crore. Already how much is paid? 10. So how much is additional compensation High Court ordered? 20 crore additional compensation they ordered. This is also called as enhanced compensation. This is also called as what? Enhanced compensation. High Court ordered it. That's it. They just ordered it. When they ordered 26-27 year they ordered. But guess what? This fellow did not receive it yet. He will be receiving, government is paying this 20 crore ultimately in 2028 and 29 year. In the previous 28-29 he got additional compensation. Tell me, this amount is received for transfer of capital asset only? This amount is related to the land only? Yes or no? How much is the full value of consideration? 20 crore. How much is the cost of acquisition? No cost. Why? Already I reduced them when I am computing capital gain at the time of original compensation. Yes or no? Enhanced compensation, from enhanced compensation received in the later year, there is only one deduction. Legal charges that you incur, you write. To get this compensation, you might have spent some charges, no? That alone you reduce. Some 1 crore you spend, 19 crore is taxable as long term. Suppose if the original gain is long term, then automatically this is also long term. If the original gain is a short term, then this is also short term. Tell me, long term or short term? It depends upon the asset transferred. If the asset transferred is a long term, original compensation gain, enhanced compensation gain, both are taxable as long term. Are you clear? Until now, are you clear? Are you clear? Yes. Further. Now tell me, land was acquired by government compulsorily in 23-24. Yes or no? First time they are releasing my money in 25-26 1 crore, in 26-27 9 crore, which is already late. Again, additional compensation 20 crore they are releasing me in 28-29 for the land which they purchased from me, which they acquired from me in 23-24. 5-6 years. Now, how much interest I would have lost? How much opportunity cost I would have lost? Government paid me interest also. What they paid me? Apart from compensation, they paid me 5 crore interest on original compensation and enhanced compensation. Both they paid me in 28-29 itself. In 28-29 they paid me 20 crore. No, they paid me actually 25 crore. Extra 5 crore they paid me for interest amount which I lost. This interest amount on original compensation, the interest amount received on enhanced compensation, this interest amount is also taxable only whenever you actually receive it. Only when you actually receive it. 145A section says that. What the section says that? 145A. That section talks about when it is taxable. That section talks about when it is taxable. Interest on compensation is taxable in the year in which it is ultimately received. Where it is taxable. This is interest amount. This is not the consideration for asset. This is interest on late payment of consideration. So this is not related to capital gains. This is related to income from other sources. And guess what? Under other sources, you tax 5 crore, right? Flat 50% deduction is there. What is it? Flat 50% deduction. Flat ma. It's a flat deduction. No questions asked. Sir, why deduction, sir? You might have went through mental agony. Yes or no? You might have went through some mental stress, pain, all that because of this compensation. This is a benefit income tax department is giving you. Happily take it. Don't question why are you giving this. Yes or no? So 2.5 crore they are giving, but flat 50% they are giving you from the compensation. Therefore, how much is the balance interest amount is taxable? 2.5 crore in other sources. Are you clear? Are you clear until now? Now there is one more scenario. Okay, sometimes same situation. 23-24 my land compulsorily government acquired. Compulsorily acquired my land. You know what? Compensation not decided now. Even government don't know how much to pay, because for the first time they are acquiring land in that locality, and in that locality the prices are so high also. So government not yet decided any compensation, but they know very well it's a huge amount. It is huge amount that we have to pay to this fellow. Government knows it. Guess what? The government is thinking to pay. The government is thinking to pay somewhere between 30 crore to 50 crore compensation, but not fixed. This is not decided. Okay, but see, actually whenever compulsory acquisition happened, they will pass an acquisition order. They will pass an acquisition order, but sometimes they will pass interim order. They will pass interim order. Interim order means what? That's not the final order. Okay, means whenever compulsory acquisition happen, there are two types of orders that government can pass. One is interim order, another one is final order. In the final order only compensation amount will be decided. In the interim order, no, compensation nobody knows. So what? Through interim order. Then why they passed interim order? Dear mister, first you take 10 crore advance. First you take 10 crore advance because we acquired your land, right? 10 crore you take. No, don't think. This 10 crore is not consideration. This you take token amount. You take it, keep it with you. Final compensation, we will go discuss with our committee panel everything, and then we will come back and then tell you. Okay, that's what government told me. Now you know what? 23-24, in the year 23-24, compulsory acquisition happened, and through interim order they paid me 10 crore money first. Can I tax this? Because you received it in the same year, right? Can I tax this? No. Remember what you should tax. You should tax full value of consideration. Full value of consideration you should tax. Is this the full value? Is this the full value? So definition of full value does not met. Since this is not the full value of consideration, I cannot tax it in the same year. Oh, so even if you receive part of the compensation, now it is not taxable. Yeah, it is not taxable. But earlier you said, sir, even if part amount is received later on, you are taxing full amount. No, that time I know full amount. That's why I'm taxing it. Here I don't know full amount. Are you clear? Are you clear? Now, sir, in 25-26, no, what happened? Final order is passed. Final order is passed, and they decided 50 crore compensation. What they decided? 50 crore compensation. Now in financial year 25-26, full value of consideration I'll take 50. But guess what? This 50, 10 already paid. Remaining 40 not yet paid. But still, part of it is already received by you. Full compensation already. Tax it fully. Full value of consideration minus cost of acquisition, indexed cost. Why? Because here transfer happened in 23-24, that is before 23rd July 2024 the transfer happened. Therefore my cost of acquisition is 1 crore multiplied by 23-24 number divided by I purchased this land in 2005-2006. let us assume. Are you clear, everybody? Yes or no? So that you reduce, and improvement if at all that also you reduce, then what you get is capital gain. Which means, what is the lesson learned here? Suppose if the capital asset is compulsorily acquired by the government, and if any amount is received through an interim order, the amount received is not taxable immediately in the same year. The first time you should compute capital gains here in this scenario when the final order is released. In that year you compute capital gains computation. Are you clear? But for indexation purpose, if at all, is indexation eligible or not, it depends upon date of compulsory acquisition. If the compulsory acquisition date is before 23rd July, indexation is available. If the compulsory acquisition date is on or after 23rd July, no indexation. Are you clear? Easy? Confident? That's it. So with this capital gains 45(1)(a), 45 subsection 5 compensations logic is covered. So if at all you are receiving compensation because of destruction or because of compulsory acquisition, in both the cases common point is what? Whenever you receive compensation, in that year only you tax it. Year of destruction, year of compulsory acquisition may be earlier years. Yes or no? That is only important for indexation purpose. Clear? Easy or not? That's it. So on this compulsory acquisition, I don't think there is a problem in our book. I think there is no problem in our book. Okay, in the book they have not given any problem, but I gave you here. I told you with multiple examples on how to solve this. Clear? Next, let me see once. Is there any problem on this compulsory acquisition? No, nothing. No problem at all. Okay, fine. Are you confident until now? Yes or no? Now next, with this 45(1)(a), 45(5) is completed. I'll stop this and immediately I will discuss 45 subsection 2, conversion of capital asset into stock in trade. That point I will discuss. I'll stop this video, then I'll come back to that, then we'll solve 2 problems, then finally we'll take a break. Clear? Next concept, another section where capital gains is not taxable in the year of transfer but some other year, that is 45 subsection 2. What is 45 subsection 2? Talks about conversion of capital asset into stock in trade. Remember, I am specifically telling you capital asset into stock in trade. Conversion of capital asset into stock in trade. Now until today it is capital asset, but now tomorrow onwards it is not going to be capital asset, it is converted into stock in trade. And even if you see 2 subsection 47, okay, transfer definition, conversion of capital asset into stock in trade is treated as transfer, and it's an inclusive definition. Even if this point is not there, It is still transfer only because that's an inclusive definition. Are you clear? So conversion of capital asset into stock in trade means your capital asset is now converted into stock in trade. So what is this exactly? I will tell you. For example, classic simple example I'll tell you. For example, I'm a jewelry shop owner. Okay, I'm running a jewelry store. My wife is wearing one very beautiful necklace, for example, okay, where one of her photo I kept in the jewelry shop, where one customer really liked it. He said, I want the same piece if you can give me, and he's ready to pay extra than market value. I felt, okay, what's problem? I felt, okay sir, you just go and come back after 2 days, I will make it available. Then what I did, this incident happened in 23-24 year. This incident happened when 23-24 year. What I did, I went and convinced my wife and gave her bigger jewelry than this, and then took her necklace and then brought it to my shop and then put it in the display. And the customer who insisted on me this, right, she didn't return back. She didn't came back. Fine, since anyhow I brought this necklace and then kept in this shop, I decided not to take it back to home. Tell me, in 23-24, my capital asset is converted into stock in trade. Am I right? Now, this is treated as transfer. Am I right? Immediately, income tax department asking, hello, mister, you brought from home necklace to stock necklace? No, stock, no. Pay me tax on this. Conversion is a transfer. Pay me tax on this. Arey, what, sir? I just, instead of my home, I just bought and kept in my shop. For this itself, you will tax it, huh? Yes, it is a transfer. Then wait, sir. Fine, sir. I will pay. I'm not denying. You know what? On the date when this conversion happened, the necklace value is 10 lakh. On the date when the conversion happened, the fair market value is what? 10 lakh. So department is saying 10 lakh. You bought long back at 1 lakh rupees only. Pay 9 lakhs. Show 9 lakhs as income. Pay tax on it is what department is asking me. I told, sir, wait, sir. I will pay. I'm not denying it, but wait. Okay, I agree. Fair market value on the date of conversion is 10 lakh. All that I agree. But tell me, did I receive any money? Not even a single penny. I received it. Not even 1 rupee I received on this. It is just on the, instead of lying in my home bureau, on a locker, I just kept it and then put it in the showroom in one rack, in one shelf I put. That's it. For this, you're asking me to pay tax. How can I pay? Okay, then department said, okay, fine, I agree. Okay, asking you at the time of just conversion. Conversion of what? Conversion means what? Just a place changes. That's it. Yes or no? Just because I was asking you because you, which is not fair. Department is asking you to pay tax in the year of conversion. It's not fair. Then when you will pay, sir? Yes, they asked. Let me sell, sir. First, let me sell. Year of sale. Nothing but year of sale. Let me sell it, sir. First, fortunately, in 25-26, the SSC sold it for what price? 20 lakh gold price. Jumped like anything. And in 25-26 year, he sold it for what price? 20 lakh he sold it. Now department is asking, sir, 20 lakhs minus 1 lakh, 19 lakhs is your capital gain. Wrong again. How come, sir? How come this is? The moment when I convert, I recorded in my books of accounts. I already, I'm a businessman. I know very well. The moment when I bring capital asset into business, conversion of capital asset into stock in trade when I bring, immediately my inventory records I updated, sir. In my inventory, in my business inventory, stock record, in that I added as addition. Addition means inflows. Inward, outward, balance, FIFO, LIFO. Remember, in that stock record I updated, sir. What value you updated, sir? 10 lakh I updated already because it's a purchase at 10 lakh right now. Maybe I have not collected the money. That's it. In my personal bank I have not collected the money, but in the business I showed it as already purchase 10 lakh. Now what I sold is not a capital asset, sir. In 23-24 onwards is my stock in trade. In 23-24 onwards, what is the stock in trade value? 10 lakh. What I sold in 25-26, is it capital asset? No, it's stock in trade. At what price? 20 lakh. This 10 lakhs is business profit. Please tax it under PGBP. Logically, right? Yes, fine. 10 lakhs is profit. But sir, your original profit is 20 minus 1, 90. No? What about 9, sir? Wait. Now, in 23-24, when I converted, what is the fair market value? 10 lakh. This I didn't tax it till now. Okay, the extra 10 lakhs after conversion, after conversion market value increased, extra 10 lakhs you made profit, that you tax it in PGBP. What about the original 10 lakhs market value on the date of conversion? This you treat it as full value of consideration. Market value on the date of conversion of capital asset into stock in trade. Market value on the date of conversion of capital asset into stock in trade. You treat it as full value of consideration. How much it is? 10 lakh minus indexed cost of acquisition. Why I am saying indexed? Because in this example, year of transfer is before 23rd July 2024. Yes or no? You know, I purchased it for 1 lakh, 2324 number, and I purchased it in 5-6. For the sake convenience, I'm taking same year example. Okay, in exam 6-7 might be 1-2, it might be 1980, 99. Something it could be. Yes or no? Suppose no, if at all this is purchased before 2001 1st April. Yes or no? I told you. Then actual cost, market value on 1/4/2001, whichever is higher you should take. Yes or no? Now I compute it, sir. Then you get what is called as long-term capital gain. Are you clear? Able to understand? Now tell me here, for capital gain purpose, what is year of transfer? What is year of transfer? Year of conversion. Yes or no? Whenever you convert it into stock in trade, that itself is year of transfer. 23-24 is conversion year, that itself is transfer year. Am I right? Yes or no? Logically right or not? So under capital gains, conversion is transfer. Therefore conversion year itself is transfer year. But when is taxable? Year of sale of stock in trade. Are you clear? And remember, the moment you sell it no as a stock in trade, okay, business profit or loss would be there, capital gains would also be there. Am I right? Now I will give one more example. For example, cost of acquisition in 2005-06 is just 1 lakh, and conversion into stock in trade is in 23-24, when the fair market value is what, you know, 10 lakh. Guess what? In 25-26 I sold it for 5 lakh. What is the tax consequence? What is the tax consequence? First tell me, what is the capital gain? Why are you thinking differently? Same logic. Capital gain is same. In financial year 25-26, full value of consideration, market value 10 lakh minus cost of acquisition, how much? 1 lakh. Therefore 9 lakh long-term capital gain. That is same. Sir, he sold it for 5 lakhs. That is business asset. What he sold, no? He sold what he sold, no? What he sold is stock in trade, 5 lakhs. Why are you worried? Your capital gain conversion value same. Principal will be same. What he sold is stock in trade. What is the sale value of stock in trade? 5 lakh. What is the purchase value of the stock in trade? Conversion FMV 10 lakhs, 5 lakhs business loss. Are you getting it? The moment conversion happened, later on, whether the sale value is more than market value or less than market value, profit and loss both are accessible under PGBP only. Are you clear? Are you getting it? For example, one more example I'll tell you. Suppose I have my personal land, my personal property land. I'm a real estate dealer. Business is real estate. I converted this land in 23-24 into my business land, stock in trade purpose, because I wanted to construct a big venture on it and then sell it. Okay, now I converted first my land, my personal land, I now converted it into a business stock in trade related land. I converted. Are you clear? Now after converting in 24-25, 26-27, 25-26 and 26, in these 3 years I constructed a building on it. Now can I call this as cost of improvement in capital gains? Oh, why you will call? Yes, it is already converted. Yes, it is already converted. Yes or no? Yes, it is already. After that you improved. Now you did improvement in inventory. You did improvement on inventory. It is further production. That is business expenditure. Nowhere linked with capital. What you transferred is land only. Later on the land you constructed building after conversion. Okay, this is business expenditure. Are you clear? Do you understand right now the conversion logic? Let's first look at the notes and then go back. Okay, now let's look at the notes. Conversion of capital asset into stock in trade, 45 subsection 2. What are they saying? If a capital asset is converted into stock in trade by the owner for the business purpose, then the same is treated as transfer in the year of conversion. Now taxability is which year? Year of sale of such stock in trade. Remember, both capital gains and PGBP head of income both will apply. What is full value of consideration? Fair market value on the date of conversion. Is indexation available? Yeah, if the conversion is before 23rd July, then indexation is available up to year of conversion. If conversion is before 23rd July, yes or no? Before only, it's before only. Okay, before 23rd July, yes or no? What is business income? Sale value identify minus market value, then you may either get profit or loss. Easy or not? Now what I told is capital asset converted into stock in trade. What I told right now is capital asset converted into stock in trade. Now let me discuss ulta scenario. If stock in trade is converted into capital asset, if stock in trade is converted into a capital asset, first of all, I have a furniture. Remember furniture example I told? I'm a furniture shop owner, and in my head office, corporate office where accounts, everything is maintained, there I want some sofa sets, chairs, tables and all. Now from my showroom I ordered some chairs, tables and all, and then they bought and kept in my head office. Okay, now tell me in PGBP, now stock in trade is removed to and transferred to fixed asset. Now this is deemed to be a sale. This is deemed to be a sale. And what is the value you should record as sale? Fair market value on conversion. Here fair market value on conversion is treated as capital gain of PGBP income. Exactly. It is treated as revenue. It is treated as turnover. Are you clear? So I will remove it from inventory record. In inventory record I will record it as outflow. And in the sales record I will show it as sale. Yes or no? In the sale record I will show it as sale. Are you clear? Sales. How much I will show it as sale market value. For example, 10 lakhs market value, I will show sale plus. Since it is now coming into capital asset, that too it is a depreciable asset, I will add in block of asset. Yes or no? In the block of asset, how much value? Explanation 1A2 section 43 subsection 1. Explanation 1A2 section 43 subsection 1. Go back to 43 subsection and see the explanations. What's the page number? What's the page number? 81. 1A, see, you see in the table 1A na? Conversion of stock in trade into capital asset. How much is the right side? Amount added to block, how much is there? Market value on the date of conversion. Yes or no? This 10 lakhs, no, I will add in the block as additions. This 10 lakhs I will add as block as addition. Now what is the conversion date? That conversion date will decide whether it is used for more than 180 or less than or equal to 180 days in that year. Yes or no? This is the treatment. So if stock in trade is converted into capital asset, the first thing happens is closing stock value reduces. Another second thing happens is sale value increases by fair market value. This is in the P&L adjustment. Again, in the balance sheet, in my books of accounts, in block of asset, I should add this acquisition. Yes or no? As addition, 10 lakhs as fair market value. Are you clear? Now, it's a capital asset for me. You know what? When this conversion happened, 23, 24, this conversion happened. Original it was a stock in trade and now it is a capital asset. So this conversion happened in 23, 24. That too, let us assume 30th March 2024, exactly year and 1 day before it happened. That time market value is 10 lakh. This is shown as sale value in the PGBP. Am I right? Furniture. Yes or no? Or maybe some jewelry, whatever it is, my jewelry. Let me assume it's a jewelry. That time block concept will not apply. Jewelry. Now this jewelry I sold in 25, 26. This jewelry I sold in 25, 26. That too when I sold, when I sold, date of transfer is what, 10th December 2025. I ultimately sold for 20 lakh. Ultimately I sold it for what? 20 lakh. Fine. Full value. Right now what I sold is jewelry, which is a stock in trade, capital asset. Capital asset. I converted already. Originally stock in trade, now it is capital asset. At the time when I am selling it, it is what to me? Capital asset. What is the consideration? Minus. What is cost of acquisition? What is cost of acquisition? When you converted in the PGBP purpose, when you converted into capital asset, you showed sale there. Under capital gains head of income, I show it as cost. Am I right or not? Yes or no? What is the cost of acquisition? Market value, 20 lakh. Market value on the conversion date is 10 lakh. So balance 10 lakhs is capital gains. That's it. Are you clear? So if stock in trade is converted into capital asset, first it will be taxable in PGBP. Yes or no? So market value on the date of conversion, show it as sale, and that stock purchase value, that business profit. In capital gains, converted value, now it is bringing it as converted into capital asset. This value is called as right now as, this value is called as acquisition cost. Tomorrow when you are selling, that's full value. Now tell me, here, is it a long term or short term? I should decide. Yes or no? I should decide long term or short term. You know what? The stock in trade originally purchased by me in 2010-11. I originally purchased in 2010-11. Now, whereas I am ultimately selling it in 25-26 to outsider. Now, holding period. Should I consider from 10-11 to 25-26 or conversion date onwards should I count? Conversion date. Why? We call this as capital asset holding period. What is it actually? Capital asset holding period. Earlier, before 23-24, it's inventory holding period. Whereas from conversion date onwards only, it is called as capital asset. From this date to sale date. From this date to sale date. 30th March 2024 to 10th December 2025. Less than 24 months. Less than 24 months. Therefore, it's a short-term capital gain. Do you understand? So how to compute holding period when stock in trade is converted into capital asset and capital asset is ultimately sold? Conversion into capital asset is there, right? That date holding period count will start, and ultimately you sold, right? That date it ends. Are you clear? Same way, 45 subsection 2. Holding period is computed from capital asset is converted into stock in trade. Holding period ends on conversion date. Counts from beginning purchase date, acquisition to conversion date. That is holding period. Are you clear? That's it. Easy. This much in depth, even in the ICA book, not there. Nowhere you will find these examples. I hope everything is logical or not. Yes or no? Everything is logical or not? That's it. Now, by the way, here acquisition is there, right? Indexation is eligible from conversion year, purchase year. Here purchase year is what? 23-24. If at all indexation is available, denominator will be 23-24. Why? That year only you brought from stock in trade to capital asset, means that is the acquisition year. Am I right? That's it. With this, conversions logic is also completely discussed. Confident? Now we'll do one problem. Okay, directly come to question number 3. Just 2 minutes. Yeah, let's continue. Illustration number 3. Okay, X converted his capital asset into stock in trade. Remember, what he converted is capital asset. Therefore, capital gains head of income will apply at first. Suppose he converted stock in trade into capital asset, then first PGBP head of income will apply. Are you clear? So X converted his capital asset into stock in trade, yes or no, which is acquired on June 10, 2006 for 60,000. So cost of acquisition 60, now converted in March 10, 2025. Wow, 24-25 is year of conversion. Yes or no? The fair market value on that date was 5,50,000. This is important for capital gain computation. That is treated as full value of consideration. Then he subsequently sells the stock in trade, so converted for 6 lakhs. Very simple. In PGBP I sold it for, and stock in trade purchase value 5,50,000. So 50,000 is business profit. Easy. And ultimately it is sold when? 25-26. Therefore in 25-26 two incomes have to compute. One is capital gain, one is business profit. Sale of stock in trade 6 lakhs. Am I right? Minus what is the cost of stock in trade? Purchase cost 5,50,000, the fair market value. Now the same fair market value is shown as full value of consideration. How much the full value of consideration? 5,50,000 minus cost of acquisition, indexed cost. When the conversion happened? March 10, 2025. After 23rd July happened. Therefore there is no indexation. So straight away 60,000 I can reduce. Yes or no? straight away 60,000. So 4,90,000. Now is it long term or short term? Let me check it. Now here it is a some stock in trade he sold. He didn't tell what asset. I assume it is 24 months logic. I assume it is 24 months logic. He purchased in 2006 and converted in March 10, 2025. So only from purchase date to cap. See, only this period only you are holding it as capital asset. From March 11th onwards it became stock in trade. So it is more than 24 months. Therefore, it's a long term capital gain. And business profit, it's a 50,000. Am I right or not? Now whether your answer is right or not, okay, fine, it's okay, it's easy, yes or no? Now look at the answer. So capital gains, where it is, business profit is 50,000, understood. Where is capital gain? Okay, the fair market value on conversion date will be full value of consideration. Okay, fair market value is 5,50,000. Now cost of acquisition 60. Okay, so the capital gains would be computed by reducing cost of acquisition therefrom, and the business income, only business income they give. Capital gains they didn't compute, but we will compute. We already computed how much it is, 4,90,000. Easy or not? Yes or no? Next, there is one more question. This is easy, dead easy, but we have one more big question on TYK, but which is very good actually. In TYK we have a very good question. One question is there. Here it is there. You see, one more question. Question number 2. Can I? Yes or no? Look at Arav converts his plot of land purchased by him in July 2004 for 80,000 into stock in trade on 31st March 2025. Year of conversion is 24-25. Yes or no? The fair market value on the date of conversion was 3 lakh. Very simple. Full value of consideration 3 lakh minus cost of acquisition 2.2 lakh. 2.2 lakh 2004 to 31st March. Yes or no? Therefore it is long term. Long term capital gain is how much ma? 2.2 lakh. Do you agree? Easy. Next. The stock in trade was sold for 3,25,000. Okay, 3 lakhs worth of stock in trade when I brought into business is sold for 3,25,000. So business profit is equal to 25,000. Yes or no? So over answer. You see, 25,000 business profit. 2,20,000 is the long term capital gain. Yes or no? 2,20,000, 25. So what is the total answer? Therefore, the taxable income is 2,45,000. Are you clear? Next. This is very good question. Question number 3 is very good. Very good question. Now look at Mrs. Harshita purchased a land at a cost of 35 lakh in 2004-5 and held the same as capital asset till 20th March 2024. Wow, fantastic. She started her real estate business on 21st March 2024 and converted the said land into stock in trade of her business on the said date when the fair market value of the land was 210 lakh. Don't compute directly. Why? Sometimes full stock in trade may not be sold. See, stock in trade, if it is fully sold in subsequent, at a time fully you compute capital gains. Okay, now remember here date of conversion is 20th March. Guess what? It is before 23rd July. It is before 23rd July. Before 23rd July 2024. And that too, this comes in 23. This comes in which year? 23-24 year. And guess what? If at all, year of conversion, nothing but date of transfer. Yes or no? If it is before 23rd July, when you are computing capital gains, indexation facility is directly available in computing capital gains. Computation time, indexation is available. But tell me, in this question, when I will compute the gains? Gains will be computed in 23-24 only, but taxability will be in year of sale of stock in trade. Gains will be computed in year of computation, year of conversion itself. Am I right or not? I will compute the gains right away. I will compute the gains right away based on the information at the moment. Can I compute or not? You see first. Computation of capital gains. Okay. In which year it is taxable, I'm not sure. Okay. Computation of capital gains on conversion. Yes or no? What is the full value of consideration? How much ma? 210 lakh. What is the full value of consideration? 210 lakh minus Indexed cost of acquisition, indexation is available right now. Why? Because conversion happened in 20th March 2024, which is before 23rd July 2024. Are you clear? Now what is the cost of acquisition for him? First of all, 35 lakh. He purchased it 35 lakhs in 4-5 year ma. What is it? 35 lakhs divided by 4-5 number. In the same question they gave. 4-5 number is what? 113. Yes or no? Now numerator, conversion year is 23-24. Yes or no? Conversion 348. Yes or no? 348. See, to make you confused, 25-26 number also they gave. Not required. Yes or no? Now what is the indexed cost? Tell me. 35 into 348 divided by 113 is equal to 107.8. Can I say 107.78? Okay, fine, it's okay, no problem. What is it a long term gain or short term gain? 2004 2024 you converted, therefore it's a long term capital gain. How much it is? 210 minus 107.78 is equal to 102.22. Now I am not taxing it. Wait, I just computed and kept. Let's keep it aside. Okay, now let's look at the next part of the question. Do you understand until now? Next part of the question I'm going to. Okay, next part of the question I'm going to. Remember, I just computed the capital gain and kept it. When I am going to tax it, how much I am going to tax it, I don't know. That depends upon the next part of the question. Do you agree? Yes. Next, she constructed 15 flats of equal size, quality and dimension. Okay, she constructed 15 flats on stock in trade. Hello? It is converted on what? Stock in trade. Am I right or not? She converted on stock in trade. Cost of construction of each flat is 10 lakh. Now if you observe, what is the land cost in PGBP? Fair market value on conversion. How much it is? 210 lakh. Now she constructed 15 flats where each flat construction cost is how much ma? 10 lakhs. Okay, 10 into 15, how much it is? 150 lakh. Yes or no? Wait, next I'm just entering the data. Okay, construction was completed in February 2026. She sold 10 flats at 30 lakh per flat in March 26. Wow. In March 2026 she sold only 10 flats. Means land also she sold how much ma? 10 by 15 portion. Can I say that? Land also she sold on 10 by 15 portion. Wait, the remaining flats were held in were still held as stock in trade. Now then from here she gave additional data ma. This is regarding investments exemptions ma. That is not yet discussed. Primary objective for me in this problem is computing capital gain. Okay, now first of all total 15 flats, total cost is how much? 360. Now can I split this into 10:5? 10 flats cost is how much? 360 into 10 divided by 15 is equal to 240. 120 is the balance. This is stock in trade ma. Now this is the cost of 15 lands. By the way, stock in trade I will show in the books of accounts at 120 lakhs on the closing stock value, but this 240 lakhs worth of cost I already sold. Now what is the sale value? 30 lakhs per flat into 10 flat, 300 minus cost of these 10 flats is equal to 240. What is the profit? Business profit is 60. Now here I should also remember one more point. By the way, this is in 25-26 financial year, previous year. In the same year I should also tax capital gains, but remember I computed capital gains for entire land, which is now splitted into 15 portions. We only sold 10 portions, which means even capital gains also I will tax only 10 by 15th portion. Am I right? Because how much converted land is sold? Full land sold in 25-26. Capital asset into capital asset converted into stock in trade is taxable only when the stock in trade is ultimately sold. Here entire land is not sold, only 10 by 15th portion is sold. Am I right or not? Therefore capital gain also 102.22 into 10 by 15, that much only taxable. 68.14 lakh is long term capital gain. Do you agree? Yes or no? Do you agree? Now look at the answer. What is the capital gain they computed? Yeah, proportionate capital gain. Look at proportionate capital gain. Look at it. How much it is? 102.2 into 2 by 3, nothing but 10 by 15. They said 68.14. Yes or no? Do we compute the same or not? Then, sale price of 10 flats is what? 3 crore. Market value of the land of 2/3 portion, how much? 210, 1 crore 40. Construction of these costs 10. Therefore, PGBB income 60. Are you clear? Now, are you confident until now? That's it. Now, here they kept pending some information. This I have not yet covered. I am keeping it pending. Are you clear? That's it. Easy or not? Yes or no? That's it. Now here entire matter is given. Please read that. You will understand even more better. Easily we computed. Tell me capital gains. Now you would have understood one point. Though when we are discussing capital gains, it looks very complex. But if you understand the twist points everywhere, computation of problem is dead easy. This computation, capital gains problems, how much time it is taking each problem, even though so big, 5 minutes only it is taking. That's the beauty of capital gains. In capital gains, computation doesn't matter. It's a very simple question. Might be one full page, but answer is always half page only. That's the beauty of capital gains. Maybe note points you should give, because you need to write, you need to explain for everything what you did. FVC, why you took that, cost of acquisition, why you took that. You should explain the matter below, logic behind it. That's it. Easy or not? That's it. Next, is there any other question on conversion? That's it. Almost all the questions we are completing. Therefore, conversion of capital asset into stock in trade is over. Conversion of stock in trade into capital asset is over. Now some students might, they might look for some notes. Okay, let's look at, I will give you some notes so you can also note down here. Okay, now first to look at capital asset converted into stock in trade. First look at this. Okay, for this 45 subsection 2 will apply. Are you clear? Next one, stock in trade is converted into capital asset. Yes or no? For this, what are all applicable? Section 28 is applicable. Explanation 1A to, yes or no? Explanation 1A to section 43 subsection 1 is applicable. Am I right or not? Yes or no? Now, first here, capital gains applicable, then business profit or loss applicable. Here, first business profit or loss applicable, then capital gains applicable. Am I right or not? Now, for capital gains purpose, what is full value of consideration? FMV on FMV on conversion date. Yes or no? Minus, what is cost of acquisition? Actual cost to the SSC or previous owner. Yes or no? Am I right? Now, year of transfer is what? Year of conversion. Yes or no? Year of taxability is what? Year of sale of such stock in trade. Yes or no? Now, business profit or loss, how should you compute? Yes or no? Sale value minus FMV on conversion. Am I right? Easy. Now the same logic. Stock in trade is converted into PGBP. Under business or profession, revenue is equal to FMV on conversion date. Am I right or not? Yes or no? Suppose what you converted, stock in trade you converted into capital asset. Suppose if the converted asset is forming part of block of asset, then the same FMV has to be added to block value. Am I right or not? Yes or no? Subsequently, after converting it into capital asset, you are selling that capital asset. Then what is full value of consideration? Sale value. Whatever sale value is at that value. Capital asset at whatever sale, FVC, that logic apply. Minus, what is cost of acquisition? Fair market value on conversion is the cost of acquisition. Am I right or not? Now, period of holding will start from which year? Period of holding will start from conversion date to sale date. Here, period of holding will be from acquisition date to conversion date. Yes or no? Conversion date. Yes or no? Now look at Okay, you need not mug up like this and take a note. You just think with logic, you understand everything. Okay, so if for example, if capital asset is converted into stock in trade, first capital gains will arise, then business or profession profit, then capital gains purpose FVC minus cost. FVC market value on conversion, cost is actual cost at the time at which you purchased it, then you get capital gains. Year of transfer, year of conversion, year of taxability, year of sale. For business profit, sale value minus FMB. Period of holding for this purpose is what? From acquisition date to conversion date. That is only capital asset period of holding. If it is more than 24, more than 12, it's a capital asset. Otherwise it's a short term. Yes or no? Long term and short term. Now stock in trade converted, applicable sections 28 to explanation 1 year, primarily first PGB, then capital gains. Business or profession, revenue is equal to FMB. Yes or no? If at all you are converting the asset and then adding it to the block, no, then FMB the same shall be added. This is what mentioned in explanation 1A. Again, capital gains, if ultimately that asset is sold, no, sale value is full value minus cost of acquisition, market value on conversion date, and period of holding. This asset is converted into capital asset. So conversion date onwards only it got identification of capital asset. So conversion date to sale date, that's holding period. Easy. That's it. You can pause the video and take a note. No problem. That's it. Okay, I'll wind up the session, and in the next session we'll cover the further topics. Easy. So now let's discuss two more sections of capital gains, that is section 46 and 46A. In the previous session we understood 45 subsection 2, conversion of capital asset into stock in trade and stock in trade to capital asset, all that. Now hereafter let us discuss special circumstances of computation of capital gains itself, special way. Now before that I just wanted to read one point, 45 subsection 5, that reading alone is pending. Compulsory acquisition of capital asset, remember? So if a capital asset is acquired compulsorily by central government under compulsory acquisition, the same is treated as transfer. Taxability, original compensation is taxable in the year of receipt of the original compensation. Enhanced compensation, if court awards enhanced compensation, such enhanced compensation is taxable in the year of receipt. What is cost of acquisition and improvement for enhanced compensation? Nil. Why? Because while we received original, no, that time itself we reduce cost of acquisition, cost of improvement. Am I right or not? What about interim compensation? Suppose no, compulsory acquisition is over, through interim order you received some compensation, not taxable in the year of receiving but taxable in the year of determining final compensation. Correct? And if transferor dies before receiving enhanced compensation, the amount is taxable in the hands of the legal heir who is receiving ultimately enhanced compensation. If at all compensation is later reduced again, after giving you 30 crore original, again later court reduced it 20 crore only, the tribunal or authority, the capital gains of that year shall be recomputed by a re-verification. Once again will recompute it, because no, you are giving back the compensation again to the government. So once again capital gains will be recomputed. So that there is a concept called rectification. There is a concept called rectification which we'll discuss in the CA final. Are you clear? Next one. 46. Next one. Section 46. Distribution of capital asset on liquidation of a company. And if you remember, for the first time liquidation concept we saw in period of holding discussion. In our discussion, for the first time we saw period of holding concept discussion. Suppose if at all you are having shares in a company and that company goes into liquidation, period of holding means acquisition date to liquidation date only. Correct? Liquidation they will declare, right, that date only. Once liquidation is announced, post that date you should not consider. Why? For example, I purchased shares in 2024 10th August. Okay, 10th August I purchased. Company announced liquidation on 5th May 2025. Ultimately settlement happened on 28th February 2026, where your shares are cancelled and you were paid money. And how much you are paid money, full value of consideration you received 10 lakh on liquidation, minus cost of acquisition, you purchased in 10th August for 5 lakhs. The 5 lakhs is the capital gain. Now is it long term or short term? This is the question. Assume that these are listed shares. Now 10th August you bought, 28th February the shares were cancelled. You should not count up to 28th February. You should only count up to 5th May, which is liquidation date. Date of liquidation is fixed by Companies Act. Date of liquidation. What is date of liquidation? Companies Act will fix the date. The liquidator will fix the date. That is the date deemed to be liquidation. On that date, what are all liabilities, what are all something is there, that only will be settled by liquidator. Post liquidation date, if the company entered into new liability, they will not be having any guarantee. Are you clear? So date of liquidation is a statutory date determined by liquidator. So post date of liquidation, holding period will not be considered. Now 10th August to 5th May, less than 12 months. Therefore this is short term capital gain. Are you clear? Now suppose company went into liquidation. Okay, company went into liquidation. What happens in liquidation? Company, what the company will do? Whatever assets of the company were there, right? One option is they can sell the assets, correct? The company will sell the assets to outsiders, and whatever the money received minus all the liabilities of the company, primary liabilities and all, list A liability, list B liability, like that, some liquidation process is there. Okay, so they will sell the liability, they will sell all the liability, they will repay all the liabilities, and balance amount will be distributed to shareholder. Are you clear? Distributed to shareholder. Are you clear? Now here company is selling the assets to outsiders. No, you just compute capital gains as per 48, or you compute capital gains as per 50, as the case may be. Are you clear? Sometimes small companies will be there, private limited companies, small companies, when they are going into liquidation, no, shareholders will be 2 or 3 fellows, not like a big company. Yes or no? In big companies, no, in liquidation they sell, repay liabilities, balance amount they will distribute to shareholders. Now suppose, no, I am one of the shareholder, I am having 1000 shares in the company whose cost of acquisition is 1 lakh. Now finally company paid me distribution, full value of consideration is 2 lakhs I got. The 1 lakh is taxable in my hands. Now what is in the hands of the company? They are selling assets to third parties. No, now they are selling non-depreciable assets, they are also selling depreciable assets. Accordingly it is taxable. Are you clear? But sometimes, no, company will not sell the assets directly, they will distribute the assets. What is it? They will distribute the assets, they will distribute the assets to shareholders. Distribute the assets to shareholders, directly distributing. Company is distributing. Now when the company is directly distributing, here company asset is not selling, they're distributing it to shareholder. Distribution 46 subsection 1 says not taxable in the hands of company. In the hands of company nothing is taxable. Actually company is transferring. Distribution means what? Company is a different person, shareholders are different person, distribution is a transfer. Technically speaking it should be taxed, but 46 subsection 1 gives exemption. If a company because of liquidation distributing assets itself to the shareholders or money to the shareholders, distributing, that is not taxable in the hands of the company. Now sir, the shareholder is receiving money on distribution, plus now the shareholders are also receiving assets, sir. For example, I am one of the, in this company there are only 2 shareholders, you know sir, I have received, 5th May 2025 is the date of liquidation announcement, sir. 28th February 2026 company distributed me, what the distributed me, to me 10 lakhs cash is distributed for me, for my share. Okay, to me 10 lakhs cash is distributed, and for me, some assets are also given. Company, one land is there, that they only gave it to me, and one machineries are there, that they only given to me. Market value of these items, market value of assets that distributed to me was 50 lakh. Total amount I got in distribution was 60 lakh. There is another shareholder, equal shareholder, he is also got 60 lakhs worth of money distributed. Are you clear? Now, and sir, look at the balance sheet date, look at the balance sheet on 5th May, liquidation date. If you see the balance sheet on the liquidation date, the company has a reserves and surplus. The company has a reserves and surplus, that to free reserves. I'm talking about what? Free reserves. Free reserves are also called as accumulated profits. What is it? Free reserves is also called as accumulated profits. Okay, so by the way, remember we both received 60. The accumulated profits of the company are 80 lakhs. The accumulated profits of the company are 80 lakhs. Okay, now accumulated profits means what? these are basically distributable profits. Am I right? These are basically distributable profits. Distributable, but not distributed. Distributable profit means what? Distributable profit means what? It can be paid as a dividend, right? Technically speaking, it can be paid as dividend, right? Now tell me, basically I received 60 lakhs, sir, but this 60 lakh amount which I received, no, that is not entirely capital receipt. That is not entirely capital receipt. In this 40 lakhs out of 80, two shareholders, no, 40 lakhs is revenue profit in nature. Am I right? It's revenue, because free reserves means what? It's a revenue profit. It's not a capital, it's a revenue profit. So 40 lakhs worth of amount that is distributed to me was out of free reserves, sir. Originally, these free reserves, if at all company paid us earlier itself, that entire amount is treated as what? Dividend. Even now, the same treatment will apply. Maybe on distribution of the capital asset, you are getting 60 lakh. One of the shareholders is getting 60 lakh. And what is his share of accumulated profits? You know, he's an equal shareholder. Total 80 lakhs accumulated profit, two shareholders only there. So his share of accumulated profit is what? 40. Up to 40, I will not tax it under capital gains. Balance amount is treated as full value of consideration. Balance amount to 20 lakhs is only treated as full value of consideration. And now, by the way, this 20 lakhs also you are getting right now, right? Why are you getting it? Because earlier I purchased shares, 1000 shares I purchased for 10 lakhs. Balance 10 lakhs is long-term capital gain or short-term capital gain, as the case may be. Sir, what about the 40 lakhs? Because you received 60 lakhs, man, not 20. You received 60. For 20, okay, you taxed it. What about this 40? This 40 lakhs is treated as deemed dividend. It is deemed to be dividend under 2 clause 22 subclause C. Under 2 clause 22 subclause C. What is this? Deemed dividend. What that provision says, you know, if a company is distributing, in this case company is distributing how much? 120 lakh to both the shareholders put together. Whatever the amount value put together, total value distributed how much? 120 lakh. Out of it, to the extent of accumulated profits, that is taxable in the hands of shareholders as dividend, that too under income from other sources, section 2 clause 22 clause number C. The balance amount only is treated as capital distribution. This is revenue distribution, this is capital. Now this is only to be considered for capital gains calculation purpose, and this is treated as full value of consideration. Both the shareholders cost of acquisition 20, 20 lakh profit, 10 lakh is for shareholder A, 10 lakh is for shareholder B, capital gain. Are you clear? Over. The provision is over. Do you understand? Now look at this point. By the way, look at one more point here. Now what happened again? You see here. A company has some fixed assets, some current assets. The company has some fixed assets and some current assets. And accumulated profits, the company has 80. Okay, fixed assets is 60 and 60. Total 120. All the liabilities settled. After settling, these are the assets left. After settling all the liabilities, outside liabilities, these are the liabilities and the assets which were there. And accumulated profits is what? 80. And whatever the assets that are there here, current assets means, let us assume cash. Okay, fixed asset means, let us assume some investments or shares or securities which are invested by the company in some other companies, something. This 60 cost of acquisition for the company is what? 30 lakh. The company cost of acquisition is what? 30 lakh. Whatever the assets left, after settling outside liabilities, 60 lakhs worth of, 60 lakhs worth of non-monetary assets are with the company, which are not in money, which are like an asset, whose cost of acquisition for the company is what? 30 lakh. Okay. Now what the company did, they didn't sell this to outsiders and then distribute the money. They distributed this directly to the shareholder. Now shareholder, I am one of the shareholder. In this 50% I get, in this 50% I get, and in this also 50% is taxable in my hands. Okay. Now what is full value of consideration? I received totally 60. Out of 120 assets, 60 worth of assets I received, minus accumulated is 40 is equal to 20. Whereas my cost of acquisition of shares in my hands, earlier I purchased the shares at 10 lakh. Therefore, balance 10 lakh is taxable as capital gain. Are you clear? Now remember, when I got this 60 lakhs, no, in this, no, 30 lakhs is cash I got. Okay. 30 lakhs market value. This is market value of some land I got. What is it? Market value worth of 30 lakhs worth of land I received. And guess what? This land in 27-28 I am selling it. This land I am selling it in 28-27 or 27-28. What is the full value of consideration? You know, 30 lakhs worth of land which I received earlier from the company. No, now I am selling it for 100 lakh. Now, what is cost of acquisition of this land? What is the cost of acquisition? 49 subsection 1 says cost to previous owner. What the 49 subsection 1 says? Source of the cost is what? Previous owner cost, whatever is it, that cost. That is the source of the cost. Are you clear? Source is previous owner. Previous owner is what? Company. And there is a section called 55. What that section specifically says, you know, cost here means not the actual cost paid by the company. No. Cost means fair market value on date of distribution. What is fair market value? 30 lakh. Therefore, balance 70 lakhs will be either long-term capital gain or short-term capital gain. Are you clear? Now, here long-term or short-term depends upon what? Holding period. Yes or no? Holding period is considered from which date? Date on which I got the land distribution. No, when the company purchased, because no, this distribution of assets by the company on liquidation is covered under 49 subsection 1. As per this concept, previous owner holding period also shall be considered. When the company originally purchased this land, that date I need. So from the date of purchase of the land till the date I am selling it in 27-28, if it is more than 24 months, automatically it is long-term capital asset and is liable for long-term capital gains tax. Are you clear? Easy. Now look at the question. Capital gains on distribution. Okay. In the hands of the company, section 46(1) says distribution is not a transfer. No capital gains tax liability for the company when they distributed simply cash and assets they distributed, nothing is taxable. Suppose no, before distribution, company sold the property to somebody. That time they made a profit. On the day after, they need to pay tax. Are you clear? And the amount is distributed. Then once amount is distributed, distribution will come under 46(2). Now see, whether distribution by the company to shareholders is not taxable. But before distribution, company selling land to somebody, company selling house some building to somebody, that is transfer by the company to somebody and capital gains is applicable. Now, whatever it is, you sold and then bought the money or you directly distributed. Now you are distributing to shareholder. Now for the shareholder, they are getting some money in distribution. What is the tax treatment? Look at money received plus fair market value of the assets received minus deemed dividend. The balance amount is treated as full value of consideration. Therefore, capital gains is equal to full value of consideration minus cost of acquisition. Here, I am computing capital gains for my shares which are relinquished. I am computing right now capital gains because my shares were relinquished. Because I am a shareholder originally. Now my shares were cancelled ultimately. Now these assets were distributed as a consideration to me. Am I right? So cost of acquisition means cost of acquisition of shares. Look at. What is cost of acquisition? Star mark I gave. For shareholder, the cost of acquisition will be cost of purchasing the shares in lieu of which they receive the money on liquidation. Long term or short term depends upon period of holding of shares held by him. Am I right or not? Yes or no? Suppose here I gave one point. If the company sells the asset and distribute the proceeds, then exemption under 46(1) does not apply. Yes or no? I mean, actually, this is not absolutely true. Okay, if the company directly selling the asset on the sales, whatever amount they receive, no, that is taxable. Now money is distributed. If money is distributed ultimately to shareholder, there is no asset transfer. No. When capital gains will apply? When you distribute non-monetary item. Yes or no? That's a transfer of asset. You are distributing money. Money is not a transfer of capital asset. Therefore, 46(1) does not apply. If money is distributed, 46(1) will not apply. Are you clear? Yes or no? No. But shareholder might receive the money, might receive the asset, whatever it is. Both put together value minus deemed dividend. Deemed dividend is what? How much ever they distributed right now. Sir, 60 lakhs they distributed me, sir. Out of which Attributable accumulated profits how much? 40 lakhs, sir. Balance amount is treated as full value of consideration. To the extent of accumulated profits, it is treated as deemed dividend. Are you clear? And the deemed dividend is taxable under income from other sources. Further, one more point I gave you. See, on subsequent transfer of such asset received under distribution, sir, I got land, no, I received under distribution, no, again I am selling this subsequently, sir, I am selling this land subsequently, then what is the cost of acquisition of this land? Fair market value of the asset on date of distribution. Fair market value is what? 30 lakh. That itself is treated as cost of acquisition. Actually, this point is clarified under section 55. Read with 49 subsection 1. 49 subsection 1 says cost to previous owner. What is cost? Meaning is explained under 55 in this case. In this case, cost means what, you know? Cost means fair market value on date of distribution. Generally, cost means what? Actual cost of the previous owner. But here in section 55, they specifically mentioned that cost here means in market value on the date of distribution. That's why eliminate the entire concept of previous owner. Directly I told cost of acquisition will be market value of the asset on the date of distribution. Easy or not? Easy or not? That's it. That's 46. There is no problem given in the book. I already right now told you that itself is more than sufficient. Confident. Next, capital gains on buyback of shares or specified securities in the hands of shareholders. Suppose, again, I purchased in 2005, 2006, 1000 shares of Infosys company. I bought 2005, 6000 shares of Infosys company. Are you clear? Okay. Let me discuss from first debenture point of view. Debentures or preference shares point of view. I will discuss from preference shares point of view. Okay. I purchased 1000 because for equity shares, buyback of shares, for buyback of shares by domestic companies is different. Buyback of specified securities other than shares, nothing but, let us assume some debentures. Okay. Better let us take debenture only. Let us take debentures only. Okay. Debenture maturity date is what, actually 31st March 2025 is the maturity date. But what company did, 23-24 itself they bought back these debentures. Buyback of debentures possibility there. Okay. If at all on maturity they are cancelling, na redemption. Now if before that they are getting it back, na buyback. Now when I purchase, per debenture I purchased at 100 rupee. Now they are buying back in 23-24 where they are paying me 400. Tell me, now I am getting how much on buyback? 400 minus what is cost of acquisition? 100. Now I am cancelling back my shares, no? Yes or no? I am cancelling back my shares, buying back. Now the assets will be destroyed, relinquishment. Yes or no? So now I am getting how much on buyback? 400. 300 is my capital gain. Am I right? Simple computation or not? But if at all buyback, this is for buyback of other than shares. If at all buyback is of shares, that too by domestic company, if at all buyback is being made by domestic company, it may be listed company or it may be unlisted company, that too on or after 1st October 2024, that too on or after 1st October 2024. What is the tax treatment? One of the worst amendment in income tax, which is a very painful amendment in the income tax. Tell me, suppose company is buying back, company is buying back and they released money to me on buyback. What happened? Because of buyback what happened? My shares were cancelled. Now it's a transfer. Am I right? It's a transfer. My shares were cancelled. In return, company paid me 4000 rupees per share. Minus what is cost of acquisition of these shares when I purchase these shares? No, let us assume 500 rupees only I purchase. 3500 is capital gain. Am I right? 3500 is capital gain, and if it is long term capital gain, happily 12.5% I will pay. Happily I will pay how much? 12.5%. 12.5% I will pay if at all holding period is more than 12 months. Listed securities if at all, or whatever it is, long term capital gain is taxable at 12.5%. You know what? How many shares I'm having? 1000 shares. 3500 per share gain, 1000 into 12.5%. How much it is? 3,500 into 1000, 35 lakhs. 35 lakhs into 12.5%, for 4 lakh. 4,37,500 is my tax. Yes or no? But this is not how you should compute. Once upon a time, this computation is right. This computation is right once upon a time. But from 1st October 2024, they brought amendment. What amendment they brought? Full value of consideration, take it as 0. Okay. Minus what is my cost of acquisition? 500. Take this as long-term capital loss. But company paid me 4,000 no per share. What is this? Straight away treat it as dividend. Straight away treat it as dividend. Straight away treat it as dividend under 2 subsection 22 and clause 2 clause 22 subclause F. Under that, entire 4,000 rupees into 1,000 rupees per share, 40 lakh. Treat it as dividend income under income from other sources. Treat it like dividend income. One of the worst amendment. But guess what? There is a logic behind it. Buyback is made out of free reserves, no? Am I right? Buyback is generally made out of free reserves. It's not out of capital profit. Am I right? Generally, a buyback is made by the company out of free reserves. What are the sources of buyback? Free reserves, securities premium account, or general reserve. But mostly securities premium won't be there. Yes, sir, most of the companies securities premium would be written off already with something else. Bonus shares they would have issued or something they would have issued. So buyback is generally from free reserves. Most of the companies. Buyback is one way to release free reserves of the company. Am I right? Instead of dividend, they pay buyback. Am I right? Buyback is most of the times is given as a substitute for a dividend. Since you are releasing only reserves and surplus again, it's not actually a real buyback. It's only a distribution of profit. So on that logic, the entire amount that you are paying under buyback, no, I will call it as dividend income. And now tell me, what is the dividend tax rate? Normal rates of income. What is the tax rate on dividend? Normal. For example, SSE has only this dividend, 40 lakh. What is the tax liability? First 10 lakh, 1,12,500 normal tax regime, remaining 10 lakh into 30%, 9 lakh. So total 10,12,500 rupees basic tax. Whereas as per old provision, 4,30,000 is the tax. As per the new provision, 10,12,000 is the tax. See the difference. So income tax brought this change, one of the worst change. And more importantly, even more painful is what, this 4,000 I received because of the 500 I invested in the company. Because of the 500 I invested in the company, I'm receiving this 4,000. What about my cost? Claim cost of acquisition in capital gains. How much consideration I should take? Take 0. The section says 46 years says take 0. Oh, you got loss. Loss you carry forward. And in future you will get some again capital gain. That time you set off. Pay lower tax that time. How bad this amendment is. Literally, income tax department is discouraging buyback now. Why? Don't pay buyback. Pay dividend directly. You pay it as dividend. Never do buyback. Literally, income tax department is discouraging buyback concept. Literally, if at all this is how the buyback is going to be taxed in the hands of shareholders, do you think shareholders will give approval for buyback? Exactly. So buyback, shareholders have to get approval. Company has to get approval from shareholder, right? If it is more than 10%, up to 10%, board of directors decision is required, enough. But even when board of directors are thinking about this, they will definitely think from shareholders' point of view. Are you clear? Let us not give buyback because it is painful for them. It is taxable so higher rate. And moreover, whatever cost of acquisition that they have, no, that also they can't claim deduction. Sir, they are claiming no here. You know what? Right now, best example I'll tell you. In this case, what are they saying? Full value of consideration take 0. Buyback 1,000 shares, right? 5 lakh is the cost of acquisition. What is the loss? 5 lakhs under capital gains. Are you clear? Now, under income from other sources, 4,000 per share they paid me. Yes or no? Into 1,000. So, what is my other sources income? 40 lakh. Sir, what is my total income, sir? 40 lakh only. Sir, minus 5, no? Section 71. Section 71. Capital gains related loss. You can't set off with other heads of income. Loss under the head capital gains. You cannot set off with other heads of income. That too, this is a long-term capital loss. You can set off long-term capital loss only with long-term capital gain. Sir, here I don't have long-term capital gain. Then don't set off. This you carry forward. Your total income is deemed to be 40 lakh. Pay tax on this. Which means here my cost of acquisition going waste. Maybe next year or that next year or that next year or that next year, if at all I have a long-term capital gain, that time I can set off and then get a benefit. What if I don't have capital gains in future? And you know what? I can carry forward this only for 8 years. I can carry forward this only for 8 assessment years. Like, what is 8 years, sir? Don't worry, we'll discuss in set off and carry forward chapter. What if in the next 8 years I never had a long-term capital gain at all? This entire my cost of acquisition go waste. That's the provision 46A. They have their own reasons. They may argue that buyback is given by the company out of revenue profits only. Basically, it's a dividend in nature only. So I am taxing it as deemed dividend under 222 clause F, subclause F. So what wrong in me? Your logic is right, but don't you look at shareholder point of view? He's suffering. Are you clear? He's suffering. Able to understand. That's it. Now look at. So generally, buyback of securities other than shares of a domestic company. Suppose if a foreign company is buying back, shares, you can apply this section. So no, what is the provision for computation? Happily, full value of consideration is equal to consideration received on buyback. So how much is the consideration? 4,000 minus cost of acquisition, amount paid at the time of purchase 500, the capital gain 3,500. If it is long term, 12.5%. If it is short term, no. Listed, no, 20%. 111A. If it is short term, unlisted, no. Then normal rates. Yes or no? Foreign company shares I'm talking about. When it is taxable, whenever buyback happened that year, what is the computation format? Section 48, non-depreciable asset format. Yes or no? Specified security means what? Under section 68, meaning is defined under Companies Act. Specified security that you take. Okay. Now, buyback of shares by domestic company. Let us once see specified security definition in Companies Act also. Okay. Section 68 of Companies Act. Okay. What is it saying? Company power to buy back its own shares. Okay. Special this process is to increase EPS. Okay, all that. Approval of threshold. Why company buyback? Shareholder exit. Okay, fine. Yeah, here it is there. Specified security definition. Here whether they gave it or not, we'll see. Okay, now provided that, where is explanation? Yeah, specified security includes employee stock option or other securities as may be defined by government from time to time. So specified security means employee stock options. Suppose company allotted ESOPs to employee, shares were allotted and that shares they are buying back, then you can still apply the same logic. Are you clear? Suppose a normal shareholder is there, right? A normal outside shareholder is there, right? He is purchasing company shares earlier. From him, if you buy back, domestic company, which section you will apply? This section. Buy back, this subsection 2 logic you apply. Are you clear? Now look at 46A. I think that's given as a proviso. Okay, it's okay, no problem. Now look at what is the section right now we are discussing? 46A. 46A. Look at 46A proviso. I told no proviso only this is added. Generally, as per 46A, what is the taxation of buyback? Generally, taxation will be like this. Whatever money received from company, I show consideration minus cost of acquisition, capital gains, which is logical brain. However, exception. What they said in exception, provided that is called as proviso. Provided that is called as a proviso. Here only one provided that is there, which means it's called proviso 1. Proviso generally contains what? Either exception or condition. Provided that where shareholder receives any consideration in the nature referred to in 2 clause 22F from any company in respect of any buyback of shares that take place on or after 1st October 2024, then for the purpose of this section, value of consideration received by the shareholder is deemed to be nil. Painful, yes or no? Now let us look at 2 subsection 22F. Let us look at 222F. Yes, 2 subsection 22F. Any payment by a company on purchase of its own shares from a shareholder in accordance with provisions of section 68 of the Companies Act other than specified security. other than specified security. Are you clear now? So look at, where a shareholder or a holder of other specified securities receives any consideration from the company for purchase of its own shares or specified securities held by shareholders or holder of other specified securities, then subject to 48, the difference between cost of acquisition and consideration received by the shareholder is taxable. Fine, this act and all not required. This is sufficient enough. Are you clear now? What is the point? You tell me. What is the point? Domestic company buying back its shares. What is it? A domestic company buying back its shares, listed or unlisted. Taxability. The amount received by shareholder is treated as dividend income. Taxability under capital gains. For the purpose of 46A, full value of consideration will be taken as 0. Therefore, capital loss is equal to FVC 0 minus cost, which may be long term or short term. Yes or no? Now, such capital loss will be set off and carry forward as per section 70, 71, 74. Discuss it later. Okay, long term capital loss can be set off only with long term capital gain, whereas short term capital loss can be set off with any capital gain. What is this point? This entirely set off and carry forward. I will discuss it later. Balance loss will be carry forwarded. Are you clear? There is no problem given on this in the book, but easy. Yes or no? Generally, if a buyback happened, if at all buyback happened is before 1st October 2024, na FVC minus cost is equal to capital gain. But now, on or after 1st October onwards, domestic company buying back shares, na on or after 1st October, domestic company buying back shares. What is the computation? FVC 0, cost minus loss. Now, whatever amount received on buyback, fully treated as dividend income under 2 clause 22 subclause F. Are you clear? That's it. That's about 46 and 46A buyback with the numerical examples also. I told you, easy. That's it. On buyback, I guess they asked one MCQ. I think they asked once an MCQ in May 25 or May 25 or September 25. It's May attempt 20. Some MCQ is what asked on buyback 46A. Are you clear? That's it. With that, buyback concept is also over. Okay. Now. Are you clear until now? Now, from the beginning, let me once cover remaining what are all pending. No, we'll be reading one by one and then proceeding further. Okay, because now you are at a better stage. Or else we'll do one thing. I think no, it's okay. We'll do at last only. Theory reading we'll do at last only. Better, just like how we practice in other chapters. All unimportant stuff we are reading at last and then discussing it. Remember, the same way will continue. Yes or no? Fine. So with this 46A is over. Am I right? Okay. Now next section I will start is 50B, 50B Bombay B, 50B slump sale. What is it actually called as? Slump sale. So next section I'm going to start is 50B. Slump sale. That's it. Fine. We'll just 2 minutes gap we'll take and then start it. Okay. Now let us discuss another computational concept of capital gain, that is 50B slump sale. Remember, till now we discussed something called 48 format. We understood 50, we understood 50A, then we understood 46 and 46A. In these cases, the computations are different. The computation logics are completely different from each other. In 46, why it is different? Amount received minus deemed dividend I should reduce. Balance only I should take full value. Correct? Here, full value is taken as 0 in case of domestic company on or after 1st October 2024. 50A, SLM basis, asset wise sale comparison. Yes or no? Next, 50, block of asset comparison. 48, FVC minus transfer expense, then net consideration minus you get cost of acquisition minus cost of improvement, all that. Am I right? Now 50C slump sale. Slump sale means what? For example, the SSC can be anybody. Let us assume there is a company or an individual, whoever it is, doesn't matter. He is having a business. Okay. If you observe his balance sheet, the balance sheet has 2 columns. He has 2 columns in the balance sheet. Okay. Now, one column is for first segment A business, another column is for segment B. Okay. In one column, he is manufacturing and selling chappals. Okay. Footwear, nothing but footwear. He is just selling footwear. And in another one, he is selling ready-made garments. What is selling? Ready-made garments. Now for him, the footwear business is going really wonderful, and even the ready-made garments is also going decently well. But he don't want to have multiple products like this. He wanted to focus only one, and he understood that his expertise is in footwear. So he decided to remove this entire ready-made garment segment itself. He decided to remove it. Like he has two factories. Or maybe one factory only. Half of it is used for ready-mades, half of it is used for footwear. Now ready-made garments related some assets are there, footwear related some assets are there, ready-made garment related some liabilities are there, footwear related some liabilities are there. Now what he is actually transferring, he is selling it. He is selling entire ready-made garments division. He is selling entire unit B division, second unit B. I will call it as unit B. He is selling entire unit B to somebody. See, if I sell missions, all ready-made related missions, if I sell that missions, I will lose money. But instead, it's already a going business, right? It's a going concern, right? I will sell unit B business as a going concern itself. I will sell to somebody. I will sell it to somebody. You know what I will sell it? I will sell it unit B. You know what? How much I received for unit B? Entire unit B I sold. Unit B sold means what? All unit B assets I sold, even liabilities I sold. Just like how in amalgamating company transfer all its assets and liabilities to the purchasing company, the same way exactly they did here. You know how much they got? 10 crore they got consideration. Minus. Generally how to compute capital gains? Cost of acquisition we should say reduce, then cost of improvement we should reduce, all that, right? But remember here what you sold is the entire division. What is this division? Cost of acquisition and cost of improvement. Section 50B says net worth of the division. What is it? Net worth of the division. Directly calculate net worth. Sir, net worth is coming 8 crores, sir. Net worth is coming 8 crore. That's it. Balance 2 crore is capital gain. That's it. Balance 2 crore is capital gain. Sir, is it long term or short term? It depends upon unit B, how long you are running it. If at all you are running this unit B, if at all you are owning this unit B for more than 36 months, in slump sale, the criteria for determining long term, short term is not 24, not 12. It is how much? 36 months. If it is more than 36, long term capital asset. If it is less than or equal to 36 months, it's a short term capital asset. Now suppose I am selling my old division, more than 3 years it's been started, it's a long term capital gain. How to compute capital gain in slump sale? Slump means what? Lump sum sale. Lump sum means what? I am not selling a mission, a land, a building. I'm not selling one by one. I'm selling lump sum all at a time. As a going concern I am selling it. Are you clear? How to compute capital gains? Full value of consideration 10 crore minus net worth. That itself is treated as cost of acquisition, cost of improvement, balance is capital gains. And you know what? I call this slump sale section as goodwill taxation section. I also call this as what? Goodwill taxation section. Basically what you're taxing is here is goodwill only. Tell me, amalgamation you might have solved, right, in accounting. Purchase consideration minus net asset value is equal to goodwill. If it is loss, capital reserve. If it is profit, sorry. Okay, fine. No, that is for the purchasing company. I am asking about selling company point of view. I am asking from selling company point of view. I am giving you 8 crore worth of net worth and you are giving me in return 10 crore. What is this 2 crore? Is it goodwill or not? Basically. Exactly. So slump sale is nothing but goodwill taxation from the seller point of view. Yes or no? It's basically seller point of view goodwill. Even buyer, some other company would have purchased this unit, they will also record this 2 crore amount as goodwill. Am I right? Now here the major question is, sale value easy, computation easy, but the problem is how to calculate this net worth. This is a question. Am I right? How to calculate net worth? Nothing but net worth is nothing but net asset value. How to calculate net worth? Very simple. Total assets minus outside liability. Am I right? Am I right? Exactly. Same. Total assets minus outside liabilities. But the problem is, in income tax, these assets are categorized into two types: non-depreciable assets and depreciable assets. Non-depreciable assets, what value I should take? Book value you take. What is the value you take? Book value you take. Outside liabilities, take book value. Non-depreciable assets, what all will come in case of slump sale? Fixed assets, cash and cash equivalents, all this, inventory, everything you take at book value. Not fixed assets, sorry. Investments, loans of the company, yes or no? Other current assets, cash, inventory, everything you take it at book value. Sir, what about fixed assets, sir? Depreciable assets, depreciable assets, you take block value on 31st March. No, sorry. You take block value. You take gross block value. Simple. What you will take? Gross block value. Gross block value means what? Opening value plus additions in that division. That division additions only you will consider. Gross block value of that division only you will consider. Do you understand? Do you understand until now? Okay. You will have to compute this gross block value as per 43 subsection 6. 43 subsection 6 is what? Discussing the concept of written down value. For depreciable assets, you should take written down values. Written down value before depreciation we should take. Written down value before depreciation you should take. Depreciation the other company will calculate, because the asset is not with you now to claim depreciation in income tax. Am I right or not? We'll solve one problem. I'll solve one problem first. Then I will come back and then explain you. Are you clear? Now, what is the problem that we have? Illustrations. I think in illustrations we have slump sale. I think illustration 10 or 11 something is there. Just open illustrations. Yeah. You see here. There is an illustration. Okay. Shall I? Mr. A is a proprietor of Akash Enterprises, having 2 units. He transferred on 1st April itself his unit 1 by way of slump sale for a total consideration of 25 lakh. Unit 1 he sold it as slump sale, that too at the beginning date. Luckily, whatever this company 31st March 2025 block value, closing block value, whatever is there as on 31st March after depreciation, yes or no, that itself is opening WDV, that itself is the net worth calculation purpose, yes or no? Yes. Next, the fair market value of capital assets of unit 1. What is the fair market value of the capital assets of unit 1? 30 lakh. Oh, fair market value of the capital asset is unit 1 is 30 lakh, but actually they sold it for the slump, he transferred entire unit 1 for 25 lakh. Actually what I told, full value of consideration, how much ever amount received is full value. But if fair market value of the consideration received is given, whatever consideration you receive, no, its market value information is given, or you sold right for some amount, that amount what you got, yes or no? Sorry, fair market value of the capital assets of unit 1. Yeah, sorry. So what is consideration here? What is consideration? What is full value of consideration? Fair market value of consideration received in our example 25 lakh. Consideration received is 25. Or fair market value of capital asset transferred in slump sale. Fair market value of capital asset transferred in slump sale. More importantly, unit 1 fair market value 30 lakh. Whichever is higher, that we should take it as consideration. So in this example, full value of consideration is how much ma? 30 lakh. Are you clear? Yes or no? 30 lakh. Okay. Unit 1 started in 5-6 year. 5-6 year it started. In 25 we sold, more than 36 months. It's a long term capital asset. Yes or no? Yes. Next, the expenses incurred for transfer. Transfer expenses were also given. How much it is? 28,000. Are you clear? Expenses for transfer. Transfer expenses is equal to how much more? 28,000. Correct? Therefore, net consideration 29,72,000. Am I right? From this, if I calculate net worth of unit 1 and reduce that, automatically what I will get? Long-term capital gain, yes or no? By the way, what is the question they are asking? Compute capital gain for the assessment year. They are asking capital gain, yes or no? Yeah. So now the format. Just before slump sale, 1st April before slump sale, 31st March balance sheet is given. Means exactly before date slump sale balance sheet date, which is right. Sometimes if the paper want to be really tough, what they will do, you know. For example, slump sale is on 1st October 25, they will say. And they will give you balance sheet on 31st March 2025, they will say. But slump sale is on 1st October. Whereas balance sheet given on 31st March. Our students blindly take balance sheet values, all that as it is. Wrong. 6 months additional information will be given. 6 months what are all happened, they will give you. That also you should consider. That also you should consider. Now, by the way, anyhow. Right now, we need to compute net worth, right? Working note 1, yes or no? Net worth we need to compute. Working note 1, am I right? Yes or no? Working note 1. Now, working note 1. Working note 1. How to calculate net worth? Total unit 1 assets. Avuna? Am I right? Minus outside liabilities of unit 1. Am I right? Total assets of unit 1 what? Array, if it is non-depreciable assets, whether it's an inventory, a cash, a current, a fixed, all that doesn't matter. All non-depreciable items, I will take it at book value. All depreciable assets, I will take it at WDV value on 31st March. Are you clear? Let us not take 31st March also. WDV value before slump sale. Before slump sale, WDV value means what? Opening WDV value, which is nothing but last year closing value, plus any additions that you made in that unit 1. That also we are transferring now. Total is WDV value of the depreciable assets blocks. Yes or no? Nothing but you should take block values. That's what the meaning. Now let us once list out. What they are selling? Unit 1. Okay, unit 1, what are all the assets they have? Land, machinery, debtor, other assets, something. Unit 2 information is irrelevant to me. Okay, then again, liabilities they gave. Revaluation reserve, that's not an outside liability. Am I right? Yes or no? Whereas bank loan, 70% unit 2, 1.4 lakh is unit 1. 1.4 lakh is unit 1. Trade creditors, out of 1 lakh 50, 25%, 37,500 is unit 1. Am I right? Next, revaluation reserve is created by revising upward revaluation of land. Oh, this land 12 lakh is there, right? Before revaluation, this is 9 lakh only. Revaluation reserve is how much it is? 3 lakh. This is for land of unit 1. Means right now the land after revaluation 12 lakh. Before revaluation, how much would be the land? How much would be the land? 9 lakhs. Before revaluation, how much would be the land? 9 lakh. Are you clear? Yes. Now, so which means after revaluation 9 lakhs. Tell me, under income tax, should I take revalued figure? No. In income tax, revaluation concept is not at all recognized. Land original cost is what? What is the original cost of the land? That only. Before revaluation you should take book value. Book values means book values before revaluation. Please understand that. Now look at. Okay. First point is that. Second point, no individual value of asset is considered in sale deed. Other assets include, second point I'll come back to it later. Okay. Other assets of unit 1. Other assets what? Oh, here 1 lakh 50 is there. Okay. That includes patents acquired on 1st July 2023 for 50,000, on which, oh my god, patent is an intangible. For intangible, no, which is acquired in July 2023. Depreciation till date was not charged. Are you clear? Depreciation on patent is 25%. Intangibles, yes or no? Fine, I'll come back to it. The value of machinery, remember, machinery is also depreciable assets. Machinery, balance sheet value 3 lakhs they shown, but we should not take balance sheet value. Depreciable assets, we should take block values. Now, the value of machinery represents, oh, written down value as per income tax. Okay, they said this 3 lakhs is written down value only. Those 3 lakhs as it is can be taken. But in this other assets, 50,000 worth of 50,000 in this other assets, 50,000 worth of intangibles were there. That alone I should now compute book value. Am I right? Okay, fine. Let me do one by one. Let me do net worth computation. First, total assets I should take. Am I right? One. First, land. How much is the land? 9 lakhs. Land is 9 lakh. Are you clear? Now, first land. Second one, now plant and machinery. They have given it is WDV value, which is as per income tax law, which is, what is the value? 3 lakh. What is the value? 3 lakh. Okay, 3. Debtors, book value. I take only book value. Yes or no? Debtors, how much I will take? How much it is? 1 lakh. Okay. Then 4. Other assets. No. Intangibles, working note 1. Remaining 1 lakh only, no. Remaining other assets is 1 lakh only, no. Because out of other assets, no, 1.5 lakh. Intangible is 50,000. Yes or no? But remaining is 1 lakh. Remaining I can take it book value. But for intangible, they have given original cost. I should take written down value. Am I right or not? Now tell me, intangible is purchased on 1st July 23. First 31st March 24. First depreciation 25%. In that year, 1st July means on the same date they might have used it. So in 23, 24 more than or equal to 180 days. Therefore 25%. What, yes or no? 25%. How much it is? 12,500. 37,500 is opening on 1st April 24. Remember, slum sale is happening on 1st April 25. So again on 31st March 25, another 25%. How much? 25%, tell me. 9,375. So opening value 28,125 rupees is the opening value on 1st April. This is the opening WDV value, block value, that I will take 28,125. Am I right? Did I consider all the assets of unit 1? Yes. Now I will total it. What is the total of the unit 1 assets? 12, 13, 14. 14 lakh 28,125. Am I right? Minus outside liabilities I should reduce. Correct? What are outside liabilities? First one, creditors. Okay, something. Creditors I will reduce. Creditors how much? 37,500 is the outside liability. Minus bank loan 1,40,000. 1,40,000 rupees. Am I right? Here how much is there? Out of 2,75%, 1,40,000. Are you clear? So that's it. All the outside liabilities considered. What is the net worth? 12 lakh. 12,50,625 is the net worth. Do you all agree until now? Yes or no? Now I will go back to this 12,50,625. So what is the capital gain? 16 lakh or 17 lakh? 17 lakh 21,375. Do you understand? Hello? Yes or no? Let's look at the answer. Is this the way to do it? Perfect. 17 lakh 21,375. Net worth is calculated 12,50,625. Are you clear? Now sir, once again can you explain? Very simple. Okay, in slump sale, how do I compute capital gains? First, compute full value of consideration. What is full value of consideration? Fair market value of actual consideration received. How much you identify? Consideration received, in this example 25 lakh. Or fair market value of assets transferred in slump sale. What is it? Slump transferred 30 lakh, whichever is higher. So therefore full value of consideration 30 lakhs minus net worth itself is treated as cost of acquisition, cost of improvement. No separate computation is required. So that you reduce it. In our example 12.5 lakh it came. So approximately 17.5 lakh is the answer. By the way, minus 28,000 transfer expenses, that also you adjust. This is what we did. Now how to calculate net worth in slump sale for the unit? Net worth is calculated into two parts. First, outside liabilities, list it out. Then total assets, list it out. When you are listing out total assets, all depreciable assets which are forming part of block, take block values before slump sale. take block values before slump sale date. Yes or no? Suppose if the slump sale is on 1st April, then block value is on 31st March after depreciation you should take. Suppose if slump sale is on 1st October, then block value is on 30th September. Opening plus addition still the date. That's it. That you should take. Are you clear? Then remaining assets, no, book values you should take. While taking book values, eliminate revaluation numbers. It may be downward revaluation or upward revaluation. Revalued figures, readjust it before revaluation figure and then arrive it. In this example, 12 lakhs is the land book value, but this is after upward revaluation. So therefore before revaluation the land is 9. Yes or no? So take before revaluation. Whereas for debtors, as it is, the same I will take. Are you clear? Creditors, actual I will take. Whereas for machinery, they themselves gave, that is income tax value. For intangibles, they gave original cost when they purchased. So for this, we computed WDV value. That's it. Are you clear? Yes or no? Now let's go back. Section 50B. What is it? Slump sale. How do you compute capital gains under slump sale? First, deemed full value of consideration. What is deemed full value of consideration? Fair market value, which is higher of fair market value 1, fair market value 2. What is fair market value 2? FMV of consideration. You might have received money or non-monetary, because of the transfer, consideration received. What is its market value? If it is entirely in cash, then cash. If it is monetary, if the cash plus some asset, then asset's market value plus cash. Total you get market value of the consideration received. Then market value of assets on the transfer date. Whatever the assets you transfer, what is its market value? Identify. The computation will be as per rule 11 UAE. This you will understand in CA final mark. We don't have it in syllabus. I just gave a reference here. Clear? Identify. Okay, full value. Then minus transfer expenses. Then net consideration, correct? Minus cost of acquisition and improvement, that is taken as net worth of the undertaking or division, that is deemed to be cost of acquisition and improvement. Here there is no indexation concept itself, no concept itself in net worth. Then what you get is long-term capital gain. Now net worth means what? What is net worth? Net worth means aggregate value of total assets of the undertaking minus liabilities as per books of accounts. Any revaluation changes in the assets shall be ignored. Now, like asset type. For example, if the asset is depreciable asset, net worth means WDV as per 43.6. WDV as per 46 means what? Opening plus WDV just before slump sale date. Yes or no? Self-generated assets, 0. Intangibles, intangible assets, that too self-generated. Self-generated means what? I didn't purchase them. My company has a goodwill. It has some value. I didn't buy it. Value is 0. Capital assets where deduction is already claimed under section 35. Suppose in the slump sale, whatever you are selling division, some capital asset is there where deduction under 35 is claimed. Then you take income tax value 0. Remaining assets, book values. Are you clear? Again, under slump sale also, SSC must furnish a chartered accountant report certifying net worth computation of the undertaking in prescribed form by 30th September. That is 1 month before the due date for filing return. So by 30th September of the assessment year, you must give a CA certificate certifying your net worth computation is correct, because you did slump sale, net worth you calculated, and then balance on a capital gains, right? You filed IT return, department cannot trust you blindly. So CA certificate is required for net worth accuracy. Are you clear? Now, what is a slump sale? What is a slump sale? Transfer of one or more, not assets, one or more undertakings, divisions, branches, yes or no, for a lump sum consideration without assigning values to individual asset. Each and every asset at what price I am selling, it doesn't matter. It won't be there. First of all, sir, unit A 30 lakhs, give me 30 lakhs. Are you clear? Maybe for consideration determination, each and every asset value they take into account. Just because each and every asset value taken into account, does it mean you are selling each and every asset individually? No. Clear? Undertaking means what? Any part of the undertaking, unit, division or business activity as a whole, but excludes individual assets or liabilities not constituting. If you are selling individual 2-3 assets put together, that's not come under undertaking selling. Yes or no? Now, note, assigning value to each and every asset or liability for stamp duty or similar purpose does not count as assigning values to individual assets. See, actually, no, you should not, you in slump sale, you should not give any value to each and every asset specifically. If you give each and every asset value, you are selling it as asset. But I am assigning values for slump sale, for stamp duty calculation or consideration calculation purpose, I am taking this. Not, I am not selling asset individually. Are you getting it? So then it is not a slump sale. That's why you see in this question they gave one point here. What they mentioned, yes or no? No individual value of asset is considered in that slump sale deed. So when you are selling the when you are selling unit A, no, you only listed what are the assets you sold in the deed. You didn't mention unit A how much, I mean building how much, land how much, at what price we are selling. We didn't mention like that. There is no individual value assigned to each and every asset. If at all workings are there like that, that is only for stamp duty purpose or taxes purpose. Are you clear? Next. Now, whether what is the nature of the undertaking? If the undertaking is held for more than 36 months, the gain is long term. Otherwise, it is treated as short term. That's it. Slump sale is over. Clear? Entirely in one page it is given. Easy or not? Some also we did. Confident everybody? That's it. So that's how slump sale provisions are. That's it. So we'll take a break and then get back. Now, let's continue discussion. In the previous session, we completed slump sale, right? 50B is completed fully, with the problem also be completed. Now, let's understand tax rates once again. Already we know it. We already know tax rates. What are the tax rates under capital gains? We have totally 3 sections of tax rates, correct? 112, 112A, 111A. And, you know, okay. I'll do one thing. Yeah, fine. It's okay. And another one is normal short-term capital gains. Normal short-term capital gains. These two are short-term capital gain rates, whereas these two are long-term capital gain rates. Am I right? Now, if at all you are selling listed equity shares, listed equity oriented funds, yes or no? Units of business trust. What is it? Units of business trust. Then 112A, 111A sections will come into picture. If at all these assets are long-term capital assets, then 112A will apply. If the same assets are short-term capital asset, 111A will apply. Am I right? Now, if at all you are selling them and it's a long term and you are getting a long term capital gains, then the tax rate is 12.5% in excess of 1.25 lakh. Do you agree? Remember this? We did already in the basic concepts chapter. Now, if the same is a short term capital gain, the tax rate is straight away 20%. Yes or no? But you know, this section before amendment, that too last year it was not related to May 26, September 26, Jan 27 or CMA June 26, December 26 exams. You don't have to worry about old rate. Old rate is before 23rd July 2024, which is taxable at 15%. That you don't have to worry about. Right now the short-term capital gain tax rate is what? 20%. Now, can I claim 87-year rebate on 111A? Absolutely. Under optional tax regime you can claim. Can I claim 112A on the tax? Can I claim rebate? No rebate at all. What about default tax regime? Here you can't claim, here also you can't claim. Yes or no? What about unutilized basic exemption limit? Yes, on 112A capital gain I can set off. Even on 111A capital gain also I can set off. Whether it is optional or default, it doesn't matter. But provided you are a resident individual. Yes or no? Or HUF. Normal short-term capital gain. Normal means what? Other than 111A. They are taxable at slab rates. If it is partnership firm, they are taxable at flat 30%. Yes or no? Like that. Then coming to 112. Other than these three, if at all, any other long-term capital asset you are selling, you are transferring, and if you are getting capital gains on any other long-term capital asset, then blindly the tax rate is what? 12.5%. That's it. Look at it. Look at it. So what is the tax rate under 112A, 111A? 112A, 111A. What assets you are transferring? Transfer of listed equity shares, units of equity oriented mutual funds, units of business trust. Sir, here where did you mention listed word? Don't worry, STT paid logic is there, right? STT paid, if at all condition is there, then by default they are listed. Securities transaction tax is applicable only for listed securities. Are you getting it? Unlisted securities transaction tax will not apply. That to remember here, not all listed securities, only listed equity shares come under 112A. Are you clear? That even in mutual funds also, equity oriented only will come. Debt oriented mutual funds, they will not come under 112A. For them it is flat 12.5%. For them it is flat 12.5%. Are you clear? Now look at. So long term capital asset. So shares, STT paid. Condition is what, you know? STT paid both the times. What? Both the times means what? At the time of acquisition, at the time of subsequently transfer. You both the time you paid STT on equity shares. Okay, then only 112A section will apply. So, for example, for you mutual funds and business trust, no, maybe at the time of acquisition, STT may not apply. That time they were unlisted. But later, before you sell, they were listed. Now after they were listed, now you sold and STT paid at the time of transfer. That is enough. Are you clear? Now, what is the tax rate? 12.5% is the tax rate on capital gain exceeding 1,25,000. Can I set off unutilized basic exemption limit under 112A? Yes. Yes, resident individual and resident HF can absolutely set off. Now, tax rate is same, even STT not paid, provided the transaction occurred in, you know, stock exchange in IFSC. IFSC is nothing but International Financial Service Center. Suppose if the stock exchange is in this center, for example, in India we have one center like this, Gift City. Okay, so Gift City, Gujarat is there. So in Ahmedabad it is there, Gift City. Okay, so in Gift City there is a stock exchange. Example, there is a Gujarat Stock Exchange, for example, not National Stock Exchange, not Bombay Stock Exchange, Gujarat Stock Exchange is there, for example. In this stock exchange you are selling and buying and selling securities, buying and selling equity shares listed. But guess what? Since you are in financial service center, STT will not be levied, because financial service centers are tax-free zones. They are tax-free zones. Now in that financial service center you are selling listed equity shares where STT is not paid. Just because you didn't pay STT, 112A will not apply. Yeah? No. 112A is applicable even on the shares which are sold through IFSC stock exchange. Even though STT not paid, 112A can be applied. Remaining stock exchange, if at all you are selling, STT must be paid. Then only 112A section will apply. Are you clear? Then what about rebate? No rebate at all. On 112A tax, whether you go optional tax and default tax, no rebate at all. And sir, can I claim chapter 6A deductions under special incomes? Never. From special incomes, deductions under 6A we cannot claim. Sir, what is this deduction under 6A? Don't worry, this point keep it pending, no problem. You will get this clarity in deductions chapter. Chapter 6A deductions introduction, I will give clarity on this. Are you clear? Suppose if the same is short term capital asset and STT paid at the time of transfer, that's enough. For short term 111, you know, at the time of transfer if you pay STT, that's enough. Need not be at the time of buying time. That and all is not there. Then tax rate 20% if the transfer is on or after 23rd July. That means before 23rd July it is, you know, before 23rd July it is 15%. Whenever I use word 23rd July, most of the places I used on or after 23rd July correctly. Before 23rd July is the right answer. Before 23rd July, indexation is not available on any asset. Sorry. Before 23rd July, indexation is available. On or after 23rd July onwards, 2024, if you are selling, indexation will not be available. Yes or no? Next. Can I have unutilized basic exemption limit set off for individual HGF resident? Yes. What is the tax rate? Even in, suppose if the transaction occurred in IFSC stock exchange, the tax rate is same 20%, even though STT not paid. 87 year rebate available under optional tax regime, but under default tax regime not available, and no chapter 6A deductions. 112, 111A easy or not? Next. Now tax on long term capital gains 112. Tax on long term capital gains 112. Now what is the tax rate on? This is applicable for all long term capital gains on different types of assets. However, they should not be covered under 112A. Other than 112A asset, remaining long term assets if you are selling and there is a long term capital gain, automatically 112 section will apply. Are you clear? Now what is the tax rate which is on or after 23rd July? Yes or no? What is the tax rate? 12.5% without indexation. Sir, the SS is a non-resident and he is selling unlisted securities or shares of closely held company. Sir, closely held company means nothing but unlisted companies. Generally right now let us assume for the time being closely held company means unlisted companies. Okay, fine. So now what is the tax rate? Straight away 12.5% without indexation or foreign currency fluctuation benefit. 12.5% without indexation or without foreign currency fluctuation benefit straight away. Like what is this foreign currency fluctuation benefit? I will come back to it later. When I am reading the theory, that time I will give you a clear example. Are you clear? Yes or no? Next, suppose the SSE is an individual and HUF resident. He purchased a land and building before 23rd July. Remember, before 23rd July, land and building purchased and sold on or after 23rd July. Then when you are computing tax, because 112 section talks about capital gain computation. No. 112 section talks about tax rate. The tax rate is 12.5% without indexation, 20% of the capital gain with indexation, whichever is beneficial. Sir, other SSEs are not individual and HF residents, sir. 12.5% straight away without indexation facility. Are you clear? Yes or no? Important points. Unutilized basic exemption limit. It is available for resident, individual and HF. Yes or no? No chapter 6 deduction under 112 also. Special incomes are not eligible for chapter 6 deductions. What do you mean by not eligible for chapter 6 deduction? I will discuss in the pin. This one. Chapter 6 deductions introduction. 87-year rebate is not available under default tax regime. However, optional tax is available. Told you, remember, under default tax regime, this year onwards, May 26 attempt onwards, there is no rebate at all on special incomes. Yes or no? In default, once upon a time, whether you are DTR or OTR, rebate is always available. Yes or no? Only 112A income is not eligible. Whereas now, in default tax, entire special incomes are not eligible for rebate, whereas normal income is, optional tax regime, all incomes are eligible except 112A income. That's it. This is 112, 111A, 112A tax rates. Are you clear? That's it. I'll stop this video and then record the next session, 54 series. Yeah. So before we start 54 series on 112, 112A, 111A, I missed it. One problem is there. First we'll solve this problem and then go that. Okay. Next, look at this. They're asking compute income tax liability for assessment year in the following cases. Now they have given 4 SSCs. Okay. Pay under DTR, exercise option to shift out. Okay. In both the cases we need to compute tax. Now first I will compute under default tax regime. Can I? Now first of all, Mr. A, he is a non-resident. Age is 45. Age doesn't matter in default tax regime. Total income other than long-term capital gain 2,40,000, whereas long-term capital gain 85 on sale of vacant site, which means 112 section is applicable. Am I right or not? So 2,40,000 plus 85. Remember, he is a default tax regime means 4 lakh rupees is the basic exemption limit. Am I right? Unutilized limit is 1.6 lakh. But he is a non-resident. There is no such concept. Therefore, 85,000 into 12.5%. How much is the tax? 85,000 into 12.5% is equal to 10,625. And remember, it's a default tax regime. Therefore, there is no rebate concept. Yes or no? So plus 4% is equal to how much? So Mr. A, 11,050. Am I right? So I'm just computing answer. Okay. Mr. A, non-resident. B, who is B? Non-resident again. He is also non-resident. Age doesn't matter. C, 81 years. So I'm just writing 81. If I mention 81 means it's a resident. Yes or no? D, 82 years. 82 years. Hey, non-resident again. Okay. So which means non-resident. Are you clear? Okay. Now first time computing the tax liability under default tax regime. What is the answer we got? 11,050. Am I right? Yes or no? Now for B we will compute. By the way, optional tax regime also will compute. Why late? Optional tax regime also will compute. Yes or no? Under optional tax regime for Mr. A, like same. I think under optional tax regime also 2.5 lakh basic exemption. 2.5 lakh minus 2.4 unutilized reserve we can ignore. 85,000 into 12.5%. Are you clear? But remember, rebate. If total income is not exceeding 5 lakh, again it is again non-resident. Since again it is non-resident, same tax liability he will get. Yes or no? 11,050. Am I right? Next, B, 4,10,000. Remember, non-resident. Okay, 10,000 on sale of listed equity shares, just 10,000. Since it is less than 1.25 lakh, there is no tax. On 4 lakh is basic exemption. 10,000 into 5% plus 4%. Yes or no? 520. That's it. Yes or no? Here it is 520. Whereas in case of optional tax regime, 2.5 lakh only basic exemption. 4 lakh 10,000 minus 2.5 lakh. Yes or no? Into 5%. 8,000 plus 4%. Yes or no? 8,320. Am I right? For Mr. B under optional tax regime, the answer is 8,320. Yes, Mr. C. Mr. C. 5 lakh 90 resident. Remember, 5 lakh is exempted. 90k is taxable at 20%. Am I right? Then 60,000 on sale of agricultural land in rural area. Agricultural land in rural area is not a capital asset, therefore not taxable. Yes or no? Now 90,000 rupees into 20%. 90,000 into 20%. How much it is? 18,000. Remember, 18,000. Remember, under default tax regime, resident total income not exceeding 12 lakh. Therefore, 60,000 rupees he can claim rebate. 18,000 only basic tax right now. Entire amount rebate will come. Therefore, the tax liability for C under default tax regime is 0. Am I right? Default tax regime, total income is less than, for Mr. C, what is the total income? 5,90,000 only. Rural agricultural land is not a capital asset, which is less than 12 lakh. Therefore, rebate amount how much? 60,000 rupees can be claimed from basic tax. Now, basic tax is coming 5,90,000 up to 5 lakh basic exemption. Sorry. Oh. Default tax regime. Okay, fine. Up to 4 lakhs, no tax. 1,90,000 into 5%, 9,500. Entire 9,500 rebate. Correct only. Even then the answer is same. But basic tax is 9,500. Okay. Basic tax is 9,500. Rebate 9,500. Therefore the answer is 0. What about optional tax regime? What about optional? Here tax will be there. Optional tax regime 90,000 into 20%. 18,000. Yes or no? But remember, optional tax regime, since total income is more than 5 lakh, that too he is a resident senior citizen. Yes or no? Tax liability will apply. There is no rebate. Plus 4%. How much it is? 18,540. No. 18,720. 18,000 plus 4%. 18,720. Am I right? Yes or no? Then Mr. D, non-resident. 4,80,000. Non-resident 4,80,000. Default tax regime up to 4 lakhs exempted. 80,000 into 5%. 4,000 plus 4%. Straight away. 4,000 plus 4%. 4,160. No rebate, nothing. Under default tax, under optional tax regime, 4,80,000. So 2,30,000 into 5% plus 4%. Yes or no? 2,30,000 into 5% plus 4% is equal to how much, ma? Wait. How much it is? 11,960. That's it. 960. That's it. That's it. So look at what is the D income? 4,80,000 minus 2,30,000 into 5% plus that's it. Okay, correct. Clear. Look at the answers. First default tax regime I will see. Mr. A. Oh my god, this did so lengthy. 11,050, 520, 0, 4,160. 11,050, 520, 0, 4,160. Correct. Then again. Then optional tax regime, final answer 11,050, 8320, 18,720. Correct. 11,8320, 18,720. Everything is correct. Easy. That's it. 112, 1128, 111A. Based on that, we did one problem also comprehensively. Confident or not? That's it. In the next session, immediately we'll start 54 series. Okay. Now let's begin 54 series. What is it called as? 54 series. Actually, popularly the sections are called as exemptions from capital gains. What is this series is also called as exemption series under capital gains. You know, we have sections 54, 54B, 54D, 54EC, 54F, and there is a section called 54H, time limit section. That is only a time limit section, 54H. Apart from that, 10 clause 37 related to 54B. Okay, there is a section which is interlinked section is 10 clause 37. Okay, so these are the sections we typically have. Okay, now what are all these sections? These sections are called as exemption sections under capital gains. These sections are exemption sections. Like, what are exemption sections? Tell me, how do we compute capital gains? Basically, full value of consideration, some amount, minus transfer expense we reduce, then we get it what? Net consideration minus cost of acquisition minus cost of improvement. Yes or no? Yes or no? Then what you get is called as gross long-term capital gain or short-term capital gain, as the case may be. That's actually called as gross. From this, right now I'm telling, right, exemptions under 54 series that you should reduce. To reduce this, there are conditions. It is not that easy to reduce. Conditions are there. Okay, then balance is called as taxable capital gain, and on this you apply 112, 1128, 111 rates, all that you apply on this final figure. Do you understand? Yes. Now let's understand exemptions. Okay, first let me talk about urban agricultural land. Tell me, urban agricultural land, UAL, I'll call it a shortcut, UAL, in this session for the time being. Okay, urban agricultural land. Urban agricultural land means what? A land which is used for agriculture purpose but which is situated in specified area. It is there in the specified area. There in the specified area means what? This is local limits of municipality. It is there within 2 km, or it is there within 6 km, or it is there in within 8 km. Now, if at all it is there within 6th kilometer, when it is urban land, if the population of this is 1 lakh, more than 1 lakh. Okay, if at all minimum population is more than 1 lakh, up to 6 kilometers any land is an urban land. If the population is more than 10 lakh, then up to 8 kilometers any land is urban land. If it is just more than 10k but less than 1 lakh, then any land up to 2 kilometers is only treated as urban land. Can I say simply like that? Yes. Now I have an urban land, okay, which is actually a capital asset, because even if you see the capital asset definition, rural agricultural land is only excluded from capital asset definition. Yes or no? Urban land. Now I am selling this urban land. What is this? I am selling this urban land. First calculate full value of consideration. I am selling it for 10 crore minus cost of acquisition. I bought it for 50 lakh. Okay, balance is 9.5 crore. Since it's an agricultural land, there won't be any improvement. Maybe if at all fencing I did, big fencing I did, maybe that can come under improvement cost. Fencing is an improvement to the land. Are you able to understand? Generally for land, improvement won't be there, but fencing and then like mudding of the land, okay, like they will tilt and then mud, they will make sure the land is proper. Earlier it was all with all trees, all that. Okay, now they made it land. That is called improvement to the land. Are you clear? And again, what you are selling is land only. Urban agricultural land only you are selling ultimately. So 9.5, this is long term capital gain. Let us assume I'm using, this is a land owned by me from long ago, or it may be short term capital gain. This is the gain I got. Now what is the tax treatment of this gain? Guess what? The consideration I got is, this is because of compulsory acquisition. What is it? This is because of compulsory acquisition I got. This is because of compulsory acquisition I got. This amount is not actually consideration, it is actually compensation. The compensation I got is 10 crore because of compulsory acquisition, and even I compared it with stamp duty value. Are you clear? This is only higher. Okay, therefore now since it is a compulsory acquisition, of urban agricultural land, there is a section 10 clause 37. It says entire gain. What is the gain here? 9.5 crore. Entire gain is exempted. Are you clear? Entire gain is exempted. Directly entire gain is exempted. Suppose I sold this land, not compulsory acquisition by government. I sold it voluntarily to somebody at same market value, which is 10 crore, and my capital gain is 9.5 crore. Basically, generally what you need to do on 9.5 crore, you have to pay, if it is long term, 12.5%. If it is short term, slab rates, because it's an agricultural land. Yes or no? Slab rates. It is not a 111A asset. Yes or no? That rate I should pay. But you know what? I sold this land only with an intention to buy another land. I'm not feeling, my children relocated to some other place. So I want to buy agricultural land at other place and then want to do farming there. For that reason, I sold it. Now department is coming and taxing me 12.5% slab rate, as the case may be. If it is a short term, long term, depending upon that, which is unfair, I felt. So department said, don't worry, my dear. Okay, you sold it, right? What is the capital gain? 9.5 crore. Use this entire amount to buy another agricultural land. What is it? Use this amount to buy another agricultural land within 2 years, from the date of the sale of the original land. From the sale of old agricultural land, buy another agricultural land within 2 years. By how much amount? Pay 9.5 crore. Then entire 9.5 crore is exempt. Sir, I bought only 5 crore worth of land within 2 years, sir. Then 5 crore is only exempted. Then how much is exempted? 5 crore is only exempted. Are you clear? Nothing but how much capital gain is exempted. This point is discussed under section 54B. What this section says, if the SSC, who is an individual or HUF, sales, transfers an urban agricultural land and made a capital gain, which may be long term or short term. If the entire amount of gain, if the SSC invested another amount in agricultural land within 2 years, then amount invested or gain, whichever is lower, that much is exempted. Exemption cannot be more than 9.5 crore. Am I right? Suppose if SSC bought new land with 15 crore money, now will you give exemption out of 15 crore? So maximum exemption cannot exceed 9.5 crore. Are you clear? Now both these sections 1037, 54B, these are applicable only to individual or HUF. Now there is one common condition in both. One common condition is that what you're actually selling, original asset, urban agricultural land you sold, right? This original asset I call, original land I call, this land must be used by such individual or HUF, must be used. They are saying it must be used by that individual or HUF for their parents or family members. Okay, they must use it for 2 years only for agricultural purpose. This is the common condition in both the sections. This is the common condition in both the sections. This agricultural land must be used by that individual or HUF for minimum how many years? 2 years for agriculture purpose before you sell it, before you transferred it. You transferred and got 9.5 crore gain, right? You sold it for 10, right? Before you sell it for 10 crore. Condition, you must have used it for 2 years. Then only either 1037 exemption or 54B exemption I will give. Remember, in 1037, no, investment is not required, straight away exempt. Am I right? Whereas in 54B, exemption is subject to investment in another agricultural land. Are you clear? What you should buy other one also? Agricultural land only. Now, are you clear? Now, in order to get this 54B exemption with investment linked, or in order to get exemption under 1037 without any investment link, 2 years before the date of transfer, 2 years before the date of transfer, he must use it for agriculture purpose. Are you clear or not? Now here, this capital gain, the land what you are selling, may be a long term or may be a short term, doesn't matter. Are you clear? Tell me, for agricultural land, no, nothing but it's a land, right? What is the criteria to decide it's a long term or short term? What is the holding period criteria? 24 months is the criteria. If at all the land is held by the individual as a owner for more than 24 months, it's a long term. If it is up to 24 months, then it's a short term. Now, let me give one example. What happened, I'll tell you. There is an SSC called Mr. T. Okay, who took an agricultural land on lease, okay, on 1st October 2021 he took on lease. Now he is doing farming on that land. Mr. T is doing farming on that land. Okay, Mr. T is doing farming on that land. Mr. T took this land from Mr. O. or else L, Mr. L. L means landlord, T means tenant. That's what the meaning. Okay, so from landlord he took tenant from Mr. Landlord. After 1-2 years of farming, he has a lot of attachment to that land. Then what Mr. T did is, T paid to Mr. L 1 crore worth of amount, and when he bought, on 10th October 2025, 10th October 2025, he bought the land. What he did? He bought the land. But somewhere, immediately after buying this land, some bad things are happening in his life. His astrologer told, this land is not suitable for you. Then immediately, and moreover, there is a booming also. Immediately there is a boom. After the land was purchased, the national highway was announced nearby. Okay, the land price shooted up. What he did is, on 10th March, I'm just taking same dates for convenience sake. Okay, on 10th March 2026, he sold this agriculture land. Remember, urban agriculture land. Okay, he sold it for 3 crore rupee. Are you clear? It's not a compulsory acquisition. It's not a compulsory acquisition. Now tell me, he sold it for 3 crore and he wanted to buy another agricultural land. Okay, he wanted to buy, and out of this 3 crore, he spent 2 crore. He spent 2 crore and purchased and bought a rural agricultural land. What he bought? A rural agricultural land he bought on 1st September, 1st July, 1st, okay, 1st July 2026 he bought. Now what are the tax consequences is the question. First thing, full value of consideration 3 crore minus cost of acquisition. How much is the cost at which he bought? 10th August 1 crore. So what is the profit? 2 crore. Is it long term or short term? 10th October he bought, 10th March he sold, less than 24 months. Therefore it's a short term capital gain. Are you clear? Minus this fellow want to claim 54B exemption. Can he claim? Can he claim or not? 54B exemption, 2 years it must be used by the SSE. The land must be used by the SSE for 2 years. Sir, he bought on 10th October and 10th March. He not even used 6 months. No, wrong. He is using the same land from 1st October. Even on the date when he is buying also, he is using that land for agriculture purpose. As a tenant using, he is using as a tenant. But he is using it or not? He is using that or not? He is only doing farming, yes or no? Condition satisfied, yes or no? Then therefore 54B, how much he invested in new land? 2 crore. How much he invested in new land? 2 crore. Sir, but he bought rural land. What he sold is urban land, bought rural land. In the section, it is silent. In 54B exemption section, what they say, if you invest in another agricultural land, that is enough. There is no necessity that it must be new also should be urban. There is no necessity. Here he invested in rural land. That too, within 2 years he invested after the sale. By the way, new asset investment, 2 years, right? The 2 years to be calculated from old asset sale date onwards, transfer date onwards. From transfer date here we bought within. So therefore balance taxable capital gain is 0. Are you clear? That's it. 54B over. 10 subsection 37, 10 clause 37, both are over. Are you clear? Now look at 10 clause 37, you look at 122 page. Okay, look at exemption under 10 clause 37 for agricultural land. What land? Urban agricultural land. When exempt if the following conditions are satisfied. Okay, exemption of capital gains on compulsory acquisition of urban agricultural land. Urban agricultural land means what? Actually land situated within specified limits or specified area. Am I right? This section is applicable to individuals and HUF. The exemption is available if the compensation or enhanced compensation is received on 1st April. By the way, here what is it? Here what is the acquisition? Compulsory acquisition, yes or no? So if at all you are receiving compensation, enhanced compensation on or after 2004, nothing but this section is brought in 2004. That's the logic. Leave it. Okay, then it is exempted. Clear? The land must have been used for agriculture purpose in the 2 preceding years before the date of transfer by individual or their partners. Yes or no? Or parents or HUF. So land must be used for 2 years. Before you sell this land, no, before government compulsorily acquire from you, past 2 years you are using it. You or your parents or HUF is using it. Then only this exemption will apply. Then immediately I wrote here one point. Immediately refer 54B. So we'll go back and refer 54B. What is 54B? Look at 54B. Asset transfer is what? Urban agricultural land. Yes or no? Who is SSC eligible? HUF or individual or their parents must use the land for 2 years preceding the date of transfer. Ownership during usage is irrelevant. Am I right? The land may be short term or long term. New asset you should buy, no. The SSC must purchase another agricultural land within 2 years. That new land must be either rural or urban. How much capital gain exempt? Lower of amount invested in the land or the maximum capital gain. Are you clear? Now here there is a concept called lock-in period. What is this concept? I will come back to it later. Are you clear? I'll come back to it later. Lock-in period concept. Are you clear? Or else it's okay. I'll tell you. Now you tell me here. How much he invested in the new land? 2 crore. And he invested and claimed exemption. And guess what? Immediately the next day after filing IT return, he sold it off. Now again, you are indirectly cheating department. Yes or no? No, this is not permitted. Now you claimed exemption under 54B by buying new agricultural land worth of 2 crore, right? Department put one condition here. You should not transfer it for minimum 3 years from the date you invested. You invested on the new land, right? Lock-in period. We call it as what? Lock-in period. The lock-in period is 3 years. 3 years you should not sell it. This is the condition. Only if you promise me, I will give you exemption. SSC bought the land and promised the department that, okay sir, I will not sell it, and bought the land. 2 crore exemption claimed, 0 tax he paid. Now what happened, you know, within 3 years. By the way, when he bought the land 1st July 2026, what is the land purchase date? 1st July 2026 is invested in the new land, correct? From here 3 years means what? 30th June 2029. Yes or no? 2029 is the 3 years date. Within this period, within this date, on 10th May 2029, what he did, you know, this 2 crore worth of land, whatever the 2 crore, right? He purchased it for 2 crore, right? This 2 crore worth of land, he again sold for 5 crore. Wow. Here, okay, that's your land, you sell it, that's your choice. But what happened is, you violated condition. What you did? You violated condition. Now how to compute capital gain? First of all, new land you sold is again in 29-30 years, yes or no? 5 crore. What is the cost of acquisition? You bought it earlier and claimed exemption also, this 2 crore. How much is the cost? 2. So what is the capital gain? 3. By the way, since you are selling this land within 3 years, yes or no? Earlier, how much exemption you got? 2 crore exemption you got. That entire 2 crore is retaxable. Earlier you got long term capital gain or short term capital gain? Sir, earlier I got exemption for short term capital gain, sir. Then now it is retaxable as short term capital gain, sir. Are you clear? Yes or no? Wrong. This is not the way to compute. The section what it says, the word, you know, this is not how you should compute. Now by the way, tell me, new land he bought in 2026 and he's selling it in 2029. Let us assume 10th May 2029 he's selling it. By the way, when he bought 1st July, when he's selling 2029 1st May, which means it's a long term capital asset. Am I right? It's a long term. So the new land which he purchased earlier, now he is selling after it became long term. Fine, it's okay. Whatever it is, full value of consideration is 5 crore only. Minus, what is the cost of acquisition? 2 crore, correct? Now what the section says, you know, earlier you bought the land, right? That time how much exemption you claimed? Earlier when I buy this land, I claimed, wow, 2 crore exemption I claimed. Now since the exemption you claimed 2 crore on a promise of 3 years, but you violated, which means earlier given exemption will be retaxable. How they are retaxing it, you know? They are not retaxing separately. They are retaxing as a reduction from cost. They are retaxing as a reduction from cost. Are you getting it? They are retaxing as a reduction from cost. Earlier given exemption will be reduced from cost of acquisition while calculating capital gains on transfer of the new asset within lock-in period. Here, the new land you are selling within lock-in period for 5 years, 5 crore, am I right? Am I right? While computing capital gains, cost you will reduce, am I right? While reducing cost from that cost, earlier given exemption, remove it. Automatically balance cost becomes 0 or something else. Indirectly, the 2 crore got taxed or not? Yes or no? Now, balance capital gain is how much in this case? 5 crore. Now, is this long term or short term? This is long term only. Why? Because this new land is bought in 2026, 1st July. Ultimately, we are selling it in May 2029, which is more than 24 months. Therefore, it's a long term. More than 24 months, dude. Here it is more than 24 months. 1st July to 10th June, more than 24 months. 27, 28 over already. Then 29 you are selling it. So this is therefore long term. But if you observe here, one important twist is there. Here 5 crore entirely, in this 5 crore, 3 crore is new land profit. Basically 3 crore is a new land profit. 2 crore earlier given exemption we are taxing. Both we are taxing as long term. But earlier what I claimed exemption is short term capital gain is what I claimed exemption. Earlier what is the gain I claimed exemption? Short term. Technically when you are retaxing also, it should be retaxed as short term. But because of the language used in the section, this is the tax treatment will apply. They didn't say earlier given exemption is retaxed as earlier given exemption is retaxed. They didn't say like that. What they mentioned, earlier given exemption will be reduced from cost of acquisition on computation of capital gain on the new asset. When you are computing new asset capital gains, right? When you are reducing cost of acquisition, right? From the cost earlier given exemption, you reduce it. Hello. Yes or no? Because they are using this language. Even though earlier I got short term capital gain exemption, now it is indirectly taxed as long term. So this is a loophole in the law. That's how they drafted. Mistake. They drafted wrongly. Suppose tell me, if the same land is sold on 10th May 2030, if the same land is sold just 1 year late, that time what is a capital gain? First of all, full value of consideration is 5 crore minus cost of acquisition 2 crore. Cost of acquisition is 2. What 2, sir? 2 crore minus 2? No. Here no. You are selling it after 3 years lock-in period. Therefore, earlier given exemption, no need to touch it. Are you clear? Now, new asset you are selling 5 crore. Earlier you bought it for 2. Therefore, 3 crore only long-term capital gain over. Do you understand the tax consequence of sale? Do you understand the tax consequence of transfer of new asset within lock-in period and transfer of new asset after lock-in period? Do you understand that logic, everybody? Yes or no? That's it. Now, there is one more concept I want to talk. Capital gain account scheme. There is one more topic I want to talk, which is capital gain account scheme. Listen carefully. Right now, this agricultural land example only I'm continuing, okay? Originally 1st October 2021 I took it on lease. Look at this example fully carefully. 1st October 2021 I took it on lease. Then 10th October 2025 I bought it. Then on 28th of February 2026, or else I'll do one thing better, I'll take a better take. 1st March 2026 I sold it for full value of consideration 3 crore. I bought it for 1 crore. What is the cost of acquisition? Minus cost of acquisition 1 crore. What is the short term capital gain? 2 crore. Why it is short term? Because 10th October you bought, 1st March you sold, less than 24 months, it's a short term capital gain. Now from this date, what is the time limit for you to invest in another agricultural land? 2 years. Yes or no? Means 28th February 2028. Within this time, you can invest in another land, right? Am I right? How much, how much is the capital gain for you? 2 crore. If at all you don't want to pay single rupee tax, how much you should invest in new land? 2 crore you should invest. Entire gain, if you invest, entire gain you can claim exemption, balance 0. Now you went to the, now by the way, this transaction happened when 25, 26 years. Yes or no? Previous year 25, 26. What is the due date for this return? 31st July 2026 is the due date for filing IT return. You went to the department. Sir, at this price I sold, sir. This is the price I bought. This is the gain I have. Now I want to use your 54B section and then want to claim exemption, sir. They said. He said. Department also, well done, sir. You can happily use. Okay, sir. 2 crore exemption I am claiming, sir. Balance capital gain 0, sir. There is no tax on this. Department asked me immediately, sir, 2 crore exemption you claim, no, sir. Show me the proof of investment. The SSC told, what investment, sir? I have time limit up to February 2028. No, sir. I will buy very soon. I'm promising you I'll buy soon. Department will not agree like that. Okay, you may promise, but you may not buy it no later. No. I will not give exemption. Sorry. I'm taking back because you didn't invest it. Sir, what, sir? You said very clearly up to 28th, 2 years time is there for me exemption. Within 2 years I can invest. No. Okay, now give me exemption. I am promising you, I will invest. I will buy new land. My people are searching now. Okay, how can I buy new land? Immediately, just because of exemption, should I buy immediately hurry barili some land? I will make loss, sir, tomorrow if I buy hurry barili. So let me take time. 2 years is section time limit and I am buying it within 2 years. Who are you to reject it? SSC cross question department. Then department gave an option. Hello, mister. I believe you. Okay, 2 years time limit, section limit, time limit is there, and you made a capital gain, you will invest. I agree. What is the guarantee that you will invest? I want somebody to guarantee on your behalf. What is the guarantee that right now you made a profit? Amount is there in your bank also, right? Yes, sir, it is there in my bank account, sir. So what? What is the guarantee that you will invest in 2 years? I want a guarantee on this. Okay, sir. So what should I do? Tell me, sir. To make you believe, what should I do? Yes, sir, replied department officer. Department officer, he gave an option. What option, Go to nationalized bank. Or go to any scheduled bank, commercial bank. You go to any bank nearby. Okay? In your bank account right now, sale proceeds how much? 3 crore is there. Forget about 3 crore. I don't even want 3 crore. Gain is how much? 2 crore. Out of this, just 2 crore, no? Transfer to capital gain account scheme, bank account. Capital gain account scheme is nothing but a bank account, just like a current account, savings account. Capital gain account scheme is a bank account. Sir, go to any bank nearby, sir. Tell them that I want a capital gain account scheme, bank account. They will immediately open it for you. Once you opened it, from your personal bank, you have 3 crores, no? Transfer 2 crore to this. Transfer this. You can't withdraw now, Sir, you can't withdraw once you transfer to this. Why, sir? What happened? How I buy? For land buying, they will give you permission to withdraw. For land buying, they will permission to withdraw. Other than that, you can't withdraw. Are you clear? That is a speciality of this scheme. Are you clear? So then, okay, sir. But sir, this is my money only. Your money only, sir. Your money only. Nobody will touch it. Just that. I want an assurance. I want an assurance that you will for sure buy the land. You will not use it for some other purpose in between. If at all your money is there in your normal savings bank account, no, you may tempt it and then use it for some other purpose. But if at all it is in capital gain account scheme, bank first of all will not allow you withdraw. If at all you are buying land only, bank will release money. Otherwise they will not release money. For that too, they will not release money to you. They will directly release the money to the seller. Are you clear? That's the speciality of the scheme. Then immediately, before filing the return of income, what is it? Before filing the return of income, SSC went, opened capital gain account scheme, transferred 2 crore rupees into the account scheme, and then came back to the SSC department. Sir, whatever you did, I told, sir. Now can I claim exemption? Happily you can claim. Happily you can claim, no problem, because now my assurance I got. The department got their own assurance. Now I will tax 0. Are you clear? Now, what is the formality on the SSC part right now? In your capital gain account scheme, 2 crore amount is lying on which you claimed exemption. Make sure from date of transfer. What is the date of transfer? 1st March. What is the due date for purchasing new land? February 2028. Make sure you withdraw 2 crore money and buy the land on or before 28th February 2028. Buy the land, make sure within that. Yes, he also, okay sir, thank you for guiding me, and he went off. By the way, now here you will get exemption. Two things. One, you buy the land before filing the return, you get exemption. I'm absolutely giving you. You didn't buy the land, you want to buy the land based on section time limit, then before due date for filing ITR. Remember this, most important. Before due date for filing IT return, you must deposit the amount you want to invest in capital gain account scheme. Only the amount that you transferred before due date, on or before the due date into capital gain account scheme, only the amount transferred on or before due date for capital gain account scheme, only that is eligible for exemption. Only that is eligible for exemption. Either buy the land before filing IT return due date, or you don't want to buy hurry barily, you want to use 2 years time limit as per the section, then do one thing. Invest that money in capital gain account scheme so that I'll have an assurance. But either of this you must do within relevant year due date for filing IT return, then only you will get exemption. Are you clear? Do you understand? Suppose in the same problem, okay, in the same problem, SSE went and deposited this 2 crore on 1st October 26 in the bank account of capital gain, which is after the due date. No exemption, zero. Even though you really went and bought within 28th February new land you bought, department will not give exemption, because by the time due date for filing IT return, you must allocate that money for investment purpose. What do you mean by amount transferred to capital gain account scheme? What do you mean by that? Whatever the amount you want to claim exemption, allocate it. You allocate it dedicatedly for investment purpose, then I'll give exemption. By the time IT return filing, you didn't even allocate the fund, which means your intention is something else. I will not give you exemption. Even later you really bought the land and showed me, I will not consider. By the time what due date for filing IT return for the relevant year in which you sold the land, original land, right, due date is applicable, right, by then you come show me that you allocated the fund, then get exemption. Later you buy within 2 years logic, 3 years logic, whatever the logic applicable. Are you clear? Fine. Now in this case what happened, let us assume this fellow in capital gain account scheme, he deposited on 25th July 26. Very good, thank God, within the due date he deposited. Then department immediately gave 2 crore exemption. Department immediately gave 2 crore. But guess what? Actually, he has in his bank account 3 crore, no? He deposited entire 3 in capital gain account scheme. He deposited entire 3 crore in capital gain account scheme, not just 2 crore. Officer also impressed. But even though I impress, you get 2 crore only exemption, because your gain is how much? 2 crore. Even though you deposited in account scheme 3 crore, you will get exemption only 2, because 2 crore only is there. Now what is your formality? Whatever exemption you claimed by depositing in capital gain account scheme, that amount you should withdraw and use it for buying agricultural land within 28th February. Am I right? Guess what happened? Okay, now guess what happened. Now after 2 years, 28th February 2028 came. 28th February came, 29th also, 29th came, because 2028 is a leap year. Okay, 29th February 2028 date entered. What is this date? This date is after expiry of 2 years. What is this date? After expiry of 2 years. 2 years time limit is over now. The next date you entered, and guess what? In capital gain account scheme, there is a balance amount left. What do you mean by balance amount left in capital gain account scheme? Unutilized money. What is it? Unutilized money. Case number 1, 1 crore left. Case number 2, 2 crore left. Case number 3, because he invested how much totally? 3 crore. 3 crore left. What is the tax treatment for these amounts? Fine. 1 crore only left means originally you deposited how much? 3 crore. In our example, originally you deposited 3 crore. 1 crore left means how much you utilize? Probably you would have utilized it for buying land only. Otherwise, banker will not permit. So you utilize 2 crore for land. Earlier you claimed exemption how much? Earlier old year exemption how much you claim? 2. Now also you utilized how much effectively? This 1 crore is excess money you deposited in capital gain account scheme. No tax treatment, 0. Hello? Am I right? Logical? 2 crore is left, which means you deposited 3 crore in the account scheme. 2 crore left means how much you actually spent within the 2 years? 1. But how much you claimed exemption? 2. You spent only 1. You claimed 2 exemption. How much is retaxable? Suppose entire 3 is left. You claim 2 crore exemption, 3 crore you deposited, nothing you spent. The money as it is there. So which means you didn't spend at all. But earlier you promised me you will spend entire 2 crore minimum and then claimed exemption 2 crore. Now if you see nothing is spent, how much earlier you claimed exemption 2? How much is taxable? 2 crore. Some students what they think, whatever balance lying in unutilized capital gain account scheme is fully taxable, they think. No. In capital gain account scheme, sometimes SSE might deposit additional amount also beyond his exemption limit. That time, that additional amount will never be taxable. Are you clear? So, I'm telling you, this level problems are not there. But still, I'm giving you entire provision. But provision is discussed in depth. So, that I told you. So, tell me, what is capital gain account scheme? If an eligible asset is transferred originally, and you computed a capital gain, and that gain, if you want to claim exemption, you have to invest some amount subject to maximum of this gain. Whichever is lower, you get exemption, right? The exemption has to be in new agricultural land within 2 years. The exemption you will get when the amount is invested in new agricultural land within 2 years from the date of transfer of the original agricultural land. Am I right? Am I right? Now still it is not over. 54B section not yet over. I'm closing it now very soon. Okay, now fine. So are you clear until now? So now, if at all you sold the land, you got the capital gain. In this example, 3 crore is the sale value, 1 crore is cost of acquisition, 2 crore is the capital gain. Earlier last 2 years SSE is using the land, therefore it is eligible for exemption under 54B. But fortunately, yes or no, SSE want to buy slowly the land. He don't want to hurry barely buy. For that, what department told? Dear Mr., you need to file IT return for this year. No, due date is there, right? By due date, whatever amount you want to claim exemption, no, at least that much money deposited in capital gain account scheme bank account. If whatever you deposited on or before due date for filing IT return amount in CGAS, only that is considered for exemption. Accordingly, SSE not 2 crore, he deposited entire 3 crore in the capital gain account scheme, and later he thought of withdrawing and then spending for land purpose. He thought of spending for land purpose later. Now, then he deposited in capital gain account scheme, and 2 years time limit over. When we see after 2 years next day, 1 crore is their unutilized amount. Actually, you deposited originally how much? 3 crore in the bank account capital gain. But exemption you claim 2 only, no? Here you deposited 3, 1 is unutilized, which means how much you actually utilized? 2 crore you utilized actually. So deposit minus utilized amount balance. Yes or no? 1 crore. Yes or no? This 1 crore you didn't claim exemption. Net effective utilization 2. Exemption claim 2. Effective utilization 2. This 1 lakh which is this 1 crore which is unutilized, no tax treatment. Same way for 2 crore and 3 crore logic, which I already told. Are you clear? Yes or no? Confident or not? Yes or no? No. Now let me take one more example. So this is what? Yes or no? This is what? By the way, ultimately successfully on 20th February 2028, this is within 3 years logic, SSA successfully bought worth of 2 crore. Okay, rural agriculture land he bought. What he bought? Rural agriculture land he bought within 2 years of selling the original urban land. Can he claim exemption for this? Absolutely, you can. And by the way, he bought only for 2 crore. Therefore, 1 crore is unutilized in capital gain account scheme. Am I right? This 1 crore, no tax treatment. Why? Because capital gain is 2 crore and 2 crore you already utilized. This 1 crore is unutilized. The extra money that you deposited out of your own interest, that I will not touch it. Are you clear? Next. Now, you know what happened, this new land, you should not sell it for how many years? What is the lock-in period? Lock-in period is always 3 years. You should not sell it. But guess what? What this fellow did, in 2029 itself. In 2029 itself, he sold it for full value of consideration. He sold it for 5 crore. He sold it for what? He sold it for 5 crore. Tell me, if the new land is sold for within lock-in period, if the new asset is sold within lock-in period, earlier given exemption, what is the treatment? Reduce it. Earlier, if the new asset is sold within lock-in period, earlier given exemption shall be reduced from cost of acquisition while computing capital gains on transfer of new land. But here the twist is, the new land is rural land, which is sold within lock-in period. Since the new land sold is rural agriculture land sold within lock-in period, it is not a capital asset. I will not compute capital gain at all. When I am not computing capital gain at all, how can I reduce earlier given exemption? Earlier given exemption, I have to reduce it from cost while computing capital gains on new asset transferred within lock-in period. Yes or no? If the new asset is transferred within lock-in period, while computing capital gains, while reducing cost from consideration, the cost is adjusted with old exemption. Yes or no? Here, the new asset transferred is rural land. There is no capital gain computation itself. Then when there is no capital gain computation itself, how I will reduce all this? How I will cancel the exemption by reducing? No retaxation. What is it? No retaxation. Loophole in the law. Are you clear? Yes or no? This is about 54B. Do you understand? There is no problem in our book. There is no problem in the past exams also on this. But still, I gave you. Remember, 54B, some students think it is not important. Whatever I told here is useful in 54. Whatever I told here is useful in 54 EC, 54F. Everywhere the same logic will apply. CGA's point is there in every section. Utilization, capital gain account scheme, unutilized money concept is there in every section. Are you clear? That's it. With this 54B, 10 clause 37 is over. Can I once go back to 54B? Now you see. What is 54B? Lock-in period. What is the lock-in period? What is the lock-in period? It is something same as discussed in 54. 54, some point is discussed. Here also lock-in period is 3 years only. What is the lock-in period? 3 years. Remember, look at, if the new land is rural land and it is transferred within lock-in period, no tax treatment as capital gains won't arise on the same. What is capital gain account scheme? Discuss it later, I wrote here, but still I told you. Am I right? Am I right? So look at what is capital gain account scheme. Once I will show you capital gain account scheme also, I'll cover it. What is capital gain account scheme? This section is applicable for exemptions when you are claiming under 54, 54B, 54D, 54F, but not 54 EC. What is this section of capital gain account scheme? Point is what? The capital gains must be invested in specified assets within the due date. Yes or no? Under for filing 139. Yes or no? If investment in new asset is not made, if at all I am not buying agricultural land before the due date, the capital gain must be deposited in capital gain account scheme. Yes or no? Now whatever the you must deposit. Now little more point is pending. I'll come back to it later. Are you clear? Now the sum of the amount already utilized for purchase or construction or amount deposited will be deemed to be cost of the new asset. Okay, fine. I'll come back to it later. Okay, let us not discuss at this moment. I will first discuss remaining. Again, I will come back and then I will discuss this. Are you clear? Yes or no? That's it. So 10 clause 37 over, 54B is over. Now the next section I will discuss is 54. Now what I will discuss? 54. Okay, fine. Just 2 minutes break we'll take and then we'll discuss. Okay. Now let us understand another exemption section, that is 54 and 54 EC also. Both will understand. Now Tell me 54B. Let me tell you first 54B. Just now we completed, right? What is the original asset transferred? Urban agricultural land. What is the original asset transferred? Urban agricultural land. Okay. The asset type can be long-term capital asset or even it can be short-term capital asset. Am I right? Condition 2 years usage. Okay, that is specific to that section. Remaining sections it is not there. Okay, fine. What is the new asset you should purchase? It may be urban agricultural land or rural agricultural land. What is the time limit? What is the time limit? 2 years. What is the time limit for investment? What is the time limit for investment? 2 years from date of transfer. Okay, time limit means by default generally it is considered only 2 years. Yes or no? Then what is the lock-in period for new asset? What is the lock-in period? 3 years. Is capital gain account scheme applicable? Yes. Am I right? Yeah. Next. You know what? 54 easy first I will tell. Okay, 54 easy I will tell. 54 easy. You know what is the original asset that you are transferring? Residential house property. What you are transferring? Residential house property. Open 54 easy. 54 easy. Both at test stage you can discuss. Okay. Okay. SSC transferring. Okay. Immovable property. It may be residential or commercial. It may be residential or commercial. In fact, I can say land, building or both. Okay. Immovable property. It may be land, building or both. It may be land, building or both. Asset type. It must be long-term capital asset. What is it? It must be long-term capital asset. So original house, original asset what you sold is immovable property. Original asset transferring must be long-term capital asset being immovable property. It may be residential property or it may be commercial property. It doesn't matter. It may be forming part of depreciable asset, a block of asset, or it may be forming part of non-depreciable. It doesn't matter. Are you clear? You are selling originally and you are getting that asset nature. That asset nature must be long-term capital asset. The nature must be long-term. And under 54 EC, you are selling originally immovable property, which is a long-term. Obviously, what gain you might have got long-term capital gain. But in case of buildings, no, which is forming part of block, no, okay, the gain is always short-term. Remember, for block of asset, in case of block of asset, no, whatever the gain or loss is always short-term. But the building may be a long-term asset. The building which you are selling as a part of block may be a long-term asset. Yes or no? Because that building is held with you for more than 24 months. But the gain or loss is always short-term. Here, asset type only important. Which gain you got is not important. Which gain you got is not important. Which asset you sold is only important. What you sold is long-term. Yes or no? Then now you got some gain, sir. 1 crore some gain you got. You want to get exemption of that. What you need to do? Under 54 EC, you have to invest in new assets. What you have to invest in? New assets. What are new assets you know here? Bonds. What are new assets? Bonds. That too, how much you can invest, you know? Subject to maximum of 50 lakh only. That too subject to maximum of 50 lakh only. Are you clear? Yes or no? Bonds. What bonds? There are so many types of bonds which they listed out. Look at it. Bonds of National Highway Authority of India or Rural Electrification Corporation with effect from 2018. That's okay, old. Bonds notified by central government such as PFC bonds, Public Financial Corporation, PFC, Public Financial Corporation, or IRFC, Indian Railway Financial Corporation. PFC means what? Right full forms. Public Financial Corporation, IRFC, Indian Railways Financial Corporation. Are you clear? Or 5 years bonds issued by HUDCO. How, you know, Housing Urban Development Company, something is there, HUDCO. Okay, housing related one, HUDCO. From 1st April 2025 only these bonds were notified. And 5 years bonds issued by IREDA. Okay, so IREDA. So So 9th July 2025 onwards only they were notified. Are you clear? Anyhow, these dates are not important for you at all. Don't worry about it. Okay, what are the bonds? NHI bonds, RECL bonds, PFC, IRFC, HUDCO bonds, IREDA. The moment in the problem they say bonds of so and so purchase means immediately it should strike for you 54 EC point. Are you clear? Now maximum exemption how much? Maximum under 54 EC, the exemption is restricted to what, you know? 50 lakh. What is the exemption restricted? 50 lakh. By the way, what is the time limit for investing? Too less. 6 months from date of transfer. Within 6 months only you should buy, since it is a very short period of time. See, assuming you are selling the capital asset, original asset on 31st March, 6 months period is just 30th September. After immediately return filing due date, if at all your return filing due date is 31st July, then 31st July. If your return filing due date is 31st October, then before due date. That's why here capital gain account scheme logic will not apply. For 54 EC, there is no capital gain account scheme concept. Why? Hello, why scheme and all? Yeah, 6 months. Within 6 months you have to buy the bonds. Then only you will get exemption here. That to tell me maximum how much exemption? 50 lakh. Maximum how much exemption? 50 lakh. And guess what? Okay, I purchased bonds and I got 50 lakh exemption also. Some 50 lakhs worth of bonds I bought totally within 6 months from the date of transfer. I bought within 6 months 50 lakhs worth of bonds. I claim 50 lakhs exemption. Now this bonds, what you should do? What is the lock-in period? 5 years. What is the lock-in period? 5 years. Look at this. The lock-in period of new asset. If you know what is the lock-in period? 5 years. Now here 5 years is not only for selling. You should not sell it for 5 years. But some SSCs know what they do, you know, they will keep these bonds in a bank as a loan and then get the loan. That also you should not do. If the bonds are transferred or converted or used for getting loans and advances within 5 years, earlier given exemption will be taxed as long-term capital gain in the year of violation. You see, they say so clearly, they mentioned it is taxable separately. They didn't say earlier given exemption will be reduced from the cost of acquisition while computing capital gains. Like that they didn't draft. They told it is taxable straight away separately. Are you clear? Hello? Yes or no? Now look at the example. Okay, for example, SS is sold an immovable property. The full value of consideration is just 2 crore minus, you know, cost of acquisition is 1.4 crore. Therefore it's a long term. It's a asset is a long term capital asset. House must be a long term capital asset. The immovable property must be long term. He got a long-term capital gain of 60 lakh. And what he did, you know, guess what? Within 6 months, he purchased 60 lakhs worth of bonds. He purchased within 6 months 60 lakhs worth of bonds. But maximum exemption is 54 EC 50. Therefore, on the balance long-term capital gain, he happily paid 12.5% tax. Are you clear? Now, he purchased 50 lakhs, 60 lakhs worth of bonds. What is its lock-in period? For 50 lakhs, 5 years lock-in period. For 10 lakhs worth of bond, no lock-in period, because this you didn't claim exemption. Am I right? Now, if this 50 lakhs worth of bonds are subsequently sold, you know what? This 50 lakhs worth of bonds, you know, within 5 years, he sold it, man. He sold it. Within 5 years, he sold it. For 60 lakhs, he sold it. What is its cost of acquisition? 50 lakhs. Okay, at that time he sold it for 60. Its original cost is 50. Therefore 10 lakhs is capital gain. Long term or short term depend upon the bond duration. If the bonds are held by you for more than 24 months and then sold, you bought the bonds, you know, originally, that you hold for 24 months and above and then sold, it's a long term. Okay, okay, you taxed it. But tell me, the same bonds, the bonds earlier you claimed exemption saying 5 years you will not sell. Now you sold it within 5 years. Earlier given exemption, long-term capital gain is taxable separately. Long-term capital gain is taxable separately. Whereas agricultural land concept we discussed, if at all new asset is sold within lock-in period, earlier given exemption will be reduced from cost while computing capital gains on new land. Yes or no? That logic will not apply here. Here it is taxable separately. Are you clear? Easy or not? Easy or not? Now, by the way, This 10 lakhs worth of bond also he sold again for 12 lakhs. What is its cost? 10 lakh. 2 lakhs is capital gains. It may be short term, long term, depending upon the 10 lakhs worth of bond holding period. Am I right? Easy or not? Over. 54 easy, over. Are you clear? Now let me discuss about 54. Let me discuss about 54. You know what? 54. Section 54. What section 54 says? In every asset, in every of these section, no, you are selling some asset, again you are buying some asset. Am I right? Yeah. Here, original asset transferred. What is the original asset transferred? House property. It is clearly mentioned residential house property. Clearly mentioned that it is residential house property. This section is available only for individual and HUF. This section is available only for individual and HUF. Able to understand? Remember, 54 easy, even partnership firms, LLPs, companies, anybody can claim. But 54B, individual and HUF. 54, individual and HUF, only them. Yes or no? That to which house? Residential property is the one you sold. What you sold is originally residential house. Asset type, only long-term capital asset. Asset type must be long-term capital asset. New asset, again it must be house property. New asset must also be house property. See, whether you buy new constructed house or old house, second hand house, doesn't matter. What you sold is house, you are buying again house. Yes or no? The new asset must be house property. Are you clear? Now, what is the time limit? What is the time limit? Very simple. You want to purchase a ready-made house, 2 years. You want to construct then 3 years from date of transfer. Now tell me immediately, since 2-3 years time limit is given, automatically capital gain account scheme is applicable. Am I right or not? But here, guess what? Generally, new asset we should buy after we sell the old asset. Am I right? New asset you should buy after we sell the old asset. Am I right? Am I right? But here there is one option given. Do one thing. It's a house property, right? Suppose you first bought one house. Okay? Then you sold the existing house. You bought one house recently, right? That also you can show it as investment under 54. You can show 1 year before transfer date. 1 year before transfer date. If at all, you recently purchased a new house just 1 year before new transfer date. Like today I transferred, in the past 1 year only I did Gruha Pravesham of one house. That is eligible for investment. You didn't have existing, then do one thing. You sold a house, right? Within 2 years you buy another house, or within 3 years you construct another house. Then I will give you exemption. Are you clear? So here new property can be purchased well in advance also. Correct? Huh? Here a new asset can be purchased in advance also. Am I right? Am I right? So this is eligible for exemption. Whatever amount here invested is eligible for exemption. Are you clear? How much amount? How much is the exemption? How much is the exemption? Very simple. Amount invested or long-term capital gain, whichever is lower. Maximum of 10 crore. Very important. Here there is a limit. Maximum exemption under section 54 cannot exceed 10 crore. That too. Okay, sir. This is investment time limit in new house, right? Yes or no? This is investment time limit in new house, right? Sir, can I purchase 2-3 houses? Can I purchase 2-3 houses? No. There is a limit. By the way, okay, look at, suppose no, if at all the capital gain is exceeding 2 crore, you sold a residential house, on that you got capital gain 5 crore, gain is 5 crore, then exemption is available on investment in only one house property, that too in India. By when you should invest in new house, by the way, you can purchase it. You can purchase it within 1 year before, or you can purchase it within 2 years after the date of transfer, or you can construct it within 3 years after the date of transfer. You can construct or purchase after within 2 or 3, or you can purchase it ready-made within 2 years, 1 year before the date of transport. Yes or no? Now, how many houses you can invest in? Only one house. New house must be only one. New house only must be one when your capital gains is more than 2 crore. If at all you are having a big capital gain, only invest in one house. How much ever you invest, that much I'll give you exemption. Suppose if your capital gain is small, if your capital gain does not exceed 2 crore, your actual gross capital gain is 2 crore or less than 2 crore, then you have one more option. You can buy happily 2 houses also and claim exemption for both the houses. By the way, time limit is same. Exemption is available on investment in 2 house properties in India. By when you can purchase them within 1 year before the date of transfer, or within 2 years after the date of transfer, or if you are constructing, it is within 2 years after the date of transfer. Now you can buy 2 houses right here, 2 houses, right? Guess what? If at all, for any particular assessment year, SSE purchased 2 houses and claimed exemption. In the lifetime of the SSE, he cannot use this option once again. In the lifetime of the SSE, he cannot use 2 houses purchase option once again. Only one time I will give you exemption for 2 houses at a time, provided the capital gain shall not exceed 2 crore. 2 crore. The gain amount shall not exceed 2 crore. Are you clear? The gain amount shall not exceed 2 crore. Look at, if the option to purchase or construct 2 houses option is exercised, the SSE cannot claim the benefit of 2 houses in any subsequent, which means again subsequently after 5 years, I sold 1 house, again I got a gain, I want to claim exemption under 54, buy only 1 house and claim exemption. Next time you can't buy once again 2 houses and claim exemption. Once in a lifetime of the SSE, 54 exemption is available, even though you are buying 2 houses at a time, provided the gross capital gain shall not exceed 2 crore. Are you clear? Yes or no? Now for example, you see, okay, I sold 1 house, full value of consideration 10 crore minus cost of acquisition 3 crore. My capital gain is 7 crore. Since my capital gain is more than 2 crore, I can only buy one house property within the time limit. Already, I bought 5 crore worth of house I bought. So balance capital gain is taxable. Are you clear? Yes or no? That's it. Then in the next year, what I did, in the next year, what I did, just 1 minute. Yeah. In the next year, what I did, I have one small house. Okay, I sold it for 2 crore, and what is its cost of acquisition? Long back I bought that one small house is there. Its cost of acquisition is 50 lakh. Therefore, capital gain is 1.5 crore. Now I want to construct 2 houses where my security people and all can stay. Okay, I want to buy 2 houses of small. Okay, since my capital gain is less than 2 crore, not exceeding 2 crore, and I bought 75 lakhs worth of 2 houses. Okay, I can claim happily exemption, and then balance is 0. Over. Again, year 3, third year again, I have another small house. Which I sold for 2 crore. Its cost of acquisition is 1 crore. Therefore, the balance capital gain is 1 crore. Now, since it is capital gain not exceeding, I want to buy 2 small houses for my security people again. Now 2 houses option are now buy 1 house only. Then I will do one thing. Entire 1 crore, I'll buy 1 house, so I'll claim exemption. 2 house exemption logic will not apply. But sell 1 house, buy 1 house. Sell 2 houses, buy 1 house. This logic, buying 1 house and claiming exemption, this you can do every year, no problem. Are you clear? Provided section conditions are satisfied. Are you clear? Now tell me, you are claiming exemption by investing in the new house, right? Lock-in period is 3 years. And tell me, you have time limit for 2 years in case of purchase, 3 years in case of construction, right? And capital gain account scheme logic is applicable. As per capital gain account scheme logic, what is the point? By the due date for filing IT return, if at all you didn't buy new house yet, exemption how much you want to claim, that much you deposit in capital gain account scheme, withdraw, and then within the respective time limit you use that money. Am I right? Now look at the example we have given here. What is the maximum exemption amount in the section? Lower of amount invested in the new house or long-term capital gain. Maximum exemption is gain amount. Subject to the maximum exemption shall not exceed 10 crore. Are you clear? Indirectly, most of the big shots were given a blow here. Most of the big shots who buy villas and then sell and buy another villa, for them all they can't claim exemption. Are you clear? Suppose a movie actor is there. He has a very big farmhouse which is 100 crore. Okay, he purchased it at 100 crore. After some 5-6 years he used and he sold it for 200 crore. Now he got 100 crore capital gain. Once upon a time, what they do, you know, they'll invest entire 100 plus another 100 crore, 200 crore and buy another farmhouse. Nothing, they pay zero tax. But now maximum exemption is 10 crore. That's how they gave a blow. Are you clear? All the exemptions, all the deductions are for common people, small and SSEs, not ultra rich high net worth individuals, not for them. Are you clear? Now lock-in period. What is lock-in period concept? If the new house is transferred before 3 years from the date of lock-in period. Lock-in period is 3 years. If at all you transfer within lock-in period, same 54 logic will apply. 54B, earlier given exemption will be retaxed. How it will be retaxed? Not separately. Earlier given exemption will be reduced. You see, capital gains on new asset transfer within lock-in period. First, full value of consideration how much? Minus transfer expense how much? Net consideration. What is its cost of acquisition? Amount invested minus earlier given exemption. Capital gains exempted earlier. You see, we are reducing here and balance only we are claiming. Yes or no? Then less cost of improvement on the new house if at all you did. Then balance will be the short-term capital gain or long-term capital gain or loss as the case may be for the new asset which is sold within lock-in period. Am I right? Yes or no? And if at all you're doing this value, no, indexation will be done on this value. But what I'm telling is now this concept is outdated because new asset right now 54 new asset you are buying in 25, 26, 27 years and you are selling it later, means there is no concept of indexation at all. So this point you strike off. Right now this point is irrelevant. Must strike off. Actually I should have done this earlier, but anyhow, since this point is there, we are able to recollect that point. Okay, next example. Suppose no, long-term capital gain is 2.05 crore. Oh, more than 2 crore. Yes or no? Then I can invest in only one house. And the SSE bought a new house which is 3 crore. Then how much is exempted? 2.05 crore will be exempted. Okay. If the new house was sold after 18 months, not, which means within 3 years, how much price? 5 crore. Then when you are computing capital gains, 5 crore minus cost of acquisition 3. Minus earlier given exemption 2, which means net cost of acquisition 95. Therefore 4.05 crore would be taxable. Easy or not? Over. Now what is capital gain account scheme? I mentioned, discuss it later, but I already told it. Yes or no? Example, sir, my long term capital gain 7 crore, sir. Since it is 7 crore, you can buy only one house, but he invested 12 crore ma. Then gain is 7 crore, investment is 12, but exemption amount is 7. Maximum exemption cannot exceed gain amount. Gain 12, investment is also 14, but maximum gain is 10. Gain 11, investment is 9, maximum 9. Yes or no? Investment is only 9, no, that's why. Gain is 15, investment is 13, maximum 10. Now capital gain account scheme related example. You see, this also we told. For example, I got a long term capital gain 8 crore ma. Construction expenditure 5 crore. Within the due date itself he expended ma. Within due date, actual original long term capital gain 8 crore. But he constructed within due date itself 5 crore he spent. Deposited in capital gain account scheme within due date 2 crore. Oh, directly incurred on the asset itself within the due date 5 plus deposit. Total 7 crore only within the due date he spent. How much exemption? 7. My gain is 14 crore. And guess what? Construction expenditure 7 crore within the due date, deposit 2 crore before the due date. So again here it is totally 7 plus 2, 9 you can claim exemption. Am I right? You can't claim exemption even after you buy house. Yes or no? That's it. So capital gain account scheme concept example, easy or not? Then 54B, that problem over. 54 EC you see. 54 EC you see. Okay. Who is eligible? Any SSE transferring long-term capital asset being immovable property, which may be residential, commercial, or even depreciable asset. Capital gain arising from transfer must be invested in specified bonds within 6 months from the date of transfer. What are specified bonds? We saw. Now the capital gain may be a long-term capital gain or it can be short-term. When short-term capital gain will come? Depreciable immovable property if you sell only short-term capital gain. Otherwise the asset must be long-term. Asset nature must be long-term, but the gain can be short-term or long-term. Quantum of exemption, lower of amount invested in the bonds or the capital gains, but maximum exemption cannot exceed 50. Suppose I am selling a residential house. I am selling a residential house. House only I sold, one house. 3 crore capital gain I got. And I bought one more house at 2.5 crore. Another 50 lakhs I bought bonds. Can I claim exemption under both 54 EC for the same transaction? Absolutely yes. You can sell one asset and you can claim exemption under multiple sections of 54 series, provided each section respective conditions if you satisfy, that's enough. 54 point of view, I sold house, now I bought house, exemption eligible. 54 EC point of view, I sold house, which is immovable property, now we are buying bonds, eligible for exemption, you see. Now, so 54, long term capital gain on sale of residential house, you are getting it. Investment in 1 or 2 houses, investment in bonds, exemption 54, exemption 54 EC. Here time limit 1 year before, 2 years, 3 years, here 6 months. Capital gain or maximum 10 crore, here capital gain or maximum 50 lakh. Am I right? That's it, nothing, not a big deal. In fact, on this there is a problem right now. We have a problem on this. You know, earlier, go to TYK questions. In that question number 7, I think we kept pending. Not 7, 6th one you see. Yeah, perfect. 6th question you see. Can I solve entire 6th question once again? I will solve entire 6th question once again. Okay. Question number 6 once again I will solve entirely. Look at. I already solved the 6th question, one part of the answer. But now once again I am solving it. Be careful. Okay. Now look at. I am proceeding. Miss Yuvika bought a vacant land. 1 minute. Yeah, we'll solve this. Yuvika bought a vacant land for 80 lakhs in May 2005, which means after 2001. So fair market value on 2001 concept will not apply. Registration and other expenses were 10% of the cost of the land. Oh, 80 lakhs plus 10%. She only is bare. So total cost of acquisition 88 lakh, land alone. She constructed a residential building on the said land for 100 lakh. This is cost of improvement. Yes or no? Next, she entered into an agreement for sale of the above residential house with Johar in 2015 April. Yes or no? The sale consideration was 700 lakhs, which is fixed, and Yuvika received 20 lakhs as advance in cash on agreement. However, due to failure on the part of Johar, the said negotiation could not materialize, and hence the said amount is forfeited. But since it is forfeited on or after 2014, this 20 lakhs is taxable under income from other sources, 56 subsection to clause number 9. Miss Yuvika again entered into agreement on latest year, 1st May 2025 agreement date for selling this house at 810 lakh, means actual consideration is 810 lakh. Yes or no? And she received 80 lakhs as advance by other than cash. Stamp duty value on the date of agreement was 890. So this stamp duty value only will apply because agreement is there. Advance is received by other than cash. So stamp duty value on the date of agreement will prevail. Yes or no? Next, the sale deed was executed on 14th July. Remember, agreement is on 1st May. Sale deed is on 14th July. So transfer is on 14th July. Both are coming within the same financial year. Transfer date, for us taxability purpose, transfer date is important, 14th July. So the transfer happened in 26 years. Yes or no? For agreed consideration, however, stamp valuation authority has revised the value, and the value of the stamp duty purpose was 900 lakhs on registration date. But this stamp duty value irrelevant for us. For us, which stamp duty value is applicable? 890. Okay. Miss Yuvika paid 1% brokerage on sale consideration received subsequent to sale. Okay. Now they are giving. Miss Yuvika made following investments. Okay. First I will compute capital gain, then I will look at the investment parts. Okay. Now first, what is full value of consideration? Stamp duty value is equal to 890 lakhs. Am I right? Which is more than 110% of actual consideration. 810, look at it, 810 actual consideration, stamp duty value 890. So 810 of 891 it will coming. Is stamp duty value 890 more than 891? No. Therefore the full value of consideration is actual consideration 810. Am I right or not? So fine, afresh I will take. Okay, the working is, you understood the working? No. Full value of consideration is 810 minus transfer expenses. Transfer expenses is how much? Yeah, 8.1 transfer expenses is 8.1. Am I right? Net consideration 1% of actual consideration. Actual is 110. Okay, how much it is? 801.9. Am I right? Minus Cost of acquisition. See, the sale is happened, the transfer happened on 14th July. After 23rd July, therefore no question of indexation concept, nothing. Acquisition cost is 88 lakh. Am I right? Huh? Improvement I'll reduce. Acquisition first I should reduce, then improvement. Then cost of improvement is how much? 100 lakh, yes or no? Therefore, what is the long-term capital gain? 801.9 minus 188 is equal to 613.9. Now you see, since the capital gain is more than 2 crore, you can claim exemption under 54 only by investing in one house. You can also claim 54 EC exemption, yes or no? 50 lakh. Now look at. Now she made the following investments. She acquired 2 residential houses at Delhi and Chandigarh for 130 lakh and 50 lakh respectively on, look at the dates, 31st January 2026 means 31st January means okay, one is 15th. Both are before due date for filing IT return. Oh, before filing, no need to go for CGS also. She directly bought. But any one house only she can claim exemption. 2 houses exemption she can't claim because gross capital gain in this case is more than 2 crore. I will claim bigger amount. Am I right? Minus section 54. One house property I will claim exemption. Yes or no? 130. Are you clear? Next. She acquired residential out at UK. UK property outside India. Only in India if you pay only you will get exemption. So this will not be considered. Yes or no? Subscribe to NHA capital gain bonds. By the way, 54 EC you must invest within 6 months. What is the date of transfer? 14th July 2025. 6 months means 13th August, September, 13th January 2026. 13th January before if you invest only you will get exemption. Now 13th January 50 lakh on 30th and 40 lakh on 9th January. Both are invested within 6 months. But maximum exemption is only 50 lakh. 54 EC maximum exemption is 50 lakh. Am I right? Is there any other exemption? That's it. Compute capital gains. They are asking. The choice of exemption must be most beneficial manner. Okay, no problem. Therefore, long-term capital gain taxable is 613.9 minus 130 minus 50 is equal to 433.9. Am I? Now look at the answer. See how easy? Yes or no? Gross answer 613 already we computed once this problem. So we got it. Now the net answer 433.9. 54 EC 50, 54, 130 over. The answer is over. Easy or not? Next. Question number 5. Question number 5 which is linked with LC. Question number 5. 54 only. This is also 54 only. Now tell me here how much is the capital gain we got. This we computed, remember 140. This we computed already. Since capital gain is within 2 crore, okay, you can invest in 2 houses. Now look at after recovering sale proceeds. Okay, I'm not solving full problem again because I already solved it. Okay, he purchased 2 houses. Yeah, one is in Karpur on 24th March within the due date. Another one is also 35 lakhs within the due date. Both put together 55. Happily you can claim 55 lakhs exemption. Therefore balance long-term capital gain chargeable tax is 85. Answer over. Whatever we kept pending in 5 and 6 problem fully solved. Easy or not? Now we'll see 4th problem. Is there a 4th problem? Nothing. That's it. Major problems is over. Now we are still left with 54D, 54F, and there is a one section, time limit section called 54H. Once we discuss that major portion, 99% of the capital gains is technically speaking over. Then theory reading is pending. That will come back and then finish. Clear? That's it. We'll continue in the next session. Okay. Now let's continue another section of exemption under capital gains, that is 54D. There is actually 54F, but 54F, no, the capital gain exemption computation is slightly different. So first I will discuss 54D. In all these cases exemption computation is somewhat similar. 54D. 54D is what, very simple, straight. I'll not write, I'll directly explain. Okay, what you're actually doing, compulsory acquisition of land and building of an industrial undertaking. By the way, 54 EC, I just wanted to give one clarification. Immovable property. Immovable property means what? It may be only land or it may be only building that you are transferring, or you are transferring both, doesn't matter. Okay, if it is, that's why I simply gave the word immovable property. Immovable property includes all, yes or no? That's it. Now let's go back to 54D. So what is this here? Compulsory acquisition. How the SS is transferring the property? Compulsory acquisition. That to what? Compulsory acquisition of land and building of an industrial undertaking. Means you are manufacturing land and building. The land and building where you do manufacturing activity. Are you clear? And that land and building is compulsorily acquired by government. Then you get capital gains rate. If it is compulsory acquisition, 45 subsection 5. Remember, in the year of receiving compensation, we compute, in the year of receiving compensation, we compute the capital gains, yes or no, and tax it. Now, since capital gain is there, it is liable for tax. You can get exemption if you buy another industrial land and building. Are you clear? Here what you transferred? Industrial land and building you transferred. In what method of transfer? Compulsory acquisition you transferred. Normal, if you transfer, this section will not apply. If at all you are transferring normal, it will not apply. That too, if you remember, what you are transferring is industrial land and building, which means capital gains has to be computed for land separately, capital gains has to be computed for building separately. Why? Because industrial building means it's part of block of asset. Yes or no? And since it is part of block of asset, and if that is the only asset in the block, if block ceases to exist, whatever amount you received might be either a short-term capital gain or short-term capital loss. Yes or no? Here the asset can be long-term or short-term. Anything it can be, no problem at all. Okay. Now, so eligible SSC, who is eligible? Any SSC transferring industrial land or industrial building or both under compulsory acquisition. Are you getting it? The transferred property can be either short term or long term. Only where you have to invest, the SSC must purchase or construct another industrial land or building within 3 years. Directly 3 years. Even if you want to buy 3 years, even if you want to construct 3 years. Are you clear? How much exempted? How much amount is exempted? Amount invested or the capital gain, whichever is lower. Is there a lock-in period? Yes. For the new industrial land and building that you buy, 3 years lock-in period. If at all you transferred it within lock-in period, retaxation also similar to this one. Lock-in period concept entirely same, means retaxation is also same. How retaxation? Earlier given exemption will be reduced from cost of acquisition while we are computing capital gains on the asset, new asset transferred within lock-in period. Am I right? Here also agricultural land condition is there. What agricultural land? Asset must have been used for industrial purpose for 2 years preceding the date of transfer. This fellow who transferred under compulsory acquisition should have used that building for industrial purpose for at least 2 years preceding the transfer. Are you clear? Now, industrial, this is applicable for any SSC. Are you clear? Next, now in entire 54 series, if you observe, for some assets they say long term, some assets they say short term, some assets all that. Don't worry, comparative analysis I will tell you. Don't worry, it will be easy for you. Okay. Next, then we have the next section, 54F. What is it? 54F. What is 54F? You see what they are transferring? Asset transferred is transfer of any long-term capital asset other than residential house property. See, if at all you are transferring originally residential house, then you are having exemption under 54 and 54 EC. Both options were there. But here you are transferring any long-term. Remember, what you are transferring is any long-term capital asset other than residential house. Now, if you observe 54, you see 54 EC and 54F. This is one segment. 54B and 54D is one segment according to me. Okay. For some common conditions, here original asset must be long-term capital asset. Are you clear? Here original asset can be long-term capital asset or short-term capital asset. Are you clear? That's a basic difference. Are you clear? Again, between 54 and 54 EC and 54F and between remaining sections, okay, 54F alone is little different. 54 EC, 54B, 54D, in all these sections, amount how much exempted? Whatever amount invested is exempted, or maximum capital gain, whichever is lower. So easy. But in 54F, how the exemption, first For example, see 54F, I have not yet explained anything, but I'm just telling you how exemption we calculate here. Okay. For example, full value of consideration is, let us assume 20 crore minus cost of acquisition and cost of improvement. If you reduce, for example, let us assume, okay, let me not take 20 also, let me take 5 crore. Okay, acquisition cost, improvement cost is how much, 4 crore. And what is the long term capital gain? Why I'm saying long term capital gain? Because the asset must be transferred is long term. Okay, therefore the amount of capital gain is 1 crore. Tell me, if at all I am investing under 54, if I have to get 1 crore exemption, how much I should invest? Normally, until now what we discussed, if I have to get 1 crore exemption, investment should also be 1 crore. How much ever amount invested or capital gain, whichever is lower. So amount invested straight away taken for exemption computation. Am I right? But here in 54F, original asset you are transferring is any capital asset other than house property. Okay. And guess what? The new asset you are buying under 54F must be house property. The new asset that you are buying must be, there is a difference between immovable property and house property. House property is a very narrow term, residential house property. Immovable property means very wider. It may be residential, it may be commercial, it may be land, it may be building, or it may be both. Are you clear? Able to understand? Under 54F, the new asset you should purchase is what? Residential house property. That too, exemption, how they will calculate, in this problem if you see, if I want to get 1 crore exemption, I have to invest entire net consideration. Only then I get full capital gain exemption. What do you mean by that? For example, in this problem, SSE bought 2.5 crore worth of house property. Here full value of consideration itself is net consideration. For the sake of convenience, I'm just taking. Okay, there is no transfer expenditure. Okay, fine. SSE invested 2.5 crore worth of the house within the time limit. Okay, within the due date for filing IT return, he has invested in 2.5 crore. By the way, he need to buy house property, right? What is the time limit? Same, 1 year before transfer date, 2 years after transfer date in case of purchase, 3 years after transfer date in case of construction. Same like 54 limit, no change at all. But suppose you invested just 2.5 crore, then how much you get exemption? Now how much of consideration you invested? 50% only invested. Then capital gain also 50% only exempt. 50 lakh is taxable. Like, what does it mean? Here exemption under section 54F is equal to, what is the long term capital gain? Identify 1 crore. How much is amount invested divided by net consideration? This is the proportion. What is it? This is the proportion. For example, right now 1 crore, amount invested 2.5 crore divided by net consideration 50 crore. Therefore, exemption is 50 lakh. Which means if amount invested and net consideration both are equal, then full gain is exempted. Are you clear? Okay. Now here again, maximum exemption cannot exceed 10 crore. Wrong. That's not maximum exemption point. A maximum amount invested more than 10 crore shall be ignored. People, many 54F, they misinterpret. It's not about exemption. It's investment in house property value shall not exceed 10 crore. The amount invested in house property exceeding 10 crore shall be ignored. But in 54 also the same wording. Amount invested exceeding 10 crore shall be ignored. But in 54, amount invested itself I will get exemption, right? Therefore, maximum exemption 10 crore logic is that the way you can interpret maximum exemption cannot exceed 10 crore. That interpretation is correct in case of 54. But the same interpretation you can't take it here. In both the cases, how the section is drafted, they never said exemption is restricted to 10 crore. They never said that. In 54, what they told, amount invested in house property more than 10 crore shall be ignored. Oh, amount invested more than 10 crore ignored means, for example, if I have a long-term capital gain, as per 54 calculation, if I have a long-term capital gain of 20 crore, even if I buy a new house with 20 crore, I have to ignore beyond 10 crore, right? Yes or no? My new house value 20, but amount beyond 10 I have to ignore it, right? Therefore, maximum exemption in this case, how much it is? 10 crore. That's how the interpretation came like that. But in the section, in the act, they never said exemption is restricted to 10 crore. They never said that. The amount invested beyond 10, don't consider, they said. The same logic is what here also they said. The amount invested beyond 10, don't consider. Are you clear? Now look at one example, I'll show you. Look at, for example, full value of consideration 20 crore. What is the full value of consideration? 20 crore minus cost of acquisition and cost of improvement, that is 10 crore. And I got a profit of 10 crore. Actually, what I sold, some long-term capital asset other than house property I sold. Example, a jewelry I sold. I sold what? My jewelry I sold for 20 crore, where cost of acquisition is how much? 10 crore. I got a profit of how much? 10 crore. Long-term capital gain is how much? 10 crore. Minus what the SSC did, entire 20 crore he bought. He invested in house property. Entire 20 crore he invested in house property. What many students will do, biggest mistake I will tell you here. What many students do is 10 crore capital gain into the amount invested 20 crore, net consideration 20 crore, 10 crore. Oh, exemption is only 10 crore, no. Therefore, 54F answer is right. They will think wrong. Amount invested, this cannot exceed 10 crore. Be careful. This is how the interpretation will make you mistake. Are you getting it? Wrong interpretation will make you mistake. So maximum amount invested beyond 10 crore you should not consider. Am I right or not? So 10 crore is the capital gain. Amount invested beyond 10 crore I'll ignore. So up to 10 crore only I'll consider. Divided by 20. So how much exemption? 5 crore. Yeah, this is how it is. In the first case, if at all 20 by 20, 10 crore. 54F exemption limit also 10 crore. It is not exemption limit, my dear. It's investment limit. In the new property, how much maximum you can invest, that is the investment limit. Are you clear? Therefore, balance is taxable. Now look at here clearly. You see, I clearly gave the word you see here. Any amount invested is considered only up to 10 crore. Are you clear? Whereas, if you see in 54, if you see in the 54 section, I might have given some other wordings. Maximum exemption shall not exceed 10 crore. Here, this wordings are acceptable. Actually, in the section, they didn't say that maximum exemption 10 crore. They said amount invested in excess of 10 crore shall be ignored. Indirectly in 54, amount invested itself you can claim exemption, no. Therefore, beyond 10 crore investment you will not consider, means indirectly exemption you are restricting it to 10 crore. Are you clear? This interpretation drawing is correct here. But the same interpretation you cannot draw in 54F, because in 54F, amount invested in proportion to net consideration. Here exemption is calculated what? Amount invested in proportion to net consideration. So in this proportion, gain is exempted. Your gain is exempt how much? Proportionately only exempt. How much exempted? Investment divided by net consideration. Okay, investment I did 20. No. Again, investment 20 crore will not be considered. Maximum investment considered is how much? 10 crore. Are you clear? Able to understand? Now tell me, since here also time limit is 2 years for purchase, construction 3 years, can I say capital gain account scheme is applicable? Yes or no? Yes or no? So suppose original asset you sold is some long term asset, not house property. New asset that you have to buy is what? House property. Are you clear? Now CGA scheme is applicable. Am I right or not? Suppose SSC wanted to claim, for example, full value of consideration 20 crore minus look at cost of acquisition and all 10 crore. Then what is the long term capital gain? 10 crore. Are you clear? Minus maximum investment, how much you can make? Actually 10 crore. Therefore SSC also making 10 crore only investment. 10 divided by 20 is equal to 5 crore exemption he claimed. 5 crore he paid tax. Now this 10 crore, what is the amount he wanted to invest? 10 crore. This 10 crore he deposited in capital gain account scheme. He deposited in capital gain account scheme. And what he need to do? He need to withdraw. He need to withdraw within 2 years or 3 years as the case may be, and then buy the new house. Yes or no? Now he bought, everything is fine, but after 3 years is over, no? Okay, what happened is in capital gain account scheme 2 crore is unutilized. What is it? 2 crore is unutilized. Are you clear? How much is taxable? Do you tax entire 2 crore? No. See, when you deposited 10 crore, how much exemption you claim? 5 crore only. Means amount deposited to exemption claimed is 50% ratio. Am I right? 2 crore left, which means how much is it taxable? 1 crore. Here the same thing can be computed again. Capital gain how much originally? Original capital gain how much? 10 crore. How much amount amount not utilized? Amount unutilized 2 crore. What is the net consideration? 20. How much is that? 1 crore is taxable. So how much of the unutilized amount is taxable? Very simple. Long term capital gain take into amount you unutilized how much? Amount unutilized how much? 2 crore divided by net consideration how much? 20. That much only taxable. Are you clear? Able to understand? Again further remember, sometimes in this case also amount we could have deposited more than 20 crore. We would have deposited more than 10 crore. Suppose SSC deposited 20 crore. But in this, only 10 crore worth only related amount he claimed exemption. Yes or no? Suppose here unutilized is more than 10. Suppose unutilized is more than 10 only, I will retaxation will apply. Suppose if unutilized is up to 10, there is no retaxation. Why? Out of 20, 10 is utilized ultimately, and we claimed only based on 10 exemption, right? So remaining 10 unutilized, which is on which exemption also I didn't claim earlier. Yes or no? That's it. Again, here also, new house you bought, right? That has a lock-in period of 3 years. That has a lock-in period of 3 years. Now, if the new house, what is it? If the new house is transferred within lock-in period, how to calculate how to retax it? Here, retaxation is done separately. Here, retaxation is done separately. For example, suppose new house, I sold within lock-in period. Now, the new house, I sold it within 3 years. Exactly in third year I sold. Means after 24 months of purchasing new house I sold. Full value of consideration. I bought the new house for, let us assume, 10 crore. What is the house I bought for? 10 crore. New house I sold for 15 crore. Minus what is cost of acquisition? 10 crore. Because I invested how much here? 10 crore. Hello? Yes or no? So what is the capital gain? 5 crore. Are you getting it? This is long term capital gain on new asset. That too, since this asset is sold within lock-in period. Earlier, how much exemption you got because of this? 5 crore. This 5 crore is taxable separately as long-term capital gain in the year in which lock-in period concept is breached. So this is taxable separately. It is not like reduce it from cost of acquisition. That logic is not there. If you observe 54EC and 54F, if the new assets are sold within lock-in period, they are taxable separately. Whereas in remaining all other sections, if the new asset is sold within lock-in period, they need to be reduced from cost of acquisition while calculating capital gain on transfer of the new asset within the lock-in period. Am I right? That's it. 54F majorly over. Still not over. Conditions. One more condition is there here. In 54F. Now what is 54F? Now let us understand 54F. I told you the theme of 54F. Now let us understand the content inside the 54F. Okay, like what is there in the 54F? Look at it. There are some new conditions brought here. There are some new conditions. Now, by the way, first, what you are transferring originally? I am transferring originally. What asset, ma? Yeah, I am transferring originally long-term capital asset other than residential house property. Like I may be selling only land. That's not house property. Or I may be selling jewelry, or I may be selling listed shares, I may be selling listed bonds, I may be selling debentures, I may be selling sovereign gold bonds, anything, any long-term capital asset. Now look at eligible. Again, this section is available only for individual or HUF. Okay. Now 54, 54B, 54F, these three sections are eligible only for individual or HUF, whereas 54EC, 54D, 54 that's it. These two sections are eligible for any SSC. Are you clear? Next, new asset. What is a new asset? Investment in how many houses, ma? Only one house property in India. When you should invest? Either purchase within 1 year before or 2 years after the date, or construct within 3 years after the date of transfer. Next, the most important condition, two more new conditions are added. The SSC must not own more than one residential house on the date of transfer. On the date of transfer, you should not have more than one house. Are you clear? On the date of transfer, you should not have more than one house, which means you are going to buy one more house, right? That should be maximum your second house. That should be maximum your second house. Today I told jewelry. On this date I'm already having one own house. Now I want to invest in another house. That should be my second property. Here now there is a twist. One student asked me a doubt. Sir, here we get exemption for purchase of the property 1 year before, right? For example, when I'm selling the jewelry, I have two houses already. Out of this, one house I bought it specifically for exemption purpose. 1 year in advance I bought. Another house is something which I already own it. Can I still claim exemption for 54F? Because on the date of selling the jewelry, I'm having two houses. On the date of selling the jewelry, I'm having two houses. One house is something which I have long back. Another house is what, I recently bought it for the purpose of claiming exemption under 54F. Because the section allows one house I can buy in advance, that house I bought, sir. This house is something which I already have old one. Now I can buy second house, that second house is what I already bought. Now, if you literally see this section, on date of sale of jewelry, I should not have more than one. But in my case, I have two, no. Can I still claim exemption? Yes. Why? Excluding this one house must be excluding the house that you are going to claim exemption. Am I right? Excluding the house that you are investing, no. Excluding that, you can have one only existing. Right now I'm having two. Within that one I'm claiming exemption. For that reason I have. So typically speaking, one only. Are you clear? Yes or no? Do you understand? Suppose if the SSC kept one house in advance and kept it along with already is having one house. This is just a second house which they bought for exemption purpose. They bought advance. They bought. Now they sold jewelry. On the date of sale of jewelry, he is having two houses. Does it mean do I violate this condition? No, my dear, because you are having two. One is your own house already. This another one you bought only in advance for exemption calculation, right? So which means you have deemed to be complied. Are you clear? Yes or no? Further. Yeah, further. There is one more condition. Fine, sir. I'm already having one house. Now I am purchasing one more house, sir. Within 2 years or 3 years or 1 year advance, I purchased it, sir. I claimed exemption, sir. Finally, I claimed exemption. After claiming exemption, you claimed exemption, which means second house also you bought. You bought house and then claimed exemption. Again, you should not buy one more house. Third house you should not buy. What is it? Again, the SSE must not purchase another house property within 2 years or do not construct another house within 3 years from the date of original transfer. See, jewelry I sold it on 1st October 2025. Are you clear? On this date I am having only one house property. Now I want to buy second house where I want to claim 54F exemption. This second house I might have bought 1 year in advance or within 2 years or 3 years, and I'm going to buy and claim exemption. Okay, you claim exemption, happy. From the same date you bought this within 2 or 3 years and then claimed exemption. You're going to claim, right? Claim it, don't worry. After claiming exemption, again don't buy one more house. In this example, that is third house. Do not buy. Are you clear? Another house. Do not buy another house within 2 years or do not buy another house within 3 years. Construction in 3 years. Sir, what will happen, sir, if I buy one more house? Nothing. Earlier given exemption will be retaxable. Because you violated this condition. First thing, what you sold is other than house property. You are buying house property. Exemption is equal to gain multiplied by investment divided by net consideration. Investment anything above 10 crore I will not consider. So this is the exemption way calculation. Am I right? Then once exemption is calculated, okay, do not buy another house for 2 years. Do not construct another for 3 years. That's it, over. Now to claim exemption, on the date of buying exemption house, no, you should not be having more than one house. That's it. Are you clear? Over. Provision over. So lock-in period. If the new house is transferred within 3 years, the capital gains exempt earlier under 54 will be retaxable as long-term capital gains separately. Are you clear? Further, retaxation for failure to comply with conditions. Suppose if at all you buy another residential house, purchased in 2 years or constructed within 3 years of transferring original asset, the capital gain exempt earlier will become again taxable as capital gain in the year of purchase or construction. Generally, we get capital gains when we sell. But here, when you purchase also, you are getting capital gain. How you are getting capital gain here? Because you violated. When you purchase or construct another property, it's a violation. Automatically, earlier given exemption is retaxed. That's it. Capital gain account scheme, I already told. Clear? Now look at net consideration 15 crore. Okay? Long term capital gain 7.5. House, new house is 12. But I will not give that much exemption. 7.5 into 10 only I will consider, divided by net. Therefore 5 crore exemption. Okay? 20 crore. Long term 12 crore. House is 15. Very simple. 12 into 10 divided by 20. Am I right? Yes. Here 12 into 8 by 16. Yes, 8 I can do. 8 by 16. 6 into 10 by 10. So entire 6 crore. 6 into 10 by 12. Yes or no? 5 crore. Am I right? Because amount invested beyond 10 I will always ignore. Easy? That's it. With this 54F is also completed. Easy or not? We don't have any problem. I already gave you the problem. With the numbers, all that I already made you understand. Clear? Now look at. Now capital gain account scheme. What is it? Capital gain account scheme. It applies to all the sections except 54EC. The logic, 54EC time limit is just 6 months from date of transfer. So no. Capital gain must be invested, or as per 54F, net consideration must be invested. Yes or no? Within the specified assets, or you must invest in direct capital gain account scheme within due date. Either in the specified asset you buy happily by the due date. You didn't buy, you want to utilize time limit, then do one thing, deposit in capital gain. If investment in new asset is not made before due date, then capital gain or net consideration, deposit in capital gain account scheme. For 54F, gain exceeding 10 crore are excluded from capital gain account scheme. Yes or no? For 54F, net consideration exceeding 10 crore is excluded. No. Amount invested is right word. Amount invested exceeding 10 crore. That's the right word actually, not net consideration. It's wrong. It's actually amount invested. It's actually what? Amount invested exceeding 10 crore. Amount invested exceeding 10 crore is the right word. Okay. What is the deemed cost of asset? The sum of amount already utilized for purchase or construction and the amount deposited in capital gain account scheme within 139(1). Within the due date, no, you might have bought new asset. Suppose no SSC what he did, no, first he bought land immediately within due date. And for construction of the building, he deposited some amount in capital gain account scheme. Then land cost plus deposit, both put together, you can use it for calculating exemption. Proof requirement, proof of deposit under CGS must be attached with IT return. Utilization of deposit, that deposit can be withdrawn only for the specified purpose. What is the consequence of non-utilization? If the deposit is not utilized within 2 years for purchase or within 3 years for construction, the unutilized amount is treated as capital gain in the year in which period 3 years expires, 3 years or 2 years. For 54F, the taxable amount is calculated proportionately. What proportion? Long-term capital gain into you claimed exemption amount invested divided by net, that is exemption. Here amount unutilized is the numerator divided by net consideration. Yes or no? That's it. So here for 54F, taxable amount is equal to long term capital gain multiplied by amount unutilized divided by net consideration. This is taxable to this proportion, because you claimed exemption in investment proportion, so automatically unutilized means which is not invested, so in the same proportion it should be taxed. Are you clear? Next, unutilized amounts is taxed only to the extent exemption claimed. Correct? Sometimes what happened, you might have deposited more amount in capital gain account scheme. Whatever in capital gain account scheme amount is there, you can't blindly tax it. Did I claim exemption on that or not? You should check out. Exemption claimed unutilized amount is only taxable. Yes or no? Yes. Treatment in case of death of depositor. Unutilized amount is not taxable in the hands of legal heirs. For example, the original owner who deposited capital gain account scheme and he didn't utilize it because he died, and legal heirs is withdrawing the money, nothing is taxable. In the hands of legal heirs, nothing is taxable. But remember, if at all it's a compulsory acquisition and legal heirs are receiving enhanced compensation, it is taxable in the hands of legal heirs. But unutilized amount taxability is not there. Are you clear? Because it forms part of estate of the deceased individual. Are you clear? This is 54F capital gain account scheme 54. Are you clear? 54D. Confident? Now, now look at, there is a concept called extension of time for acquiring new asset 54H. This is regarding time limit. Tell me, in all the assets, in all the cases. For example, my land is compulsorily acquired. Under compulsory acquisition, my land is taken. Normal land, not urban land. If it is urban land, exemption is there. Normal land is compulsory acquisition, they have taken. 23-24 year they have taken. And in 25-26 only they released me compensation. So in this year only I will compute compensation, capital gain, everything. Am I right? Now what is compulsory acquired is my land. Now I want to invest the amount received in house property, and I want to claim 54F exemption. What I want to claim? 54F exemption I want to claim, or maybe I want to claim 54EC exemption. For time limit, no. Time limit is counted from 6 months from the date of transfer. Array, transfer happened in 23-24, compulsory acquisition. In case of compulsory acquisition, what is the transfer date? Compulsory acquisition date is transfer date. Am I right or not? Sir, I received compensation in 25-26 only. How can I invest within transfer 6 months date? Is it possible for me? No. See, generally investment times are computed from transfer date. But in case if the capital gains are computed out of compulsory acquisition, where capital gains computed in the year in which it is received, then when compensation is received from that date, 3 years, 2 years, 6 months time limit will be counted. Logical? If you apply the strict logic transfer date onwards, without receiving money, how can I invest? Which is unfair, yes or no? So for compulsory acquisition cases, conversion of capital asset into stock in trade case, where year of transfer is one, whereas year of taxability is some other year where amount is ultimately realized. In these cases, time limit will be counted from year of realizing the money, not from the original transfer date. Are you clear? That's it. This you see. What is the key provision? This provision is mainly applicable when this provision 54H is applicable when this is relevant when in case of compulsory acquisition of original assets. If the compensation for compulsory acquisition is not received in the date of transfer, then the time limit for acquiring new asset for depositing will be extended. The period of making investment under these sections starts from the date of receipt of compensation, not date of transfer. Then sir, what about conversion of capital asset into stock in trade, sir? What about this, sir? In this also conversion is transfer date, but ultimately I am selling it in later year. Here also date of sale of stock in trade is there, right? From that date the time limit will be applicable. Where this is clarified, sir? Through a circular it is clarified. Are you clear? Through a circular which is not kept in our syllabus. Confident everybody? Yes or no? That's it. Major provisions are completed. Now let's once go back to question bank. Let's look at, is there any pending question? TYK open ma? I think all questions completed, no? TYK all are over, huh? Just see, up to 7th question we did. I remember up to 7th question we did. 4th one over. Okay, 5th one also we completed. Yes or no? This also we did right now. Yes or no? 5, 6 one also fully done. Am I right? We fully did 6th one also. Yes. Then 7th one also. 7th one exemption is not there, first of all. Okay. Then 8th one. Wow. 112A related question is there. Why I missed this? I should not miss this. No, I should not have missed actually. It's okay. We'll do it. 8th one will do it. Okay. No problem. 8th one I will do it. Okay. That's it. 8th question. Shall we do it? Fine. I'll stop this video because this is different, whereas this is a problem on 1128 111A question. Okay. Shall we? Yes. Fine. Next one. Question number 8. This is actually 112A or 111A related problem which we missed to solve earlier. Okay. But on 112A 111A tax computation illustration 13 we solved already. Remember non-resident, resident case, all that. And now let us solve this also. Determine the capital gain or loss on transfer of listed equity shares STT paid both at the time of acquisition and transfer of shares. For shares STT must be paid at both the times, whereas Equity oriented mutual funds, STT paid at the time of transfer of asset, that is enough. Yes or no? For assessment year 26-27, and compute tax also if any payable thereon in the following cases, assuming that these are the only transactions covered under 112A during the year. So only these transactions, two transactions were executed. One is, you see, shares, another one units. Fine, it's okay. Units will take. Are you clear? Units will take. Now, next. First shares I will compute. Mr. Shugan purchased 300 shares in A Limited on 20th May 2017. Are listed shares were bought before 31st, on or before 1st February. Yes or no? Before 1st February 2018 he bought. Yes or no? Remember that higher of A or B. Again lower of 1 and 2. Again between A and B higher of whichever is higher. Yes or no? So he bought at the cost of 400 per share. He sold all the shares on 31st May for 1200 rupees. Okay, fine. Let me do computation. Okay, I'm straight away doing. Okay, so what is the full value of consideration? 1200. What is the full value of consideration? 1200. Okay. Yes or no? Now minus the price at which these shares were traded in National Stock Exchange as on 31st January is as below. Highest price we should take. Yes or no? Now what is the cost of acquisition? What is the cost of acquisition? Note number 1 I will write. Note number 1 is equal to A or B, whichever is higher. Yes or no? Again within B, lower of 1 or 2. Yes or no? One is FMV on 31st January 2018 and another one is full value of consideration. Yes or no? Now A is actual cost. Here 2001 logic will not apply, original cost only. Actual cost is what ma? 400 rupees. Yes or no? 400 rupees. Now fair market value is what? 700 rupees. Yes or no? Full value of consideration, you sold it for what price? 1200 rupees. Whichever is lower, this. Now between these two, whichever is higher, 700 is the answer. Am I right? 700. By the way, is there any brokerage and all income? Nothing. 700. Yes or no? Therefore capital gain is 500 rupees. Am I right? Into how many shares ma? 300 shares. Therefore 500 1,50,000. Yes or no? Let's look at the answer. Let's look at the answer. That's it. So total long term capital gain is how much ma? 1,50,000. Am I right? Yes or no? Now then units he purchased. For units, no, what value you should take? Once I will open the book and then show you. Yeah, remember, for CAClasses listed on stock exchange, for shares, no, we should take what ma? Highest price quoted. Just now we computed 700 is highest price quoted, we took. Yes or no? If at all you are selling units, no, okay, which are not listed on any stock exchange as on 31st January. If at all stock exchange, see, generally if the asset is listed on the day, highest price I will take. If the units, no, suppose if at all unit that is not listed on 31st March, on 31st January, on any date, then you should take NAV of that on that date. See, if at all it is listed, no, then I will take quoted price, happily highest traded price I will take. But if it is not listed, then what I will take? NAV I will take. Now again go back here, that point only tested here, you see. Mr. Raj purchased 200 units of equity oriented fund, okay, which is fund A 1st February 2017 at a cost of 550 per unit. Yes or no? The units were not listed at the time of purchase. Subsequently, fund A were listed on 1st January 2018. Are you clear? Okay. On National Stock Exchange, Mr. Raj sold all the units on 3rd April 2025 for 900. The details relating to quoted price on stock exchange NAV were given. Highest traded price on 750. I think it is listed on the day 750. You can happily take. Yes or no? Yeah, you can happily take what price ma? 750. Because no, here okay, I thought NAV might be tested, but NAV they didn't test. Yes or no? If the units are unlisted as on 31st March, then I will take NAV. But if the funds are listed on 31st January, I will take highest trading price. But in the given case, no, 1st January 2018 units got listed. Yes or no? You see here, 1st January units got listed. That's why I will ignore a net asset value. This point I'll ignore. I will directly take highest trading price. Now look at. So first, full value of consideration. Units are sold ultimately for what price ma? He sold all the units on 3rd April for 900. Yes or no? Minus cost of acquisition, note number 1. Now note number 1, higher of A or B. A, actual cost is equal to actual cost how much ma'am? 550 rupees, correct? 550. Now B, lower of 1 or 2. 1 is what? Fair market value on 31st January. Yes or no? Here fair market value you should take, not NAV you should take. Yes or no? Fair market value means again two meanings, highest trading price or NAV. Highest trading price when if it is listed on 31st January. If at all not listed on 31st January, yes or no, then I will take NAV. In this case, in the problem, 1st January itself it got listed, so highest trading price I will take. Highest trading price is what on the 31st January? 750. Yes or no? Or sale consideration 900, whichever is lower, 750. Again 750, 550, whichever is higher, 750. Yes or no? Therefore capital gain is 150 into 200 units. Totally he sold how many units ma? 200. Therefore 3 lakh. Yes or no? Sorry, 30,000 rupees. What is the capital gain? 30,000 only, no? Yeah, 30,000 rupees. Are you clear? Yes or no? That's it. The answer over. See, but this question, if the same question comes in exam, no, you need to write provision everything, right? You need to write provision everything. Yes or no? They will ask you for minimum 6 marks question. Are you confident? MCQs also they can give you. Each of this is given as an MCQ. 2 marks MCQ, 4 marks you might get. Confident. That's it. That's it. So suppose no, see what you are saying, if at all capital asset is listed on 31st January, which capital asset? It may be equity share, equity oriented fund, or unit of business trust. On this date if it is listed, highest trading price happily I will take. Suppose if it is a unit not listed on that date, then I will take NAV. Suppose if it is share not listed on that date, 31st January it is not listed, but subsequently it was listed at the time of sale. That time what is cost of acquisition, market value, fair market value, how will you compute? Not the trading price, because no, on 31st January it is not listed, so there is no trading price available. I should calculate market value separately. How I will calculate? Original cost you take, multiplied by 1780 inflation number you take, divided by year in which first held, that year inflation number, that year inflation number, base year, base year in the sense that whenever you first purchased inflation, so market value will be indexed value. Are you clear? This is when if it is an equity share, today you sold, hello, today you sold, STT paid, and earlier equity share as on 31st January it was not listed. Are you clear? That time this is how cost has to be computed. Extreme rare scenario. Are you clear? That's it. But remember, so which is equity share not listed on 31st but listed on the date of transfer. When you are selling it is already listed. Again not listed but obtained through 47 transaction, later listed. Listed on the date of transfer, acquired under 47 modes. That's it entirely. Are you clear? That's it. Confident. Amma. And remember cost of improvement point. I'll just close it off here because I think something is missing here, highlighting. What is cost of improvement? For any capital asset you take cost of improvement cost incurred before 1st April 2001 nil. Whether you incur or previous owner incur, doesn't matter. If improvement cost is incurred by previous owner on or after 1st April 2001 and you got the asset under circumstances given under 49 subsection 1, cost to previous owner. Improvement cost incurred by the SSC, actual cost. Cost of improvement does not include routine repairs, maintenance, or any expenditure deductible under other heads. Are you clear? Repairs and maintenance and all is not a cost of improvement. Are you confident? Now let us look at cost of acquisition, some other provisions. By the way, what is the capital asset received? What is the capital asset received? I will do one thing. I'll conclude this video. In the next video, I'll just put as exclusive video for all theory reading. Can I? I think all the problems completed. Just look at once. Illustrations also completed. All the illustrations. Just open and see which illustrations are pending. Which illustrations? TYK fully done. And I'm telling you, only from this book you will get the questions on capital gains. Trust me, maximum all models they only covered. Beyond that, in the class I gave even more higher number of example. Liquidation we did problem. Buyback we did problem. Everything we did problems. Yes or no, with the dummy numbers. Illustration 13 over, am I right? Then illustration 12. Okay, easy. Illustration 11, can I do it? I'll do problems, okay? Yeah, I'll continue. Mr. C purchased a residential house on July 20, 2023, July 20, 2023 for 10 lakh rupees and made some additions to the house 2 lakhs in August 2023. Cost of improvement. He sold the house in April 2025, less than 24 months. Yes or no? It's not a long term capital asset. 54 exemption will not come. 54 EC will not come. Yes or no? Next up, for 20 lakhs, out of the sale, he spent 5 lakhs to purchase another house. Another house he purchased within due date, irrelevant. Why? Because, what is the sale value of the house? 20. What is the purchase cost? 10. 20 lakh minus 10 lakh, it's a short-term capital gain. Directly 10 lakhs is a short-term capital gain, short-term capital asset. Now here, if you remember, tax computation, they didn't ask. Okay, now they're asking what is the amount of capital gains taxable in the hands of C for the assessment year. How much it is? Oh, improvement is also there. Sorry, I missed improvement. Improvement is the 2 lakhs. So what is the capital gain? 8 lakhs. That's a short-term capital gain. Are you clear? Now if you observe. Here house is bought before 23rd July 2024 and it is sold later. House bought before 23rd July but sold later. If it is a long term and if you have to compute tax, gain is same 8 lakhs. Long term gain is same 8 lakhs. But if you are computing tax, this is option 1 gain. Option 2, you should apply indexation and then compute the gain if it is a long term. But luckily here it's a short term. So there is no concept of option scheme. Option scheme at the time of tax computation will come into picture when if it's a long term eligible for indexation. Am I right? And remember, indexation benefit is available only for long term assets. Short term assets are not eligible for indexation benefit. That too, indexation right now we think of indexation concept, that too only at the time of tax computation. Am I right or not? Or indexation concept we will think when year of transfer is old years but taxability is in 25-26, like compulsory acquisition, conversion of capital in stock in trade. In these cases, indexation concept we will think about. Again, yes or no? That's it. Then next one. This is illustration 10 is over. Illustration 9 is also over. Yes or no? Is there anything pending in 9? No, nothing. Next, illustration 8. This also we covered, no? Stock in trade was sold ultimately. No, we didn't cover. Okay, we'll cover it now. Shall I? Mr. A converted his capital asset acquired for an amount 50,000 in June 2004 into stock in trade in the month of November 2024. Thank God. November 2024 is after 23rd July 2020. 4. After 23rd July is the date of transfer. Since date of transfer is after 23rd July, straight away no indexation concept. Are you clear? Yes or no? The fair market value on the date of conversion is 4,50,000. Therefore 4,50,000 minus 50,000. Therefore capital gain is how much, ma? 4 lakh. Long term capital gain is how much? 4 lakh. The stock in trade was ultimately sold for 6,50,000. So 6,50,000 minus 4,50,000 is equal to business profit is equal to 2 lakh. So capital gain 4 lakh. Business profit is 2 lakh. Yes or no? That's it. Okay, the business profit information they didn't give. In the month of September, in the above they gave business profit 2 lakh. Capital gain is 4 lakh. Easy. Yes or no? Next, illustration 8 over. Next, this is some theory question related one, ma. I will discuss it. Okay. Okay. Then again, this is also some theory question related, ma. Reverse mortgage. This is also some theory question related, ma. I will come back to it. Fourth question also some theory question related, ma. I'll come back to it. Okay. That's it. So 1, 2, 3 already over. Major questions over. Now we'll go back and read entire pending theory. Illustration 1 over. We solved it. 12 is not over. We did already. I showed it's already highlighted. That's why I did. It's already highlighted. I told already 12 is done. 12 is pending. Okay, 12 is also theory question, I think, but we can do it. Look at 12. Long-term capital gain of 75 lakhs arising from transfer of building on 1st May 2025 will be exempt from tax if that gain is invested in bonds redeemable after 5 years. Long-term 5 years and more above bonds, if you invested only, it is exempted. Issued by NHI. Examine with reason. No, entire gain is not exempt. Only maximum 50 lakhs is exemption. Therefore, maximum exemption is 50 lakh. Are you clear? That too, investment has to be made before 1st November because here the transfer is 1st May. Therefore, within 6 months you have to make it. Are you clear? That's it. Over. Confident? So now I'll stop this video. Then in the next session, I will finish the capital gains chapter, theory reading, all that. Am I? Can I? Yes. Now let me discuss the pending topics in capital gains topic. Just a theory reading. Technically, we solved major illustrations, major TYK questions completed. In our question bank, only theory questions oriented are pending. Am I right? But before discussing that, we need to discuss the pending theory in the capital gains topic, right? Now, this particular last video is not important. Basically, it is not important from exam point of view. But still, All the cases and all we are discussing. If the paper maker want to make it tough na, if the paper want to be really tough, right now whatever I'm going to discuss remaining points now, from that they might generally test, because these are the points which generally students ignore. Okay, fine, look at. So from the beginning I'm going, whatever pending I'm just revising that, I'm just explaining you and then proceeding further. Am I right? Yes or no? Next, charging section. Any profits arising from transfer of capital asset which is transferred during the year shall be taxable in the year of transfer. But for that, what are the exceptions? 45(1)(a), compensation received on account of destruction, demolition, conversion of capital asset into stock in trade. 45(5), compulsory acquisition of capital asset by central government. Yes or no? In all these three cases, transfer year is destruction year, conversion year, compulsory acquisition year. But taxability is in the receipt of compensation or sale of stock in trade. Am I right? Yes or no? Now even though they are taxable in separate years, but counting 54 time limits, 54 series time limits, in these cases time limits will be counted not from transfer date but from realization of money date. Yes or no? Transfer includes what? Transfer, I told you, it's an inclusive definition. Yes or no? Transfer includes now you see, sale, exchange, relinquishment. Relinquishment means what? Destruction, demolition, all that, and extinguishment. Yes or no? Okay, next, here I gave you, like wrong meaning. Extinguishment means relinquishment means all destruction, everything will come here. Yes or no? Yes or no? Yes. Next, the compulsory acquisition thereof. Am I right? Compulsory acquisition under law, conversion of capital asset into stock in trade, maturity or redemption of zero coupon bond. Zero coupon bond, what is the time limit? 12 months. What is the criteria for determining whether it's a long term or short term? 12 months. Now zero coupon bonds, directly whenever I'm selling, I will directly full value of consideration minus cost of acquisition is equal to capital gain. Simple. Whether you maturity amount or redemption amount or you are transferring it, whatever the reason, the amount received is taxable. Am I right? And 6, part performance of a contract. Sometimes possession of an immovable property given in consideration of part performance of a contract, nothing but in 25-26 year itself, agreement over, possession received, advance also you paid, then in 25-26 itself we can compute capital gains. We need not wait up to 26-27 actual registration date. Are you clear? This department will exercise whether in a case to case basis. We don't have to exercise it. Are you clear? Next, any transaction which has effect of transferring, enabling enjoyment of the immovable property. Suppose I bought a share in society, because of that I am getting enjoyment of immovable property. That one. Example, if a person becomes a member of society, company or other association for building a house or flats and pays agreed amount, they receive possession of the house or flat without registering a conveyance. Means flat will not be registered on the name, shares will be registered on the name. Are you clear? That's it. Easy. Transfer definition not that important. Are you clear? Next, capital asset. What is a capital asset? Any property held by SSE, whether or not related to business. Securities held by foreign institutional investors. Investment fund under section 115 UB, which is inserted in Finance Act. So, and these two items, even if it is a stock in trade for you, we still consider it as capital asset only. Yes or no? And ULIPs for which exemption do not apply, that will also be treated as capital asset. But at CA Inter we don't have ULIP taxation. At CA Inter we don't have foreign institutional investment fund taxation. Are you clear? Now, however, capital asset does not include general raw material, finished goods, work in progress, nothing but stock in trade. Yes or no? Consumable stores or raw materials which are held for business or profession use, these are all not treated as capital asset. Personal effects are also not capital asset. Personal means what? Movable plus personal use. However, the following personal assets are treated as capital asset: jewelry, archaeological, drawing, painting, sculpture, work of art. Rural agriculture land, not a capital asset. Certificates under gold monetization scheme, not a capital asset. And I told you, when I'm telling you gold monetization scheme, I told you few more items. Sovereign gold bonds, it's a capital asset. Digital gold, it's a capital asset. EGR is a capital asset. Yes or no? Gold ETFs is a capital asset. Am I right? Next, jewelry includes ornaments made of gold, silver, platinum or other precious metal with or without precious or semi-precious stones worked or sewn into apparel. Include precious or semi-precious stones whether or not set in furniture. You may use it. You may have a silver furniture in your home, that's jewelry. You may have a gold furniture in home, that's a jewelry. You have a silver plates, everything, that's a jewelry. All that comes under jewelry. Now there are some well established cases once upon a time that silver utensils is not treated as capital asset, because silver utensils were used as a part of Indian custom as a personal effect, not as a wealth creation purpose but as a usage purpose they use. So silver utensils are not treated as capital asset. Gold utensils are treated as capital asset. Like that some judgments and all were there. Now it is not relevant for you. Are you clear? Next, Agriculture land already I told. Rural land means what? Agriculture land not situated in specified area. Am I right? Then types of capital asset. So capital gains are broadly classified into long term and short term, which is based on period of holding. Period of holding means what? Generally, period of holding means holding period by transfer or preceding the date of transfer. If the period of holding is more than 12 months or more than 24, it's a long term. If the period of holding is up to 12 months or up to 24 months, it's a short term. Yes or no? Now 12 months is applicable for 4 assets: listed securities other than units, units of equity oriented fund, units of unit trust of India, zero coupon bonds. For remaining all other assets, 24. I told you what are all comes under all other assets. Yes or no? Now new point. Section 50 AA, section 50. Generally, tell me, if I sell long-term capital asset, I get long-term capital gain. If I sell short-term capital asset, I get short-term capital gain. But there are some assets. Those assets may be long-term or those assets may be short-term basically. But the gain is always short-term. When I say the gain is always short-term, they are taxable at normal rates. They are taxable at what rates? Normal rates. You know what are the assets? If at all any capital gain arising from transfer of following assets, that is always treated as short-term capital gain irrespective of holding period. What are they? Units of specified mutual funds acquired on or after 1st April 2023. Specified mutual funds. What is specified mutual funds? You know, debt-oriented funds. They're actually what? Debt-oriented funds. Market-linked debentures, unlisted bonds and unlisted debentures. In all these cases, 24 months is the criteria to decide whether they are long-term capital asset or short-term capital asset. You know what is the criteria? 24 months. You apply 24 months logic, everything. The gain is always called a short-term capital gain. The gain is always called a short-term capital loss. Are you clear? Even though the gain is short-term capital gain, but you are selling some asset, no? Yes or no? Which is long-term asset you are selling, you are eligible for 54F exemption. You are eligible for 54F exemption. You are eligible for 54EC exemption. No, 54EC exemption is only when you are selling original asset which is immovable property. Be careful. Okay, so 54EC won't come, only 54F exemption will come. Are you clear? Then depreciable assets, even depreciable assets, capital gains arising on transfer of depreciable assets which are forming part of block is always a short-term capital gain irrespective of period of holding. Yes or no? Now, you know, equity oriented funds, units of equity oriented funds, okay, they are treated as short term, long term based on 12 months logic, right? First of all, what is an equity oriented fund? Very simple. What is equity oriented fund? You know, if at all 65% or more of the total proceeds in a fund, 65% or more of the proceeds in a fund were invested in listed equity shares of domestic companies, then that fund is called as equity oriented fund. Sometimes what happens, you know, mutual fund is what, you know, basically mutual fund means we all buy mutual fund units, we invest in mutual fund, that mutual fund company invests directly in shares. Sometimes what happens, mutual fund company invests in another mutual fund, we buy funds of the fund. Able to understand? That time, you know, what is the equity oriented? You see, this is fund where the fund invested in another fund. Are you clear? If the fund invests 90% or more of the total proceeds in listed units of another fund, where the other fund is investing minimum 90% in listed equity shares of domestic companies, then whatever the fund units I bought, no, that is also treated as equity oriented fund. What does it mean? Very simple. Suppose, no, I bought units of you know, one fund which directly invest in listed equity shares, then minimum 65%. Okay, if the fund invests minimum 65% or more directly in listed equity shares, this fund is called as equity oriented fund. Suppose, no, I invest in units of fund which actually invest in another fund, then when this will become equity oriented fund, if this fund invests minimum 90% or more in listed equity shares of domestic company, then only this will become equity oriented fund. Easy or not? Yes. Next, the percentage of equity holding, you know, the percentage of equity holding or units held is calculated based on annual average of monthly. Is not required in, you know, when you are having demat, no, they will tell you is it equity fund or not. Demat they will tell you is it equity fund or not. If they say equity fund, you can consider equity. You don't have to check is it equity fund or not, how much invested, you don't have to worry. Are you clear? Next, what is a zero coupon bond? Zero coupon bond, Zero coupon bonds are the bonds for which no payment or benefit is received or receivable before maturity or redemption. You will not get any payment until maturity or redemption. Are you clear? And these bonds are issued by infrastructure companies or infrastructure fund or IDF, infrastructure debt fund, or public sector companies or banks. Only these will issue zero coupon bonds, and these are something which are notified by central government. Are you clear? And income from transfer of zero coupon bond is treated as capital gain, and transfer includes maturity as well as redemption. However, if at all you invested in zero coupon bond as a stock in trade, then that is not liable for capital gains tax. Are you clear? Then determining period of holding. Suppose if you are having shares held in a liquidation date will be decided, no statutory date. From the date, no, don't count the period of holding. So exclude the date of holding, exclude the period of holding after liquidation date. Are you clear? Suppose no, you got asset in 49 subsection 1 circumstances, then include previous one or holding period. Sir, I am converting inventory, sir, into capital asset. Remember I told you period of holding will start only from conversion date. Consider from the date of conversion into capital asset. Period of holding will be considered from conversion date. Yes or no? Remember I told already. Problem also we did. Yes or no? Right renouncement. Consider from date of offer by company. Suppose no, company gave me an offer, but I don't have money, and I am renouncing this right to somebody else, my friend. Okay, so now I renounced right, and I got 500 rupees per right. Cost is 0. Now I got a gain. Is it long term or short term? I should count from the offer date. How long I'm having right in my hand? Okay, until I renounced it. That is the date of transfer. Generally, right renouncements is short term capital asset, and the gain is short term capital gain. Tell me, for right renouncement, 12 months logic apply or 24 months logic apply? If it is listed shares, 12 months logic. If it is unlisted shares, 24 months logic. But guess what? Rights issue a company once announced has to complete in 90 days or something, some time limit is given. Rights, which means the right itself will have a validity life of 90 days or 60 days, some days. It can never be long term. It's always short term. Yes or no? Next. Transactions which are not regarded as transfer. What are not regarded as transfer? You know what? Any distribution of capital asset on partition of HUF. If a Hindu undivided family, no, all these days it's a joint assets. Now family is dividing, all the brothers are dividing into nuclear families. Now family property is distributed among the brothers. That is not taxable. It is just a distribution. No money is received by anybody. So it is exempted transfer. It is exempted. So this is not regarded as transfer. Now tomorrow, one of the son who got one house, he is selling that house tomorrow. What is cost of acquisition? Cost to HUF. Cost to previous owner. Are you clear? Next, and you know what? Second one, any transfer of capital asset by individual under a gift will or irrevocable trust, that is not a transaction which is treated as transfer. However, any transfer of ESOP under gift will or trust is treated as transfer up to assessment year 24-25. So this is a old provision, right now not required for you. Are you clear? Though it is given in ICA book and in our book also, it is not required, because for you right now problems are 26-27 based. Remember. Are you clear? Right now, for example, I am an employee. I got ESOP from the company. In my hand, ESOP I got. You know what? I am gifting it to somebody. Nothing is taxable. Are you clear? Right now, ESOP gifting is exempted. Once upon a time, ESOP gifting is taxable. It is treated as transfer up to previous year 23-24, whereas 24-25, 25-26. Right now, our problems are based on 25-26. It is now gifting of ESOP. Transfer of ESOP under will. Everything is exempted. Are you clear? Now, the other person, he got ESOP shares. Nothing but shares as a gift from me. Tomorrow, he is selling to somebody else. What is cost of acquisition? Cost to previous owner. Yes or no? Next. Now, transfer of capital asset by holding company to its 100% subsidiary being Indian company. Transfer of capital asset by holding company to 100% subsidiary, provided the recipient is Indian company. Then any asset transferred between them, not a transfer. Are you clear? Nothing is taxable. Yes or no? Transfer of capital asset by subsidiary to its 100% holding company, that is also not a transfer. However, exemption is not applicable if the asset transferred is as a stock in trade. You didn't transfer capital asset, you transferred stock in trade. That time it is fully taxable. Are you clear? Now this logic is not that important. Easy. Next. Transfer of capital asset by amalgamating company to amalgamated company in a scheme of amalgamation, provided amalgamated Indian company, I said, in all the cases, no. In all these cases, no. This one, and even this, this one. Are you clear? And in all these cases, no. Recipient must be Indian company. recipient company must be Indian company. In case of holding to subsidiary, subsidiary. In case of subsidiary holding, holding. In case of amalgamating to amalgamated, amalgamated. In case of demerged company to resulting, resulting. The resulting company must be Indian company, amalgamated company must be Indian company, subsidiary or holding company must be Indian company. That too, remember, holding to subsidiary, when the transfers are exempted, if the subsidiary is a 100% subsidiary, if the subsidiary is a normal subsidiary, this exception will not apply. Be careful in exam. A company has a controlling interest in another company, 60% holding is there. Okay, and this company is transferring capital asset to the company. Evaluate tax implications, taxable. It is not 100% subsidiary. 100% subsidiary means what, you know? What, you know, 100% subsidiary? Holding company has 100% control. Now immediately you should get this doubt. How 100% control is possible to incorporate a company? Minimum 2 shareholders required. How come 100% ownership will be 100% of the ownership will be with the one person? 100% subsidiary is not in legal way, not just legally. 100% ownership beneficially we see. We see beneficial ownership how much? Like you see, you know, power distribution companies, power supply you get, no, you will get a power bill, no, at home. You see TNPCCL, Tamil Nadu Power Distribution Corporation Limited, Andhra Pradesh Power Distribution Corporation Limited, Karnataka Power Distribution Corporation Limited. These are state owned PSUs. What are they? They are state owned PSUs. What are they? 100% owned PSUs, 100% state government owned. How 100% owned? You open their share capital, you will see 99.99999% state government owned. Some 7 shares were allotted to some different directors. These are called as nominee directors. What are they called as? Nominee shareholders. Nominee shareholders. Nominee means what? They are not the real shareholder. I am only the shareholder, but he is a nominee. Just for the namesake we kept. Are you clear? That's it. So ultimately, beneficially, government is only owner for 100% of the share capital. Are you clear? Next, same way, transfer of capital asset by demerged company to resulting company in a scheme of demerger. That to resulting company must be Indian, then only exempted. Same way. Now tell me, when amalgamation happened, selling company assets will become buying company assets. Now transfer happened, right? Not taxable. In demerger company assets and all will transfer to resulting company. Transfer is not taxable. Not only transaction, not only here, here owners changed, but asset is same. Not only this, here for shareholders also there is an exchange happened. In amalgamation, what happened? Amalgamating company shareholders, they relinquished their shares in amalgamating company, and they got new shares from amalgamated company. Here owner remained same. Asset changed, asset got converted, even that is exempted. Look at it. Any transfer or issue of shares, okay, any transfer by shareholder in a scheme of amalgamation of shares held by him in amalgamating company in lieu of shares in amalgamated company, yes or no, except where shareholder itself is amalgamated company. Fine, I'll come to that exception later. Very simple. I am a shareholder of in a Vodafone company. Vodafone example I took earlier, yes or no? Vodafone. Now Vodafone Idea shares were allotted to me in cancellation of Vodafone shares. Now shares exchanged. Exchange is a transfer but not taxable because it is covered under section 47. Since it is covered under section 47, exchange is not taxable. Are you clear? So any transfer of shares by the shareholder of amalgamating company in lieu of shares in amalgamated company in a scheme of amalgamation, provided amalgamated company is an Indian company, except this exception need not even seen if the amalgamated company itself is the shareholder. What does it mean? Suppose my subsidiary company is there. My subsidiary company is there. I am the holding company. Are you clear? Sorry. I am the subsidiary company. There is a holding company. And in my entire subsidiary company, shares are held by holding company. Are you getting it? Now, holding company absorbed the subsidiary company, amalgamation. Now, will holding company allot shares to itself? Will holding company allot shares to itself? Earlier I have shares of subsidiary. Now I am cancelling these shares. Now that company incorporated into myself. Now I am the shareholder of the subsidiary. How should I pay compensation? I should pay my shares to myself. How can a company allot shares to itself? Exactly. That's why they said except where shareholder itself is amalgamated. Means in this case the logic will not apply. Exemption is same. Are you clear? Next, transfer of government security, which is carrying periodic payment of interest, nothing but government bonds, government debentures, government related securities. Okay, where is the transfer happening? Outside India. Who is transferring? Non-resident. To whom he is transferring? Another non-resident. Remember, a non-resident is transferring to another non-resident a capital asset situated in India. A government security is Indian government security. So source of income is in India. Accrual is in India. This is deemed to be accrue or arise in India. But section 47 says, don't worry, you don't have to pay tax because it is not treated as transfer. So that's it. Transfer of any of the following capital asset. What is it? Transfer of any of the following capital assets to the government or university or national museum, art gallery, national archives, or any other public museum or institution notified by government to be of national importance. If you are transferring following assets, what are they? Work of art, archaeological, scientific, art collection, book, manuscript, drawing, painting, photograph, or print. You know, you are selling some valuable items to the government itself so that they can put it in the museum and attract more and more tourists. You are helping tourism. Therefore, you are transferring to government, you are getting profit, nothing, don't worry, it is not taxable. Are you clear? Next, conversion of bonds, debentures into shares, there is no taxability. Conversion of preference shares, no taxability. Are you clear? Now, transfer of capital asset under reverse mortgage, not taxable. What is reverse mortgage? You know, for example, no, I'm a senior citizen. Reverse mortgage is applicable only for senior citizens. Okay. What happened? Generally, mortgage means what? I put my house into loan and I'll get a money, and tomorrow I'll have to repay. In a reverse mortgage, repayment will not be there. In a reverse mortgage, repayment will not be there. In return, bank only will pay you every month some amount. In a normal mortgage, you take a loan and you have to pay every month to the bank EMI. Whereas in reverse mortgage, bank only will pay you every month some money. Like what exactly the scheme? Generally, senior citizens, once they retire, they will not have income, but somehow they have a own house. Now, but they are not having monthly income, no kids, nobody to support them. So there is a scheme called reverse mortgage. Now, what actually, they can sell the house and get the money, they can put it in FD and then they can happily survive. But the culture anywhere in the society across the world, elder people, they will not give rent. If at all something happened to them, who will remove them? All that issues and all were there. So now a person who is having own house, what he can do? If at all he sell, he can't stay anywhere. Are you clear? So all these issues were there. So government understood this and then they brought a new scheme called reverse mortgage. What is this scheme? Though a senior citizen who is having a own house, getting it, that house he can go and enter into RM agreement with bank, reverse mortgage agreement. What is this agreement? Banker will take your house into mortgage, but you can stay happily in the same house. I will not give you lump sum amount. I will pay you monthly amount, or even lump sum amount also can be given to you. Lump sum amount also can be given to you, and bank will tell, sir, your lifetime happily use this money and survive comfortably. Okay, over. Once if something happened to them, what bank will do is, bank will sell the property in auction and set up the loan given by them. If at all any amount else balance is there, then that will be given to the legal heirs or nominees whom they notified. The senior citizens will tell some nominee names, to them the amount will be given. Now, by the way, when something happened to the senior citizen after a while, bank will sell the house, I told, right? First, bank will not sell it. They will give option to legal heirs. Do you want to buy this house? You repay the loan and then get back the house, release the house. If nobody said I don't want, then bank will sell the house. Are you clear? Now look at. Now here what is happening now? Tell me. Under reverse mortgage, see, tell me, if I'm a senior citizen, if I sell my house to somebody and then get the money, capital gains is there. I have to pay capital gains tax. But if I sell it back to, if I give it under reverse mortgage to bank and I'm getting lump sum money, no need to pay capital gains. What is it? No need to pay capital gains tax. Are you clear? Now look at what is reverse mortgage. Senior citizens can mortgage their house to a scheduled bank or a finance company in exchange for a lump sum or in exchange for a regular income. So they can continue living in the same house without repaying the loan in their lifetime. Loan limit up to 60% of the value of the house property. This loan limit is a banker's choice, but that is not required for us generally. Property will be revalued once in 5 years by the bank, and accordingly they will give you loan extra, all that. Okay, the loan must be used. You, for what purpose you can use the loan? For family expenses or medical emergency, yes or no, or for renovation or extension of the house, but you cannot use for speculative or trading purpose. Remember, no loan, even personal loan, gold loan, nothing. You cannot take a loan for speculative purpose and all. By the way, my gold buying one video is there in YouTube. If at all possible, to watch it. I will tell you a financial planning there. You will understand like how financial planning I do basically. Okay, fine. Next, disbursement. Lump sum amount may be given or periodic payments like monthly, quarterly, annually, depending upon the depending upon the requirement of the senior citizen. So the loan can be disbursed to the institutions like LIC, IRDA, insurance for periodic annuity payments. This is an annuity is nothing but something similar to pension. Annuity is nothing but period, something similar to pension. What bank will do, they will give a lump sum amount to LIC. Now what LIC will do, to the senior citizen, every month they will pay annuity. Annuity is nothing but pension. Are you clear? Maximum loan tenure 20 years from the date of reverse mortgage agreement. What is the maximum tenure for reverse mortgage? 20 years. Next, recovery. How the bank will recover the loan, sir? After the borrower's death, the loan and interest will be recovered by the selling the house. Any excess amount will be paid to the legal heirs. But legal heirs will be given preference. What preference? Legal heirs can repay the loan and interest to reclaim the property before it is sold. Now, so since transfer of house under reverse mortgage is not treated as transfer, therefore there is no capital gain tax. Further, senior citizen receiving every month income, no, revenue income, right? It's a revenue receipt, right? What about that? It is exempt under 1043. It is exempt under 1043. Loan amount received is exempt from income tax under 10 subsection 43. Are you clear? That's it. So reverse mortgage easy, all of you. Then some important definitions. What is an amalgamation? Amalgamation means what? When one or more company merge into another company, or when two or more companies combine to create a single company. Yes or no? The company which is merging is called amalgamating company. The company that absorbs the other company or new company is formed, right? That's called amalgamated company. What are the conditions? Now above, no, I told no, any transfer of capital asset by amalgamating to amalgamated company, the transfer of capital asset is exempted. When only when that amalgamation comes under the definition of this. Only if the amalgamation satisfies this condition, that exemption will apply. What are the conditions? All the property of amalgamating company shall become property of amalgamated company. This is there in pooling of interest method also. Similar condition. All liabilities of amalgamating company shall become share liabilities of amalgamated company. Minimum 75% of the shareholders holding the shares in value must continue, must become shareholders of amalgamated. Major shareholders must continue. In pooling of interest method, 90%. Yeah. And amalgamation does not include, the following is not amalgamation. One company purchases property of another company. Array, you are purchasing property, full assets you are purchasing. Just because you are purchasing full assets, it is not amalgamation. To call it as amalgamation, there must be a scheme of amalgamation. Yes or no? Or the property is transferred after company is wound up and distributed to another company. Liquidation, one company liquidated and the entire assets are transferred to another company. That is also not amalgamation. Easy or not? Same way, demerger. Demerger means what? Transfer of one or more, one of the business undertaking, one of the division, yes or no, by a demerger company into a resulting. Because you are removing one segment from you and then keeping it as a different business, a new business resulted, a new company resulted. That's why it's called resulting company. Are you clear? Demerged company, the company transferring the undertaking, that is demerged company. Resulting company, the company receiving the undertaking and issuing shares to the shareholders of demerged company in exchange. Are you clear? What are the conditions for demerger? What are the conditions? The transaction qualifies as demerger only if the following conditions are satisfied. What is it? All the property of the undertaking, for example, slum sale, remember, that is one of the example of demerger. Are you getting it? But here it's not, slump sale is not a scheme of demerger. Here you are selling division to somebody else. It's not under demerger agreement. If it is a demerger agreement and you are incorporating one more company, that comes under demerger and nothing is taxable. Are you clear? Yes. All property is transferred becomes property of resulting. All liabilities will become the liabilities of resulting. Yes or no? Property and liabilities are transferred at book values as they appear in books of accounts. Yes or no? Exception you leave it. This is regarding some India's point. The resulting company issues shares to shareholders of demerged company on a proportional basis. Shareholders holding at least 75% in value of the demerged company must also become the shareholders of resulting, and the transfer must happen on a going concern basis. Going concern means what? You are demerging another company which is a successful company, already successful division. Are you clear? The demerger must follow any other conditions notified by the government. Suppose if a public company, if a public sector, government company, public sector means government company, split into separate company for transferring asset to resulting, it is also treated as demerger if resulting company is also a public sector company and other conditions are satisfied. These definitions of amalgamation, demerger, absolutely irrelevant, not required at all. Are you clear? Don't even touch it later. Don't even touch it. Next, 45. Is it over? Yes or no? Distribution of liquidation over. 46A, buyback over. Computation of capital gains, the format entirely is over. Yes or no? Now I will discuss once the format. Okay, just 2 minutes. Yeah, okay, let's continue. So what is a computation for other than depreciable assets? Computation format of capital gains. First, FEC. then transfer expenses, then you get net consideration, then cost of acquisition or indexed. Right now I can tell you can strike off absolutely indexed, because indexed cost of acquisition now you will not compute at all, yes or no, but you will do it only at tax computation stage. I told you this. You will not compute in the main problem computation time. You will only compute at tax computation. In problem computation time also we do indexation when, you know, exceptions, if at all, year of destruction, year of conversion of capital asset, year of compulsory acquisition, if they were before 23rd July and ultimately you are taxing it in 25-26, that time up to year of conversion, year of destruction, year of compulsory acquisition, indexation is available. Are you clear? Yes. Next. Then you get gross capital gain from that exemption under 54 series, that also be completed. Am I right? Next. All the points below are discussed in detail under other topics. So full value means what? Actual consideration or deemed consideration. Deemed means 50C, 50C, 50D. Expense related to transfer, I already told. Cost of acquisition, actual or deemed cost, as the case may be. Indexation is available when for individual HF who transferred land or building on or after 23rd July, which is acquired by them before 23rd July. That too, this is available only at tax computation step. Am I right? Next, no deduction towards interest on housing loan. Am I right? Array, interest you paid on housing loan, can I call it as cost of acquisition, cost of improvement? No. Cost of improvement means what? Actual cost or deemed cost? Deemed cost means what? Cost to previous owner. That's what the meaning. Yes or no? As per 55, as applicable. Indexation is available if at all land and building is sold on or after 23rd July, but which is acquired by you before 23rd July. This is also to be done only a tax computation step. Am I right? And from gross capital gain, deductions will be claimed subject to 54 series. That 54 series also be understood. Am I right or not? Next. Computation of capital gains for non-residents for unlisted shares and debentures. This is called currency conversion benefit. What is it actually called as? The currency conversion. This provision shall not apply for 112A capital assets, because no, 112A is dealing with listed equity shares directly. Yes or no? Fine. So non-residents, what are you actually selling? Unlisted shares and debentures. You know how to compute capital gains, you know, for unlisted shares and debentures? First compute everything in foreign currency. Everything you compute in foreign currency. You gain also you compute in foreign currency. That you convert into Indian currency. And this is taxable ultimately. Now, first sale consideration, cost of acquisition, transfer expense, everything you convert into foreign currency. At what rate? Average rate. What average rate means? TT buying rate and TT selling rate on relevant dates. Okay, on relevant dates, no, for example, sale is on so and so date, buying rate, selling rate will be given, average you take. Transfer expenses, buying rate and selling rate will be given for foreign currency, take average rate. Okay, then that's it. Cost of acquisition, buying rate, selling rate will be given on the same date, then convert average. At average rate, no, amount and all convert into foreign currency. Are you clear? Convert into foreign currency. Step 2, compute the capital gains in foreign currency. Then the resulting capital gain convert back into Indian currency at buying rate. Are you clear? This is called currency conversion benefit. Are you clear? Because currency might be at different rates. Currency might be at different rates. Are you clear? See, if everything is converted in Indian currency, if everything is computed in Indian currency, what happens, you know? You see, I'll tell you very simple. For example, no, when I bought the assets, no, I will tell you, for example, you know, entirely converted into foreign currency, full value of consideration $5,000 minus cost of acquisition $4,000 is equal to $1,000 is capital gain. And now buying rate, right now buying rate, TT rate is on buying rate, TT buying rate on date of transfer, on the date of transfer 80 rupees is there, 80,000 is the capital gains. Suppose no, if at all everything is calculated original Indian currency, what happens? I'll tell you. These are all $5,000. You know, I sold $5,000 into 80 rupees. You know, 4 lakhs. Are you clear? I bought at $4,000 in 2001-2. That time dollar is 10 rupees only. That time dollar is how much? 10 rupees only. Let us assume 4,000 into 10, how much it is? 40,000. Capital gain, how much it is coming? 3,60,000. You see, 80,000 where? 3,60,000 where? So if you calculate capital gains in foreign currency itself and final gain you convert into India, it's a benefit for non-resident or not? This is an encouragement for non-resident. Are you getting it? Exactly. This is an encouragement for non-resident. So if a non-resident is selling unlisted shares or unlisted debentures, step number 1, consideration. First consideration, acquisition, transfer expenses. No, on respective dates, convert Indian currency. They'll give you, convert them into foreign currency at the respective dates, average rates you convert. Okay, then compute capital gain in foreign currency, then convert back into Indian currency, and then compute tax liability on that, which is actually a beautiful provision for non-residents. Am I right or not? Yes or no? That's it. Now I just wanted to open 1121s. Okay, nothing, for my checking only. Is there any observation? I just wanted to tell. Okay. Just 1 minute. Yeah, actually now one important point I'll tell you. Right now this benefit you can ignore. This benefit you will ignore, because long-term capital gain right now is taxing it 12.5%. This become redundant. Okay, I will tell you to strike off this. Not required, actually not required. Okay, I kept it unnecessarily. It was relevant in 24-25. For 25-26 it is not relevant. Please strike off it. Okay, right now since capital gain is taxable at 12.5%, this currency conversion benefit will not be available. Are you clear? Leave it, no problem. Okay, then what is deemed full value of consideration? Section 50C, I already told. If stamp duty value does not exceed 110% of the actual consideration, then actual consideration, not exceeding. If at all exceeding 110%, then stamp duty. Stamp duty value means what? Transfer date generally. However, if agreement date is there, on or before agreement advance is received by other than cash, then agreement date stamp duty value shall be taken. Now, if the stamp duty value is unreasonably higher, SSC can request income tax officer, assessing officer, to refer the case to valuation officer. If valuation officer gave a value more than stamp duty value, then stamp duty value. If a valuation officer gave a value less than stamp duty value, then the valuation officer value. Suppose if the valuation officer value is less than consideration, or minimum consideration amount, yes or no? That's it. Next. Now, suppose if at all you are selling unlisted shares, then what is the full value of consideration? Actual consideration or FMV of the shares? Yes or no? Yes. Next, if any other asset, if consideration received cannot be ascertained, then market value of the asset transferred on the date of transfer. Are you clear? Next, ESOPs, no, this is applicable only up to 24-25 assessment year. I am telling you to strike off, not required. Okay, not required, no, because we are all doing problems right now. 25-26 based, this ESOP point and all will not be given. Are you clear? Next, what are cost of acquisitions? Remember, indexation point, everything we covered. For feature or for advance, everything is covered. Yes or no? Yes. Next. Now 49.1, many a times we came across circumstances mentioned under 49.1. Previous owner holding period shall be considered. Previous owner means what? Distribution of assets on liquidation of a company. Right now I'm a shareholder, I got the assets on liquidation. The company earlier, how many days the company is holding the property, that period also will be counted. And here cost of acquisition is cost to the company. Now cost to the company means what is 55 section says? Fair market value on the date of distribution is taken as cost of acquisition. I told you this. Yes or no? Transfer to a trust. Transfer of assets by holding company to 100% wholly owned subsidiary or vice versa. Transfer of assets during amalgamation. Transfer of assets during demerger. Conversion of individual property into HUF property. In all these cases, cost to previous owner will be taken as cost of acquisition. Cost of improvement will also be taken cost to previous owner. Yes or no? Easy. Now, earlier I told only this. Now, distribution of assets on partition of HUF. Now, in the individual member, no, what is its cost of acquisition? HF at what price they bought? That is the cost of acquisition. Yes or no? Cost to previous owner logic. Easy or not? Yes or no? That's it. Don't go in depth. Whatever I'm telling you in depth, that alone you see, remaining is not a big deal at all. Are you clear? Next, sir, I got amalgamated company shares, sir. What is its cost of acquisition? Array, you have amalgamated company Vodafone Idea shares because you have Vodafone shares earlier. So what is cost of acquisition of VI shares, Vodafone Idea shares? Cost of acquisition of Vodafone shares shall be cost of acquisition of shares in amalgamating company. Now, what about debentures converted? What about cost of acquisition of shares or debentures received under conversion? Cost of acquisition of shares is equal to old debentures is what converted now. Cost of acquisition of bonds or debentures before conversion. Yes or no? Now look at what is cost of acquisition of specified securities sweat equity shares received under 17 subsection 2 clause number 7 ESOP. You got to the employee. You know, for example, no, I'm an employee working in a company. Okay, the company allotted me ESOP. You know, I exercised the option on some, let us assume 28th February 2026, I exercised the option when the fair market value is 1000 rupees. Guess what? My option exercised is at 500 rupee. How much is balance? 500. This is taxable as perquisite under head of income in 25-26 years. Am I right? In 27-28, the shares, no, I am selling to outsiders at 1000 rupees. Now, what is cost of acquisition? Fair market value considered for perquisite valuation. That is cost of, because no, you paid 500 plus another 500 is taxed as income. Indirectly, you only earned entire 1000 rupees. Yes or no? So, cost of acquisition is 1000. Look at it. Okay. So what is the cost of acquisition of shares or securities received under salaries and which is taxed as perquisite? Then whatever fair market value used for perquisite valuation, that itself is treated as cost of acquisition. Yes or no? Sir, what is cost of acquisition of equity shares, sir, which are received under conversion of preference? Preference shares were converted into equity. Now what is cost of acquisition of equity? Cost of acquisition of preference shares. Now the twist is in cost of acquisition in resulting company, cost of acquisition of shares in demerged company. Here is the twist. You know, I will tell you. Look at this example. You know, there is a company which has unit A, unit B. Okay, unit A, unit B. Unit A net worth, I am telling you directly. Unit A net worth is 100. Unit B net worth is 200. Total net worth of this company is 300. This is a single company. Now what happened is unit B, they are demerging. Now unit B is incorporated as a company B, which is a resulting company. Now you know what happened? Entire this unit B is transferred to company B. Now original company has a shareholders, right? I am one of the shareholder. The original company shares, no, I bought. Cost of acquisition, original company shares, no, I bought, let us assume at 600 rupees. These are all crores, ma. These are all crores. I bought the original company share at 600 rupees. Now this company got splitted. And company B shares were also allotted to me. Company B shares are also allotted to me. Tomorrow this company B shares, I sold it for 1000 rupees to outsider. What is its cost of acquisition of company B share? Can I say 600 as a cost? No. Why? You know, in this 600 only, some company A value is there, company B value is there right now. What is company B share cost of acquisition? Very simple. What is my cost actually? Original cost is what? Before demerger 600 divided by 600 is a cost I paid when the company net worth is 300. Now unit B, company B net worth is only 200 crore. Therefore 2 by 3, 600 into 2 by 3, 400 is the cost of acquisition. Am I right? Logically, am I right? Therefore balance is 600 is capital gain taxable on sale of share of resulting company. Can I say that? Now you know what, along with this, my company, original company shares also I have, no, that original company shares I sold for 500 rupees. Original company. What is original company cost of acquisition? 600. You should not take 600. Out of 600 I allocated 400 here. Balance is what? Balance 300 only taxable. So demerged company, original company shares, no, original company shares cost of acquisition after demerger is what? Original cost 600 minus cost of acquisition allocated for resulting company shares, which is 400, is equal to 200. What is the cost of acquisition of resulting company shares? Original company shares into net worth transferred in demerger. Net worth transferred in a demerger divided by net worth before demerger. Yes or no? Original cost is 600, 200 crore is transferred to other company. Original net worth is 300 crore. Am I right or not? Logic, yes or no? Now look at. So what is the cost of acquisition of shares in resulting company? You know, cost of acquisition is equal to A, cost of acquisition of shares in demerged company, A, which is actually 600 rupees in our example. P, net book value transferred, 200 worth of crores transferred, divided by C, net worth of the demerged company. Demerger means what? Before demerger. This is before demerger you should take, which is actually 300 crore is equal to cost of acquisition 400 rupees. Am I right? Next, what is original shares demerged company? What is cost of acquisition of original shares in demerged company post demerger? This is actually post demerger. Original cost 600 minus 49(2)(c) cost. 49(2)(c) means resulting company cost 400 is equal to 200. Am I right? Next, what is cost of acquisition of inventory which is converted into capital asset? Fair market value on the date of conversion of inventory. Yes or no? Easy. Remember we discussed already. What is cost of acquisition of EGR sold? Suppose no, I converted my gold into EGR and EGR I sold. Cost of acquisition is cost of acquisition of gold. Suppose cost of acquisition of gold transferred a person who purchased EGR. Originally I purchased EGR 1 crore. I converted into gold. Gold is sold for 2 crore. What is the cost of acquisition of gold? EGR cost. Easy. Yes or no? Entirely easy. Yes or no? This point no, gift related provision. Okay, this I will discuss along with the gift this I will discuss along with the gift provision. Are you clear? I will discuss this along with the gift. Okay, this alone I am keeping it pending in the entire capital gains topic. Only this point I am keeping it pending. Okay, next. Now, what is meaning of cost of acquisition? What is meant by cost of acquisition? Section 55 talks about meaning of cost of acquisition. That too subsection 2 specifically talks about it. For intangibles, cost of acquisition is purchase price. Sir, I purchased goodwill, sir. What about cost of acquisition? Cost of acquisition is purchase price minus depreciation under section 32 up to previous year 1920. Because no, on purchased goodwill also under income tax you get depreciation. That too only up to 1920 year you get depreciation on goodwill. From 2021 previous year onwards, goodwill is not eligible for depreciation. So if at all you are selling goodwill to somebody tomorrow, what is its cost of acquisition? Purchase price minus depreciation under section 32 up to 1920 year. That is cost of acquisition. Are you clear? Sir, self-generated assets, like for example I self-generated one intangible, sir. Tomorrow I sold it for 100 crore. What is cost of acquisition? 0. Are you clear? If assets acquired under 49 circumstances, then cost of acquisition is cost to previous owner. Suppose if cost to previous owner cannot be ascertained, then cost of acquisition will be fair market value of the asset on the date of acquisition by previous owner. If previous owner cost of acquisition I am unable to identify, I don't know, because that records and all were not there. When he purchased, I know 1980 purchased, on the day market value. That itself is cost of acquisition. Are you clear? Financial assets, remember I told entirely. Yes or no? Cost of acquisition of assets received under liquidation. Yes or no? SSE was taxed under 46 at the time of distribution. Then fair market value, cost of acquisition will be fair market value of the asset on the date of distribution. Yes or no? Suppose a share or stock of a company may become property of the SSE. How a share can become a property? The shares originally you own, maybe this is actually not required. Accounting concept not required. Okay, not required. Literal I'm telling, not required. See, tell me, this is the first thing I'm writing, striking off in this book. Yes or no? Not required. They are talking about reconversion, conversion into stock, subdivision of shares, conversion. These are all olden days. Now it is not there at all. Are you clear? Then fair market value concept over. Cost of improvement for intangibles and all, cost of improvement is always 0. There can only be acquisition price, but there is no improvement. Next, computation of capital gains for depreciable over. Now capital gains in case of market linked debentures 50AA. Remember at the beginning I told the capital gain under 50AA. 50AA is what? It is dealing with units of specified mutual fund, market linked debenture, unlisted bonds, unlisted debentures. You know what are they saying? These assets, 24 months is the criteria to know whether they are long term or short term. Generally if it is a long term, the gain is called as long term. If it is a short term, the gain is called as short term. But for specified mutual fund, debentures, unlisted bonds and unlisted debentures, whether they are long term or short term doesn't matter. The gain is always short term capital gain or short term capital loss. But remember, if it is listed debenture, 12 months logic is applicable. And if it is listed debenture sold, which is a long term, then that is long term capital gain only, which is taxable at 12.5% only. Are you clear? Unlisted debenture, unlisted bonds will come here. Market linked debenture will come here. For them, the gain is always short term, and when it is a short term capital gain, it is taxable at normal rates. Yes or no? Capital gains arising from these assets are always treated as short term capital gain regardless of holding period, which means at what rate they are chargeable to tax? They are chargeable to tax at normal rates. How to compute? Consideration minus transfer expense minus acquisition cost. No deduction for STT paid. What is specified mutual fund? It is a mutual fund where more than 65% of the total proceeds is invested in debt instruments or money instrument. If more than 65% is invested in listed equity shares of domestic company, that's an equity oriented fund. Yes or no? Or a fund which invests 65% or more in units of above fund. Yes or no? The investment in debt or money market instrument is calculated based on, see, how much investment. This point is irrelevant, only this is important for meaning. Okay, then what is market linked debenture? It's a security where underlying principal component is in the form of debt security. Debt security means what? Debt means what? Any security where repayment is in fixed, where repayment, periodic payment will be fixed. Returns are linked to market returns on securities or indices. It includes any security classified as regulated as market linked debenture. Definitions are not that important. Easy or not? Next, slump sale. Every line we covered. Yes or no? Exemptions. Every line, every point we covered. Yes or no? Every point literally we covered. Clear? Then this 112A, 111, all that. Finally, one point is a reference to valuation officer. This is a section which is used by assessing officer. Okay, this might be asked for MCQ or theory question. This section is used not by the SSC. Remember, this is used by assessing officer. There are some circumstances where assessing officer may refer a scenario, either consideration or cost of acquisition, wherever market value logic is involved. For example, if cost of acquisition, if for asset, what is the cost of acquisition for the asset which is acquired before 1/4/2001? Actual cost or market value, whichever is higher. Yes or no? Their market value logic is there. So now look at the assessing officer may refer valuation to valuation of a capital asset to valuation officer. Suppose if the value showed by the assessee, claimed means showed, varies significantly from market value of the asset as per AO opinion. SSC showed value of the asset, cost of acquisition something which is market value. According to assessing officer, this much market value not there that time. I know very well. He felt like that. Then he can refer to valuation officer. Now when he will refer, there is a threshold. You can't refer just 10,000 rupees difference is there. You can't refer it. For look at, if the AO believes that fair market value exceeds amount claimed value by more than 15% or 25%, whichever is higher. Like minimum 15% should be there. Minimum variation must be 25,000. Minimum variation must be 25,000 amount or 15%. SSC showed 10,000 rupees market value, and here assessing officer thinks cost of acquisition value is 20. The variation is 10k, which is 100% variation. Even though 100% variation, the difference is only 10k, not exceeding 25. Therefore, don't refer to valuation officer and waste his time. Okay, it's a petty case. Okay, or if AO consider the nature of the asset or circumstances to justify reference, he felt that it is better always to take an opinion from valuation officer. He felt that time he can refer. Now what fair market value? Fair market value, it may be either sale consideration or it may be either cost of acquisition as on 1st April 2001. When he can refer, if he thinks the value shown by the SSE as per registered value or market value, whatever SSE showed, that value according to assessing officer is something different by more than 15% or 25,000, whichever is higher, then he can refer. Clear? That's it. Entire capital gains is over. Entire capital gains is over. Are you confident? Yes or no? That's it. Easy. That's it. Okay, and I told, right, capital gains entire chapter right now it is applicable for May 26, September 26, Jan 27. I will upload this in YouTube completely. Whatever the number of hours is there, I will upload this fully on the YouTube also, this capital gains chapter. You can watch it whenever you want later. Okay. Okay, fine. Some illustrations are pending. That's okay. I will finish right away. Okay, what are there? Illustration 12 is over. Then what are there? Tell me illustration. From reverse you tell me. 4, 5, 6 only pending. 7 is there, no? Look at. Examine with reasons whether the following statements are true or false. Alienation of residential house in transaction of reverse mortgage under scheme notified is treated as transfer. No. Alienation means attachment, nothing but false. It is not transfer. Such alienation of transaction reverse mortgage is not read as transfer. Zero coupon bonds are bonds of eligible corporation held for 14 months will be long term. True. If it is more than 12 months, it is capital asset. It's a long term. Yes or no? Zero coupon bonds means a bond on which no payment or benefit are received or receivable before. True. Easy. Next. Yeah. Mr. Abhishek is a senior citizen, mortgaged his house with a bank under reverse notified mortgage. He was getting loan from the bank in monthly installment. He did not repay the loan on maturity and hence gave the possession of house to the bank to discharge his loan. How will the treatment? Are fully exempted. So, reverse mortgage transaction is fully exempted. Alienation, that too you are getting monthly amount, lump sum amount, that is also exempted under 10 subsection 43. Yes or no? In which of the following situation capital gain tax liability does not arise? Mr. A purchased gold in 1970 for 25,000. In 25-26 he gifted to his son at the time of marriage. Gifting to gift 49 subsection 1. 47 gift will not taxable. So as per 47.3 gift of capital asset by individual is not regarded as transfer. Therefore capital gain taxability does not arise. A house property is purchased by Hindu undivided family for 20,000. It is given to one of the family member at the time of partition. Nothing is taxable. 47 partition, distribution of capital asset in partition, total or partial by HGF. Mr. B purchased 50 convertible debentures of 40,000 in 1995 which are converted into equity shares of 85. Conversion is not a transfer. M held 2,000 shares in company ABC Limited which is Indian company. This company amalgamated with another company XYZ Limited during the year 31st March. Under the scheme of amalgamation, he was allotted 1,000 shares of the new company. The market value of the shares is higher by 50,000. Oh, new company shares market value higher. Assessing officer proposed to treat it as transfer and want to tax 50,000. Any transfer of shares to the shareholder of amalgamating company in a scheme of amalgamation is not a transfer. So in the above example, transaction is squarely covered by exemption. Therefore, AO treatment to tax is not justified. Over. Yes or no? 100% capital gains chapter is completely over. Easy. I know I was little speed in the last 45 minutes, when I'm explaining, but I already covered them in depth in the problem solving time. When I'm discussing the original concept, everything in depth I covered. Only reading part I briefly discussed. Are you clear? That's it. Capital gains is over. Let's begin income from other sources.